So let's begin professional ethics. Professional ethics and liabilities of auditor. In ethics, we have discussion in 4 parts. In ethics, we have total discussion in 4 parts. One is ethical principles they talk, which are like general principles of ethics, like what are fundamental principles, what do you mean by independence, what are threats to independence, how to safeguard this independence, like that. Some principles of ethics they talk. And there are some provisions related to CA Act. Remember, many students consider this code of ethics, principles of ethics is second category, third category chapter, and they don't. The second C category questions they think, and then they won't even study. Last 3 attempts, you found a question on concept. For example, in the last attempt, May 24, confidentiality, one of the sub point is asked. That before attempt, they straight away asked what are the fundamental principles. When the question is so easy, then also student can't handle. Because since it is easiest topic, you would have never read. He will write something and come that time, though he is very good at that concept. So you must be able to handle the easiest topic as well as the toughest topic. Both you must be prepared for. So that's why don't neglect anything. Last attempt what they asked, confidentiality provision is there, right? In this confidentiality, the 6th point they asked in the May attempt, 4 marks question. What are the factors auditor should consider? What are the factors in deciding whether to disclose confidential information? What a CA has to consider? So this is the answer. Now immediately some of you might conclude, since it came last time, this time it won't come. Foolishness. No. If paper setter changed, obviously it will come. So it will never be like that. Institute will never set the question paper like that. Remember this point. Never be with that attitude. So I'll discuss this principles of ethics straight away. And one is general principles of ethics. Another one is CA Act provisions were there. Like how to apply membership to the institute. What do you mean by certificate of practice? What do you mean by deemed to be practice? Can I open a branch office? Like how should I run my practice? Like that, some provisions are there. Then we have, in the CA Act itself, we have a concept of membership of the institute. Then they are talking about types of misconduct, like how many ways a professional can do a misconduct that results in disciplinary action by disciplinary committee. And these misconducts are broadly classified into so many subcategories. They have given a misconduct for people who are in practice, people who are in service, people who are otherwise. We'll discuss that, don't worry. We'll discuss one by one. And we have council guidelines. For example, what logo can we use? How many audits we can do? How many tax audits we can do? Like that, some guidelines were given related to our practice. Then we have some recommendatory self-regulatory measures. Self-regulatory measures. These are all just recommendatory. Like what are they? For example, how much fees I should charge? There is a recommendation by ICI, minimum charge this much fee. For drafting a partnership agreement, charge 15,000 they are asking. In reality, 500. So for drafting a partnership agreement, ICI is asking you to charge 15,000 rupees depending upon the location where the firm, city. Firms are divided into 3 categories, type A, type B, type C, depending upon the city where they are situated. So depending upon where you are operating, that much fee you should charge. That's only a recommendatory. That's not mandatory. If it is mandatory, it's good. But that's only recommendatory. Big Four, no? They charge the fees by showing this to the client. If the client negotiates, they show this. See, this is the amount that we are supposed to charge. This much service we are doing, all that. Now, when you are setting a practice, office, it's okay. Take loan, no problem, nothing wrong. Some students, some people will have, I should never take a loan. Take loan, no problem, but ensure that you repay it. That is the most important thing. Take a loan, make your office wonderful. Even if it is a small room, the moment client enters, his pressure should go off. You see, if you have any problem in health, you go to government hospital, it will increase more. You go to a Apollo hospital, the moment you enter into hospital, that smell, aroma, everything, yes or no? Automatically you will get half confidence. And the moment doctor touches you, that's enough. I'm talking about the same gender doctor. Okay. Yeah. Yeah. So that is also okay. Always culprit. Fine. So generally that feel. So if a client comes, he should feel that whatever fee you ask, he should pay. So your ambience should reflect that. Fine. Anyhow, we'll discuss all this, combining all this masala and all we'll discuss. So what are the fundamental principles? Not much focus. Integrity. Integrity means what? Straightforward and honest. In business and professional relationship, you must be straightforward, and you must not associate with reports which contains false information, where information is furnished recklessly, which omits information where that omission is misleading. You should never associate with report that contains misleading information, that contains omissions which are material. So you should never associate. You should be straightforward. And see, you can associate with these reports. Even materially misleading reports also you can associate, provided you give a modified report on that. You give a modified report on that. The second important principle is objectivity. Remember, these are all principles common in every profession. Doctor, lawyer, CS, engineers, everybody, this is a common principle. Objectivity. You must not compromise. You must not compromise in your business based upon any conflict of interest or undue diligence, undue influence. Like you must not be influenced by caste, color, race, religion, nothing. You should not influence by anything. Unbiased attitude you must have. Then relationships, where bias or undue influence will be affected, where you are biased in a relationship, in a client relationship, business relationship, maximum as much as possible avoid it. Maximum, please avoid the relationships that create any conflict of interest. That's about objectivity. Sometimes I'll ask you a 4 marks question. Write about integrity and objectivity. I'm telling you, 90% of the students write only first point. The second point they can't even think. Getting it? Because they never pay attention to this. You should not associate with the reports that are containing false information, that are recklessly furnished, that are omitting an important information. However, if you are giving a modified opinion, you can. Objectivity. You should not compromise because of bias, conflict of interest, undue influence. This point everybody will write. Second point they will not write. Relationships that create these situations must be avoided. This point many won't write. You're getting now where you will not miss, why many will not get full out of full marks is because they write correct answer but not complete answer. Next, competence and due care. One of the moral responsibility for you is you must be competent enough. And in fact, when we are accepting any client relationship in SQC, we have seen the auditor has to check competence. The auditor has to check competence, capability, availability of time and resources. Yes or no? The objective is to maintain professional knowledge and skill based on the latest and updated technical professional standards. You must discharge the works competently with the latest information that is available. And competence is 2 types. One is getting that competence, maintaining that competence, learning income tax, updating income tax year to year. Both are competence only. It is your moral responsibility. By the way, does it mean you have to know every act, every law that a CA deals generally with? No. With respect to the client, whatever you are performing the work, that work you must know. A doctor may not be aware of all the surgeries, but he must be continuously, he must be very competent in the surgery which is going to perform in the afternoon. Correct? So, serving clients and employing organization with competence requires sound judgment in applying knowledge. Maintenance requires continuous awareness and understanding. I recommend you to read once ICA annual report. ICA will release every year annual report. Now the 23-24 annual report, somewhere now they will be releasing probably. Annual report of ICA. You read that, in that annual report 2 sets will be there. One is Hindi version and another English version. You open English version, you will find so many things which ICA is doing for creating opportunities for members. So you will get an idea what ICA is exactly doing, what facilities we have, what are the resources ICA is giving. So you will have a complete idea of how to use the ICA. You will understand that. Institute is telling how you can use it and make money out of it. We are not reading it. Getting? Next, confidentiality. And of course, in this point, no, two elements are there. One is competence, another one is due care. Care means what? Diligently you have to perform. Skill, care, diligence. Skill is competence. Care and diligence means the way you are performing the work. You must perform, you must serve the client carefully. You must not casually give any conclusion. You must not casually give any reports. You have to verify thoroughly the evidences and give opinions or conclusions. That's why you see Schedule 2, Part 1, Clause 5, Clause 6, Clause 8, Clause 9. All of them are dealing with what? Obtaining sufficient appropriate evidence and then give opinion. Without getting evidence, you give opinion. Professional misconduct. Correct? Huh? Wherever appropriate, the auditor, the accountant shall make the client aware of inherent limitations. Wherever appropriate, as an accountant, we must tell our client what are the limitations that we suffer from in these works. And another important ingredient is confidentiality. You must maintain confidentiality of the client information. Like clause number 1, part number 1, schedule number 2. Dealing with confidentiality. A CA in practice is prohibited to disclose information belonging to the client unless a permission is obtained from the client or when there is a requirement under the law. And in that there is a discussion about IT returns, IT fact, income tax. Some discussion is there, we'll discuss later. So you're prohibited to disclose information of the client. Which client, by the way? Present client or past or future? Everyone. Every client. The confidentiality requirement you have to satisfy even after completion of the engagement. Correct? A professional accountant should refrain disclosing information without authority from the client unless there is a legal requirement. The professional shall maintain confidentiality even in social environment. Means you should not even tell your client data to your relatives. Maintain even after the end of relationships. Under what circumstances you can disclose? When there is a requirement in the law or when it is permitted by law and authorized by client, or it is mandatory. Requirement under law, mandatory, both are same only. Okay. Professional duty, or you will have to disclose it because of the professional duty you have. For example, peer review is conducted, quality review is conducted, some inquiry is going on from the regulatory authority, or there is a standard where you have to comply. In order to comply, you have to disclose this data to others. Then also you can disclose. In all these cases, when there is a requirement in law, when the client has authorized and the disclosure is permitted by law, or when there is a requirement under peer review, quality review, or some technical professional ethical standard, or some investigation going on by regulatory authorities. In all these cases, you can disclose the client data. They'll ask you, write about confidentiality, under what circumstances the principle of confidentiality can be overridden. Getting it? Now, what are the factors you should consider? Suppose if a situation comes, should I disclose this or not? Think these principles. What are they? Whether interest of any party is affected. By disclosing this, will anybody affect? Whether all the information is known and substantiated. Before I disclose, I must have a concrete evidence that this information is correct. The client information, whatever I'm going to disclose, I must have an evidence that this is correct information. The type of communication expected and to whom it is addressed. Like to whom you are addressing. Like suppose if some regulatory authority sent a mail. Please send this data belonging to the client. Just because requirement in law is there, requirement from regulator that you can't directly confirm whether the recipient is correct or not. Once you confirm that the recipient is a legal and regulatory authority, then send the information. Whether parties are the appropriate recipients. So the same address. One is confirming the regulatory authority. 2, recipient is the right guy or not. So these are all the factors. This was asked for 4 marks question in the last attempt, May 24 attempt. Nobody predicted. But before that attempt only they asked fundamental principles. That could be a reason you could have at least focused on this, right? Last time they didn't focus. Because that time people would have told this and all won't come every time, this time only it came. Again the next attempt it came, confidentiality. So never be with these assumptions. Any question can come, any subtopic might come. If at all you can't study full syllabus, take some 2 or 3 big chapters and leave it. Some 2 or 3 chapters you select and leave it. Remaining you be 100% perfect. Well, the logic is very simple. In every chapter, ignoring 30% is risky. Ignore 30% of chapters, that is less risky. Getting it? Digital audit, SDG. You feel digital audit is tough. Digital audit is 60 pages chapter. Almost in this book, condensed book itself, 45-50 pages. It is there, 60 pages chapter. Weightage is 5 to 6 marks. Within that 60 pages you revise, study, you can revise all standards on auditing, So that's now standards on auditing weightage is 35-40 marks. Whereas digital audit weightage is 5-6 marks. Which is better for you to revise? Standards. Digital audit plus SDG, Sustainable Development Goals, put together 100 pages syllabus. And what is the weightage from that? 10 to 12 marks. That's why I always keep them at last. Because digital audit first understanding is also difficult. SDG comprehending that is also difficult because most of the content is completely memory oriented. You're getting it? So reading that, revising that is very challenging. Instead of that 100 pages content, revise 100%, 100 pages of standards, where you will get perfection, where you can score damn sure marks. So that's why select some 3 or 4 chapters like this, ignore them completely. Remaining chapters, revise and revise and revise until you become perfect. Go and write the exam. 80 marks if you write perfectly, you will get 60 plus for sure. That's it. Next. And one more important ingredient is professional behavior. What is professional behavior? You shall not engage in any employment occupation that impairs integrity, objectivity and reputation. Yes or no? Like recently this case happened in Nagpur. A CA is performing stunts in the car. Getting it? CA is performing some illicit affair, okay, in the car. And backside sticker is there, CA sticker. Media channel highlighted. A CA is doing something in the car with his girlfriend. Getting it? That's the news. No, it became a hot topic. India Today, Times of India, everybody only showed that as if there is no other article. So they showed this. So don't put CA sticker behind your car. Next. Fine. This was there, you saw this. So now instead what they did, they sent a notice to them. They sent a notice to that CA and banned him. Like you are bringing disrepute to the profession by using qualification even at illegal affairs. Getting it? Some other things. Next. The professional behavior. When you are marketing or promoting yourself, you should not bring profession into disrepute. Professional accountant should be honest and truthful, should not exaggerate the claim, should not make disparaging references, should not advertise against advertisement guidelines. Like I can file, many articles do this. Their principal clients, they do negotiation. Why you're paying this much fees, sir? I will do for half fee. Yes or no? Many articles who entered into practice, if at all, they were very successful within 3 years. The risk factor is this. The principal should immediately see this. That's why we have in clause number 6. If at all principal related clients, yes or no? Like if one CA introduced you a client, and if at all that client is approaching you, you should take the previous CA permission and then take up. I'm not talking clause number 8. By the way, that's a different scenario. That's communication with previous audit. That's a different scenario. In clause number 6, there is an example. Original work emanating from the members, introduced by another member from a client. You should always ask your previous auditor, whoever previous CA is, because he is the one who introduced the client, and you are grabbing him now. His business is taken by you, right? So clause 6 very clearly says that's an indirect solicitation. You are treated as guilty of professional. I say will entertain these cases. I say if at all that fellow, that other member went and complained, my article took my client away, I say will punish you. They'll suspend your COP. You're getting it? Of course you can do without COP. That's a different issue. But your name will be highlighted. Next. Conflict. Suppose, these are all fundamental principles that you have to comply, right? Any of the fundamental principles, if a conflict arises, means a situation arises where you cannot comply with fundamental requirements. For example, you have to be independent, right? One of the fundamental requirement is objectivity, which means independence. Independence is required. Suppose I'm doing audit of, suppose a company approached me. In that company, my relative is having shares in that company. Conflict is there. See whether you can put a safeguard. Safeguard means what? Relative can have shares, but up to 1 lakh face value permitted. Yes or no? But already my relative is having more than 1 lakh face value. See, can you eliminate that? I asked him to sell. They are not selling. I should withdraw from the engagement. I should not accept that. If they are eliminating, if they are reducing the shareholding, so that the conflict is resolved, I can accept it. So when there is a conflict with the independence or conflict of interest is there, try to avoid that conflict. Try to eliminate that conflict or reduce it to an acceptable level. So whenever there is a conflict, no, discuss with the client, discuss with the employing organization if at all you are a member, like member in service. Discuss with top management. If you still have doubts, discuss with institute. Even if you didn't get resolved, discuss with lawyers. So there are many threats that are creating, especially like the code of ethics for professional accountant as per IFAC identifies 5 types of threats. So first of all, identification of threats. These are all threats that affect independence. Self-interest threat, self-review threat, advocacy threat, familiarity threat, intimidation threat. Advocacy threat is where generally many have confusion. Advocacy threat means very simple. Whatever the client is saying, you are saying okay. You are supporting the client to such an extent. Suppose the client is having some litigation. You have to verify whether the litigation results in a contingent liability or provision. You cannot support the client and say argue. You should be unbiased. Advocacy threat indirectly says if the auditor is not biased, if the auditor is unbiased, then there is an advocacy threat. If auditor is biased towards client, supporting the client's logics, everything, even though in reality there is no such substantiation, that is when advocacy threat is deemed to arise. Like that's why they give you this example. Advocacy, acting as an advocate on behalf of assurance client, where you are providing assurance to a client, there you are acting as an advocate for him, like you are supporting him, you are defending him at some court, you are defending him at some arbitration process. Generally this creates advocacy threats. Lobbying in favor of legislation on behalf of client, promoting shares in a listed company of the audit client, promoting shares of that company. For example, the company went for IPO, you are sharing in Telegram, Instagram, everywhere, the client is coming for IPO, please subscribe. You are also sharing and you are the auditor of the company. Getting it? You should not do this. These are all treated as what? Advocacy threat. And self-interest threat, all that I hope you are familiar with. I'm not repeating. Familiarity threat also you are familiar with, yes or no? Intimidation threat. Intimidation means what? Either threat of replacement or bribing. Bribe or blackmail. Both comes under what? Intimidation. So auditor has to check whether these threats exist or not. Threats will be there for sure. See whether are they within the acceptable level. Acceptable level means what? Some threats we can measure. For example, self-interest threat can be measured. If I have a loan in the company, up to 5 lakhs it is permitted. Measurable, that threat is measurable. So is it within the acceptable level or not, you can check out and then proceed further. So if at all, if it is an acceptable, so how do you know whether it is acceptable? By the way, you please perform reasonable and informed third party test. You please take up reasonable and informed third party test. So take a third party test, you will get it. Next. Now address it. Okay, after taking the third party test, I found there is a threat to my independence. How you have to do? What you have to do? Either bring it to an acceptable level or eliminate it if possible. If bringing to an acceptable level and eliminating is not possible, you don't accept that engagement or withdraw from the engagement if at all already accepted. Compulsory withdrawal. When compulsory withdrawal, there are some threats that can only be addressed by declining the relationship, declining the activity. There it is not possible to continue. What if I myself have shares? You are getting it? And my demat account is blocked to sell the shares. So it is not possible to accept the audit. With having ownership in the company, it is not possible for me to accept the audit. So decline the engagement. There are some threats that can only be addressed by declining the engagement. Clear? All these are important, I'm telling you, because definitely they may test it. Senior citizen paper testing, he will test this only. He will not test class numbers and all, he will test this only. Independence concept, students, badipanga illa, they will be testing like this only. Next, compulsory withdrawal. Compulsory withdrawal from engagement. When you have to compulsorily withdraw? If, of course, that's what. If elimination of threat is not possible, you have to compulsorily withdraw. Now, there are safeguards. To eliminate these threats or to reduce the threats to an acceptable level, some safeguards were implemented. Some safeguards has to be implemented. The safeguards are broadly divided into 2 categories. Actually, in your ICA book, it is only like they didn't give any such category. In the old scheme ICA book, it was given as a 2 categories, firm-wide categories, threats, engagement-specific safeguards, just like that. In the new scheme book, they didn't put that breakup. Safeguards we should implement, right? What are the safeguards? One, firm quality control policy should address how to address the threat. That's a safeguard. Like if a firm has established quality control policies where the partners have to check independence, ethical requirements before accepting, that's a safeguard or not? That's a safeguard or not? So that we can eliminate the threat. Assigning additional time and qualified personnel to ensure that engagements accepted are proper, whatever. Assigning right people so that competence can be complied with. Competence requirement can be complied with. In this threats, in this safeguards, any 5 points of your choice. In the entire thing, any 5 points. They may ask you this question. In order to eliminate the threat or in order to overcome these threats situation, the firm has to implement certain safeguards or the auditor has to implement certain safeguards. Give you examples of safeguards. Any 5 points. Any 5 points. NOCLAR I covered already. When I'm discussing SA 250, applicability of NOCLAR I spoke. What is applicability of NOCLAR? For listed entities, you are doing audit. Then it is applicable. For listed entities, you are working as an employee where you are a senior professional accountant. Correct? Where you are a senior professional accountant. Senior professional accountant means you are a director in the company, you are an officer, you are a senior employee who can influence and make decisions regarding various things in the company. Senior professional accountants refers to nothing but key managerial persons. They are all senior professional accountants. For all of them, NOCLAR is applicable provided the company where they are working is listed entity. Correct? In this NOCLAR versus 250, there is a high possibility for this. And applicability of NOCLAR. Right now I said no applicability of NOCLAR. This first point. These are the two important questions in that. They will ask you this question also. Write about examples of non-compliances with laws and regulations. How many ways this NOCLAR, non-compliance with laws and regulations, are divided? How many types? They have divided the non-compliance with laws and regulations into following types. It may be fraud, corruption, bribery, money laundering, terrorist financing, security markets, banking, data protection, environment protection, public health and safety, tax and pension liabilities, what not. NOCLAR is very wide. Every law that is applicable to the entity, if you know that there is a non-compliance, if you are an auditor of a listed entity, you must report to respective legal authority if at all there is a requirement. Remember, NOCLAR is applicable only when if the law has a requirement that I should complain, then only I should complain. Correct? If I don't have, if the law is silent about reporting by auditor, if the law is silent about reporting by those charged with governance or key managerial person, if the law is silent on that, I need not report. NOCLAR is not applicable. When NOCLAR is applicable only when there is a requirement on the accountant of the company or requirement on the auditor of the entity that if any non-compliance they identified, they have to report. If that reporting requirement is there in the law, only it is applicable. I told this when I'm discussing 250 as a continuation to 250. I told already. Remember that? That and all is not that important. Now membership of the institute. Membership of the institute also in this membership certificate. There will be COP membership certificate. Like you have a student card, right? In SSP portal we can download member card. So member card will contain what? Name, address, residential, professional, date of birth, date of taking the membership, date of taking COP, if at all the person is in practice, full-time practice or part-time practice. Correct? And how many articles registered under them? That only in membership register details will be there. Whatever details there in the membership register only, member card will be contained. Whatever details about student, the ICA have, registers have, the same only student card will reflect. Disqualification, this is important. When a member is disqualified, not attained the age of 21 years, nothing but completed years. You must complete 21 years age. Only then you are eligible to apply for the membership of the institute. He is unsound mind or undischarged insolvent, means insolvency proceeding is still going on, or he is discharged insolvent. He is discharged insolvent means he is discharged, he is declared insolvent, but court gave him a certificate that he is an innocent default. Court gave him a certificate that he is a innocent default. If you have not obtained that certificate, a person is discharged insolvent but not obtained that innocence certificate. Innocence certificate means what? That insolvency was caused by misfortune without any conduct. He became insolvent because of the circumstances happened around him. Not intentionally he defaulted. Getting the point? Such a kind of certificate court gave. He is eligible to apply even though he is a discharged insolvent. Suppose he is discharged and insolvent and court did not give this innocence certificate. Court did not give. It means he has manipulated people around and stolen some money, cheated people, and that's how he became insolvent. Then court will not give certificate and he is disqualified. And if at all he has been convicted by a court of an offense involving moral turpitude or of an offense involving that is of not a technical nature offenses are different. Okay, technical offenses means probably when we are complying our duty, some offense might have happened, but it has to be proved that intentional. If it is proved intentional, generally that comes under again moral turpitude. If at all you intentionally manipulated client financial statements, intentionally you are involved in manipulation process, then that comes under moral turpitude. You are getting the point. If at all client financials are materially misstated, you couldn't figure out, generally that comes under not technical nature. It's actually debatable. That's actually very lengthy topic. Technical nature of it. Technical offenses means what? Non-technical offenses means what? That is very high. Offenses which are not of technical nature. Offenses which are not of technical nature. If at all any court convicted you of an offense which is not technical nature, you are also not eligible to apply for membership. Or if the name is removed because institute found you are guilty of professional misconduct, your name is removed, then also you are disqualified to apply membership. See, this is disqualification, by the way. This is what? Disqualification. In order for you to apply membership, if you have to apply membership, what are the disqualifications? Means if you are suffering from this, you cannot apply for membership. One, you were removed from the member's name because of misconduct. You should not apply the name of the you should not apply for membership of the institute again. Until the punishment is over, you should not apply. 2, you were convicted by court of an offense involving moral turpitude or an offense that is not of technical nature, or you are discharged insolvents and have not obtained a certificate that your insolvency was caused by misfortune. You are undischarged insolvent. You have not attained the age of 21. You are unsound mind. When all these cases, the answer is yes, you cannot apply for, you cannot apply for this membership of the institute. You cannot apply membership. See, there is another question, under what circumstances name will be removed? This is what, your name is already in the membership. You are already in the membership, but in the following cases your name will be removed. When a member is dead, a member from whom a request has been received for removal, a member who has not paid fees, a member who has been affected with disabilities. Disabilities means what? The above section we have seen. If a member is affected with disabilities, see some of them, suppose a member is already sound mind, later he became unsound mind, so then his name will be removed. A person is normal, he is not insolvent and all, later he became insolvent. See, that's why this section is disabilities as well as disqualification. Unsound mind is a disability, insolvent is a disability. One is physical disability, mental disability, another one is legal disability. You are getting it. Insolvency is a legal restriction. Generally in CA contract law also you might have studied, a person who is insolvent cannot enter into any contract. He is incompetent to contract. Yes or no? Section 10 of contract law. Something. Next. Then we have membership. Then we have membership concept. Are you clear until now? Removal of members. Suppose like removal of members, I have another provision to discuss. Sometimes we have to pay every year. Suppose once you qualify, you have 2 options, either 3 options technically. I always say 3 options. 1, doing some business, family business, whatever. 2, related to the profession you qualify. That you can either take up employment or you can take up the practice. If you want to take up the employment or practice, institute is asking please have membership number, because many companies are asking membership number for employment. In campus interviews also they are asking membership number. Having membership number is different. Having COP is different. Membership number means you are a member of the institute. By qualifying CA, you will not become a member of the institute unless you get a membership number, 6-digit membership number right now. So you have to get a membership number of the institute, and that's how you become a member. Now the membership of the institute is 2 types. The members are classified into 2 types. FCA, ACA and FCA. That I will discuss little while later. Now you have to pay, right? In order to get membership number, you have to pay some fees. Initial application fee will be there. Annual membership fee will be there. Some benevolent fund fee that and all ICA is collecting. If you pay that membership fee, then you will be getting membership number, provided you are not subject to disqualifications. You will get a membership. If you do not pay membership fee, for the renewal, every year you have to pay. Every year you have to pay membership fee. For ACA, the annual fee is different. FCA, the annual fee is different. For a member who is in practice, annual fee is different. Not in practice, annual fee is different again. So many classifications. We pay membership fee, COP, for a financial year. Suppose I took membership somewhere in January month. Up to March only that membership is valid. Getting the point? Again, for the next year, April starts, you have to pay membership separately. For every financial year, you have to apply membership. If at all tomorrow you want to apply membership somewhere in the month of March, don't apply. Because only 20 days it is valid. And generally when you are applying for membership number, you are at the initial stage of employment where your money will be little lesser generally. So don't waste that money, 8,000, 9,000 membership fee. Getting it? So March month, February month, just think if it is so necessary, only apply. Otherwise, April month you register, you pay. So full year, that entire membership will be proportionately, it will be there. Again, once March completed, next year you have to pay membership. What is the due date for payment of membership fee? September 30 of the respective financial year. Right now the financial year is what? 24-25. For this year, I should pay membership by September 30, 2024. I did not pay. What is the consequence? My name will be removed. My name will be removed from the records. Now it is automatic, I think. Now it is automatically they are removing. You will get a mail. Your name is removed successfully. Getting it? So your name will be removed. Now can I restore it? Pay membership, pay additional fee, pay condemnation, some fees and all is there. Pay all that and then I will restore you. You know this restoration has a logic. If you pay the penalty everything by closure, 31st March. Like generally 30 September you have to pay for this year. Sorry, you did late. If you pay by 31st March at least, by end of the financial year, I will restore you with effect from the date of removal. With effect from the date of removal. In that sense, break-in service won't be there. In the sense, for becoming FC, there is a condition that 5 years of continuous practice. 5 years of continuous practice. Suppose I am a member of the institute, 4.5 years completed. I have to pay membership fee now actually. For this year, 5th year membership fee I have to pay. I forgot to pay. And March is also over. Then in the next year, April I paid. Membership will be restored from April month. Membership will be restored from April month. This year membership is stopped by September 30. October 1st onwards membership is removed. Again membership is restored on April 1. Now again I paid membership fee, another 6 months completed. Totally 5 years I completed, but not continuously. In between 6 months break is there. You will be disqualified for FCA. You will be disqualified for FCA. That's why paying membership is very. Why this point is there? Effective from the date of repay. Effect the membership fee. Whatever, if you pay membership fee lately, within financial year, membership will be restored from the date of removal. Means typically if I see as a whole, removed on the same day, restoration also same day. Means there is no break. Correct? Why that provision is? For this only. Only if a member who is in continuous period of 5 years practice, only for him FCA will be given. If at all 5 continuous years he didn't complete, freshly again 5 years continuous period will be counted. 5 years will be counted freshly every time. Understood? Break-in service should not be there. So from this, what is the concept? Restoration. What is the effective date? What is the effective date for restoration? If the application for restoration, removal, both are in the same year, what does it mean? In 24-25 financial year only removal happened. In the same year you applied for restoration. Then restoration will be with effect from the date on which it was removed, which means there will not be any break-in service. In articles also, suppose you took termination. You took termination. 109 you filed, for example. Let us assume you took termination on 29th October. 30th October itself you enrolled with another firm. Only 103 you pay, you filed. If at all you enrolled as per the records 1 day late, you should file 102 once again. Right now I am not sure. The same forms are? Forms, numbers are same. Just that they were electronic. Hey, same only. Okay. Electronic. Just that they were electronic. I received one article related thing. He submitted complete certificate. I should approve it. Fine. I mean, in our firm, no. Though I'm a sleeping partner. So, but the firm is carrying. So that one. So break-in service there also it will come. If break-in services are 1 or 2 form has to be filed. Same logic, similar logic. Break-in service should not be there. If you don't want to break-in service, please pay the membership within the end of the financial year at least, along with penalty, all that. Suppose no, if a member name is removed in a disciplinary action. In that case, no, here your name is removed not because of non-payment of membership fee. You are removed because of the disciplinary action. Then from which date restoration will be? Order will decide. The disciplinary order will decide. I will show you disciplinary how that works. I will explain briefly. Any other case, restoration will be with effect from the date on which application along with the fee is received. Any other case means what? For example, removal happened in 1 year, restoration happened in the next year. Application is made in the next year. In that case, what is the rule? From the date and when you applied for restoration, from the date restoration will be coming. Suppose if the restoration application is made in the same financial year, then restoration will be from the date of removal. This is for membership restoration. What about COP restoration? Same provision. That is again separately discussed, but same provision is applicable for even COP restoration also. Confident until now? We'll discuss about COP and further topics in the next session. You're all confident until now? Ethics will be super entertaining, I'm telling. Like completely we discuss about real practice, like what we do, what they are telling. And there is a definitely misstatement between these two. Yeah. So we started discussion regarding this membership concepts, where we understood disabilities of a member, or when a member is disqualified, when a person is disqualified to apply membership, or when a member will be disabled, so that his name will be removed from the register of members. And we also have seen under what circumstances a name of the member will be removed from the register. And I also spoke about restoration, correct? Now, the types of the members, there are 2 types. The moment you qualify and apply for membership, you get a membership number, you are recognized as ACA, Associate of the Institute. Once you completed 5 years program, once you completed 5 years of practice, you will be treated as what? Fellow. You are treated as a fellow of the institute. These are all Britain terminology. Associate, fellow, all that is a Britain terminology adopted from that. So an associate member who has been in continuous practice for at least 5 years, then he will be treated as what? A fellow chartered accountant. Further, a member who has been associate for continuous period not less than 5 years and has experience equivalent to experience normally acquired as a result of continuous practice, he will also be treated as what? FCA. Like, what does it mean? See, you see this sentence. Who possess such qualification, who possess such qualification as prescribed by council, that he has experience equivalent to experience normally required as a result of continuous practice. Like if you have 5 years continuous in practice, you are an FCA. That's agreed. What if I am working in an audit firm? What if I am working in an audit firm as an employee? Same, whatever partner is doing, I am also doing the same. Practice work only I am taking up. Just that I don't have COP. If at all I am not having COP for 5 years, will you deny me from getting FCA after working 5 years in a firm? No. Even if you work as an employee under an audit firm for 5 years or more than 5 years, that is also treated as what? In practice. That is also deemed to be in practice. So whether you work in Big Four, whether you work in audit firms, in all these cases, when you're working continuously for more than 5 years, if you're working, it is treated as if you are in practice and considered for the purpose of COP calculation. Clear? Then now this is penalty for falsely claiming to be a member. Suppose you're not a member, but you're claiming yourself as a member of the institute. All the CA students who are saying CA so and so, yes or no, without qualifying in Instagram, social media, everywhere, getting it. So you're all liable under this class. You're liable to pay 1,000 rupees on your first conviction. Subsequent term 5,000. Your monthly stipend you have to pay. Getting it? So penalty for falsely claiming to be a member. So not a member, but represents that is a member of the institute. Uses designation as a chartered accountant. So, and one more thing here, you don't have COP, but you are saying that you are in practice. Even for a member who do not have COP, but saying that he is in practice, for him also penalty is leviable. You are not a member, but you are claiming to be a member. You are not having COP, but claiming to be a COP. And there is in Schedule 2, one more thing is there. Schedule 1 or Schedule 2. Okay, I didn't remember, but I'll show you how I'll remember. Getting it? While explaining to you how to remember cumulatively the clauses, I will show you. As of now, at this moment, if you ask me, do you remember? Barely I remember few. Maybe I have to stress little bit. I'll recollect everything. But let us do that exercise of remembering all the clauses with the provisions. Cumulatively, let's understand that. Fine. So, there in the Schedule 1 or Schedule 2, one clause is there which says that you are not an FCA, but you are claiming as an FCA. You are not an FCA, but you are claiming it as an FCA. Schedule 1 offense it will be, for sure. Why? Because in Schedule 1 only it is dealing with what? Schedule 1 only it is dealing with professional practice. It is not dealing with serving claims. Like how to recognize this, I will tell you a technique. How to recognize that particular clause. First of all, you must have studied that. So I feel it is Schedule 1, and this is generally for everybody. This provision is applicable not just for who are in practice. Schedule Part 3 will be the provision which is applicable. Inside that, a member who is not an FCA but claiming to be FCA, some clause number is there. Part 3 is having totally 4 clauses. I think 4 clauses. Part 3 Schedule 1 is having how many? 4 clauses. In that one of the clause number 1 or 2. 1, you see, yeah. Like I just applied backward. I'm just thinking logically and applied, discover the, clause. If I strain little more, I'll discover the right clause. You're getting it? So I'll tell you the technique, how to discover the clause through a backward thinking approach. Okay, next. It is just that a struggle in mind. That's it. You have to struggle. If you struggle your brain, it will come out. So that's it. Then write about CA in practice. You cannot practice without obtaining COP. First of all, what do you mean by a practice? You are deemed to be in practice if you satisfy the following definition. You are deemed to be in practice if you satisfy the following criteria or following definition. They have given a definition. When a member is deemed to be in practice, so that he has to obtain certificate of practice. When a member is deemed to be in practice, so that he has to obtain COP. If at all you are not deemed to be in practice, you need not get COP. You're getting the point? You're not deemed to be in practice. As per DTP definition, you're not covered. You need not get COP. But if at all you're doing any of this, whatever activity that you're doing, if it is being covered under deemed to be in practice, you have to get COP, you have to pay annual membership fee, you have to obey the council guidelines, schedules, all that. Whatever respective schedules that is applicable to you. Correct? So when a member is deemed to be in practice, a member is deemed to be in practice either individually or in partnership, where consideration is received or to be received, means you are charging consideration. A member is deemed to be in practice if the member is charging consideration for what? For engaging in practice of accountancy. What does it mean, accountancy? Accountancy means, practice of accountancy means chartered accountancy, or you are claiming to the public, you're exhibiting yourself to the public that you are some statutorily eligible accountant. So practice of accountancy has a wider meaning. It includes auditing. Practice of accountancy includes auditing. Practice of accountancy include making books of accounts for the client also. Practice of accountancy includes preparing books of accounts to the client also. Practice of accountancy. Remember, we have a practice, PRACTICE, not SE. Certificate of practice, CA in practice, CE at the last. It's not SE. SE is a verb. CE is a noun. Practice is a noun. Practice is a verb. Getting it? So practice means it's a license. It means it's a license. A doctor in practice, a lawyer in practice, a CA in practice, engineer in practice. It's a license actually. Practice dictionary meaning is what? It's a license. An eligibility to do certain activity is called a practice. Now, so you are engaging yourself, you are engages in practice of accountancy, or you are performing auditing, verification of transaction books, accounts, records, or you are preparing or verifying certification of accounting and related statement. Remember, even preparation, even if you are doing compilation engagement, you are deemed to be in practice. Even if you are offering yourself to prepare books of accounts of others, you are offering services to prepare books of accounts. Even you see, or you are doing verification services. Verification of what? Accounts, records, financial transactions, or you are holding yourself out to the public that you are an accountant. Remember, not everybody who is telling who is publicly saying that he is an accountant becomes a deemed to be in practice. When you are deemed to be in practice, when you are a member of the institute and making an exhibit explicitly, you are expressing to the people that I am an accountant, I am an accountant. Accountant here means what? Chartered accountant. You're getting it? Accountant means you're what? Chartered accountant. You are exhibiting outsiders that you are an accountant. Tell me, when you are a CA and you are exhibiting that outside that you are an accountant, I am ready to offer accounting services, I'm ready to offer verification services. By default, people think you have license, correct? By default, don't you think that you have a license? For example, there is a doctor who did not get COP, but established a small clinic, and he is using the qualification MBBS, MD, all that. Don't we think that he is having a license, active license? By default, we think that. That's why it's called deemed to be in practice. Are you getting the point? Logic is very simple. What you are doing, if at all it appears to the public that you are offering some license-oriented services, we will license it to you. Means you have to obtain the license. You are deemed to be in practice, get license. Means what is the license for CS? COP. That's it. Next, or not only that, you are rendering some services or you are providing some assistance in matters of principle, in accounting, procedure, detailing, or financial facts and data, certification, recording, presentation, certification, or rendering such other services which council thinks that only a CA in practice can do. What do you mean by council? Council is nothing but the ICI. You know, we have an ICI. There is something called central council. There is something called central council. Just a minute. So I'll just show you briefly, if at all you don't have an idea. Suppose I'll show you like see, you see this is the ICI site, right? You see here committee, or else here you will find so overview. In this overview, the council is there. So we have totally 5 regions council and nominated members. Totally ICI is having 40 board of directors. Simply speaking, council members are nothing but what? Board of directors. ICI is having totally 40 council members. Out of them, 8 were nominated by Government of India. Remaining 32 were elected. For example, from southern region, 6 members were elected. Few are from Hyderabad, one is from Vizag, and 2 are from Chennai, 1 is from Kerala. Like that, from southern region, 6 members were elected. For western region, some number will be allocated. For eastern region, some number. Central region, some number. So totally 5 regions: north, east, west, south, and center. So totally 5 zones. And all these members are what? Monitoring overall ICA decision making process. They are the supervisories of ICA. That's why they are called a central council member. Central means not a member coming from central region. Central council means what? Main member, like overall. In ICA, there is a 3-level architecture. Central council, where they monitor overall ICA decision making process. Regional council, where they only focus on southern region, eastern region, western region, SIRC, WARC, EIRC, NIRC, CIRC. These are all regional councils. Again, they will have branch level management, like Chennai branch of SICASA, Cochin branch of SICASA, Thrissur branch of SICASA, Vizag branch of SICASA, like that. So this is 3rd level management. So where their duty is only related to that branch. Southern Regional Council, SIRC, their duty is related to only Southern. Central Council as a whole. Now within the Central Council, election will be happening from every region. Representatives will be there from every region. Same, whatever federal structure we follow in Government of India, whatever federal structure, same federal structure is being implemented in ICI. Clear? Yes. Now, I'll just show you. Like you might have understood some various committees, right? You might have understood about Accounting Standard Board, Auditing Standard Board, all this, right? They're nothing but what? Non-standing committees of ICA. They're nothing but what? Non-standing committees of ICA. You see, Accounting Standard Board, Auditing and Assurance Standard Board. Auditing and Assurance Standard Board is the one which will issue auditing standards, which will design, participate in development of auditing standards, all that. What are they actually? Accounting Standard Board means what? What is Auditing Standard Board? What is Tax Audit Review Board? What is Peer Review Board? They are nothing but these committees. These committees are formed based on whom? Council members. Just like in a company, board of directors will form risk management committee, board of directors only will form audit committee, board of directors only will form finance committee, board of directors only will form CSR committee, corporate governance committee. Yes or no? Same way, ICA board of directors will form multiple committees where each and every committee will look into exclusively that affairs. One of that committee is Accounting Standard Boards, which we know. One of that committee is Auditing and Assurance Standard Board, which we know in Accounting and Auditing. Yes or no? They are nothing but committees of ICA. They are nothing but committees. They are non-standing committees. There are 4 standing committees. Standing committee means permanent bodies. Non-standing committee means where they establish for a particular purpose. Once that purpose is fulfilled, the committee will be withdrawn. Suppose Auditing and Assurance Standard Board is there. That's a non-standing committee. That's not a permanent body. But still, it has a permanent in nature because continuously they will be evolved, right? Standards and all will be evolved, right? So, though it is not a permanent body, its nature is permanent. Now, you see, like committees, like you will have many a times council committee discussions, all that, right? Standing committee means this only. Disciplinary committee, executive committee, finance committee, examination committee. Examination committee is what? Conducting exams for you. Finance committee is nothing but dealing with ICA finance matters, all that. Executive committee dealing with entire board of studies, total ICA, operations, everything like that. Next. So that is what council means. So a member shall be deemed to be in practice if at all he, in his professional capacity, remember, not in personal capacity, not as an employee. In your professional capacity, you are acting as a liquidator, trustee, executor, administrator, arbiter, receiver, advisor, representative for costing, financial and taxation. This is most important. Even if you are providing representation services for costing, financial, taxation matters. If you are providing representational services for taxation matters, you are deemed to be in practice. Representational services. That's why many a times at clause number 7 related provision, you will see this word. A member shall have no other capacity except as a member of the ICA. You might have heard this word. A member shall have no other capacity except as a member of the ICA. Like you are providing representation services, right? Generally, when you are eligible to provide taxation representation services, you're only eligible to provide only when you are having COP. Only when you are having COP, you are eligible to provide representational services. On representational services, we have some practical questions where it says like, the auditor has submitted some information to income tax authority or tax authority or GST authorities based on the information given by the client. And the information is completely wrong. Fact, false information, completely false information. Still he submitted to the department. Is the CA treated as guilty? This is a question. Generally what we think, we apply clause number 5, clause number 6. We say that a material fact known to him failed to furnish to the the concerned authority. That's what we generally apply. But what the answer says, representation services, you are just acting as a representative of the client. Whatever clients gives you, you are just giving it to the income tax authority, where you are acting as a mediator of the client. Therefore, you are not held guilty. That's the answer. We have 2 practical questions. One illustration we have in our normal ICA book itself. One previous year examination question this was asked. Generally, when we see this question, we are tempted to conclude that yes, submitting false information knowingly is a guilty of professional misconduct. So, like this, what are all the crux point were there? Like I will be reminding you. I'll be reminding you whatever those crux points at the respective clause. Fine. Are you clear until now? Or remember, you are deemed to be in practice in one more scenario. You are taking up appointment made by central government or state government or a court of law or any other legal authority, or you are acting as a secretary. You are acting as a secretary. Recently in the May 2024 exam, somewhere in the RTP or MTP, this question was asked. Secretary related point they have asked. The CA has been appointed as a secretary. by so and so. So that too, this is what, clause number 11 linked. Clause number 11 linked. For this, generally, when appointments made by government, no, you need not take separate permission. Appointments made by statutorily, you don't require any separate permission for that. Are you getting it? But remember, you can take this appointment if you are taking up this appointment in your professional capacity. In your professional capacity, then you are treated as what? You are deemed to be in capacity. You are deemed to be in practice. What is professional capacity? Because you are CA, this appointment came. Because you are CA, this appointment has come to you. Not because of otherwise. Because you are a chartered accountant and well known in the market, credibility is there. Some issue is going on in some very big listed company. You are appointed as a secretary for that company by the central government. Because you are a CA, that is called professional capacity. Are you getting the point? So, which means if you are using your qualification and getting something, you are deemed to be in practice. Simple logic. Deemed to be in practice means what I say says is, if you are using your qualification, which the membership of the institute which is granted to you, you are using that and procuring business in your professional capacity, you are deemed to be in practice. Whether you procure this work for accounting, auditing, representational services, arbitrar, liquidator, whatever it is, I am not bothered. You are deemed to be in practice. Now, we have this question. We have this another question. Can a member who is in practice, can he provide management consultancy, other services? Suppose I'm in practice, I'm a CA having COP. Can I provide consultancy and other services? Absolutely, no restriction. Absolutely, you can provide. Consultancy and other services is something that anybody can provide, not necessarily CA. Anyone can provide. For example, working capital management services. There are many portfolio working capital management related. Many startups were there where they are saying we will manage your working capital. We will give you time to time finance decisions, everything that you have to take. There are many startups. Applications were developed. Who are they? They are not even CS. Anybody can provide consultancy services. Anybody can provide other services. Only those services which are statutorily required to be performed by chartered accountant, others cannot provide. Are you getting the point? For example, internal audit. Anyone can provide. Anybody can be an internal auditor. In many companies, MBS were there as internal auditors. There is no qualification requirement. Section 138 does not prescribe any qualification. A company shall appoint internal auditor. Qualification can be any. At the end of the day, you must have audit skill. That's it. I will get audit skill only if I study CA course. Huh? No. Even otherwise, I can audit the books of accounts. If at all I know how the books of accounts, how the company functions. As simple as such. So, entire consultancy and other services I've highlighted with red color key points. Okay, I have highlighted with red color key points. You just read that later, the list. I'm not reading the entire MCOS list. I'm just giving you an idea what confusion generally you will have. So, CAs in practice, can they provide consultancy and other services? Absolutely. Suppose you are only providing this, you are a member, but you're only providing this. Will you be deemed to be in practice? No. If at all, whatever services listed out here, any of the services that are listed out here, if at all any of that service comes under DTP definition, then only you are deemed to be in practice. Otherwise, you are not deemed to be in practice. Then what is the significance of MCOS definition? The significance is very simple. Even if a member who is deemed to be in practice, even if a member who is in practice, can they provide consultancy and other services? Yes, they can provide. For example, what are consultancy and other services? They gave a list. What is not a consultancy also? They gave a list. This is important. Consultation, management consultancy and other services shall not include statutory, periodical, audit, tax. Representation services is also not treated as what? Consultancy service. Advisors concerning tax matters. If you are doing an advisory, tax advisory services, it is not MCOS. You are acting as liquidator, trustee, executor, administrator, receiver. You are not treated as providing consultancy. When they are excluding certain items under consultancy, they don't come under consultancy. They all come within the DTP definition generally. They all come within the definition of DTP. Deemed to be in practice. These services will come within the definition of deemed to be in practice. So what are they? Statutory audit, periodical audit, representation services. Representation means what? Direct tax, indirect tax, or even costing, finance matters, advisors on tax matters, acting as various roles. All these items you will not be treated as, they will not be treated as consultancy and other services. Which means these services, who can provide? Only a CA having COP can only provide. Because all these services comes under within the definition of deemed to be in practice. The moment you provide any service, being a member, the moment you provide any service, and if it falls within the definition of deemed to be in practice, you must obtain COP. You must obtain COP. I just want to open an office where I want to put a name board called my name and below chartered accounting. Can I use it like that? Yes, get COP and use it. Get COP and use it. The moment you put an office, you are publicly showing that you are practicing indirectly. Do that kind of activity only after getting specific license from the institute. Without obtaining COP, if you are practicing, what is the penalty? 1,000 rupees first time, subsequent time 5,000 rupees. Clear? Not just penalty. Sometimes it's a Schedule 2 offense because you are violating CA Act, CA guidelines. The institute can reprimand the member, can even levy up to 5 lakhs. The penalty can be levied up to 5 lakhs. That's it. Now, and one more class of chartered accountants, another class of CAs, they are also treated as deemed to be in practice. What you know? A CA in practice or a firm of, an associate or fellow who is a salaried employee. Suppose if I'm working in an audit firm, I am also treated as what? Deemed to be in practice. But the thing is, I won't get COP. But when I'm obtaining COP, to determine whether I am an AC or FCA, the period which I worked in this firm is also counted. Correct? The period which I worked in the firm is also counted because the work experience in the firm is treated as equivalent to the practice experience. That's why. Not only that, there is one more service which is counted. If you are working in armed forces, Navy, Airways, all that, Army, yes or no, you are working in armed forces. So long period that you are working in armed forces, that is treated as deemed to be in practice. Suppose I became a CA and out of my passion I went to army for 5 years and I came back. Now I want to apply COP. I will directly apply for FCA. The so long 5 years I worked in armed forces is treated as deemed to be in practice. It is treated as deemed to be in practice. Nothing but it's counted in what? COP calculation. To encourage people to work in armed forces, these kinds of benefits will be given. Getting it? By working in armed forces, they should not lose certain eligibilities outside. That is the reason why people working in armed forces were given age relaxation, various other benefits. So, now the question, one more question is, okay, I understood. What is deemed to be in practice? We understood. When a CA is providing these services, is deemed to be in practice, he must obtain COP. Further, we also understood that a CA can provide, who is in practice can also provide consultancy services. We understood what are not included in consultancy, which are coming under DTP, which only CA with practice can provide. Consultancy can be provided by the way, anybody, not necessarily CA. When it is open to anybody, it is obviously open for CAs in practice also. That is the reason why they gave clarification, correct? Now the question is, to the same company where I am doing audit, can I provide these consultancy and other services? Remember, consultancy and other services are nothing but non-audit services. They are nothing but what? Non-audit services. Can I provide to my audit client? Can I provide to my assurance client? Non-audit services, non-assurance services, you can provide. Unless it is prohibited under Companies Act 144 section. In Companies Act also you have a word called management service. Management service means what? Directorship service, KMP service, key managerial person service. Those are called as what? Management service. This is what? Consultancy service, means it's a supportive service to the management. They are not direct managerial services. Management service is nothing but managerial services. Understood? So to the same company can I provide? 144 section you need to comply additionally. Except the services listed under 144, any other consultancy services, any other services you want to provide, you can happily provide to the audit client. Only one requirement. Council guidelines says fees charged for other services shall not exceed fees charged for audit to avoid self-interest threat. Correct? To avoid self-interest threat, fees charged for total other services shall not exceed fees charged for audit. To the same audit client, if at all you are providing other services, audit should be the primary motive for you. Audit independence should not be affected by other services. If you are getting fees in other services so much, if there is a threat comes from the client of intimidation, you will compromise in audit because you are getting more fees for other services. That's why what auditors do, they take a bill in the name of audit. So they provide other service. Other service they give discount. Audit service they add premium. Simple logic. This is reality. Next, are you clear? All of you. Next. One more condition is a company cannot engage in practice. A company cannot engage in practice. What do you mean by a company cannot engage in practice? You cannot practice in corporate form. Corporate form you can establish. Sir, can a CA firm, all the partners, can they establish a company? They can establish. Can they be a whole-time director in a company? Yeah, they can be. Can they be a managing director? They can be. Provided that company is exclusively providing management, consultancy and other services that are listed here. Not any other activity. Manufacturing, trading activity is not permitted. The company is providing just what? Consultancy and other services. That company, can we become a full-time director, whole-time director? Yes, provided the company name got approved from ICAI. Provided you inform ICAI the details of company got an approval. Further, you are becoming whole-time director, managing director, all that, right? At the time of company approval by the ICAI itself, that will be given approval. Naturally, you need not get a separate approval under clause number 11. Are you clear? Very simple. Mine is a firm. I am providing so many services, audit, assurance, non-audit, all that. I want to have only audit and assurance services on my firm name. I want to float another entity where I want to provide all this non-audit services. Can I float such an entity? You can absolutely float. Provide. Now, clause number 11 says what? It's an additional occupation, prohibited, they are saying, right? But council guidelines says corporate form of practice where a member can establish a company, and in that company the member can have substantial ownership. The member can be a director. That is permitted, provided IC will approve it. All consultancy services we will provide in the name of the company. Many audit firms that you see, medium and above medium sized firms, they have a parallel company also. They have a parallel company. Whoever partners are there in the firm, generally they will be directors. That is one of the council guideline, important council guideline in corporate form of practice. No attestation service, no certification service shall be made in the name of the company. Only one condition, attestation, assurance, that alone cannot be done on the name of the company. That's the only condition. That's what here also they're saying. A company cannot engage in practice. In order to do practice, either you must be a sole proprietor individual or you must be a firm. Are you clear? How we can practice, by the way? Sole proprietary means individually in my name I can practice. I don't even take a name of the firm also. Caramharsha is a practicing CA. Enough. Or I can open a firm, Caramharsha and Co, where I am a proprietor. That's called a sole proprietary firm. Or if I take another person as a partner, then I must form a partnership firm or LLP. Yes or no? When I want to have a business name, not my individual name, when I want to have a business name like Caramharsha and Co, Caramharsha and Associates, if I want to have a business name like this, I must obtain firm registration number from institute. I must obtain firm registration number from institute. I don't want to get any firm name, business name. I just want to practice in my own name. Membership number, COP, that's enough. Firm name and all not required. But if you get a firm name, you will have a goodwill. You can accumulate goodwill. You can sell your firm name to somebody later on. Upon expiry of the proprietor, the legal heirs can sell the firm name to somebody. Experience of the firm is there, goodwill is there, that can be sold to another fresher CA, for example. And the fresher CA can continue using the firm name. That is why in clause number 2, clause number 3 or clause number 2, we have this provision. Share of sale of goodwill. There I will discuss. Clear? Next. And one more thing we know very well, a CA is prohibited to use any designation. A CA is prohibited to use any designation. Which CA? Practice. A member in practice is prohibited to use any other designation except the word chartered accountant. When you are using the word chartered accountant, can I use some other designation? You can use some other designation provided the other designations are insolvency resolution professional, registered valuer. Only these two designations you can use. Remaining designations you cannot use. Remember, can I say Ramharsha CA, CMA, CS? Yes, no problem. Because they are not designations, they are just qualifications. Can I use Ramharsha below chartered accountant, cost accountant, company secretary, lawyer? No, because these are all designations. These are all what? Designations. To your name, either suffix or prefix if you put, that indicates actually a qualification. That does not indicate you are in practice. Below, full form you are using generally, that indicates a designation. Full form generally indicates what? Designation. So the institute clearly says through section number 7, you cannot use any designation other than chartered accountant. You cannot use any description in substitute or in addition thereto. Ramharsha chartered accountant, tax expert. It is not permitted. Any other description is not permitted. You're clear? So, can I mention membership of the foreign institute? Absolutely can mention. I can mention CIMA, CIMA. No problem, not an issue, because that's just a qualification you are mentioning, not an issue. Provided mentioning that qualification does not tantamount to mentioning as a designation. Unless it appears like you are mentioning it as a designation, unless it appears like that, you are permitted. So if it is appearing like a designation, you are not permitted. That's the meaning. That's the context of section 7. The same thing is once again highlighted in clause number 7. Clause number 7 is what in part number 1, schedule number 1? A member is not permitted to exhibit or advertise his professional attainments, or is not permitted to use any designation or description in addition to or in substitution of chartered accountant. Correct? All of you able to recollect? Can I mention about directorships of the companies, all that? No, not permitted. You are not permitted to mention anything. The moment you are using chartered accountant as a designation, you cannot use any designation. Even if you are an MLA, even if you are MP, you cannot use chartered accountant, a member of parliament. No, not permitted. Next. So I have given here a few examples. You cannot use certain phrases. They just gave examples. Not just these phrases, any other phrase also you cannot use. You're getting it? Income tax consultant, cost accountant, company secretary, cost consultant, management consultant, like that. However, can I use abbreviations like this? Absolutely. Abbreviations you can use beside your name on the visiting card. No problem at all. Clear? Because mentioning qualification is different from mentioning designation. Like doctors also will have this kind of restriction. A doctor can present all his qualification. IFRS, something, some kind of qualifications will be there. Okay, FRCS, sorry. Okay, FRCS, that's what. Like, so and so doctor, MD, all that MBBS, FRCS, all that. So many will be there. They can mention like that. But below, neurologist, virologist, radiologist, that is only one. Cardiologist, yes or no, nephrologist, only few, I mean only 1 or 2 designations only permitted. They cannot use multiple. Either you can be a neurologist or psychologist, physiologist, or whatever. Only one designation you can. Getting it? Yeah. So provisions related to branches. The point is very simple here. The logic is very simple. See, what do you mean by practice? Generally, you will have an establishment. Physical establishment is what generally we know nowadays. Yes or no? Physical establishment. We know very well we are not permitted to do practice online. Correct? Are we permitted to do practice online? Definitely not. Through a website, can I provide practicing services? No. As of now, the guidelines were not evolved and it is not permitted also. Website should work only on pull mode, not push mode. So many guidelines were there, which makes us, we cannot practice over online, correct? So we can only practice offline. For offline practice, you must need an office. Either your residential, suppose you say my office is my home itself. Okay, that itself, let it be. Your firm name is there, right? Your office name, firm name will be there, right? Name, firm name board. It can only appear at the office, whatever you told. It cannot appear at another place. It cannot appear at some other place. Suppose at some other place also you want to put a name board. Like I want to put my firm name board, Caramharsha & Co. Chartered Accountants, this name. This is a firm name, my business name. This is my business name. My business name I want to put at some other place. Okay, that's called as branch. If you are using it at more than one place, it's treated as what? Branch. Now, can I put a member board? Can I put a nameplate at another place? What is the requirement? First of all, what is the condition here? You can put absolutely, provided for that office a separate CA is there. For that office, a separate CA is available who is in charge. Who is in charge? If this condition is not there, what happens, you know? Name board costs how much? 500 rupees. I can go to every state. I will meet every tax consultant. I will tell him to put my name board. You will get more clients. Yes or no? I can have 50,000 branches in South India. 50,000 branches in South India where my firm name is there everywhere. I can practice like this. If at all such a condition is not there, if at all you are claiming that so and so is your branch, if at all you are exhibiting that so and so is your branch, how do we exhibit that it is our office? By putting the name board of the firm. Firm name board, correct? By mentioning firm name board, we are saying that that's our office. If at all firm name board itself is not there, then that's a different story altogether. If firm name board is given, that's an office. Now, is it the office from you are practicing? No, I'm practicing from some other office. That's your main office. This is then branch. Can I have a branch like this with just where I mentioned the name board? You can have it, provided another chartered accountant is heading that. Another chartered accountant is heading that. Nothing but there must be a separate in charge for that. Like who should be that? Either he must be your partner or he must be your full-time employee. Either he must be a partner or he must be a full-time employee who is a chartered accountant. Having membership number. Who is a member of the institute? Nothing but. Who is a member of the institute? Either a partner of your firm or employee of their firm. If any of them are acting as in charge for that branch, then you can have any number of branches. I don't have objection. Because there is a direct one CS supervision is there. Profession of accountancy is a personal in nature, correct? Yes or no? It is something like personal in nature. You cannot provide, in the absence of you cannot run practice without your presence. Only with your presence only practice can be done. Only with your presence only assurance can be provided. If this condition is not there, every CA, once he get little financial status, he will buy the name boards of the firm and put across India at all tax consultants office. Happily I can say I have branches across India, 10,000 branches I have. Name boards, how much it will cost? Correct? Is this a risk or not? So institute is avoiding this risk by prescribing the condition that if you want to have a separate branch, another branch you want to open, have a separate in charge. Simple. Now, separate in charge is not required if at all I have premises, if at all I have another office, if at all I have another office within the same city, within the same building, or within 50 kilometers from the original office. Let us call the first office which you declared, no, the first office which you declared to ICA, no, let us call that as head office. From the head office, if at all another office is located within 50 kilometers from not this office, from the city municipality limits, from the municipal limits of the city or town, cantonment board, whatever, from the city outskirts, nothing but limits. Suppose Chennai Metro Development Authority, CMDA limit will be there. Sorry. CUDA. Chennai or Metro Development, correct only. Correct only. CM? Okay, whatever it is. Chennai Metro Municipal Authority will be there, right? Correct one, I think. CMR is CMDA is correct one, I think. So, Chennai Metro Department will be there, right? City, I'm talking about municipality. Whatever that municipal limit says, from that limit up to 50 kilometers, you can have a branch without an in charge. Why? The logic is very simple. I want to open a branch in the city, the rents are so high. So I went to outskirts, you can say. Up to 50 kilometers, you can have no problem. Can I have a branch in Tanjavur and say, can I have a branch in Cochin? I say, I don't have premises in Chennai. That's the reason I opened in Cochin. Daily I will travel up and down. No, you can't, yes or no? So their intention is not proved. You're getting it? Up to 50 kilometers from the city municipal limits, I will consider it as single office. No problem. Within the same building, you have 2 offices, I will consider. Within the same city, you have multiple offices, not just 2, multiple offices. It doesn't require any separate CA. You have 100 within the Chennai, no problem at all. 1 CA is enough in charge. But the moment it is more than 50 kilometers, it is not possible for you to monitor both of them directly. So there must be a separate CA who should monitor that. That's the logic. Understood? Over branch office provision. Now, when do we say a member is in charge of that branch? A member should either reside at that place. The place wherever I say branch, there the member should reside minimum 182 days. Or he is attending the office minimum 182 days in a year. Or in some other circumstances, establish active association. Nothing but member is not attending daily. He is not staying there. He is always in the outstation audit. More than 182 days on behalf of that office is in outstation audit. That's okay. That is also treated as what? Active association. Clear? So a member is deemed to be an in charge. I mean, a member is deemed to be an in charge. 182 days he attends that office, or in the same city is residing for 182 or more than 182 days, or in the opinion of the council, it established, it ensures that you are actively associated with that. Then you are compliant. Understood the logic of the provision? That's it. Now, a member, for a member, who is actually practicing in hill area, Ooty, Kodaikanal, Munnar, yes or no? If a member is practicing in hill areas, temporarily he has so many clients at the plain. Temporarily he has so many clients at the plain areas. Temporarily can he open in the plains the temporary office without a separate in charge? Can he open without a separate in charge a temporary office in the city of plain? Yes, you can, provided your original practice is in hill area. Provided your original practice is in hill area. You can have a branch in a plain, means normal altitude, whatever, yes or no, normal areas. You can have a practice, provided the temporary office duration shall not exceed 3 months. Generally, this was given, here they use winter all that. Before commencement of winter, you should submit the institute. When are you opening temporary office? For how long you're going to keep? After closing the office also, you have to submit to the institute that you have closed the temporary office, all that. Winter, that under logic is used generally because the filing season is what? June, July, August, September. The filing season, July, August, September is, technically speaking, is a winter season in India. So that's the reason why they use the word winter. Are you getting it? Before commencing this, you have to inform the institute that you're opening. After office is closed also, you have to intimate that the office got closed. Now, can the name board be present? Can the name board be present? Name board can be presented of the individual. Like my name board I can use in my residence place, no problem. Firm name board I cannot use. The moment firm name board is there, it's an office. The moment firm name board is there, it's a branch. Simply speaking, it's a branch. Unless you are practicing at your residence, you cannot use firm name board. You cannot use firm name board. Only your member board you can be used. Simply Caramharsha Chartered Accountant. It's a member name board. Firm name board means what? Caramharsha and Co. Chartered Accountants. It's a firm name board. Are you getting it? That cannot be used at place of residence. If at all residence is not listed with ICA website as a practice place. Clear? Suppose if at all no, in a same city you have multiple offices. You need to declare. When it is simple, if a member is having multiple offices, you should declare which is head office to the institute, so that entire communication will be going to that particular head office. That's it. Now, member in charge must be there, right? What should be which member? Can I put my friend as an in charge? No, he must be of course he must be a member of the institute, he must be a partner of the firm, or he must be an employee of the firm, associated with the firm. Remember, whenever I recruit a CA as an employee in my office, I have to file a form with ICA that this fellow is working with me. Just like how articles form and all we file, we just file it. Therefore, in the institute database, in this firm, how many CAs are there? Partners, paid assistants, whatever, how many CAs were there? This is relevant for panel, empanelment in bank audit, empanelment in insurance and all these cases. Clear? That's it. Now, disciplinary procedure. Disciplinary procedure. You have a website called ICI. You can simply search this was file a complaint on CA. File a complaint on CA. Some initial 3 links you will get. Disciplinary committee website, DISC ICI. DISC ICI, some website is there like this. Inside that you have to pay 3,500 rupees and file a complaint on a CA. Now institute will take up the case. The moment you file a complaint, no, disciplinary directorate, he will get a pop-up notification. Yes or no? Your complaint received, new complaint received. Prima facie complaint, whoever complained, no, he will be putting some facts and evidences. No, prima facie, after seeing the evidences, he will say prima facie, is it guilty or not guilty, he will see. Prima facie, by looking at the information, by looking at the facts. Suppose some innocent fellow did, CA is rashly driving the car. Suppose, the CA sticker is there behind, he is driving the car so rashly and he is putting evidence, all that. Maybe the council may not react on that, discipline director may not react on that. So prima facie they may decide that it is not guilty. Suppose if at all that particular complaint was given by a very big media channel owner, then they may consider it as guilty because he is bringing disrepute to the profession. Yes or no? Because of his actions, he is bringing disrepute to the profession. So prima facie guilty. Then he should decide, will it come under first schedule guilt or second schedule? If it is first schedule, he should place the matter before board of discipline. If it is otherwise, disciplinary committee. Remember, first complaint will be received by disciplinary directorate. Then it will go to the committee. Second schedule means higher level. In a company also, director lower level, committee is higher level. Correct? Same logic. Disciplinary director will receive some complaint, and if at all depending upon first schedule, entire board of discipline will look into. If it is second schedule, much more severe offense, it will go to the committee. It will go to higher level, which is committee. Then board of discipline, they accepted looking at the fact. They investigate. And if at all the member was found guilty, yes, reprimand means warn the member, give a warning, remove the name for a period of up to 3 months, impose a fine up to 1 lakh. Suppose disciplinary committee received this second schedule complaint, conduct inquiry, found guilty, give warning to the member, remove the name for whatever duration it think fit, and impose fine up to 5 lakh. What is the difference between first schedule and second schedule offense? First schedule dealing with the offenses in conduct of your practice. Second schedule dealing with the services provided to the clients. Tell me where the severity will be high. If a third party is affected because of my negligence service, if a third party is affected, that severity is very high. That's why second schedule offense. That's why second schedule talks about breaching confidentiality, giving report without evidence, giving report without containing material facts and all. Some third party interest is affected because of the offense you did in part 1 schedule 2. I put name board of my firm name at so many places without IC. Is there any third party which is affected? No, third party is not affected. It is against institute code of conduct. That's it. Here institute, you and me only affected, not others. Clear? That's it. Then, and once suppose if a member is aggrieved by either disciplinary committee order, board of discipline order in case of first schedule, second schedule offense in case of disciplinary committee, the member can go for appellate authority. The member can go for appellate authority. That's it. Write about types of misconduct. Write about types of misconduct. I already told professional misconduct, other misconduct. 2 misconducts. Professional means what? Those misconducts that arise in profession. Because of your professional negligence, these are arising. Other misconduct, they are not related to your profession itself. For example, I told Nagpur case. I told corruption cases. CA involved in so and so. All that. So your qualification, because you are using qualification at some other places where it doesn't require, and there you are doing something nonsense, and institute caught that, you are bringing disrepute to the profession because you are a CA. Even media channels, they won't highlight the name, they highlight the profession. A doctor is indulged in so and so, CA is indulged in so and so, lawyer is indulged. So people will see more. That's it. Why? To comment that educated brute. Below they want to comment educated idiot and the madri. So no, they see, you see. In the social media now there is a new word called netizen. Have you heard of this? Citizen illa, netizen. Netizen, they only react in net, not otherwise. So I'm proceeding further. Can I? Yes. Actually, before I said part 3 we have 4 clauses. No, it is 3 clauses. So right now my state of mind is like I'm half remembering the clauses, half remembering right now. Once when I'm discussing with you, I will explain you how to remember all the clauses simultaneously along with you studying them. Getting it? Yes. So schedule 1 deals with all offenses that are primarily dealing with conduct of affairs, conduct of practice, conduct of business, conduct of employment. Whereas schedule 2 primarily deals with third party. Third party is involved in your activity. A third party is being affected. That is schedule 2. Schedule 1 has a clear breakup for when a member in practice is deemed to be guilty, when a member in employment deemed to be guilty. Service, member in employment is treated as member in service. Member in practice is treated as CA in practice. It is defined as what? CA in practice. Second part, it is defining as member in service. Third part, generally, whether you are in practice or otherwise, there will be some misconducts which you do in profession. Other misconduct, something not related to the profession, you did some misconduct. So first schedule answers that. Second schedule, no, member in employment, a member in service, there is no separate part. That is why part 1 directly practice, part 2 generally for all members, generally whether in practice or not, and part 3 other misconduct. In the last one, part 3, there is only one misconduct, okay, where imprisonment is exceeding 6 months. Last one, schedule 2 part 3 other misconduct. When that will apply? When a member is punished with imprisonment or transportation for a period more than 6 months. What is transportation punishment? Sometimes the punishment will be banishment from the city. Getting it? You are banished, you are banned from the city, which means you have to compulsorily transport to another city. That's called punishment of transportation. What is it called as? That's called punishment. Or you may be held in custody at some other place, not in the city where you are living. You are in custody at some other place altogether. That is also treated as what? Punishment of transportation. Imprison means nearby prison, whatever is there you will be generally kept. So that's called imprisonment. If a member is punished with an imprisonment for a period exceeding 6 months, that's a severe guilty. In the Indian Penal Code, Criminal Code procedures, most of the imprisonments are less than 6 months, which are not that severe. Severe guilty, severe moral turpitudes, they only have punishments for more than 6 months. If you did something more than 6 months, that's a severe thing, something you have done. So it's a schedule 2 offense. If it is not exceeding 6 months, it will come under what? It will come under schedule 1, part number 4. Okay, part number 4 has 2 clauses. Clause number 2 is dealing with imprisonment. Clause number 1 is dealing with a member is bringing disrepute to the profession. A member is dealing with disrepute to the profession. Just to once open, is that clause number 1 correctly? Clause number 1 only? Don't guess. I'm asking you to see and tell. Clause 2, clause 1 imprisonment, then fine. Yeah. Now make memory mapping. Clause number 1 and part number 3 also clause number 1 only, and it has only one clause. It has only one clause. Let us call clause number 1 only. In part number 3, schedule 2 other misconduct, part 3, in that clause number 1 is dealing with imprisonment. Part number 4 of schedule 1 first point also dealing with imprisonment. The only difference is there it is less than 6 months, here it is more than 6 months. In schedule number 1, there are 2 other misconducts. What is other misconduct? Something not related to profession, but because of which CA profession is being damaged. That could be the reason, right? Other misconduct, the same only drafted. A member is treated as guilty of other misconduct if his conduct is bringing disrepute to the profession. Yes or no? See, they didn't define what exactly he did. They defined saying something you did that is bringing disrepute to our profession. Then also I will treat you as what? Other misconduct under schedule number 1. In schedule number 1, other misconduct is dealt under the last part. Schedule 1 last part is what? First part is practice, second part is for service people, third part is for both of them, fourth part is for other misconduct logically. So one logic you establish, that will be enough. And part 4. Now the same in part 3 schedule to imprisonment only it is dealing with more than 6 months. Now you see other misconduct, you will remember the clause numbers. Yes or no? Clause number 1, imprisonment. Here also clause number 1, imprisonment. There clause number 2, bringing disrepute to the profession. Here there is no clause 2. That's it. Easy. Next. Now let us look at generally. What is it? Let us look at generally. When you are treated as misconduct generally. When you are treated as misconduct generally. Here, no, part number 3. Schedule 1, part number 3. It has 3 clauses. It has how many? 3 clauses. We completed just now the last part. Now we are going to the last but 1 part. Okay. Schedule 1 has part 3, which is dealing with the members' misconduct generally, whether in practice or otherwise. What are they? Just once I will see. Once I will go through that. What's the page number? This also let us remember. 1. Yes. Now, first schedule, part 3. It has some misconducts. It has some misconducts which is applicable for every member, whether you are in practice or otherwise. In that first clause is saying what? You are not a fellow, but acting as a fellow of the institute. ACA acting as FCA. Now remember, you can become an ACA just by applying membership. Even if you are not having COP, you can claim yourself as an ACA. And you are acting, pretending yourself as an FCA. FCA who can do? Who can pretend? Only when ACA is in continuous practice of 5 years and after obtaining FCA certificate, you can pretend as an FCA. Correct? Otherwise you cannot. Now, so clause number 1, part number 3, first schedule. Every time don't remember the entire sentence. If you try to remember entire sentence, clause number 1, part number 3, first you will do mistake. Only when it is necessary to write, only recollect entire this. Otherwise, just remember the clause and part. Don't remember the schedule. Don't recollect. Schedule remembering is easy, right? Technically, schedule remembering is easy, right? So don't recollect. Only when you're writing answer, try to recollect. So right now I'm dealing with what? General misconduct under first schedule. General means for practicing and non-practicing members. First clause what it says? You are not an FCA, but you are pretending as an FCA. You are treated as guilty. Clause number 2, what it says? You are failing to supply information called for or does not comply with the requirements of, means you are not complying with these requirements, you are not providing these information. Either you are not providing information, you are not complying with the requirements of the various committees. So there are so many committees where there are so many requirements. Means suppose director discipline asked you to attend for some hearing. You are not complying with this requirement. It will come under clause number 2. Now tell me, in all these cases, requirements, are they only for practicing people or are they for general also, normal people also? Normal also. So clause number 2, part number 3, which deals with a member not giving information to these people or a member not complying with the requirement of these people, these committees, either the institute, council, all that. You are not giving them or you are not complying with them. Now you see schedule 2, part 2. Schedule 2, part 2. Inside that, this is clause number 2, part number 3. Schedule 1. Whereas parallelly, I want you to compare clause number 3. Clause number 3, furnishing false information. Correct? Part number 2, schedule number 2. Correct? So that's why I don't want you to think about the schedule because you will confuse. Now you open parallelly part 2 in schedule 2. Inside that, clause number 3, what that clause says? The last clause, what that says? Last but 1 clause. Clause number 3, what it says? Providing false information to the institute, council, committee, director discipline, board of discipline, disciplinary committee, quality review board, appellate authority. Same list. So there it is false information. Here it is no information. Correct? Here you are not giving information. There you are giving false information. Now, just a minute. there itself, clause number 1 you see, failing to comply with CA Act. CA Act, regulations made there under. Correct? Failing to comply with CA Act, regulations made there under. Failing to comply with Act is much more violence, ultra worse. Correct? Failing to comply with Act is much more bigger violence. At least failing to comply with these people orders, that's okay. You can go negotiate with them and resolve. But you failed to comply with the Act itself, the very Act itself. Section 7 you failed to comply. Membership provision you failed to comply. Section so and so 8, disability provision you didn't comply. Demotive in practice, definition you didn't comply. Articles related guidelines were there, your regulations were there, you didn't comply. You are not paying stipend on time to articles, regulations you failed to comply. These are all severe violations, right? Yes or no? These are all severe violations, right? See, if I do not comply with these people's order, that's okay. I can negotiate first schedule, little punishment. I failed to comply with something that is made as an act. I failed to comply, that is something act. That is something a regulation. Directly failed to comply with a regulation. Direct regulation itself I failed to comply. That comes under severe punishment, schedule 2. And in schedule 2, what is the clause answering? Clause number 1. Schedule 2, what is the clause which is answering? Clause number 1. First get the data, then mapping we will do again. So now you see, failing to supply, the clause is here. But if you are giving false information, clause number 2, part number 2, correct? If you does not comply with these, schedule 1. If you does not comply with the Act, if you does not comply with regulations, if you does not comply with Act, if you does not comply with regulations, which clause? Clause number 1, part number 2, schedule number 2, correct? Now if you recollect, schedule 2 has totally 4 clauses. In part number 2, it has totally 4 clauses. One of the clause number 4, I think that is regarding keeping client money with me. Correct? I think one of the clauses is what? Keeping the client money with us. What is that like? Whenever you are receiving any fees from the client or any amount from the client, except fees for service performed, any other amount you received as a pure agent, you must deposit that in a separate bank account. You must not keep it in your own bank account. Correct? Yes or no? You must not keep it in your own bank account. So that is a clause. Clause number 4, part number 3. Nothing but the last clause in second schedule, general misconduct. Generally for all the members, the last clause is dealing with member taking client's fees. Remember, member, I can file IT return even if I don't have COP. I can file IT return on behalf of somebody even if I don't have COP. In that case also I may collect some amount from the client, right? So that logic is applicable for all the members. Third party affected. Naturally, which schedule is applicable? Second schedule. This taking money from client, who can do? Only practicing people. Members also can do, right? So automatically which part? Part 2. Now taking money from the client, kept in a separate bank account. That was the last clause. You should remember like this. Don't remember clause number 4. You know very well that part 3 has 4 clauses. Part 3 has 4 clauses. But which clause exactly dealing with? Last clause is dealing with that. In that part 2, last one is dealing with that. You are getting it? So naturally, how to derive the clause number? Clause number 4. Hey, adana kete. Huh? Just a minute. That's what I'm asking. Clause number 10. Keeping separate bank account. Hey, you will solid up or ipo. Huh? Sorry? What is that? MSME. Embezzlement. Yeah. Just a minute. Okay, fine. Cheating the client. Fraud, making fraud with the client. Small correction once again. That's why I told you 50% only remember. I'm deriving now. You have to help me that. And by the time we complete this, we will remember all the clauses. By the time we complete this exercise, not only understanding the clause, we also remember the clauses. That's why be active, man. You're seeing the book, no? I cannot scroll down like this. Okay, fine. That's it. That's okay. Making mistake is much more indication that you remember much more stronger. Actually, you remember much more stronger. Now I will not forget because I made a mistake in public, right? So clause number 4 and part number 2 that deals with embezzlement. Embezzlement, nothing but theft. Simply speaking, theft of cash. Theft of cash. Theft can be done by any member. Embezzlement of cash. So can one of you, can you read that clause number 4? Or else you read that. You don't have book, you read that louder. That's okay. Enough. Any amount of fraud, I mean any fraud in the form of defalcation, embezzlement of receipt which is received in professional capacity. Client, you are going for audit or you are going for some checking, whatever reason. You are embezzling the receipts, you are manipulating the receipts, or you are informing the client that you have to pay so much of tax, but you have retained some amount as a commission without informing the client. That also comes under embezzlement. Correct? Generally, whatever money you received from client, you should keep it in a separate bank account and use it only for the purpose for which you received it. If you are embezzling it, if you are embezzling or if you are misappropriating it, that comes under clause number 4. Suppose if you fail to keep it in a separate bank account, it comes under clause number 10. Technically, they can make it in a single provision, right? Logically speaking, they can make it into a single provision, right? Yes or no? These are the two where we confuse the most. Embezzling the receipt we confuse with keeping it in a separate bank account. In keeping in a separate bank account, you may have not actually done the fraud, but client money you should keep it in a separate bank account. That's the logic. Once again, can you confirm, is that clause 10 only? Then fine. Again, after half an hour, don't say that. So clause number 10. Whatever money you collected from client, you should keep it in a separate bank account. Failure to keep it in a separate bank account is treated as guilty of professional misconduct for the member in practice. Now, if at all the amount is going to be spent within short period of time, no need to keep it in a separate bank account. Or if the amount is received as a remuneration for the service performed, no need to keep it in a separate bank account. Any amount that you received as a pure agent of the client to remit to tax department, ROC, whatever fees purpose, whatever amount you received, which you have to spend, that amount should be kept in a separate bank account. In the process of this or otherwise, if you are embezzling the receipt, you are receiving, you are verifying cash, you are stealing some money, embezzling receipts. Getting it? Defalcation you are doing. You are producing dummy challans to the client and somehow you are manipulating the cash. Then that comes under part number 2, clause number 4. Until now clear? Now cumulatively you need to read this. Schedule clause number 3. See, for this generally for us part number 1 clauses is not a big confusion. Even part number 1 in schedule number 2 has slight confusion. Because in schedule 2 part 1 will have clauses which are repetitive in nature. The matter is repetitive in nature. There we will have confusion. Part number 1, generally schedule number 1, we are very confident, all of us. Mostly we are very confident. Part number 2, part number 3 in the schedule 1, part number 2 in the schedule 2. This is where most of the mistakes happen. Whereas in schedule 1, the professional misconduct that is dealing generally, right, it has 3 issues. First issue, you are not an FCA but acting as an FCA. Second issue, two complaints were there, 2 problems were there. You are not supplying information called for them, you are not complying with their requirements. Parallelly, if you give a wrong information to them, that's even more severe mistake. If you violate the act, that's even more severe mistake. What are the respective clauses? Clause number 1 in part number 2. Clause number 1 in part number 2, second schedule. Getting it? So in the severe compliances, clause number 1 dealing with what? Not complying with act and regulations. Giving false information is dealt under clause number 3. Clause number 4 is dealing with the theft of cash. Clause number 4 is dealing with theft of cash. But you are taking client money and not keeping in a separate bank account, that is dealt under part number 1, clause number 10. Clear? Money dealing with the client. Dealing money with the client is always last clause in the respective parts. It is always the last clause in the respective parts. Client money you received, kept in a separate bank account. That you failed, part number 1. Client money you're dealing with and you're embezzling it. That's a part number 2, last clause. Part number 2 has how many clauses? 4 clauses in schedule 2. Now in that schedule 2, clause 1 ruled out. What is that clause number 1? Not complying with the act and regulations. Clause number 3 is what? Not giving false information to them. Clause number 4 is what? Embezzlement. What is clause number 2? I think this is regarding confidentiality for employees. Correct? Correct. Confidentiality for employee. Correct. No? Confirm it once again. Again I will freeze my mind. Okay. Yeah. Clause number 2 is what? Confidentiality for employees. Technically, it should be given as a separate part. Guilty of professional misconduct for member in service should be separately given. For one clause, why? That's why they gave it in the part number 2. They merged it separately. Generally, you see schedule number 1 for members in service, separate clause is there. Separate part itself is there. Whereas in schedule number 2, member if an employee a member who is working in a company breached confidentiality, is there any punishment for him? There is no part in the second schedule addressing it. Suppose you see confidentiality breach by a practicing professional, clause number 1, part number 1 is dealing. What about employees? It is there in the part number 2, clause number 2. Don't worry. You're getting the point. It is there in clause number 2, part number 2. Which schedule? Naturally, third party is affected. Schedule 2. You are getting it. With this, it is not over. Now, come back to this. Again here, giving false information to others, not ICA. Giving false information to others. Others means what? While inviting work from another CA, while responding to tenders, while advertising through a write-up or anything as provided, while advertising through write-ups. For example, you are writing blogs. You are writing blogs. A member is permitted to advertise through a write-up. But in that exaggerated claims only should not be there. You can mention that you are so and so firm, you are a partner in that firm, this is the website of the firm. You can just mention briefly like this. You give whatever the article you are explaining, I explain that article, no problem. Blogging is permitted. That's called as what? A write-up. That's called as write-up. Write-up is not that popular nowadays. Getting it? So when you are inviting work from another CA, when you are responding to tenders and inquiries, or while advertising through a write-up, getting it? If at all you are providing false information knowingly, means here you are providing false information not to the committees, not to the ICI, not to the disciplinary director. You are not providing to them. You are providing false information to others while inviting the work, which means it's business related misconduct. Correct? It's business activity misconduct. Correct? So all business activity related misconducts are covered under schedule 1. While providing service to the client, I did something wrong. I did not comply with some standard. I did not comply with some auditing standard. I did not comply with some law or regulation. That all comes under schedule 2. The way I practice my business, the way I practice, how I use my firm name, with whom I can form a partnership firm, how can I share profits, with whom I can share profits, how can I advertise, can I accept a company audit or not, if at all I am accepting, to whom I should communicate. All these are related to what? The way you are practicing. The way you are practicing business affairs. Your firm business affairs. Even this is also, while you are inviting work from others, no, you are giving false promises. You are giving false information while inviting work from others to get that work. Indirectly, business practice. What is it actually called as? Business practice. Giving false information out of business practice comes under schedule number 1. Agreed? Now, that comes under the last clause in general misconduct. That comes under last clause in general misconduct. Professional misconduct, that is applicable generally to all the members. That's what the meaning. Clear? All of you. So this clause applies whether representation is made in, whether the misrepresentation is documented or otherwise, even by acts. Getting it? Suppose if the false information is to ICI, clause number 3 only, that is also. But part number 2, schedule number 2. Here false information, there also false information. Here false information is given to clients while getting work. Prospective clients. There you are giving false information to the institute, committees, disciplinary director, like that. If you are not complying with the CA Act, clause number 1. If you are not complying with the requirements of the committee, clause number 2. Not giving information to the committee, clause number 2, part number 3. Understood? All of you. I think now we completed 3 clauses here. We completed parallelly 4 clauses there. Now one revision I'll do. Very simple. It will be over. Now clause number 1, part number 3, schedule number 1, dealing with professional misconduct, whether by a CA in practice or a member in service. Clause number 1, you are not an FCA but are presenting yourself as a fellow chartered accountant treated as guilty of professional misconduct under clause number 1, part number 3. 2, clause number 2, failing to supply information called by ICI, committees, disciplinary, appellate authority, quality review board. Peer review board is not covered, you see. Why? Committee means what? Peer review board is included. Various committees of ICI means what? 44, 45 committees are there. Accounting standard board, auditing standard board, tax audit board, peer review board, all were covered there. Getting it? Committees covers all that. Quality review board is not an ICI committee. Quality review board is an outside body. Quality review board is an outside body of ICI. That is not part of ICI. Information called by quality review board, appellate authority, disciplinary director, disciplinary committee, board of discipline, ICI, council, committees, institute. Getting it? If any of them you fail to supply information or not complying with their requirements, it's part 1. Sorry, it's a part 3, schedule 1, clause number 2. Giving false information to them. Schedule 2, clause number 3. Giving false information to not ICI, to somebody else. Clause number 3, part number 3, schedule number 1. So part number schedule 1 you should derive logically. Remember, always you should derive it logically. Only clause numbers you are supposed to remember. Worst case, okay, part number. Schedule number always you should derive logically. Are you getting it? That's how we have to store it. Next. See, here no, it is something easy to store because sentences are small. This technique will not apply in auditing standard. This will not apply in auditing standard because here the content is small. Limited content, so easy. We can define it with a single heading. The matters also can be drafted with the heading itself. You can draft on your own, not an issue. Most of the meaning can be derived. Now part number 2 of schedule number 2. 4 clauses it has. Clause number 1, what is it? By the way, again we'll come back in the same order. Clause number 4, some theft, cash theft. Yes or no? In the part 1 also there is a clause which is dealing with client money. But there the issue is you are not keeping it in a separate bank. Just now we completed clause number 3, giving false information to the institute, committees, all that. Clause number 1, not complying with the act, not complying with the guidelines, not complying with the regulations. Clause number 2, not applicable to practicing people, applicable to employee who breached confidentiality. Now I think to some extent remembrance is improved. Yes or no? Once at the end of all the clauses, no, I will repeat. Fully I will repeat. That time you will get much more clarity. Clear? Now you see, we have completed 2 parts in 2 schedules. We have completed 2 parts in 2 schedules. Typically speaking, in second schedule 2 parts is over. Yes or no? In the first schedule 2 parts is over. What is left in first schedule? Part 1 and 2. Let us complete part 2 exclusively for service. Very simple. While getting the job, I should not pay to somebody. Getting it? I should not pay somebody while getting the job. After getting the job, I should not cheat my employer by taking money from somebody, leaking my employer's information. Correct? Leaking employer's information. That is why now here first one is what? For getting job you should not share. First you should get a job. Correct? So a member in service is prohibited to share any of his profits, remuneration, emoluments, whatever he is receiving, he should not share to others. That is the first clause. Correct? sharing to others in first class. So logically what? First you should get a job, right? So in order to get a particular employment, you should not bribe anybody to get. Generally in employment, no bribe will be paid. Once we get the employment, once we receive the salary, monthly we will pay them. Job consulting firms. Okay, you got the job, very good. Now you are in a key role in the company. You have to authorize various purchase vouchers, vendors, all that. You should not take kickbacks. You should not take kickbacks. Clause number 2 dealing with that only. A member in service who is in employment shall not accept any profits or share or commission, by whatever name you call it as, from the suppliers or vendors, service providers of the employer. Agreed? From the employers, service providers, you cannot take. But you know, for a CA in practice, providing audit service to a company, CA in practice, providing audit service to the company. If the client is asking the CA, sir, I want some internal auditor, please recommend. I went to my friend, I said, hey, Macha, I cannot do internal audit because it's prohibited. Can you do internal audit? This much fee they'll pay, give me 10% commission. I went and took a commission from a fellow member. That is permitted for practicing people. That is permitted for practicing people. Why? I am a principal to principal relation, one-to-one relationship. I can have my own terms. But as an employee, you have to be honest with the employer. By definition, you are an employee, you are an agent of the employer. Contract of agency, agent should be complete, honest and truthful to the principal. Correct? So, an employee who is taking referral fee, commission from lawyers, you know, whoever he recommend to their employer, there if at all he is taking referral fee, commission, kickback, whatever name you call, that is prohibited because you are taking unauthorizedly. That is prohibited. Whereas CA, it's an industry practice. Even the client knows that this fellow will charge referral fee. That's an implied assumption. So that's not guilty. Whereas a member, if at all in service did that for the employer, it's guilty. Clear? Clause number 1. For getting the job, I should not share profits from my emoluments, whatever I'm receiving from the salary, whatever I'm getting. At the same time, I should not derive any benefit in the form of kickbacks. I should not derive any benefit in the form of kickbacks. Getting it? Now, understood the concept, right? You have to read that matter later. You have to read the clause so that the technical terminology will be stored. What is that second clause? Can you read louder? Got it. A member of service is treated as guilty of professional misconduct if he accepts or agree to accept any fees, commission, brokerage from chartered accountant, lawyer, or any engineer or architecture, whatever it is, yes or no, for providing services to the employer organization. Within brackets, kickbacks. It's called as what? Kickbacks. Yes or no? So that is not permitted. Clause number 1, can you read that? Yeah, just a minute. Yeah, are you done with that until now? Hello, yes or no? So a member in service pays or agrees to pay, allows or agrees to allow any part of his emoluments that he is getting from the company, from the employer to others, is treated as guilty of professional misconduct. However, can I share to my family members and all? That's logical. That's an exception. Understood? So we completed in the professional ethics 3 parts of first schedule, 2 parts of second schedule. Hardly half an hour we spent. Another 1 hour will complete part 1, part 1 both, and will memorize once as a whole. You see how why you will forget. Because I intentionally did this exercise because I also want to remember. And again I'm telling you, I will forget after 2 days. Why? Don't test you will forget. That's okay. You will forget, obviously. Day before exam you will study, na? Yes or no? That intense revision is enough. In between, before you are forgetting, that's a common phenomena. Even I won't remember. Just now you saw. It's a common phenomena. That's very common. But whenever we are reading, we should revise intensely so that the memory, chances of remembering will be very high. And day before exam, you revise, right? Tomorrow, if you ask me a question, I'll try to remember. And I will also explain you how to derive the clause number slowly. Like sometimes we don't remember. If you suddenly ask me, I won't remember. But if you give me 1 minute time, I'll try to recollect. I'll try to structureize my memory. Getting it? Then I will retrieve it. It will be stored. Retrieval is only difficult. Getting it stored in your mind. So how to retrieve that? We will practice that. All of you? Yes. We'll take a break and get back and finish part number 1. Council guidelines over. Ethics is over. Okay. That's it. And also 1 minute. So let's begin part 1, schedule 1. Professional misconduct for CS in practice. In that, the first point is saying a chartered accountant in practice is deemed to be guilty of misconduct if at all he allows any other person to practice in his name. This is what branch provision, right? This is what even branch provision says. If at all you are allowing somebody else to practice in your name, nothing but if your name is being used at some other office which is not belonging to you, then you are treated as guilty. However, your name can be used by somebody if at all he is a partner of the firm, if at all he is a employee of the firm. They both are only allowed. That is what branch office provisions also say. If at all you want to say something is a branch, it must have a separate CA in charge. Either he must be associated with you as a partner or as an employee. Somebody who is not a partner of the firm, not an employee of the firm, who is not a member of the institute, is not allowed to use your name to practice. So in your name, either you can practice, your employee can practice, or your partner can practice. Nothing but here, name means what? Firm name, most importantly. If at all auditor doesn't have firm, then individual name. If auditor has a firm, then firm name you can constitute. You're getting it? Then you are prohibited to share profits to non-members. You are prohibited to share profits to non-members, like your profit of the profession, whatever the profession you're running, from that any profit is there, you cannot share to somebody. Somebody does not include relatives and friends, by the way. I can happily share my profits to my relatives and friends. That's not an issue. But I cannot share it to somebody. Like, what does it mean? Why are you sharing it to somebody? Are you sharing it to procure the work? Are you sharing it for advertisement? Are you sharing it for solicitation, commission, bribe? What? For what reason? Don't share to others. That's why, to avoid this, you should not share your profits of the firm to somebody. However, you can share it to another member of the institute as a referral fee. You can pay, no problem at all. To another partner you can pay, to a retired partner you can pay, legal representative of the deceased partner you can pay, or a member of professional body, CS Institute, CAA, Bar Council, IIA, Indian Institute of Actuaries and Architects. Getting it? So to all of them you can share. Not just that, you can also share fees. You can also share your profits to another person having recognized qualifications. Qualification list is bigger, therefore we can take this. Instead of body list, you can take qualification list. So BTech, Architect, LLB, MBA, BE, Actuary, CMA, only with these people you can share profit. Which means, suppose if any of them referred you work, they are asking referral fee, you can happily pay, no problem. You can happily pay referral fee to any of them. You can pay referral fee to your previous partner, retired partner. You can pay referral fee, profit share to deceased partner's representative. No problem at all. So see, payment to legal representatives of deceased partner, payment to legal representatives of deceased partner, we can pay either in two types: ad hoc amount or monthly amount. Why we are paying is because of goodwill. Why are we paying? Because of the goodwill of the previous partner. That's nothing but previous partner's share. It is a share of goodwill. If at all I settle at a time to the legal representative, over. If not, maybe as per the partnership deed, on a monthly basis we will be paying. What about a sole proprietor? What about a sole proprietor? A sole proprietary firm. Can they pay share of profit to previous proprietor representative? On a monthly basis, you cannot. If you want to sell, suppose I am a representative, I'm a representative of the sole proprietor. And the proprietor died, expired. And he is having a firm. Now that firm name can be used. The name can be continued even if at all he is not there. Provided you have to transfer that firm goodwill to another member of the institute within 1 year. Within how many? 1 year. Get permission of the institute, transfer the firm name to another member, another fellow member or another CA. Transfer him. He will use the firm name and continue. For that you can charge lump sum goodwill. For that you can charge lump sum goodwill. But you cannot transfer firm name to another person and ask a monthly share. No, that is not permitted. Sale of goodwill is permitted. Receiving proportionate of profit is not permitted in case of sole proprietary concern. Whereas receiving monthly payment is permitted for representative of a partner who is deceased in the partnership form. Understood? Now the sale of goodwill must be happened. What are the conditions? Death of the proprietor is honor after 1998. Only that case is enough. This is already long back the provision came. So you need not discuss about before 1998, after 1998, all that you need not. So permission, first get a permission from the institute that you are transferring goodwill. So sale, no, you must complete up within 1 year. Until this 1 year, no, institute will not remove the name of the firm. But member name will be removed because he died. Removal of member. A person who is dead, that name will be removed. But firm name will not be removed from the ICA database of firms. Until 1 year they'll wait. Suppose if at all there is a dispute regarding legal heir. Who is the heir? There is a dispute. Then until the dispute gets resolved, until that date institute will wait. From that date 1 year time. From the dispute resolution date 1 year time. That much time institute should keep the firm name in validity, existence. Just any formality, fees and all that and all they have to pay, they will pay. Clear? That's clause number 2 over. Clear or not? Clause number 3. Clause number 2 says what? You should not pay any share to others. Same way, you should not accept any profits from others. Kickbacks. Kickbacks are not allowed. Kickbacks are not allowed. Suppose a company is, I am the auditor of a company. I know another company which is actually supplying raw material that is useful for this company. The company asked me, sir, since you are having familiar relationship with them, if possible, can you negotiate some discount? They ask. Okay, since both are interested to me, both are like important clients to me, I will negotiate with them and give you a best dealing with them. I negotiated and I made sure that the company supplied raw material at discounted price. Now this company is paying me some commission out of it. Prohibited. That is prohibited. Referral fee you can take from another members. You can take share of profit. You can take commission. You can take referral fee only from the following. You can take only from the following. Who are they? If at all you are taking it from a partner, retired partner, legal representative of, legal representative of the deceased partner, member of another professional body, or a person having recognized qualification, from them you can take referral fee. Now you are taking from your client referral fee. No, that is not permitted. You are not a broker. Are you getting the point? So here that comes under brokerage service. Altogether different domain. Whereas within the profession, with the fellow professionals, I can have this. No problem at all. You are not damaging the dignity of the profession, because among your professionals you are settling. Within yourself you may have different terms. That's not an issue. But from the client, from another client, for example, this example you take, this is not permitted. Are you getting the point? All of you. From the client you must only get, see, if at all this is permitted, now I can settle contract which creates a self-interest, which is a business relationship prohibited under Companies Act. Business relationship means what? Any sort of relationship other than profession of audit. Other than audit and assurance service, if I have any other relationship, that's a business relationship. Agreed or not? So if I arrange for this client another supplier and get a commission out of it, is that a business relationship or not? This is prohibited. Clear? Next. Okay, clause number 1 says you should not allow somebody to practice in your name. Good. Clause number 2 says maybe cleverly, without practicing, without allowing somebody, you may give somebody the money and then get the work done. That is also not permitted. Third clause, don't accept money from somebody. Fourth clause, your clause number 1 is dealing with don't allow your name. Can I form partnership with others? Firm can I form? I will not allow him. That's okay. Can I form a partnership firm with others? That is also not permitted. Can I form a partnership firm with a non-member? Can I do that? Not permitted. So clause number 4 is dealing with forming an organization with non-members. That is not permitted. You can form with another CA, or you can form with another member of professional body. You can form with another member having recognized qualification, or with another person who is having equivalent qualification to ICA. With these people you can form partnership firm, no problem. That is permitted. Multidisciplinary firm is permitted by ICA. But as of now, guidelines were not yet issued. That is what guidelines, as since right now multidisciplinary firm is not permitted because guidelines in this regard are not yet issued. As of now, we don't know. See, it's like as of now it is not possible to form a multidisciplinary because until other professions also come with this concept. Yes or no? Even CMA profession should agree that. Now here you see, you can form partnership with a person having recognized qualification. What is recognized qualification? CS, CMA, LLB, architect, engineer, BTech, yes or no, BE, Bachelor of Engineering. These are all the recognized professions. Architect and actuary, all these were covered. These are all recognized. With them you can form a partnership, no problem at all. Under Companies Act, your firm will be appointed as an auditor only if majority are CAs and having COP. In Companies Act also, it is not saying all the partners must be CA. It only says majority must be CAs. So multidisciplinary firm is allowed under Companies Act to be acting as an auditor. Even in the professional ethics clause number 4, permitted expressly, you can form partnership with other professions. That is permitted. Just that, since guidelines were not available, at this moment let us not permit. That is the concern. Clear? All of you. Then, not only that, we have clause number 12. Clause number 12. In this order only you should read. Fine. Clause number 1 is what? Clause number 1 says, a CA is not permitted to allow another member, a non-member to use his name. Clause number 4, okay, I will not allow to use my name. Can I form a partnership firm and then let him use? No. Clause number 12 says, you should not allow another member to sign on your behalf. You should not allow another member to sign on your behalf. See, these clauses and all were not drafted in one night. Whenever a situation comes, that time the clause is added. That is the reason why there is a little bit vagueness. See, they can entirely describe one clause. What CA cannot do in a one clause, they can describe all the cases. Instead of that, the fellow who is drafting would have added it as another clause whenever the situation comes. You are getting the point? A CA is prohibited. A CA is treated as guilty if he allows to sign on his behalf somebody. Who should be that somebody? See, generally in my firm, no, who can sign any audit report, assurance report? Any partner can sign, provided that partner must be member of the institute. So the partner must be member of the institute, must have COP, and he must be a partner for sure. He is a member having COP, he is a partner. So just like how I have as a partner with COP rights, he also have same rights. He can sign, no problem. But have another partner who does not have COP. Without COP, how come you practice? How come you allow him to sign? First of all, he cannot practice, and you allowed him to sign, moreover, in spite you don't have practice. That is not permitted. Suppose I allowed somebody is in practice. He's in practice, he's a member, but I allowed him to sign, but he's not my partner. If at all my firm related works are there, the only firm representatives can sign. Whatever works firm has accepted, only firm representatives can sign. Who are representatives of the firm? Partners. That to which partners can sign? CA with the COP, only they can sign. So if at all any of the work that your firm has accepted engagement, that work should be signed only by nothing but who can be engagement partner. That's it. This clause number 12 is asking, this clause number 12 is addressing who can be engagement partner. The engagement partner must be the partner of the firm having COP. He he must be the engagement partner. Only engagement partner can sign the reports that are given under the standards on auditing, where the reports are given for audit, review, assurance, related services. Any report, only you can sign. Partner of the firm only can sign. Engagement partner only can sign. Agreed? Others cannot sign. Who is not an engagement partner? Who is not an engagement partner? He is just a partner but not having COP. Or he is a partner but not a member of the CA Institute. These cannot be signed. So, if a non-member is signing, or member only signing but not in practice, or a person who is not a partner. So, in simple 3 conditions. He must be the member of the institute, he must be having COP, he must be a partner of the firm. Only then they can sign on behalf of your firm. That's it. Logical or not? However, some documents are there which does not involve opinion, which does not constitute a report, which does not constitute an attestation, which does not constitute a certification. There are some reports, there are some documents, they are not reports, they are not opinions, they are not conclusions, they are not certifications, they are not attestations. Then what are they? Routine documents, correspondence, cash verification memos, records received memos. Getting it? Working paper signatures. That and all anybody can sign on behalf of your firm. Your articles can sign, your paid assistants can sign. That's not an issue. Which you should not sign? That document which is a final outcome of that work. The document which is generally the final outcome of the work. That document only engagement partner can sign. Easy. Can we conclude that like this? Yes or no? So, issues of audit queries, asking information from the client, letter forwarding observations, initiating vouching, all that, carrying routine correspondence with the client, issuing a memorandum for cash verification, stock verification, issuing acknowledgement for records received. Like client, we asked for records, they gave records. Client is asking to sign memo. I sign it. Anybody can sign it, no problem. Because that is not the final report. Na? In audit, final report is audit report. In assurance, final report is assurance report. In a stock certificate, the stock certificate is a final report. Final ultimate report deliverable is there, an ultimate deliverable. That only a partner shall sign. Are you clear? Even letter of weakness shall also be signed by the partner, because letter of weakness also come within the definition of deliverable. Come within the purview of deliverable. Are you getting it? Engagement partner only generally signs what? Letter of weakness. Engagement letter also comes within the meaning of deliverable. Deliverables to the client, only the partner shall sign. Who is a CA having COP. Anything that is not coming within the meaning of deliverables to the clients, deliverables to the client, it can be signed by anybody on behalf of the firm. Simple logic. I think I explained better than in my regular classes point. Revision has this advantage, because like this I can't give in a regular class in a simplest way. They don't understand. That's it. Fine. Next. Also the council, that's okay. I think all the points have been clear. So clause number 12 over, understood? Then clause number 11, I'll come back to it later. Clause number 10. Then clause number 10. Now 1, 2, 3, 4, 5. 1. What is clause number 1? Allowing a non-member to practice in your firm name or your personal name. Clause number 2. Allows or agree to allow, pay or agree to pay any share of profits to a non-member. You are treated as guilty of professional misconduct. Exception: you can pay to a you can pay to another CA in practice, nothing but another member of the institute, or you can pay to you can pay to current partner, you can pay to retired partner, you can pay to legal representative of the deceased partner, you can pay to a member of recognized professional body, you can pay to you can pay to a member having recognized professional qualification. To them you can pay. Now further, can I accept any share of profit from others? That is also not permitted. However, you can accept from a partner, from another CA in practice, from a person having recognized qualification, from a person having from a person of member of recognized body. From these you can accept. Same whatever, wherever you can share, from there you can accept also, not an issue. Getting the point? Then clause number 4. can I form partnership with anybody? You cannot. The moment you take up CA COP, you must be in full-time practice. When you are in full-time practice, there is only one firm you can form. And in that firm, the partners must be only these fellows, either CA or a member, CA with the COP, or a CA without COP, nothing but member of the institute, or he must be a member having recognized qualification, or he must be a member from recognized body, or he must be a member of some other institute which is considered as equivalent to ICI, like England and Wales. Yes or no? With them you can form, no problem. With them only you can form partnership. With others can I form? Sir, I want to form a partnership with one partnership firm which is dealing with trading in steel, iron and steel. Can I form? You are not. If you want to form, get permission under clause number 11. Because that amounts to engagement in additional occupation. So get permission under clause number 11 and form. If institute give clause number 11 permission, deemed permission under clause number 4. Are you clear? Next, clause number 12. So you said others shall not use my name. You told I cannot form partnership with others also, clause number 4. You are mentioning me, don't even let others to sign on by behalf, clause number 12. Clause number 10. Do not accept fees as a percentage of profits or contingency in nature. As a contingency in nature. When you are rendering any services, you see, a CA is treated as guilty if he charges, accepts in respect of professional employment the fees which is based on percentage of a profit or which is contingent upon findings, results of such employment. Based on findings or results, if at all you are taking contingency fee, that is prohibited. As a percentage of profit also, you are prohibited to take up the remuneration. Correct? However, percentage of profit, remuneration which is contingent, you can charge in the following cases. Many a times they may ask this question. Under what circumstances acceptance of fees as a percentage of activity, or percentage of outcome, under what circumstances CA can charge? If you are a receiver or liquidator, you can charge. Auditor of a cooperative society can charge. Recent May 24 MTP, or it was somewhere it is there. An auditor of a cooperative society can charge remuneration as a percentage of income of the society. In case of valuer for the purpose of direct taxes, indirect taxes, the fees may be charged as a percentage of property valued. Remember, we can only provide valuation services on financial assets only. We cannot provide valuation services on plant and machinery. We cannot provide valuation services on equipment, property, plant and equipment. Simply property, plant, equipment. You cannot provide. You can only provide valuation on financial assets. Getting it? Even stock valuation you can't do. Stock audit you can do. Stock audit means it's about existence of the stock. Value generally will be realized value, workings will be there, that you will take and then give. If at all value is doubtful, you will take help of an expert and then do it. You cannot value the market value. Can I value the stock? Is it possible for me? I don't have technical competence. There is a coal company, there is a lignite company, some lignite corporation is there, so much of lignite storage is there. How can I value? Do I have that competence? Simple logic. And in case of management consultancy services like energy audit, environmental audit, internal audit, staff recruitment services, in all these cases, you can take as a percentage of the benefit given to the company. No problem. In these cases, you can take. For fundraising, suppose if a CA is also a director in an underwriting company, getting it? Investment banking company. Their investment banker will get fundraised as a percentage. That is permitted. Or you are doing fundraising services for the company, just fundraising. You are not auditor of the company. See, remember, whenever you are reading, don't confuse with the role of the CA. Just see the provision. Can a CA charge like this or not? That's it. Are you auditor of the company or not? Ethics is not talking about. If at all you are the auditor, that is again a different interpretation. Many students confuse in ethics because they always link with company audit chapter. That's the reason. Can I take remuneration as a percentage of loan obtained for the company? You can take, because that's a fundraising activity. You can absolutely charge as a percentage of loan obtained. You negotiated with the banker, you convinced with the banker, you presented the company true picture. By the way, here you cannot put a false picture. That's again a different thing. If at all with respect to the company projections, everything, even though the assumptions are not reasonable, you certified 3400 prospective financial information falsely. That's a different provision altogether. Correct? That's wrong certification. That's a different provision. That's a different consequence. So you certified projections, you spoke to the bankers, you negotiated, and finally, the banker gave you the loan. And you pass a percentage of that loan, you are getting some fee. You can take it, no problem. Are you getting it? But here this since I brought this discussion, I'll tell you 1 minute clarification. Can I provide a fundraising service and share of profit for fundraising in an assurance report service? Like suppose a client specifically called me to provide assurance on PFI. To provide assurance on PFI. To the same company is asking, sir, you only find a banker, get us the loan. Self-interest threat is there. I will not do that. Whether legally there or not, self-interest threat is there, I will not do that. Because to an assurance client, how can I provide fundraising service? And that too, I am charging fees as a percentage of fund raised. Direct conflict of interest. So I will not do. Another CA company approached. There already one CA gave PFI all this, sir, certified and all over. Can you negotiate fundraising and all? Can you do? He can do. You're getting the point. So he can get. So in case of certain fundraising services, the fees may be as a percentage of funds raised. Remember, it all depends upon the circumstances. In case of debt recovery, the fees may be as a percentage of debt recovered. In case of cost optimization, the fees can be as a percentage of benefit given to the client. Any other service or any other service or audit as may be. For example, you are acting as an insolvency professional or you are providing non-assurance services to non-audit clients. Recently in May 2024 exam, it was asked. Non-assurance services provided to non-audit clients. This itself is enough. This itself is enough to prove the intention of this section. Just now I told this example. You are providing assurance report to them. He's an assurance client. To them, can you provide non-audit service and take a fees as a percentage of profit? No. That's the logic. Suppose he's not an assurance client. I'm not giving an assurance to him. And I'm providing some activity services, some non-audit services. Can I take fees as a percentage of the benefit given? Yes. Are you getting it? Now, there is a question in the last attempt, May 24, I guess. There is a question on some tax representation. The CA is reducing the demand liability. The income tax demand has been reduced. Income tax demand is reduced to some extent. Like I will directly show that particular answer. I think that's better. When we are discussing previously, the suggested answer was not there. Just a minute. Yeah, this is the question. This is the question. May 24, Kumar, a practicing CA, is well known in the field of pleading income tax cases at income tax tribunal. And does not provide any assurance service. Considering the long standing, remember he does not provide any assurance. Considering the long standing, he approached by the company to file an appeal in the tribunal against the income tax department for rupees 10 crore, which was added by CIT appeals, and to plead on behalf of XYZ, CA Kumar offers to accept the fees as below: 5 lakhs or 10% of the demand reduced, whichever is higher. Comment whether he is correct or not. So what are they saying? He will not be held as guilty. Why? Because representation, he's actually doing what? Representational service. He's doing what? Representational. And only a CA in practice can do that. That is first point. 2, is he providing any assurance to the client? No. He is dealing a tax query belonging to the client. Some tax issue is settling by providing representation between the department and client. So he is negotiating with the department and then somehow reducing the demand. For that, he is taking as a percentage of either demand reduced or 5 lakhs, whichever is higher. The provision clause number 11, you see, providing non-audit services to non-assurance. This was a recent clarification given in 2021. Earlier, this clarification was not there. Earlier, before 2021, this clarification was not there. Earlier, they used to consider this, since it is not given under the exception list clearly. Earlier, the answer is considered to be guilty. Later, when the provision was amended at last, finally, insolvency professional, non-audit services to non-assurance clients. For a non-assurance client means what? I am not providing any assurance service to them. So to them, I am providing which service again? Non-audit service. Non-audit means what? I am not giving any audit assurance, no, nothing. Income tax representation is a non-audit service. And the information clearly given saying that it is not a assurance engagement. So he will not be held guilty under clause number 10. So Regulation 192 allows CA in practice to charge fees in respect of any professional work of which is percentage profit or contingent upon findings. In the case of non-assurance service to non-audit client, the fees may be as a percentage of demand. In the given case, CA is practicing an audit, provides non-assurance service. He is approached by expected a non-audit client to file an appeal in the tribunal. So CA Kumar offers to charge whichever is higher. Therefore, he is not guilty. So he is not providing any assurance services to non-audit client. He is not providing any assurance service to non-audit client. Clear? All of you. Earlier, before 2021, before that guidelines came, typically this particular whatever the point is there is applicable only from the financial year 20 to 23 onwards. Before that, this clarification is not there. Earlier, we used to interpret the same situation as guilty. Earlier, you are not, because that was not given specifically under the exception. We used to consider this as guilty. Now later they give whether this case will come under that case or not. Non-assurance service to non-audit client, whether it will come or not, benefit of doubt is there. Recently with this question, it was cleared. You're getting the point? Honestly, until this question suggested answer comes, we are also doubtful. Whether do they bring another logic and say it is guilty? We are 90% certain that it's a non-assurance service to non-audit client, but we little bit some uncertainty is there whether they will bring some other logic and say since it's a practicing related work, only CA in practice can do. It is not something other professionals cannot do. You are using unduly your capacity and then charging. That logic can be argued, right? That the person suggested answer, he can argue that logic also and say that no, it is not permitted. You see, in exception, whatever services are there in exceptions, whatever wherever you can charge as a percentage of fee, fund, whatever it is, these are the services not restricted to CS, you see. Yes or no? These are all exceptions. Where and all you can charge as a percentage of profit or contingent in nature. The services which are covered under exception, where you can charge like this, those services, it is not only CS can perform, anybody can perform. Correct? So income tax representation cases, technically anybody can perform. Not necessarily be CA, but in some cases at appellate level, CA or advocate, any of them can perform. On that logic, again interpret and I can give this answer. I'm just telling you in how many ways the logics are coming. You're getting it? Entire professional ethics, I can tell you 5% to 10% vagueness is there. If at all somebody says professional ethics 100%, I'll give you clarity, don't believe. It's not there. It's not possible. I'm just telling you the counter argument. I'm telling you to this question, I'll give a counter argument, say this is wrong, and I'll prove it. You're getting my point. So there are some questions where it is debatable. For example, there is another question. A CA shall not do investment advisory services. Agreed? You are prohibited to do investment advisory services. Why? What is investment advisory service? You are establishing an organization, providing investment advisors to others, and then you are getting some remuneration. This comes under additional occupation, correct? But in one of the ethical standard board guidelines says, a CA can be equity research analyst, can give suggestions to his friends and relatives, for which he may be charging a fees. That is permitted. Why not this is investment advisory service? Is this not an investment advisory service? In one of the MTP it was there. In one of the MTP, it was there. Commodity derivatives, stock derivatives and all, you need to obtain permission. Commodity derivatives, Trading in commodity derivatives, I think somewhere there is a relaxation on that. You're getting it. Don't worry, when I come there, I will explain those confusing points. I hope this point you're clear, right? We'll discuss that. Okay. Are you clear on this? So, clause number 10 over, clear? Then, clause number 11. So, one, they are saying, don't allow somebody to use your name. Clause number 2, don't give profits to another person other than recognized. Don't accept from another person. Don't form partnership with others. Don't allow somebody to practice in idiom. Don't charge fees as a percentage of profit or contingents except the some cases. Then final this one, do not engage in other activity. If you want to have practice, if you are in if you are with COP, only work you must have is COP. COP related work only you must have. Other occupation you cannot. If at all you are taking other occupation, how come you make yourself professionally competent with respect to audit services? So in order to protect quality of the work, what institute is saying, don't engage in some other occupation. Give full-time dedication to practice. However, there are some activities which you can take up. They will not affect your competence. So these activities generally considered as not affecting competence of the CA. What activities? Employment under another CA in practice. You can owning an agricultural land and carrying out agriculture activity. Doing agriculture is a constitutional right. For that, why should you obtain any permission and all? So it's a constitutional right. Yes or no? Agriculture. With respect to agriculture, no law can touch unless through constitution. Agriculture income was exempted by constitution, not under income tax section 10. Taxes can be levied on income except agriculture income. Entry number 82 or something. Some number is there. So in the constitution itself, there is an exclusion. Income tax also giving, and specifically they are giving exception. But of course, they are collecting through another way tax on that aggregation concept. That too for individuals and all. That's a different scenario. So I'm just telling. Next, you are acting as a recovery consultant, debt recovery services. Debt recovery services, it doesn't require any permission. Generally, if this question is asked, if this particular question is asked, 99% think it's an additional occupation, requires special permission. Here in the CA did not get the permission, so guilty. They will write like this because they will read all this. They will remember attending classes is permitted, teaching less than 25 hours permitted, all that they will observe. This point they will not make an observation. This point, debt recovery. You can act as a recovery consultant in banking sector. You can be getting it. Acting as surveyor or loss assessor under Insurance Act. Acting as surveyor or loss assessor. Generally, if a car met with an accident, so I need to go and check what is the accident, what happened, how much is the loss, so that I will give a report to the insurance company. They will release funds to the policy holder. That work is called as what? Surveyor, assessor. Editorship of professional journal. Professional journal is permitted. Retail journals not permitted. Professional journal means what? Those journals which are distributed among the professionals. Getting it? Professional means what? Me or my fellow professionals. That's it. These are all for career development, content development for that reason. Like all of us, knowledge development, knowledge sharing. Retail journals, that is commercial in nature. That is not permitted. So retail journals, somewhere it is there. Editorship of journals other than professional journals. If the retail journals, Dalal Street Journal, Wall Street Journal, there and all, I am giving some advisories, articles and all. That comes under additional occupation. That comes under additional occupation which requires special permission. Next, valuation of papers, paper setter, head examiner, moderator, observer, whatever. Examination, you can act as any of this. You can do part-time tutorship under coaching organization of the institute, ICI. In the ICI, can you teach? For that you require permission. ICI only are calling you. Why permission again? Yes or no? Next, acting as notary, justice of peace, special magistrate, like this. We don't even know what are they. Leave it. Honorary office leadership of charitable education and other non-commercial organization, you can act as a leader. Remember, honorary office of leadership, you are only taking up as a leadership, chairman. You are not actively engaged in that. Holding acting as an MLA, I mean, competing for MLA, MLC, MPs, all that, and holding those posts, permitted by default, permitted. They're all constitutionally permitted. Attending classes and appearing any examination. I'm a CA in practice. I'm attending coaching classes for some additional courses. You can. No permission is required. Holding life insurance agency license is prohibited, because life insurance agency is required only for whom? Only for who are selling policies. Sir, here I sold policies long ago. I sold policies long ago. Now, whatever policies I sold long ago, right? They're all renewing. On the renewal, no, I will get commission again. For getting that commission, I must hold the business. Agency I must hold. No, agency is not permitted. Sir, I will not do new business. Whatever renewal business is, that commission I will get if I have this license. For that purpose, can I hold? You can hold for that purpose. Getting the point? Authorship of books and articles, not retail reports. Books and articles you can. Novels and all you can't. Commercial novels, fiction books, no. You can write income tax guide, CA guide, all that you can write. Yes or no? Who will not read? Nobody will read. That's it. Are you clear? Now, these people are super clever. See, generally, I should either tell you what you should do or what you should not do. Any one I should tell you to avoid confusion. They told what you should not do, what you should do, both. How come? See, if I say these are the activities does not require permission, remaining all other requires. Correct, right? Over clever. Requirement for special permission or prior permission, they gave this list. Remember, this list is inclusive. Whereas permission automatic, no permission is required, right? This is exhaustive. Understood? This is exhaustive. Only these services don't require permission. What about them? Only these require permission? Huh? No. These are just an inclusive list. Any other activity that does not come under general permission route requires permission. Are you clear? Now you see clause number 4. I should not have partnership with others, right? I should not have clause number 11, engagement in business. I should not have another business, right? Suppose I am a partner in one partnership firm, which is a trading concern, trading manufacturing concern. I am a partner in the partnership firm. Clause number 4 violated or not? Clause number 4 violated or not? But here I became a partner by not forming it, by devolution, by succession, by inheritance. I got this. I did not form with them. Clause number 4 will not apply. Clause number 4, when it will apply, if you form with non-members. I did not form here. They took me. You are getting the point. I became a partner by inheritance. Whatever it is, in a partnership firm and sole proprietary concern, if at all you are having ownership, it is very difficult to prove whether you are engaging in occupation or not engaging in occupation. Is difficult to prove. By default, in a partnership firm, partner means active partner. Well, people think. By default, if you are a proprietor, they think you are an active proprietor. That by default is an additional occupation. Correct? Now, can I have a share of profit in a partnership firm which is a trading manufacturing concern? Can I be a sole proprietor in a trading concern? You can be. Condition number 1, that ownership you got how? Through succession, inheritance, or devolution. Getting it? Through succession you got, simple. By inheritance you got. You must prove the institute. You must prove the institute you are not actively engaged in any activity. Then they will give you permission to have the ownership itself. See, you should not form partnership with others, right? Can I be a sleeping partner? You might get it out. No. Clause number 4 does not say active partner, sleeping partner. No. Clause number 4 straight away says you cannot form partnership with others. Sir, but here I have a partnership. No. Get a permission of the institute. Institute will not give permission unless you give proof that you are not actively engaged in that. That is what interest in family business concern. This is where many students have doubts. This point they will get confusion always. This one, and for that, member in practice in a HUF business, member in practice in HUF business. There are 2 points. These two are interrelated. Have you seen this earlier? Edo padichittum sir, edo gnavilla. So, member in practice in HUF business or any sole proprietary, a member of the institute can acquire interest in family business, like in a proprietary partnership, all that. It is necessary to provide evidence that interest in the business is devolved on him as an inheritance, succession, partition of the family business, and he was not actively engaged. Only this and all he has to prove. Then he can hold that ownership. For holding ownership also proving required, which means permission is required even for holding ownership in a proprietary concern, in a partnership form, or in a HUF. You are getting the point? Or of you? So, can I get interest in family business concern? Yes, you have to. You can get, provided no active part is taken. You have to get permission even for getting interest. Even for ownership in that, you must need permission. Forget about you working or not. For ownership itself, you must get. Provided institute will give permission when you actively not engaged. There are some cases where they will give you permission for actively engaging also. Very simple. Permission I should not engage in other occupation means what? You must not have ownership in proprietary concern. You must not have ownership in partnership firm. You must not have ownership in HUF. Simple. You must not have ownership anywhere. Proprietary concern, partnership firm, HUF. Tell me, is there any other way I can have ownership in another entity? Company. In a company, you can be a shareholder. You buy any shares, no problem. You're not a director. Being a shareholder in company is permitted because shareholder by definition is not executive. Correct? That's why company form is not covered here. Whereas HUF is covered, partnership firm is covered, sole proprietary concern is covered. In that ownership means you are engaged in occupation by default. How you got the ownership? I don't matter. It doesn't bother me. It is not permitted. However, only one thing is permitted where you can have a ownership. Through inheritance you got. That is permitted. Logic clear? All of you? Then what are all where you require permission? Full-time employment. Employment in business concern. You want to work as an employee in some business concern. You need permission. Full-time employment in non-business concern also, you require permission. Simply you want to take up some employment along with COP. Permission you should get. Office of MD or whole-time director. You want to hold MD, managing director or whole-time, because these two are the directors who are treated as executive directors. These are the two directors who are treated as executive. Sir, a company is appointing me as an independent director, sir. Do I need permission of the institute? No need. Only for whole time and executive director, managing director, you require permission. Sir, I want to have ownership in education institution. Suppose, take my case. I have ownership in Shrestha. I have specific permission. You're getting the point. Part-time, full-time lectureship other than institute. Like, if at all you want to take up lecture as a lecturer in ICNO, you're permitted automatically. Sir, I want to take in some institute like KS Academy, A&M classes, something like that. Getting it? Is it permitted? You need to take a permission. Provided coaching number of hours in a week shall not exceed 25 hours. Can I be editor of other journals? No. Any other business or occupation which council feels necessary, there and all you require special permission. Very simple. This logic you remember. Do I have ownership in some other entity? Other entity can be proprietary concern, partnership firm or HUF or LLP, whatever. Company you can have, because there it is, just because you're owner in the company, you're not participating in the company. So the company you can have, but remaining three, the moment you have ownership, people think you're participating. Requires permission. Are you getting it? I say generally will give permission when, if at all, that ownership is getting through inheritance, succession. Clear? Clause number 11 is over predominantly. Clause number 11 is over. Confident all of you? Yes. Yes. Then clause number 9. So clause number 9, what it says? It is telling something like this. Actually, this clause technically supposed to be scheduled to part 1, because the third part is affected here. Generally, it is supposed to be scheduled to part 1. But mistake they did. They kept it in schedule 1 part 1. You are prohibited to accept audit of a company without complying with provisions of Companies Act. Forget about Companies Act, company audit. For every audit we need to check, right? Are we liable to check for every audit eligibility? Otherwise what will happen? It amounts to violation of SQC. Acceptance and continuation of client relation, you have violated without checking ethical requirements, you accepted. It amounts to violation of SQC. When it amounts to violation of SQC, in my regular class, I will not explain this point generally, because by the time we discuss ethics, we don't discuss standards topic. Correct, right? SQC we have not discussed. That's why that time I will not cover this point. I will cover this in revision generally. Fine. So, suppose a client appointed me as a tax auditor. I accepted without checking anything negligently. Where I am punishable? Where I am punishable? I am violating SQC. SQC is a requirement of Auditing and Assurance Standard Board. Auditing and Assurance Standard Board is a requirement of a committee. Committee requirement, failure to comply with the requirements of the committee. Clause number 2, part number 3, schedule number 1. I can correlate like that. You're getting it. Here narrowly they covered only company. Suppose a company approached you to accept the audit. It is your responsibility to give acceptance after checking compliance with 139, 140, 139. Appointment, reappointment, resignation, appointment, reappointment, rotation, casual vacancy, branch audit, all the provisions you need to check. You need to check who is the previous auditor, why he was not reappointed, is there any auditor resigned, is there any auditor removed. 141, qualifications and disqualifications. 142, whether they fixed remuneration properly. So without checking these conditions, these sections, if you accept audit of a company, which audit? Obviously stat audit. 139 means obviously external audit. If you accept audit of a company without checking this, you are treated as guilty. Are you getting it? Like, what do you mean by, like, what indirectly what the section is asking, what the clause is asking? Before you accept any appointment, see whether your appointment was valid first of all. When an appointment is valid, suppose if previous auditor was removed by central government. Previous auditor was removed by central government. They were removed by obtaining special permission from the central government and a special resolution passed. It resulted in casual vacancy. Now the casual vacancy can be filled by board of directors within 30 days. See whether I was appointed within 30 days. If at all I was not appointed within 30 days, within 90 days. No. If at all board of directors fails to appoint within 30 days in case of casual vacancy, directly normal provisions of ROC, some provisions were given in that. The guidance note on that will apply. The guidelines will apply on that. Generally, we will not go up to that level. We will backdate and appoint. Correct? We will backdate and appoint. We will pay late filing fee. Simple. So we will backdate and appoint. Fine. So we need to check if previous auditor was resigned, removed, or I am appointed under rotation. If so, what provisions I should check? I should ensure that previous auditor removal was proper. After checking thoroughly all the provisions management followed correctly or not, only I should give acceptance. Before I give acceptance, again I should check my own thing, integrity of the client, competence, ethical requirements, all that I should also check. Apart from that, I should check whether client appointed me correctly or not. That is what this section says. That is what this clause number 9 says. In this clause number 9, you have a detailed discussion in board book. Almost 7-8 pages discussion is there. There where they are talking about, suppose if previous auditor was removed by central government before expiry of the term, what points you should check? If you are appointed as a first auditor of a government company, what points you should check before accepting? If you are appointed as a subsequent auditor for government company, what you should check? If you are appointed as a first auditor for non-government company, what you should check? Subsequent auditor for non-government company, what points you should check? Appointed under casual vacancy other than resignation, you were appointed to fill it, what you have to check? They appointed you to fill casual vacancy due to resignation, what you have to do? You are appointed under rotation, what you have to do? Like that, so many combinations they explained, which is completely dealing with provisions of Companies Act, where everywhere it will say verify that, verify that, verify that, verify that. That's it. Are you getting it? You need to read that entire content which is given in the ICS study material, which is 2023 edition. These are the page numbers, not that important from exam point of view. Are you clear? Next, clause number 9 is also over. 9, 10, 11, 1, 2, 3, 4, over total. Next. Yeah, you can clap, no issue. Then so then another 20 minutes probably I can complete this. 20 minutes to 30 minutes. Then another half an hour to 40 minutes I'll complete. Half an hour it like scheduled to part 1. Then I'll revise completely. Then council guidelines, important guidelines I'll tell. Over. Ethics will be over. Regulatory measures I'm not covering. Self-regulatory measures I'm not covering. You know, right? Self-regulatory measures. Hey, what happened? You didn't study that. எல்லாரும் எப்படின்னா கோயில்ல பிரசாதம் முடிஞ்சு போனா அந்த டிசப்பாயிண்ட் இருக்குமே நம்ம லாஸ்ட்ல இருக்க கியூல அந்த மாதிரி இருக்கு ஃபேஸ் எக்ஸ்பிரஷன். Shall we? Yeah. Clause number 8. Communication with previous auditor. What is it? For every audit, voluntary audit, statutory audit, non-statutory audit, tax audit, internal audit, GST audit, company audit, for every audit, if at all previously that audit was performed by another CA with COP, now that audit was given to you, it is your moral responsibility, it is your professional courtesy to get an NOC, to obtain no objection certificate from the previous auditor who held that position. So why you need to get, why you shall communicate with previous auditor, why you should communicate, you should get NOC. Why? It's a courtesy. How do you know that he was removed properly or unjustifiedly he was removed? If you don't communicate with him, tomorrow else it will happen for you. The institute is protecting your rights in so many ways. Member's right is protected, a member's work is protected, his culture is protected, his clients are protected by including all these rules. Professional courtesy to know the reasons for change in auditor, so that you can safeguard your own interest, to protect the independence of existing accountants. Suppose client is blackmailing me, I will remove you. Okay, remove it. Next auditor has to accept. No, without my consent, how he will accept? My independence is enhanced like this. Yes or no? When making inquiry from retiring auditor, the proposed auditor should primarily find out whether there are any reasons why you should not accept the appointment. Generally, non-auditor change occurs when because the client praise changed, where a local auditor is preferred, where partner dealing with the client affairs dies, the engagement partner dies. For example, temperament clash. When client has some other reasons to get dissatisfied, maybe client himself will dissatisfied with his work. In listed companies, audit committees monitor your work like anything. They monitor your work, whether are you working correctly or not. If not, no, they will tell your partner, no, he doesn't know anything. If partner himself doesn't know anything, they'll tell director, they don't know any work. You appointed them. Next. Now, generally, objection, previous auditor can raise what? What objection he can raise? My fees is not paid. It will not be paid. Yes or no? Fees is not paid. Generally, existence of dispute regarding fees not having paid often may be the reason for auditor getting changed. So this itself is not a valid reason. This is not, I mean, see, one more thing. What they're saying is, suppose, no, can I accept the previous auditor? Like auditor was changed, previous auditor fees was not changed. Sorry, fees was not paid. Can I reject this appointment, or he raised an objection that fees is not paid? Now, can I hold this appointment? Can I not accept this appointment? You can accept it, provided you take all your influence, you use all your influence and position and power to ensure that his fees is paid. That's what they say. However, in case of undisputed fee or undisputed audit fee not paid, what is undisputed audit fee? Suppose, no, the previous auditor billed 10 lakhs. The client is saying 6 lakhs only I will pay. Why I will pay 10 lakhs for your work? 6 itself is high. So client is saying that 6 only I will pay. Now in that case, 6 is undisputed, right? He is also ready to take that 6. Client is also ready to give 6. This is undisputed. Remaining 4 is disputed. Remaining 4 lakhs is under dispute. Undisputed fee, whatever is there, it must be paid. So first you convince other guy, hey, first you take 6 lakhs. No, we'll discuss that 4 lakhs later. We'll that dispute, let it go. First to take that 6 lakhs. You should make sure your client prepared a demand draft or gave a check and issued to him. If at all he is not traceable, ensure that your client took a DD, purchased a DD and posted the DD to the address, firm address. Enough. That was the reason. Are you clear? Fees not paid. This itself can be asked as a 4 marks question. So Does reply must from retiring auditor? Obviously. But by the way, how long you will wait? You will wait for a reasonable period of time. If at all you get a reply, okay, follow whatever is there in the reply. If at all you didn't receive the reply, after waiting, if reply is not obtained, after waiting reasonable period, you can accept the audit. Suppose you received reply, no objection, happily continue. Objections raised. Objections are not justified. He is saying, I didn't like this. He replaced me without my consent. So accept the engagement if the objection is unjustified. Objection is justified, reject the appointment. Correct? Now I should communicate with the previous auditor, right? What is the mode of communication? Registered acknowledgement, RAPD method, registered acknowledgement, registered acknowledgement with confirmation due. Registered post acknowledgement due, RPAD, sorry. Registered post and acknowledgement due. What does it mean? Once I posted, it will be delivered only to that person upon verifying his identity. Only to them it will be given. The moment you got a delivered message, it means it is delivered only to the concerned person, not at the door. That is what RPAD method is. Suppose you sent by certificate of posting. You send a letter by certificate of posting. Certificate of posting means what? At the door, whoever takes delivery, they can take. That cannot be a valid method. So you can send communication with previous auditor by registered post acknowledgement due. Recently, mails are also permitted. To which mail you can send? Last known mail. You see here. Acknowledgement of communication through his mail address registered with the institute or last known official mail address is permitted. Now on this, there was an MTP question. Generally, they will say reply was received from previous auditor, which was as per the company records last mail, but it is not registered with institute database. Many students, what they will write, since it is not a registered mail ID with the institute database, that reply cannot be considered. Therefore, the present auditor who accepted based on that reply is guilty. No. Last known mail ID, last known mail address. Last known mail address means what? Look at the correspondence made by the company with the previous auditor. From which mail ID he communicated last time? That can be taken, and to that you can send a mail, no problem. Sir, whether that mail is registered with ICA or not doesn't matter. This was an RTP or MTP question in number 23 attempt. Are you clear? All of you. So generally every one of you remember this registered address. But last known mail ID, nobody will pay observation on that. And that is what tested in that particular MTP. And suppose when the post was sent, premises was found locked, it is deemed to be delivered. Or when the address itself is not found, it is deemed to be delivered. Clear? All of you. Nowadays you see in GST registration, geotagging is required. You need to tag your address. Yes or no? Geotagging is required. Why? Because in north side, so many places GST address is that cemetery. Graveyards. That was given as GST address. That was given as address. When department, the people went for inspection, they found this. So from that moment, you have to put geotagging. Compulsory geotagging is required. And all public places in geotagging were eliminated from that. Getting it? That's why GST registration becomes so difficult now. It is taking time. Earlier, it's as simple as if to obtain MSME certificate. Every one of you can get MSME certificate. Udyam portal, you go give details, it will give you no proof. Even it will not even ask any uploading of card. Of course, the first authentication is Aadhaar authentication. That itself is enough. Clear? Next. So that's it. Clause number 11, all of you. Sorry, clause number 8, all of you. Clear? Then we have 5, 6, 7. What is the fifth clause is saying? I am just covering only the confusing points. Mainly, where and all you will confuse. Of course, I am covering mostly, but confusing points I am highlighting more. Clause number 5. What are they saying? A CA in practice, if at all he is securing either through services of a person not an employee, or who is not a partner, by means not open to CA. See, you can secure clients, you can secure business through your partners, through your employees, or through means open for you. What are the means open for you other than clause 6, clause 7? In clause 6, they tell about certain means in which you can acquire a client. Okay, they are not permitted. Only few means like through your relatives you can get clients, through your friends you can get clients, through another member in practice you can get, through another member of the institute you can get, or from recognized professional body members. For them you can ask the work, or some senior CS, but you can ask them the work. That and all permitted. You should not advertise. You should not solicit indirectly or indirectly by personal, whatever. The clause 6, I'll come back to it later. So, a CA, if at all securing any professional business, he shall be treated as guilty. If you are securing any business, you are guilty. However, if you are securing through an employee, if you are securing through partner, or if you are securing through means that are open to CA, that are not open to CA, you are securing. Through that mean you are securing. Through the prohibited route you are securing. Through not a partner you are securing. Through not an employee you are securing. Other than partner, other than employee, other than means open for you, you are trying to get clients. You are guilty. What are the means not open to CA? What means are not open to CA? Clause number 6, clause number 7 tells you that. Clause number 6, clause number 7 tells you in what way you should not get a client. Clause number 7 says, showing your professional attainments and getting a client, prohibited. Showing your professional attainments and getting a client is prohibited. Clause number 6, advertising is prohibited. Circulars is prohibited. Giving interviews in news channels and all where your firm name and all is displaying, prohibited. Like that they have given certain cases. Correct? Clause number 6. Let's look at directly clause number 6. A chartered accountant in practice soliciting clients, professional work by circular, advertisement, personal communication, interview, by any other means, he shall be guilty. However, this will not apply if at all you are getting work from another CA in practice, or you are securing work as a consequence of response to tender. So some company open a tender, I just reply to the tender. That is permitted, provided. Can I reply to a tender? We have some conditions. Tender you can reply only if the tender document predetermines the fees already. Fees is predetermined, means you can't influence in terms of fees. You can quote to the tender. In that case, since fees is fixed, the client will select based on merits only. Suppose if fees is to be negotiated, you can influence. Hey, I will do for lesser fee, why that much? You can negotiate. Getting it? Or if the professional work is not exclusively reserved for CS, means tender is there, fees and all they didn't mention. They didn't mention fees and all. But for the tender, anybody can respond. Anybody can respond. Getting the point? What is your profile? What clients you're handling? What are the things that you're handling? How much fees you're charging for this? You can give. Not only that, anybody can respond to the tender, any profession. It is not restricted to CS. Suppose if the tender document specifically is calling for CS, a CA can reply to the tender only when the fees is already determined. Are you getting it? So if a work is reserved only for CS and tender document, generally tenders and all, who will do? Government. So government generally issues tenders. In the recent May 2024 MTP, they asked something called GEM portal. They asked a question in MTP on GEM portal. It's actually government e-commerce portal. It's government e-commerce. In government, there are so many departments, some 30 to 40 departments will be there in state government and central government departments. All these departments have to buy some goods and services, right? For their departmental needs, government needs. For that, they can buy from government e-commerce platform, e-marketplace, government e-marketplace. In that, the only buyer is government, either state government or central government or their departments. Buyer is only government. Sellers can be anybody. You and me can be a seller there. You and me can be a service provider there. Can a CA in practice register as a service provider in GEM portal for providing professional services? Permitted. It is permitted. GEM portal, because the buyer is only one. The buyer is only one. That is, government is the buyer. Are you getting it? Now, there how it happens, whenever a government department looking for auditor, they will post a product. Like we are looking for auditor, you just have to click apply. Fees, everything will be predetermined. So here, procuring work is through tendering process in the GEM portal. Just that it is electronic tendering, nothing but. So can I see a register in the GEM portal? Yes. But you cannot call them and ask, please allot me the work. That's called roving inquiry. Getting it? A CA in practice is not permitted to do roving inquiry. You can register in GEM portal. You can register in RBI empanelment. You can register in societies empanelment. You can register in IRDA empanelment. You can register in, any other like multi-state corporate societies empanelment or trust empanelment. You can register. No problem at all. But you cannot call the management of these empanelment bodies and ask for allocating the work. That is not permitted. GEM portal you can register, but you cannot call the department, respective department, allocate me work. You cannot make such a claim. Clear? All of you. So, tendering related one, GEM portal example I have covered. Getting it? They asked GEM portal, I was shocked seeing that question. Like, see, since I know this particular GEM portal related thing earlier. I saw this once. Say that I know. First of all, many don't even know GEM portal means what. That question is asked in ICA book. I mean, this MTP. If this question comes in main exam, 99% cannot even understand this question. So it's a government e-marketplace actually, nothing but. Now, suppose a CA in practice, he can involve in private tutorship, right? Or tutorship under the institute. In both the cases, up to 25 hours in a week, you are permitted. Private tutorship means I am a private tutor. Independently, I am running. I can do that. Suppose if I am a private tuition, private tutorship, a small coaching center I have. I cannot, I can put outside the coaching institute, signboard, all that. Now tell me, this and all outdated. This entire council guidelines were drafted in 2008. It's almost when you are going to school. That time this was drafted. Getting it? So how come tell me this is relevant? No? Some provisions are not relevant. Personal canvassing or canvassing for clients of previous employer, that is not permitted. That is not permitted. People know they work in Big Four 4-5 years. They'll come out. Already when they're working in Big Four, with the clients and all, they'll have a good rapport. And they will need extra work. That time they will contact these people. So that the client fees will be lesser and these people have some, avenues. If at all the Big Four, like the firm knows, get to know this. They can complain to I say that he's grabbing my client's related works without my consent. Next. This is what? Can I apply for empanelment in C&AG, RBI, IRDA, GEM portal? Yes, but you are not prohibited to, you cannot do roving inquiries. However, if at all they called and asked you, you can quote a fee. That is not a problem. If client himself approaches you, you can send a reply, profile. Getting it? Don't take list of all the clients' mail IDs. Put a BCC mail. Sending your firm profile. I am interested to become your auditor. Yours loving. Something like that. Getting it? You can't do that. Next. Can you advertise about silver, gold and platinum, century, all that? Yes, you may publish it in a normal size. It should not be glazing, colorful, front Times of India first page full. No, that is not permitted. Sponsoring activities. Can we sponsor, can CA firms, can they sponsor games and all? You can. Only those games which are organized by ICI. ICI has a POU, program organizing unit. They'll be organizing cricket, they'll be organizing some competition between the firms. Articles and all they will be feeling as if they're playing IPL, they feel. Yes or no? So it's good actually, that's sportiveness, that's actually, okay. So, the t-shirts and all you can sponsor. Your firm name, everything can be given on that because it's within the fraternity, no problem, no problem. Can a member who is sponsoring CSR activities, distribution of rice bags, distribution of groceries to flood victims, you can do. You can even mention your name, CA so and so. Firm name should not be mentioned. Firm name should not be mentioned. Firm name or CA logo not to be permitted. Can a firm have a separate logo? No. Only one logo. We are all one, represented by one logo, CA logo. Right now CA logo is updated. I hope you know. CA logo with the tick India. They just added the word below India, which actually beautiful logo. Earlier logo is also beautiful, only it has some explanation which is conveying so many lies about us. Somewhere is there a logo? Where is it? That's okay. That's okay. It's okay. It's okay. We'll go with the flow. Now coming to website. Can you give public interviews by the way? Absolutely. Suppose a news channel, YouTube channel called me, one YouTube channel, for example, sir, can you please talk about MSME loans and all? I can go and talk about MSME loans, what are their advantages, how to get MSME loan, all that. I cannot say that come to our firm, we will get you how to get MSME loan. That is not permitted. Yes. Can we do educational videos? Yes, I am doing on the YouTube educational videos, that and all, no problem. I cannot say if you have any parents or relatives who need IT filing, come to me. I cannot say that. Website, is it permitted? Yes. Pull mode, not push mode. Simple. Caramharsha, if you type, my firm website should not come. That's push mode. You're getting the point. Website name should be fully typed on the search bar. Only then it should appear. That's called pull mode. Website is working on pull mode. Getting it? And in the website, no, you can mention nature of services, experience, partners, employees and articles, when it was established, year and all you can mention. Date you cannot mention. One question is also there on the date of establishment is mentioned. What's wrong in the date? Maybe some people have numerology issues. Yes or no? So bias might be there. We don't know why date is. That question says, since the firm mentioned the date of establishment, it is guilty. Are year mention panna guilty, illa date mention panna guilty enna. Too much strict interpretation. But since that question has that answer, we should follow with that answer only. Don't apply your common sense sometimes. Next. Website address can be mentioned in the letterhead. What it should not contain, this is important. Website should not contain names of the clients and fees charged. Your website should not contain others' advertisements and all. Generally blogs, no. How bloggers will get revenue? In that blog, no, some lifestyle is advertising, some footwear company is advertising, some telephone company is advertising, Vivo phones and all advertisement will be there in the blogs. That kind in your website does not appear. It's not professional, no. Moment website opened, Vivo 1999, 111,999, some model is there, phone model. Yes or no? That and all should not be there. That's awkward, right? Actually, that's actually another occupation. Correct? It's not permitted. No other photograph other than passport size photo. Only passport size photos, Sai Baba pose. That's it. Not any other pose. Sorry. Okay. It's not like, I mean, I'm just normal way, not in offensive way. Getting it? It should be like a Sai Baba pose means when you go to temple, you'll be like this, no, with bindi and all that. That pose. Only that should be there. You cannot post with the Burj Khalifa like this. You're getting it? Yeah. Next. You cannot mention rate card. That is prohibited. Rate card is prohibited. ITR 1,999, ITR 3. That and all is not permitted. Next. Can we list our website on search engine? No. That is what? Pull mode only should work, not push mode. Then, now this is like, there are so many websites like Clear Tax, Your Accountant, Taxman. In all these cases, they provide, talk to an expert. Some chat option will be there. You click on the talk to an expert, talk to CA, talk to my CA. Like there are some websites like this. You click on that, you put your query, other side a CA will reply. Can we provide those services who are in practice? Absolutely yes, you can provide, provided your firm name is not revealed. Your firm name is not revealed. That's what this entire discussion. Clear all of you? Except making a statement that they are chartered accountants, their firm details, contact details, nothing should be given. Next. Then that's it. Clause number 6 over. Then clause number 7. Date of setting up of practice. You should not, it is not permitted. Here it is given. In 1980 it was given in the website. In 1980 website is for the first time. Who will have website in 1980? Only Google has website. Yes or no? Date of setting up of practice, date of establishment of firm on the letterhead and document should not be mentioned. There is a case also on that. However, year can be mentioned. See, by the way, clause number 7 is what actually you cannot mention professional attainments, all India first rank, all India 5th rank in websites and all. Getting it? When you are inviting work from others, you cannot describe your professional attainments. Solve the complex case of so and so client? No, you cannot. Services offered. A member is treated as guilty if at all he advertises services offered, uses any designation other than chartered accountancy. This we already discussed under section number 7. There, section 7, it is clause number 7. In that some important things only I'll tell. Can we mention qualification? This was asked somewhere in 2022 November, this question. Specifically, it was asked. You know, a member is permitted to mention title on their visiting card to indicate membership of foreign institute which is recognized by council. You can indicate membership of foreign bodies. You can mention membership of foreign bodies if those foreign institutes are recognized by council. Now, council has recognized some 3 bodies. What are they? Institute of Chartered Accountants, South African Institute of Chartered Accountant, Ireland CPA, and England and Wales, that CA. Only these 3 are recognized by council till date. Only these 3 memberships you can mention it along in your name, beside your name in the visiting cards. Remaining you cannot mention. So this question was asked. The members are permitted to mention a title on their visiting cards to indicate membership of Foreign Institute of Accountancy which has been recognized by the council. Clear? Only these 3, South African, Ireland, England and Wales. Only these 3 are permitted. Remaining it is not permitted. The question is like they gave a visiting card. 2 visiting cards they gave. Which visiting card is proper, they asked. RTB, MTB, main question, I'm not sure. It was asked. That's a kind of question which is asked. Next. QR code on visiting card is permitted, absolutely. But by scanning the QR code, only that details, only those details that generally appear on visiting card, only they should be reflected. Can I use electronic media like members may appear on television, films, internet and agree to broadcast in the radio, give lectures at forum and may give names and describe themselves as chartered accountants. Firm name may also be mentioned. However, claims that is not exaggerated claims or any claims that are promotional in nature, that is not permitted. Somewhere in the clause 6, TV credits, television credits, movie credits, special thanks to, like that in movies you will get, no, that and all we can give. Just that it is not, it is just like the name is appearing just like any other name, that's it. Conferences, you are permitted to attend conference and speak, no problem. Just that reference to firm should not be given. You can describe yourself as a chartered accountant, no problem. Next. You cannot use the word, you cannot use well-known form. You see ICI, you go to ICI, starting notice board will be there. In that so many letterheads will be there. A well-known firm is looking for articles, it will say. Many, a reputed firm is looking for articles, it will say. But since it is within the professional, within the fraternity, no problem. Success in articles, success of articles. Suppose my article got all India first rank. I didn't do anything. He got. But I am advertising. I am advertising, for example, that is not permitted. Seminars you can attend. I mean, you can give lectures in seminars and all. You can write articles. You can use signboards. Getting it? Glow signs not permitted. Glow signs not permitted. Can we mention your firm? I mean, your details in the prospectus and all? You must. Like here, what they say is, it should not advertise any professional attainments. It should not amount to any solicitation. That alone you ensure. Company said our auditors are so and so. Brief statement of facts only they mention. Just facts they mention. It does not amount to any solicitation like that. Yes or no? We are proud of our auditor. That should not be like that. Getting it? Next. Directorship in a company. That's okay, not that required. Common CA logo. So many lies. The green logo indicates, signifies growth, prosperity, harmony, freshness. Yes or no? Blue indicates knowledge, integrity, trust, truth, stability, depth. What? You are all asking important questions. Bulk SMS not permitted. Bulk SMS, I hope you know it. You will get messages, no bulk SMS. Offers available like that. That one. That's it. Entire part number 1 is over. Clear? Second schedule. So in that clause number 1, part number 1. Second schedule is dealing with those misconducts which are severe in nature, where a third party interest is generally affected. Prohibition on disclosure of information pertaining to client. Nothing but SCA is treated as guilty if it discloses information relating to client to any third party. However, it does not apply if at all consent is obtained or if it is required under law. This confidentiality requirement will apply even after completion of the engagement. Consent from whom you should apply in case of proprietor, in case of proprietary consent, proprietor, in case of partnership from the partner, in case of a company, board of directors power. If see whether board of directors can give this consent or any managing director can give this consent. Accordingly, whoever is having authorization power, from them you should get the consent. Are you clear? Working papers. Can I show working papers to others? Working papers are property of the auditor. Yes or no? SQC1, you are not obliged to show working papers to others. Nobody can compel you. At your interest, at your discretion, you can show to others. Members liability for unlawful act in case of client. Suppose client has done something unlawful, some non-compliance with laws and regulations. What is the member's liability in this regard? A CA is not bound to disclose income tax authorities about taxation fraud committed by him, committed by client, which he came to know during the course. He is not bound by disclosing. A CA in practice is not bound by disclose in case of the work, like whatever he get to know. However, if it comes under a NOCLAR, if it comes under NOCLAR purview, where you have to give it, where there is a requirement in the law that you have to report, then you have to report. Are you getting it? Generally, if there is no such requirement to report, you can still maintain that confidentiality of the client. The law says you are like a barrister, especially when you are dealing with income tax authorities. The representational service you are dealing with income tax authorities is like an advocate service, barrister service. Accordingly, Indian Evidence Act 126 section protection applies, where you can maintain how a lawyer maintain client details secretly, the same way CA can maintain his client mistakes, everything secretly. Are you clear? Now, in the barrister law as well as here also, if a total client committed new fraud again, there it will not be. There Evidence Act protection will not apply. If a new fraud is newly committed, freshly again, still in the course of proceeding, for that Barrister Act provision, protection will not apply. There you are duty bound to disclose. If the other party, there is a requirement for you to disclose. Are you clear? In case of representational service, you are just a third party between the department and the client. You are neither biased to them nor biased to the client. You can be neutral. If you want to ignore something, you can ignore something. If you want to consider something, you can consider something. Absolute discretion is given to you. Are you getting it? Next. Suppression of facts in the past IT returns. Yeah, suppose client intentionally suppressed some past facts and all in IT return. When you are dealing with the representation service, you got to know. When you're dealing with that services, when you're providing some tax related service, you discover the suppression made by client. You can still support your client, no problem. Because you are just a representative here. Suppose unintentionally something was suppressed, it was now discovered. In the course of income tax proceeding, investigation is going on. You are investigating complete affairs of the client so that you can present the case better to the department. At the time you discovered some unintentional suppressions. That is client choice. Like here what they say, CAP may disclose to tax authorities, they may say. They may disclose. It's not compulsory. Remember here, whatever lines they gave right, whatever points they gave right, they were based upon big case laws, where so much of discussion happened. In that last 3 lines, some discussion judgment they copied and pasted here, where we don't understand exactly the full facts of the case. Are you getting it? So can I take this as a hard and fast rule? No. This is just a guideline. That's it, a basic. So in a real case, what should be done? We need to look at the facts and circumstances of the case, requirement in the law, all that you need to look into. Further, suppose I discovered mistakes in the client IT records which was earlier certified by me. Now tell me, here I have 560 requirement. I must insist on the client to rectify the books of accounts. Yes or no? The member shall advise the client to make a complete disclosure. If client refuses, withdraw from the authority, inform that the books of accounts are unreliable. Why here I'm reacting severely? Because I certified them. If they were discovered now, if those incomes were discovered now, material amounts they were discovered now, I request clients to record it as a prior period item because I am certifying the client records. Getting it? Suppression related to current period, you must give a full disclosure. If at all client is not giving, you either withdraw or give a modified report. Suppose employment of the member is dispensed before the accounts are completed or reported. Like you were removed from the position of auditor. Later you got in about client some suppression. What's duty for you? You're already not an auditor. You're already not any consultant to the client. No duty at all. Easy. Don't interpret too much in this because they are a summary of various judgments. We don't know in what light of the judgment they gave this conclusion. So brief understanding is enough. Then a CA is prohibited. A CA is deemed to be guilty if he certifies or reports on financials which are not examined by him, which are not examined by the partner, which are not examined by employee, which are not examined by another CA in practice. Another CA. For example, exception, joint audit. In case of joint audit financials, even though you have not audited major portion, you can still sign the audit report that they are true and fair by relying upon joint auditor. So in order you to certify any financial statements, he certifies or reports on financials. If at all you have to certify, either you have to verify that, your partner should have verified that, or employee should have been verified that. Without verifying by your firm, you cannot certify. If you certify that like that, it's a gross negligence under clause number 7. Yes or no? When clause number 2 applies, most of the times clause number 7 also apply. When generally clause number 2 apply, clause number 7. Like suppose you verified entire financials, just 1 or 2 elements missed. That's not gross negligence. That's a normal negligence. You didn't verify itself properly, carelessly you signed. That's a gross negligence. Are you clear? Yeah, next. Yeah. So, clause number 3, what it says? A CA is deemed to be guilty if he allow or permits his name or firm name on a report that is dealing with the earnings estimate which is contingent upon future transactions. You are prohibited to sign projections, you are prohibited to sign forecast, you are prohibited to sign earnings estimate unless you clearly indicate in the report source of the information, basis of forecast and assumptions, and you mention the fact that you did not vouch the accuracy. These are the requirements in 3400 also, reporting requirements in 3400 also. What auditor has to state in the assurance report on prospective information? He should state that these are all based upon assumptions. He should say that if the assumptions are altered, this can be altered. You should say that you have not verified the accuracy. You should state that the actual outcome may be substantially different from the projection given here. The discrepancy will be material. You should say that. Yes or no? So the council has opined that same opinion would also apply to projections made on the basis of hypothetical assumption, about the future, that are not necessarily expected to take place, as long as the auditor does not vouch the accuracy of the projection. A CA, he has signed the projected statements of various individuals without verifying basic documents. So therefore, he is guilty of professional misconduct because he is not verifying anything. He is allowing somebody to sign that projections. Yes or no? So he is guilty of gross negligence. Moreover, he is guilty of gross negligence. We'll discuss various clauses and tell you how interlinking will apply. Then clause number 4. A CA is treated as guilty if he express opinion on financial statements of the business in which he or his firm or partner has a substantial interest. In a business entity where you are having, or your partner, your relative, if any of you are having, actually here relative is not covered. In the clause, relative is not covered, but relative is covered in council guidelines separately. Relative is covered in council guidelines separately. We have in council guidelines that point separately. You cannot certify accounts of an entity in which your relative has a substantial interest. You cannot certify accounts of an entity where you or your partner has a substantial interest, or your firm has a substantial interest. So if at all is expressing opinion on financials of the businesses or entities in which they are having substantial interest. No, forget about substantial. Even if I have normal interest, that is also prohibited. Because in Companies Act, you should not have even single share. Yes or no? The above will equally apply for all attest functions. The objective is to protect independence of mind. All attest functions, assurance functions, you cannot attest, you cannot sign if at all you are having any interest. And can you do audit of a college where you are working as a lecturer? No. No, you cannot. You cannot be an auditor of the college where you are working as a lecturer. You cannot accept the audit of a trust where your partner or employee or a trust is a trustee. I mean, said very simple. You cannot do audit of a trust where your partner is a trustee or where your employee is a trustee. Getting it? Or maybe Your partner is either employee of the trust or your partner is a trustee of the trust. Vice versa, both you can take. You're getting it. Very simple. My partner is a trustee in the trust. No, you cannot accept the audit. My partner is working as an employee. Straight away prohibited. Self-interest threat, self-review threat. Yes or no? It is not permissible for a member to undertake assignment of certification wherein client is a relative of the member. Remember, these are all inclusive. Whenever we are discussing these examples, these are all only inclusive. Look at the intention of the law. Look at the intention of the law. Even if you're firm employee, if they are trustees in the trust, then also you can take this interpretation. Nothing wrong. In Companies Act, you have a provision. If a partner is an employee of the company, indirect relationship is also covered. Same way here also, suppose your firm has an employee, he is a trustee in one trust, you should not do audit. Technically, no. It creates an impact. It affects obviously some sort of independence, not just partner. Here they are saying for partner only, but for employee also it will work according to me. Getting it? But of course, I don't think they'll test that level. Members shall not write books of accounts of the clients. Members shall not write books of accounts of the clients. Suppose you recently worked as a director in a company. And withdrawn. Up to 2 years, you cannot accept the audit of the same company. Self-review threat to be avoided. For a period of 2 years, you cannot accept the audit of the same entity where you recently completed as a director. That's it. So clause 1, 2, 3, 4. What are they? Clause 1. A CA is treated as guilty if at all he discloses information pertaining to the client without the consult of the client or without there is a requirement under the law. Clause number 2. A CA is treated as guilty of professional misconduct if he certifies reports on financials which are not examined by his firm. By his firm means what? Partner, employee, or himself. Yes or no? Now, clause number 3. A CA is deemed to be guilty of professional misconduct if at all he signs, if at all he allows his firm name or his name to deal with a report that is dealing with earnings estimate. Clause number 4. You cannot certify accounts of a business or entity in which you, your partner, or your firm has substantial interest. Further, council guidelines says if your relative has substantial interest also, you cannot sign. Correct? Further, they have given some clarifications. Sir, what about a trustee? I am a trustee in a trust. Can I sign that? No. My partner is a trustee, sir. Can I sign? No. Clear? Sir, I am an employee in the trust. Obviously, you cannot sign. Clear? Clause number 5. A CA shall be deemed to be guilty of misconduct if he fails to disclose a material fact known to him which is not disclosed in financial statements in accordance with applicable financial reporting framework. As per applicable framework, some contingent liability should be disclosed. That is not disclosed, and CA knows it already. The CA knows that it is not disclosed, but he failed to report that. When I know that company omitted some important disclosure, non-disclosure is a material misstatement, yes or no? Non-disclosure is a material misstatement. If there is a material misstatement discovered by me, I should give a modified opinion, but I didn't give like that. I am treated as guilty. Now you see, if the failure is on the part of a member who is in employment and that information is not meant for any outside authorities, then it shall not be treated as guilty. This is about internal computations that to employees. For them, this provision will not apply. That's what they're saying. Internal circulation purpose, if at all they're doing, this will not apply. This, don't interpret much on this. Okay. Next, clause number 6. Clause number 5, clause number 6, both are same only. Clause number 6. A CA shall be deemed to be guilty if he fails to report a material misstatement in financials known to him. Material misstatement means what? Amount, classification, presentation, disclosure. Disclosure means what? Misstatement. Non-disclosure, inadequate disclosure, both. Correct? Anyhow, misstatement, clause number 6 is addressing everything, right? Why clause number 5? Now clause number 6 also known to him. Remember, in both these clauses, you know that there is a material misstatement. You know that there is a non-disclosure of important fact. You failed to report that. Then you are treated as guilty. Are you clear? Generally, when clause number 2, what is clause number 2? Without examining, you are signing. Without examining, you are signing. Who is not examining? You didn't examine. Your partner didn't examine. Your employee didn't examine. You signed. That's carelessness. You signed a report, you gave a certificate or report on financial statements without examining it. It may be a gross negligence or it may be a normal negligence. Suppose if it is like CS signed without verifying anything, so carelessly and recklessly, then it comes under clause number 7 also, gross negligence. Then clause number 3, what is it? Earnings estimate. You cannot associate with earnings estimate. Their gross negligence may not come. Suppose no, earnings estimate you signed, where the earnings estimate disclosed assumptions and all, but you didn't verify reasonableness of the assumption. You didn't verify reasonableness of the assumption. Out of hurry, you signed the assumption without even verifying reasonableness of the assumption, out of some hurry. Getting it? It again comes under gross negligence. Then clause number 4, you signed financial statements of the entity where you are having substantial interest, or your partner is having substantial, or your relative is having substantial interest, then you are treated as guilty, right? Their gross negligence, clause number 7, link may not apply. You are getting the point. Clause number 5, there is a material fact which is not disclosed, and I know that, but I didn't report it. Why you didn't report? Maybe out of hurry you compiled the report and gave it without analyzing the entire summary of findings. You didn't analyze and gave report just like that. That may be a situation of gross negligence. When gross negligence, I can say whatever duty you are supposed to do as per auditing standard or as per guidance note, something that you are supposed to do, you didn't do. You're getting the point? Carelessness is involved. Carelessness is appeared in that. So you're treated as what? Guilty of gross negligence. Clause number 6 says what? You failed to report a material misstatement known to you in the financial statements. Then you are treated as guilty. Clause number 7 understood? A CA shall be treated as guilty of misconduct if he does not exercise due diligence or or he's grossly negligent. They have given some examples. Please read these examples later. Please read these examples later. Clause number 8. A CA shall be deemed to be guilty if he fails to obtain sufficient appropriate evidence which is necessary for expression of opinion. Clause number 2 also same only, na? That's why in the clause number 2 below or clause number 3 below, when that point came, 8 and 7 also referred. When clause number 2 applies, what is clause number 2? You failed to you certified or reported on financials not examined. Not examined means what? You didn't verify, you didn't obtain sufficient appropriate evidence. When clause number 2 applies, most of the times clause number 8 also applies. So, like, sir, can I quote all these 3 clauses? Suppose 2, 8, 7 applicable as per my choice. Sir, can I quote all the 3? You can quote, but don't quote continuously. Quote clause 2, clause 3, clause 2, clause 6, clause 7, clause 8, like that. Clearly, like how to present, especially ethics related answer. Read the question. Read the question. Heading you should put. For ethics alone, this presentation you follow. Heading. Non-compliance, or else you can say professional misconduct under clause number 2, clause number 6, clause number 7, clause number 8, like that. Now, a CA in practice is deemed to be guilty of professional misconduct under dash. I'll just show you. A CA is treated as guilty of professional misconduct. A CA in practice is treated as professional misconduct under clause number 2, clause number 7, clause number 8. Getting it? What is clause number 2? A CA is treated as guilty of professional misconduct if he reported, certified or reported on financial statements not examined by him or partner or employee. Yes or no? Clause number 7, fails to exercise due diligence or grossly negligent in performance of professional duty. Clause number 8, a CA reported on financial statements without obtaining sufficient and appropriate audit evidence. He is treated as guilty. A CA is treated as guilty of professional misconduct under clause number 2, clause number 7, clause number 8. Actually here 1A is, let us assume this is a question, this is a border. Getting it? So you will give heading professional misconduct under clause number 2, clause number 7, clause number 8 of part number 1 of schedule number 2. You should write full forms always. Yes or no? So now here you can put a side heading. Here you can put a side heading. You can put a side heading like this. What side heading? Relevant discussion. Relevant discussion under code of ethics. Code of ethics. You should always underline. And further you should underline key matters. Not examined by him. Failed to exercise due diligence or grossly negligent without obtaining sufficient appropriate. In every line keyword you must underline. In presentation, when you are presenting, underline. Remember, make the examiner job easy. Getting it? He must understand your answer so comfortably. Make sure he understands your answer comfortably. You should always think of an unknown person valuing your paper who is not familiar with your writing. Getting it? So make his job simple. Now, analysis and conclusion. Analysis and conclusion. You should write analysis and conclusions in detailed. In the given case, the CA has certified the financial statements without obtaining sufficient appropriate evidence, without examining either by his partner or by his firm or by himself. He certified the financials. Hence, it is treated as grossly negligent and therefore he is treated as guilty of professional misconduct under the above clauses. Or you can write he is treated as guilty. Now you are writing treated as guilty, right? Highlight that. And analysis you are writing, analysis you should mention. In the analysis you should mention that the CA has not exercised due diligence or grossly negligent, does not obtain sufficient appropriate evidence. CAP does not obtain sufficient, underline that. Treated as guilty, underline that. So by only looking at what you underlined, I must figure out what answer you wrote. In that case, examiner may not read the entire answer sometimes. Examiners were also given discretionary valuation power also. Generally, scheme of valuation they should follow. In scheme of valuation, no, they will have marks weightage allocation like this. For example, if the suggested answer is like this, allocation will be for quoting clause number 2, 1 mark. For closing clause number 7, 1 mark. For quoting clause number 8, 1 mark. For giving analysis and conclusion, 2 marks. Within this 2 marks, analysis 1 mark, conclusion that you are giving 1 mark. 5 marks like this. If any 1 point or 2 points you missed, getting the point, you will not get. Are you clear? There, see, the problem comes, the weightage issue will come. In one scenario. Suppose suggested answer contains that clause reference, but your answer is not there. In your answer, suppose you missed to include, you forgot to include clause number 8 here because you thought it is not examined scenario. You only referred these two. But what I always tell is whenever clause 2 is applicable, clause 8 also you refer because both are dealing with the same. When clause 5 is applicable, material fact known to you, not disclosed in financials. Material fact known to you, not disclosed in financials. That's nothing but a material misstatement. In such a case, that is clause 6 also applicable. When you think clause 5 is applicable, write about clause 6 also, no problem. See, if you write an extra clause, examiner doesn't know this is right or wrong, so he will ignore that. Whatever is relevant only he will take. Suppose if you missed a clause, and if at all suggested answer contains that clause extra also, then you will lose a mark. For writing an extra point, you will not lose the mark. For not writing the relevant point, you will lose the mark. You are getting the point. Now, in the suggested answer, whether they referred about clause number 8 or not, we don't know. So, when there is a conflict like this, multiple clauses apply, quote all the multiple clauses and relevant provision. Just mere mentioning clause number alone will not give you marks. You should mention that clause also. Are you clear? Understood how to score in ethics? All the clauses you should mention. If at all that particular clause is not relevant, he will not consider. Because you write an extra point, he will not, reduce any mark. He don't have that power. You're getting it. Even if you write 3 pages irrelevant answer, he must value it. He must read every line. He must value that. That's it. Remember one more thing. Examiners are paid very 150 rupees only for paper valuation. 120, 150 rupees. Writing, valuing a correct answer is easy than valuing a wrong answer. Correct answer is matching with suggested answer, easy for me. But when you're writing some wrong answer, some other analysis you are giving, the examiner don't have that knowledge. Remember that. If I give you CA Foundation statistics paper, will you evaluate? You qualified foundation, na? Don't say, sir, I'm coming from direct entry. Example I'm telling. Getting it? If I give you a foundation paper, statistics paper, you passed foundation, does it mean can I assume that you know very well foundation? Does it mean I conclude that you know alternative answers in statistics? No. Examiner CA qualified 5 years before. That's one of the requirement. Completed 4 years of post qualification experience to become a valuationer. Not engaged in teaching. He should not engage in teaching activities to the CA students. Only then he is eligible for to become a valuer. Means examiner suttama knowledge irukudadu. Correct? So examiner should not have knowledge at all. So that's a requirement. Fine. So you know what? ICA is conducting exam for examiners. If I have to become a paper valuer, it is conducting exam where you must score some 60-70 marks. Those exams are so kevalama irukum the questions. Anybody can qualify. That kind of questions. So examiner is not that competent, remember. So if you write additional point, no problem. If you do not write relevant point and wrote alternate, for you it is alternate. For him it doesn't know anything. He will consider your alternative answer as a wrong answer unless that alternative answer is presented in the scheme of valuation. Clear? And what is the possibility of your own beautiful assumption presented as alternative answer in the key suggested answer or scheme of valuation? The possibility is very low. Because our students will take unreasonable assumptions. Next. One student so cleverly wrote one paper like, is it in accordance with FEMA? That's a question actually. I saw that answer. If it is as per the FEMA law, then it is right. If it is not in accordance with FEMA law, then it is wrong. So the auditor has to check, the CA has to check whether such an act is in accordance with the requirements of the FEMA or not. In the absence of contrary, it can be considered as valid. He didn't write any answer. Their provision is expected. This fellow is not writing provision and articulating so cleverly. Next. Clause number 8 over, all of you. Then clause number 9. Clause number 9. A CA shall be treated as guilty if he failed to comply with GAP. GAP means what? Auditing standards you failed to comply. SQC you failed to comply. Just I told SQC. If SQC is failed to comply, you can directly apply clause number 9. And in one of the attempts, no, November 22 or May 23 attempt, no, they have asked one question on this point. You know, there is a company which approached, listed company approached one audit firm where their peer review certificate was cancelled. And this firm has accepted the audit without even a peer review certificate. Comment in light of CA Act. They said this is the question. Always remember when you're reading the question, look at the last. Are they saying anything like Code of Ethics, CA Act in the context of ethical requirement? Then only ethics chapter will apply. Many students, they didn't observe that line. They wrote peer review certificate cancellation provision. Because that time we have a chapter called peer review. So that time they wrote everyone that answer. Comment in light of CA Act, they said. So here in entire Code of Ethics, where this peer review concept is discussed under clause number 9. Under clause number 9, getting a peer review certificate is a generally accepted auditing principle. It's an general audit practice. Getting it? Only a firm having peer review certificate can accept audit of listed entity. So they linked this clause with this point. You're getting the point? Then that's it. Over. Clause number 10 is what? A CA, any amount received from client must be kept in separate bank account and shall be utilized for the same purpose. For short duration, where advance is received against a service, like you're receiving remuneration advance, that you need not. Money received for expenses which is to be spent within a reasonably short time, no need to put in separate bank. Money is received in his capacity as a trustee, executive liquidator, it must be put in separate bank account. Getting it? Some observations. That's it. Easy. Next. Now, relating to money received from client, we have seen part number 2, last clause. Embezzlement or theft. Clear? Okay. So shall we do revision of these clauses? Yes. Right now, just now we covered this. Part number 1, schedule number 2. Part number 1, schedule number 2. Clause number 1. A CA in practice is treated as guilty of professional misconduct if he disclosing information belonging to the client to others without permission of the client, or when there is no requirement under, or when there is a requirement under law, you can disclose. Then clause number 2. A CA in practice is deemed to be guilty of professional misconduct if he reports or certifies financial statements that are not examined by him or his partner or his firm. Clause number 3, a CA in practice is deemed to be guilty of professional misconduct if he signs an earnings estimate. However, this guilty will not apply if at all sources of information is given, assumptions used is given, and the fact that he has not vouched the accuracy of the information, then he is not treated as guilty. Clause number 4, a CA's practice is prohibited to sign, report financial statements of a business or entity where himself or his partner or his firm having substantial interest. If at all relative is having, then council guidelines says it is guilty. Then clause number 5, a material fact is not disclosed in the financials and you know that and you failed to report it, you are treated as guilty. A material misstatement is there in the financial statements and you know that you failed to report it, guilty under clause number 6. You failed to exercise skill, care, diligence, you failed to exercise due diligence or grossly negligent, clause number 7. You failed to, clause number 8, yeah, sufficient appropriate evidence is not obtained and you reported on the financials without obtaining evidence, you are treated as guilty. Clause number 9, gap. If CA in practice deemed to be guilty if at all he fails to comply with gap while rendering the services, yes or no. Clause number 10, any money received by CA in practice from the client should be kept in the separate bank account. Failure to do so is treated as guilty of professional misconduct. However, you need not keep in a separate bank account if advance is received for so and so and remuneration, or if the amount is to be spent in reasonable period. Further, a liquidator, if a CA is acting as a liquidator, trustee, receiver, he must always keep the amount in a separate bank account. Clear? Then schedule 2, schedule 2 has 4 clauses. Sorry, schedule 2 part 2 has 4 clauses. Clause number 1, yes, no, that is linked with the original one. So clause number 1, not complying with the act, not complying with the regulations made there under. Getting it? Suppose if you are not complying with the requirements of the ICA, not complying with the requirements of the ICA committees, disciplinary directorate, quality board requirements, you are not complying. Schedule 1. Requirements not complied can be for members in practice or may not be for not in practice, which means part number 3. Inside that, clause number 2. Clause number 2 is dealing with what? Fails to give the information, fails to comply with their requirements. You are violating act itself. Then schedule 2 offense, clause number 1. Then clause number 2, part number 2, schedule number 1. Employee breaching confidentiality. A CA who is a member in service, disclosing information pertaining to employer to third parties without the consent of the employer. Clause number 3, false information to the institute. Yes or no? Institute, committees, disciplinary committee, disciplinary directorate, all that. False information to others for getting the work. Then that is clause number 3 in part number 3 in schedule number 1, which is the last clause there. And already now in this clause number clause number 4, already just now we discussed embezzlement and theft, over. Now third part in the schedule 2. What is the third part in schedule 2? Imprisonment for a period exceeding 6 months. Imprisonment for a period not exceeding 6 months. In both the cases, first clause only. Yes or no? Here it is part 4 of the schedule 1. Whereas in schedule 1, part 4, there is another clause. What is it? He is bringing disrepute. In the opinion of the council, if a member in practice is bringing disrepute to the profession, then the council punish him by treating him as guilty of other misconduct. Then part 4 is over, part 3 is over. Part 2, employee is not permitted to share profits. Employee is not permitted to accept kickbacks. Now 12 clauses in part number 1. Clause number 1, a CA in practice is deemed to be guilty of professional misconduct if he agrees to, if at all he is allowing another person to practice in his name. That member should be, if at all you are allowing, that member should be member of the institute and a partner of the firm. Then no guilty. Clause number 2, a CA is treated as guilty of misconduct if at all he is allowing or agree to pay to a non-member any share of profits. Then you are treated as guilty. However, you can share it to non-member. You can share it to the following: another CA in practice, another member of the institute, a partner of the firm, retired partner, legal representative of deceased partner, member of recognized professional body, member having recognized qualification. Correct? Then clause number 3: a CA in practice is prohibited to accept any share of profit from a non-member. However, from the following members, exceptions, same exceptions, you can accept. Now, Clause number 4, you are prohibited to form partnership with a non-member. You can only form partnership with the following members: another CA in practice, or a member of the institute who are not in practice, a member of the recognized professional body, member having recognized qualification, or another member of the institute which is treated as equivalent to ICAI. Then clause number 12, a CA is treated as guilty of professional misconduct if he allows another person to sign on his behalf. Signing can be done only by firm partner. Signing can only be done by CA with COP. Only engagement partner can sign, others cannot sign. But routine correspondence can be signed by anybody. Clause number 10, a CA in practice is deemed to be guilty of professional misconduct if they are accepting fees as a percentage of profit or contingency upon findings. Exceptions, main important exceptions, last one, you can accept fees as a percentage for insolvency professional service, to non-assurance service, to a non-audit client. You can tax. Income tax representation case May 24 attempt, I told you. Then clause number 9, a CA is treated as guilty of professional misconduct if at all he is accepting audit of a company without verifying compliance with 139, 140, 141, 142. Correct? Then clause number 8, a CA in practice is treated as guilty of professional misconduct if at all he is accepting the audit, if at all he is accepting audit which is held by previous auditor without communicating with him. Inside that mode of communication we saw, inside that we have seen fees not paid, what has to be done. We have seen thus communication must from the retiring auditor. Then we have seen why communication is required, professional courtesy, all that, to know the reasons, yes or no. Then clause number 5, 6, 7 is pending. Clause number 5, a CA is prohibited to secure professional business other than an employee, other than partner, by any mean other than not open to CA. What are the means not open to CA? Clause number 6, clause number 7 they deal with. Clause number 6, a CA in practice is deemed to be guilty of professional misconduct if he advertises through a circular, personal communication, advertisement, or any other mean, or interview or any other mean. Inside that some issues we have seen, tenders and all we have seen, yes or no, tender document, website guidelines, educational videos, there are few important points. Then clause number 7, a CA in practice is deemed to be guilty of professional misconduct if at all he is securing professional business through other than partner, through advertisement of professional attainments, or using designation in addition to chartered accountancy. Then in these cases you are treated as guilty of professional misconduct. Over. Yes or no? You see, now at the first I struggled, now you see this is what happens day before exam also. You don't worry about if you are not remembering day after tomorrow this clause. I will also forget tomorrow. But day before exam for sure I will read, right? I will remember. Tomorrow I will remember. Because this intense revision I did no. So I will for sure remember. After a week I will forget for sure. Maybe a glance I can remember with 90% accuracy. But if I have to struggle, little bit to recollect exactly that map. Getting it? Generally, day before exam, 1.5 day time you are having, you revise that time, you will understand, you will remember. Clear? Then council guidelines we have. Inside that council guidelines, I will only discuss with respect to few important issues. Maintenance of books of accounts. A CA in practice shall maintain books of accounts. Chapter 5 of the council guidelines. Compulsory. Whether or not you are liable under income tax law 44AA, doesn't matter. You have to maintain books of accounts because you are a CA in practice. A CA is prohibited to accept more than certain tax audit assignments. How many tax audit assignments permitted? 60 per financial year, not per assessment year. In this financial year, right now what is the financial year? 1st April 2024 to 31st March 2025. In this year, I open Udin portal. How many tax audits you signed? 60 only should come. Which assessment year doesn't matter. However, in this limit, these tax audits will not be counted. Any tax audit that has been conducted under clause number C, clause number D, clause number E of 44AB. Under 44AB, clause number C, clause number D, clause number E. These three clauses will not be, because in these three clauses you are doing audit because the SS is declaring income less than presumptive basis. Are you getting it? So those. Which audits are counted in 60? You are doing audit because the SSC turnover is more than 1 crore, because the SSC turnover is more than 50 lakhs in case of profession, in case of business. A and B clauses only covered within the 60 count. Are you clear? That is why in tax audit, no, 3CB, you need to select the clause. Are you clear? Next, 60 per assessment. Now, 60 per financial year. Now, how the 60 will be counted in case of partnership firm? Per partner having full-time COP. Suppose if a firm is having 5 partners with full-time COP, 5 into 60, 300. Now, each partner should sign only 60 files. No, the firm can allocate the 300 among any. The choice is within the firm, no problem at all. One partner can sign all the 300 signatures, no problem. Remaining partners should not sign that time. Are you getting it? Now the firm shall maintain a register of tax audit assignments per assessment year. For every assessment year, for every financial year, whatever all they are signed, they should maintain a register. Now it is technically not required because UDIN itself is giving a register. Are you clear? Next. That is one. Next, another one. Limit on prohibition on audit assignments under Companies Act. Prohibition on audit assignments under Companies Act. This is one provision where many has confusion. Very simple. Under Companies Act also there is a ceiling limit. Yes or no? What is the ceiling limit under Companies Act? Let us look at Companies Act. Let us look at Companies Act ceiling limit. A CA can do an audit of maximum 20 companies. However, in that, what are not counted? 1-person company, dormant company, small company, private limited company, less than paid up capital, less than 100 crore. These are all not counted. Correct? CA Act, Council Guidelines, what they say, a CA in practice cannot do audit of more than 30 companies other than 1-person company, other than dormant company. Only 1-person company, dormant company is excluded, which means even if you are doing small company audit, even if you are doing private company audits, even though their paid up capital is less than 100 crore, they are counted under CA Act. Now, which one I should comply? Both. You must comply both. For example, I am having 20 1-person company audits. I am having 24 private limited company audits. Private limited company audits whose paid capital is less than 100 crore. I have 7 small company audits. I have 2 government company audits. Now, these are the audit composition right now. Can I see compliance with the Companies Act and all? Yes, first I am seeing Companies Act compliance. The Companies Act, what are counted? This 7 small, no, this is also not counted. Under Companies Act, no, this is not counted, this is not counted, this is not counted. Only this gets counted. So as per Companies Act, it is less than 20, therefore permitted. Now under CA Act, I will see. 1-person company will not be counted. Private limited company, 20 will be counted. Small company will be counted. 2 will be counted. 24 plus 7 plus 2. How many? 33, man. Yes or no? 33. Since you are exceeding 30, it's a violation. Any 3 companies you have to resign. Under Companies Act, no problem. But under Council Guidelines, there is a problem. So you have to comply with both. Correct? Are you clear? Now here also, 30 they said, right? How they can allocate among the partners? Number of partners into 30 is equal to that many audits the firm can accept. Allocation can be of their choice. Same provision for tax audit. Next. Now this is very important council guideline. What the council guideline says is, this guideline is applicable for PSUs, government company, listed entity, other public companies having turnover 50 crore or more. Private company clients, this is not applicable. Ceiling on non-audit fee, the provision is not applicable if I am doing audit of a private limited company. In question they will twist you. Private limited company they'll give you non-audit fee, big case study they'll give you. Because of the case study you will lose in the case study your mind. You will not observe the fact that it's a private limited company. Getting it? Many students will not focus on this applicability part. So in case of public sector undertaking, means all government companies, listed entities, other public limited entities having turnover 50 crore or more, then the guideline says you are providing to that company some audit service and non-audit service both. Non-audit service means those which are not prohibited. That's what the meaning. Now for audit, no, you are taking a fees of 2 crore. For non-audit service, the client is coming and asking you an extra work, non-audit, permitted. But the fees for all non-audit services provided by you put together shall not exceed 2 crore. If at all another non-audit service client is asking, already 2 crore remuneration limit reached, don't accept that. If you want to accept that, resign from audit and then accept it. You're getting the point. So non-audit service from a client cannot be accepted if the fees received for all the non-audit services plus the proposed non-audit service fees put together, if at all they're exceeding audit fees for statutory audit, don't. Now non-audit fees, no. Who is billing this non-audit? Either your firm is billing or the company, management consultancy company, which firm only established. Partners only, directors. Whether the company is charging the bill or the firm is charging the bill or both of them put together charging the bill for other services, that limit should be considered. Understood? Suppose in network guidelines, this provision was extended. Suppose my firm belongs to one network, Deloitte network. Now I am providing audit services to one client where I am charging 5 crore fee. Where I am charging how much fee? 5 crore. And I am also charging non-audit services, other services where I am getting 4 crore. Did I comply with this guideline? Yes. Apart from me, my network firms are there, right? My network firms, within the Deloitte, some 4 or 5 network firms were there. They are also providing non-audit services. They are also providing non-audit services to the same client where I am the auditor. One of the network firm is auditor, remaining network firms are providing other services. Can they provide? Yes, they can provide, no problem. Only prohibited service they can't provide. Only prohibited service under 144 they can't provide. Other services they can provide, no problem, they are providing. That they are charging a fees of more than 4 crore. My audit fees is 5 crore. My audit fees is how much? 5. Network firms, 3 or 4 firms put together charging more than 5 for other services. Forget about my other service, 4 crore. My limit satisfied. They are charging more than 5 crore. 5 crores for all of them. Is it permitted? Yes. Up to 3 times of the fees that you are charging for stat audit. That much value, that much worth of non-audit services can be provided by network firms. No problem. Are you clear? Indirectly, for you 1:1 permitted, for them 3:1 permitted, 4:1 permitted totally. Entire from the network. The total fees for non-audit service shall not exceed 4 rupees of the 1 rupee fee that you are getting for stat audit by one of the network firm. Clear? 4:1, don't remember the 3 for networks, 1 for this firm. Okay? Again 4 where is there? You don't ask me. Next. Are you clear? In that network, that is one of the important point in network guidelines. Suppose a CA is treated as guilty if the CA or partner or the firm or relative, they are indebted to the entity where they are doing audit more than 1 lakh, you are guilty, or limit specified under the law. Whatever limit is applicable, that one. It's not whichever is higher, whichever is lower. No. You are getting it? If at all there is no law to the client where I am doing audit, am I indebted? Yes. Is it exceeding 1 lakh? Yes. Disqualified. Sir, I am doing audit of a company, sir. Is there a law for indebtedness? Yes. In the disqualification, how much is the indebtedness limit? 5 lakh. Then 5 lakhs limit applicable. Are you clear? That's it. Networking guidelines. See, very simple. When a group of firms are treated as network, when they are all using common brand name, common trade name, common quality control policies, and sharing significant professional resources. What do you mean by significant professional resources? It may be work methodologies, it may be manpower. Generally, manpower sharing, if it is there, it is generally treated as sharing of significant professional resources. Just suppose, me and another firm, we just joined together to develop one work methodology alone. For that reason alone, we just joined. We are not treated as a network. When multiple firms are treated as network, then they are all having a common quality control policy, having a common brand name, having a common trade name. For outsiders, it appears that either of the firm is same only. In that way, if multiple firms are projecting themselves, then it is called as what? Network. And a firm can only be forming part of one Indian network. Or a firm, can it be a member of international network also? You can. Are you getting it? You can. If at all a firm become a member of one of the domestic network or international network, whatever it is, suppose there is another firm. In that, there is a common partner. The other firm also should go with the same network. Suppose in my firm, there are 3 partners. We joined Deloitte firm network. One of the partner is also working in another firm as a partner. That firm want to join KPMG network. Is it permitted? No. Are you clear? These are the issues, crux. These are the issues which are there in the network firms, which generally you will have a confusion. Clear, all of you? And how to establish a network, all that they have given guidance, that is not required. Now, ethical compliance for network, just now I covered. Ethical compliance. prohibited services. If at all you are providing audit service to a company, your network firms cannot provide a prohibited service under Companies Act to the same company. And ceiling on non-audit fee, just now I told, rotation of auditors, Companies Act itself says under rotation the incoming auditor shall not belong to the same network. Yes or no? Now the firms can have framework for internal bylaws. I don't think they will ask like this. I don't think. Now how a network will be formed? By the way, network, no, can network do practice on its own? No, only member firms shall do practice. Network shall, can the network name be KPMG and Co? No, they can say KPMG and affiliates. Network is just a entity which is there to monitor member firms. That's it. Network will not do practice on its own. Network will be represented by the word and affiliates. Member firms cannot use the word and affiliates. As a CA, if you want to open a firm, your firm name can be and co, your firm name can be and associates. Any of these two only permitted. Are you clear? That's it. Network guidelines are over. Are you clear, all of you? Understood or not? I spoke all the confusing points. Now in this network, no, you have this discussion like registration of networks, approval of the name of the network, that and all not permitted. Form, network itself can have an entity. Say network is an entity, right? What form? Can they be a partnership firm? Yes. Can they be an LLP? Yes. Can they be a company? Yes. Can they be a mutual entity? Yes. Can they be a society? Yes. Anyway, it can be. But whenever they are exhibiting, no, it must exhibit with a name called so and so and affiliates. Are you clear? And co and associate. Practicing network cannot do work directly. Network is only for monitoring member firms. So from each member firm, one senior partner will be the board of director in the network. They will design, they will sit and design quality control policies, all that, which is applicable for all member firms. So that's network guidelines. With this, I think all the important points in council guidelines I have covered. Then we have something called self-regulatory measures. Till date they've never asked, but maybe it can be relevant also. Now, in one more point is there. So can we register on aggregator? Can we register on aggregator platform? No. Clause number 6, any means is prohibited. You cannot list your services on aggregator. Gem portal is permitted. Gem portal is not an aggregator. It's only for government buyer. Amazon is an aggregator where so many buyers register, so many sellers register. Flipkart is an aggregator. Urban company is an aggregator where so many buyers register, so many sellers register. Just Dial is an aggregator. Buyers register, sellers register. Are you getting it? Aggregator means a common platform where buyers and sellers register and exchange goods and services for consideration. That's it. CA, can he register on aggregator platform? Prohibited. That's it. Self-regulatory measures are very easy. In this, only one regulatory measure I will discuss. Every CA in practice, shall have at least one qualified member. Shall have at least one qualified member for every 5 non-qualified members. In my office, if at all so many non-qualified staff is there, for every 5 non-qualified, I must have one CA in practice. One CA, one member of the institute. He may be as a partner, he may be as an employee, whatever it is, to maintain quality balance, to ensure that CAs will not do entire work with articles who are cheap labor. Yes or no? Next, who are not considered non-qualified members. By the way, articles are not counted, type is not counted, peon not counted, any other person not engaged in professional works, they are all not counted. Means paid assistance if I am taking, BCom, MCom, yes or no, or CA finalist paid assistant I am taking, they are all counted in 5 number. For every 5, it is recommendatory for you to have one qualified member. Otherwise, how will you monitor all of them? Only qualified person can monitor, yes or no? Quality control review can be done only by either partner of the firm, another member of the institute, or suitably qualified external person. Only you are there. Everyone is non-qualified staff. How will you review? How many you will review? First of all, you are getting it. In order to comply with all quality control practices, this recommendation is there. Right now, it's only recommendatory, not mandatory. Clear? That's it. Ethics is over. And one more thing. One important thing. You have important decisions of ethical standard boards. In that, no. Refer latest ICA material, even for November 24 exams also. Open ICA material, Inside that, in the last page, recent ethical standards board decision, something like that is there. Can I see a trade in commodity derivatives? Can I see a trade in equity derivatives? Can I see a do equity research? All that, like that, some questions and some statements and all were there. Please read them for sure. From that also questions are being tested in MTP, RTP. From that also questions are being tested. Unless you read some of the points, you can't figure out whether it is guilty or not guilty. Clear? Please read that. That alone, you please keep it for self-study. Are you confident? That's it. Ethics is over. Almost we spent close to 3.5 hours. So let's begin the next session, that is specialized areas. So we have 4 set of other standards that we have. One is specialized areas, which deals with special purpose frameworks. And we have related services, review and assurance engagements, which are dealing with various things, which I already told. Like we have totally 46 engagement standards, out of which 35 standards on auditing, 3 standards on auditing only. They are also dealing with auditing standards only, but they are specially considering about specialized areas like special purpose frameworks. If the financial statements are prepared in a special purpose framework, what auditor has to specifically consider? That is what 800 series addresses. Then we have review. Review is like 2000 series. Related services 4000 series. You know, whatever services we provide, they are broadly classified into 2 categories: assurance and non-assurance. Non-assurance means where there is no third party. Assurance means a third party is involved. In an assurance engagement, there are 3 parties who are involved. One, the responsible party, the one who prepares the subject matter. The one who prepares the subject matter. For example, in audit, subject matter is financial statements. Responsible party is management or those charged with governance. Correct? Management or those charged with governance is the responsible party. They prepare the financial statements based upon some criteria. That is called as applicable criteria. What is it called as? Applicable criteria. So the responsible party prepares the subject matter based on applicable criteria, for which the auditor, another party, the auditor verifies that financial statement subject matter against applicable criteria and gives a report. And he will give a report. And that report is used by users. That report is used by users. So totally there is a 3-party relationship: responsible party, auditor and the user. And there are 2 more elements of this assurance engagement. There will be a subject matter, and the subject matter is prepared against applicable criteria. So these are the 5 elements of an assurance engagement. Now this assurance is again 2 kinds. Assurance on historical financial information. Assurance on historical financial information. Assurance on other than historical financial information. On historical financial information, we give 2 levels of assurance. We give 2 levels of assurance. One, reasonable assurance. Another one, limited assurance. Yes or no? We know this. The basic difference between reasonable assurance and limited assurance is as this. Reasonable assurance, we tell the whether financials are good or bad. Are they reliable or not? Whereas in a limited assurance, we just say that not bad. If at all I did not find any mistakes in that. We don't say that they're good. We don't say that they're true and fair. We say that we don't have anything to say that they're not true and fair. Negatively we will say, like suppose if a movie is so super good, we say that the movie is excellent, hit, super hit. If the movie is like okay, it is not like you can't even watch it, it's okay, one time watch, not bad. Limited assurance is not bad kind of assurance. Reasonable assurance means saying that it is good. You're getting it? So limited assurance is a generally lower level of assurance than reasonable assurance. Now the limited assurance is addressed by a separate set of standards where we call them as review standards. Standards on review engagement. What are they? Standards on review engagement. Whereas reasonable assurance, auditing standards. We have totally 38 auditing standards technically. 35, 200 to 700 series. 3 standards that are dealing with special purpose frameworks. Then we have other than historical financials. We are providing assurance on Not only historical financial, we are also providing assurance on other than historical financial information. For example, we have seen 340T. We are giving assurance on controls, which is a non-financial information, We are even providing assurance on prospective financial information. That is 3400. We are even providing assurance on proforma financial information. Proforma. What is proforma? What is prospective? That and all we'll discuss in the assurance chapter. Then we have the final non-assurance services. If you recollect professional ethics, in that there is something called management consultancy and other services. Inside that consultancy and other services, there are some assurance services like internal audit, environment audit, energy audit, various. Ignoring that, most of other services are non-audit services. Most of the services that are covered in that management consultancy and other services definition in professional ethics, they are all non-audit services. All that comes under related services. All that generally comes under what? Related services. Now, whether a CA in practice, can he provide both assurance and non-assurance to the same client? Yes, he can provide. Subject to, suppose if it is a company, they have given a list of services that an auditor cannot provide. Prohibited services. Except those prohibited services, except those non-audit prohibited services, rest all other services you can provide. For example, one doubt was asked, in the previous session. Suppose there is a company called ADP Incorporation, that payroll company, let us assume. They approached me and they asked me to be a service auditor, and I accepted the appointment, and I'm giving report all that, independence, everything is to be required here. So I accepted, I'm giving service organization, service audit report, all that. Because they impressed with my work, they even proposed me, why can't you be the stat auditor? I can accept it, no problem, because both are assurance only. So for a company which is a listed company, can I do both 3402 engagement? Can I do even audit engagement? If there is no prohibition, you can do both. Where is prohibition on this? In 144 section, is there a prohibition on this? No, so you can accept. So whenever a conflict, whenever you get a doubt like this, simple, interpret, is there a prohibition? If there is no prohibition explicitly, it is permitted. Clear? These are the composition of various standards. In that, now we are going to discuss about special purpose frameworks. If you observe this, 800 series, if you observe, the name itself says, it's not audit of financial statements prepared accordance with a special purpose framework. They added a prefix called special considerations. Like, what does it mean? Which means, if you are auditing special purpose financial statements which are prepared in accordance with special purpose framework, you can still follow all the auditing standards that are given under 200 to 700. However, with coming to reporting alone, 800 itself gave an exclusive format. So that's why we follow 800 format of reporting. If at all 800 is silent on the audit report, we would have followed what? 700 format. When we are doing audit of special purpose financials or audit of general purpose financials, in both the cases, your objective is to obtain reasonable assurance whether the financial statements are prepared in accordance with the applicable framework. In a general purpose financials, applicable framework is general purpose framework. In a special purpose financials, applicable framework is special purpose framework, as simple as such. So our objective is same, which means the methodology of conducting audit is also same. Okay, when every aspect of audit is same, what is special about this framework? Are there any specific points I should consider? Yes, you have to consider certain specific points. Those specific points are addressed by 800. When you are doing an audit of special purpose financials, are there any specific things to consider? Apart from 200 series to 700 series, anyhow you consider that. Are there any other specific things that you need to consider? Yes, you need to consider. 800 answers that. 805 is also answering special considerations only. Provided here in 805, you are auditing not complete set of the financials. You are not auditing complete set of the financials. Generally, whenever we think of financial statements, it is complete set of the financial statements. It is complete set, nothing but balance sheet, P&L, cash flow notes, statement of changes in equity, which are prepared in accordance with some framework. So this financial statements full set is called as what? Complete set of financial statements. This full set is called as complete set. But here you are not doing complete set. You're only doing single financial statement. You're auditing only a single financial. Suppose an entity approached you just to audit cash flow statement. Just to audit cash flow statement. Or they approached you to audit a specific element called stock. For example, banks will do stock audit, right? Stock audit comes under specific element audit. 805 is applicable there. Stock audit in the cases of banks, 805, this is specific element because I'm doing audit of a specific element or a specific account or item of the financial, specific account or item. Audit of single financial statement or specific element or item or account of the financial statements. What specially you need to consider? What are the points you should consider if you want to take up this kind of activity? Standard 805 answers. Whereas 810 is talking about, you see here, they are not using the word audit of summary financials. We don't audit. We only report on summary financial statements. We only report. Getting it? Like many confuse with audit of summary financials versus report of summary financials. We don't audit summary financials. We'll discuss, don't worry. I'll explain all the logic slowly. So on summary financials, we only give a report. That's it. We just give a report. After confirming few things, we give a report. We don't specifically and separately audit summary financial statements. Summary financial statements are nothing but as simple as such. You will find public companies, not public sector companies, government companies, they are advertising about their financial results. Annual financial results, they are advertising in the newspapers. You will find in many newspapers, especially during the month of April, May, June, many government companies presenting their condensed financial statements. Balance sheet they will present. In the newspaper they will publish. In the newspaper they will publish P&L. They are the best example of what? Summary financials. Summary financials is also called as internationally condensed financial statements. They are internationally known as what? Condensed financial statements. Understood? So that is what entire 800 series is dealing with. Now let's begin the 800 directly. We already discussed, if you recollect, in the fundamentals topic itself. What is a special purpose framework? What is a general purpose framework? I already explained. In a special purpose framework, the rules and regulations for preparation and presentation of financial statements. The rules and regulations. The rules for preparing the financial statements is dictated by a specific user. Is dictated by a specific user. As per his rules and regulations, we have to blindly prepare. That's it. Whether they are achieving fair presentation or not achieving fair presentation doesn't matter. Remember, special purpose financial statements are not available on a public domain. They are confidential in nature. What is a special purpose framework? Does Companies Act talk about it? Does SEBI talk about it? No. It is prepared for a special purpose. What purpose? Nobody knows. Nobody knows that purpose. Suppose a company chairman who already retired from the active affairs of the company, he want to review company financial statements in a different principles. With a different principles he want the picture. So he asked the company directors, like, for me alone separately you prepare financials on a cash basis. I will not believe on this accrual system, all that. Cash basis you prepare. What are all provisions you created in normal financials, which is accrual, right? Give me a list of provisions. Give me a statement where the profit calculated on cash basis minus expected losses provision, what is the revised profit? Give me that statement separately. So I want to see financial statements with a different perspective. I told what is my requirement. The board of directors have to prepare financial statements exactly as per my requirement without any deviation. They have to exactly prepare as per my requirement without any deviation. Now, since since board of directors has to prepare without any deviation, this is a compliance framework. This is what? Compliance framework. Like whether the chairman, he gave a rules, right? On what basis we should prepare financials. Whether they achieve fair presentation or not doesn't matter for him. I am not bothered all that. I want, this is how you have to prepare. That's it. Whether this is fair or not fair doesn't matter. I gave you the rules. You follow the rules. Prepare the financial statements as per that and then give it to me. They prepared and gave it to me. Now whether they prepared as per my rules or not, I want assurance. Whether they are prepared as per my rules or not, I want an assurance. So I appoint an auditor. Now for the auditor, which standard is applicable? All other standards are applicable to audit. Additionally, what is applicable? 800 is also applicable. because these are the financial statements prepared in accordance with special purpose framework. So audit of financial statements prepared in accordance with special purpose framework. What are the special considerations? Special purpose framework means, now you understood, right? That is why I tell special purpose framework is a best example of compliance framework. Compliance framework, what is it? What actually it says? Some rules will be there. You strictly has to follow the rules for preparing the financials. The compliance framework is a financial reporting framework where financial statements are prepared as per the requirement of the framework. What framework says? As per that requirement we prepare. That's it. No deviation. Exactly we follow that. Now this framework is a special purpose framework. Here we are talking about what special purpose. What is the characteristic here? We have to prepare as per the rules given by the chairman. For his internal purpose, for his decision making purpose, we have to prepare. Can I deviate? No. Sir, it is not achieving fair presentation. His methods are unconventional. Not achieving fair presentation. None of your business. Prepare as per his requirement and give it. Can I call this requirement of special purpose framework as an example of compliance framework? Yes or no? Exactly. Whereas general purpose financials, the Companies Act specifically emphasizes auditor has to verify whether the financials are true and fair or not. You see 129 subsection 1 Companies Act financial statements section. Every company shall prepare financial statements in accordance with accounting standards, in accordance with Schedule 3, and shall reflect a true and fair view of the affairs of the entity. Means Companies Act clearly says annually every company prepare financials, right? They must be prepared as per standard. They must be prepared as per the Schedule 3. In addition to it, it must also achieve true and fair view. When there is a requirement in the framework that the financial should achieve true and fair view, naturally the framework is fair presentation. What does it mean? You know, generally when you're preparing financial statements, you prepare as per some rules, right? You prepare as per some rules, right? Though that rules are like originally required to follow, if at all you feel that some of the rule is not achieving fair presentation, you can deviate from the rule. You can deviate from the rule. Follow some other rule that brings a fair presentation. That flexibility of deviation is permitted in which framework? Fair presentation framework. In a fair presentation, we are deviating to achieve fair presentation. Ultimately, to achieve fair presentation, only we are deviating, not for some other purpose. Clear? So, compliance framework, one of the best example is special purpose frameworks. These are all best example of compliance frameworks, special purpose frameworks. Getting it? So, the SCA 800, they are dealing with, can you accept the engagement? How to plan and perform the audit engagement of special purpose framework? How to express opinion? But it does not dealing with expressing opinion on effectiveness of internal control. Of course, the standard does not deal with internal control related issues. They are mainly dealing with what? Financial statements. How are they prepared? Are they true and fair or not? That's it. What is a special purpose framework? It's a framework for financial reporting. Special purpose framework, as it's a financial reporting framework designed to meet financial information needs of not wide range of users, specific users. You see, in general purpose framework, here they will add one more word, common financial information needs. When I will say common requirement in everybody, when the users are wide, when the users are many. Yes or no? The requirement of applicable framework determine the form and content of the financials. What constitute a complete set? So what is the complete set of financial statements? What should be the format of the financial statements? What should be the content inside the financial statements? That is entirely decided by the framework. Correct? That is entirely decided by the framework. According to whose requirement you are preparing. Suppose if I am preparing financials as per Companies Act, then the Companies Act will tell you what format, what are the components of financials, all that Companies Act will tell you. If some user is telling you, then he will dictate it. Next. So whatever I have told is included in the entire first question. Now, what are the considerations when accepting an audit of special purpose framework? What are the considerations when you are accepting? This is an important question, 4 marks or 5 marks question straight away. What auditor has to consider when you are accepting audit of special purpose financials? Very simple. The first thing I look at is, who is the user? What is his requirement? What is his requirement? What rules and regulations he gave so that the requirement will meet. I will first analyze the user requirement, needs of the user I need to look into. And I will also look into what rules and regulations he gave. First point, I will look into what rules and regulations. Whether that is acceptable or not, I will check. Whether that is acceptable or not, I will check. Acceptable means what? Directors came and showed me, sir, this is the rules, sir. This is the user, sir. So he want financials to be prepared as per these rules and regulations. Now I need to think from user point of view. From the user point of view, is this rules and regulations acceptable based upon his requirement? I will think of it. If at all the responsible party prepare the financials using the rules which user is also asking, if that is acceptable from the point of view of user, that's the first condition for me whether to accept or not. Clear? That's the first condition for me whether to accept or not. Second thing what I will check is whether is there any acceptable organization standards. I will see, are there any standards for this acceptable organization standards for preparing special purpose financials? I will see that. For example, suppose, best example I'll take. Suppose the government has given a grant. The government has given a grant to NGO. Now government want the NGO to prepare some reports and financial statements so that utilization of grant is given highest priority. Where in the financial statements major attribute is what? Utilization of grant. So government want to see the financial statements of this NGO which contains major focus, which gives major focus on utilization of grant. So government gave the rules and regulations. On what basis you have to prepare financials, all that. This is one of the condition for the grant given. This is one of the condition. Dear company, take this grant. Use it for the purpose you mentioned. Use it for the purpose you mentioned. Give me revised financial statements and a report on grant utilization. And in the financial statements also, grant should be given specific emphasis. Generally, this NGO will not prepare financials as per that requirement. For NGOs, there is a separate organization. There is a separate organization available. For example, financial reporting body for NGO. There is a separate body which releases some format of financials which NGO has to follow. Hypothetical example I am telling. For example, there is a separate NGO body, financial reporting body for NGO is established for NGOs. For example, that body decides what framework is applicable for NGO. What framework they should follow normally. That format generally NGO prepares. If at all government has not given any such condition of format, all that, NGO will follow that format. If NGO format is there, government is also there. If when like that is what? Regulatory requirement means what? The auditor has to check one, whether are there any specific standards for the special purpose financial reporting. That first point. Two, whether is there a regulatory requirement. Here government gave the grant, right? Here government is a regulatory for the grant. What government is asking? It is asking NGO to prepare financials in a certain format. So regulatory requirement also you should check. Suppose if there is a conflict. Suppose if there is a conflict between organization standards, the specific organization standards and regulatory requirement, which one will prevail? Auditor should ask the management. Auditor should look into the light of circumstances and decide. Sometimes special purpose financials may be prepared as per contractual obligations. To meet terms and conditions in the contract, special purpose financials has to be prepared as per the terms and conditions given in the contract. For example, here grant letter is there. Inside that grant letter, some additional conditions were given. That also has to be complied. Special purpose financials has to be prepared, keeping in mind important attributes to the users. For example, here when I am preparing financial statements separately for the governmental authority which gave me grant, the most important attribute they are asking me to focus is utilization of the grant. In the P&L account, I must separately show for grant expenses as separate items. Normally printing and stationery, the NGO incurred. From the grant also you might have spent printing and stationery. For every item you must also separate how much you spent from grant, how much you spent from your own donations, contributions, like that. What are the attributes to be given more focus on? What is the most important attribute in case of grants? The government authority want to know whether you are using the grant for the required purpose or not, stated purpose or not, whether the financial statements are achieving the transparency or not. That is the most important attribute. You're getting it. So the auditor has to check. If in case of special purpose financials, the financial information are very important factor to determine acceptability. So how they prepare financials? They will give you some rules. Are these rules acceptable for the user? Because here I am not doing audit from any common point of view of various users. No, I'm doing audit from the point of view of user. A specific user is there, he appointed me. I'm doing audit from his point of view. So is it acceptable for him? Is there any special organization for this to talk about the special needs? If so, check whether that is acceptable. Check whether that is applicable. Is there a regulatory requirement for special purpose financials? In this, if the situation is there any regulatory requirement? For example, sometimes government will be giving so many grants to various NGOs. In order for the government to know, whether these NGOs are properly utilizing, they established a framework for that. So for NGO, financial reporting framework for NGOs that are receiving donations from government of India. They published a framework. They published. So that framework is called as what? Organizational standards. Organizational standards means nothing but the framework may cover some standards established by organization that is authorized to promote standards for special purpose. If government established one framework, one department, one committee, and they established one framework, like all the NGOs that are receiving grant from us, in addition to their regular financial statements which they prepare annually, they should prepare additional financial statements for our purpose exclusively. Like this, they established a body. See, regulatory requirement also. The body is established, fine. Now grant is given, right? Inside that grant, some terms and conditions were there which contains beyond the organization standards. For this particular NGO, we gave extra grant. So we want to put some additional terms and conditions. The auditor has to consider all this. When you are accepting a special purpose financials, is the special purpose financials are prepared exactly from the point of view of user? Are there any established organizational standards for preparing special purpose financials? Check out. Is there any regulatory requirement for the special purpose framework? Check out. If there is a conflict between these two, which is applicable, which that NGO has to follow, decide. Or sometimes the financial reporting framework is decided by the terms and conditions of the document. Grant letter, check that and see attributes were given major importance, because every financial reporting framework is giving certain focus on certain elements. Here, in case of this NGO, the major focus is on grant utilization, transparency, that one. See whether that attribute is addressed by the framework or not. See, otherwise there is no point. If the financials user want to know something about the financials, if the financials are not addressing that, which is actually required for the user, I should not accept that audit, because the financial statements are not acceptable. Ultimately, they became not acceptable. Why they are not acceptable? Because the financials are not prepared in accordance with the contractual provisions of the grant. Because they are not prepared as per the regulatory requirement, if at all there. They are not prepared as per the respective organizational standards, if at all there. So I will not accept. Our financial statements are not considering the need of the special user. If they are unacceptable, I will not consider, I will not accept. Understood? These are the two major questions. Especially the second question is what mainly people confuse. Like they don't understand the context of discussion here. Next. So what are the considerations when planning an audit ultimately? Okay, you understood, you decided, let us accept this engagement because the framework is addressing. All the issues. Now, what is the requirement? The auditor has to comply with the 200. And all the SCS relevant to audit also has to be complied with. All the standards that are relevant for audit has to be complied. Comply with standards on auditing. If at all you are deviating from standards, if at all you are deviating from any of the standard when you are performing special purpose financials, why are you deviating? What alternative method you followed? How does it achieve evidence? How does it achieve the objective of the standard? See, every standard has an objective. For example, 250 is there. The objective is very simple. Identify non-compliances that has an impact on financials. If so, report it to the users. As simple as this. This is the objective. To achieve this objective, what processes you should perform? 250 says. Like you verify legal expense account, you verify lawyers, internal counsel, you talk to management, you connect with external lawyers, somehow try to identify what are all the litigations, claims, pending liabilities, non-compliances with laws and regulations. So what are their consequences? All that you try to identify. So they are giving procedures to achieve this objective. Sometimes you may not follow one of the procedure given there. How, for example, external legal counsel you need to talk. You didn't follow that. Why you didn't follow? Because they're not cooperating. Then how did you verify alternatively whether these information about non-compliances, how did you know? What alternative ways you performed to get this evidence? Prove that. You're getting it. So depart. So, when, auditor has to sometimes judge it necessary in exceptional circumstances to depart from the requirement of essay by performing alternative and application of some of the requirement of standards and auditing in application of special purpose framework. Obviously, we apply some of the standards and auditing requirements. For example, we take 320 standard, we apply materiality, we use 260 standard, even in special purpose framework. No, remember, for special purpose framework, those charged with governance may be different. Generally, for general purpose financial statements, those charged with governance is so and so management. For special purpose framework, those charged with governance means a specific department would have been created for that. So who is those charged with governance in case of special purpose financials? Don't blindly apply 260 requirement which generally talks about general purpose. Adapt it to special needs. When a complete set of financials is also prepared, when a complete set of general purpose are also prepared, those persons responsible may not be same those who are responsible for general purpose. Clear? So recognize. So various provisions of normal standards and auditing can be applied in special purpose financials. They'll give you an example. They'll give you this itself as a 4 marks question. Give you examples of, they'll give you a question like this. Give you examples of application of some of the requirements of standards and auditing on audit of special purpose financial statements that require special consideration. Give you examples. SA 320 we can apply. SA 500. Whether evidence obtained by us is sufficient and appropriate. Even in special purpose framework also we should apply the same principles. How to audit special purpose financials? You do some risk assessment procedure, you do further audit procedure, all that you do. 315 we can apply. 260 you can apply. 570 you may have to check if at all there is a requirement. What not every standard will be applicable. 210 is applicable. You have to establish terms of engagement, right? When you are doing audit of special purpose financials, don't you require engagement letter? Which exactly defines what you have to do, what you are not supposed to do. Are you clear? Here they have given few examples, that's it. Then finally, auditor has to form the opinion. Now, what auditor has to describe? Write about description of applicable framework in audit report and alerting the users on its usage and distribution. Like for this, for example, this is 800, SA 800 related illustration. For better idea, I'm just showing you. This is the format of audit report that we generally give for 800. Independent auditors report, say heading will be same. Addressee, to the addressee. This is old format of audit report. For November 24 exams, this is only applicable. Even for May 24, unless institute gives a supplementary material saying that new material is applicable. In the sense, new format is applicable. Until now, for May 25, November 25, separate material itself is not there. The 2023 version material only is there. So, except that there is no other indication. For November, you need not worry at all. The same format is applicable. So, addressee, introductory para. We call it as what? Introductory. We have audited financial statements. Management is responsible. What is auditor responsibility? Opinion. Simply citing his opinion means what? Obviously, unqualified opinion. Now, this is reference to special purpose framework. Reference to special purpose framework in the audit report means what? In the audit report itself, I am telling you what is the basis of accounting. And not only that, special purpose financial statements are restricted for distribution and use, right? Are they publicly, can we put it? No, unless there is a requirement in the law. Is there any such requirement in India? No. In some other country, there might be such a requirement. Whatever purpose you are preparing financial statement, you should submit to the lawmaker. I want to know every internal affair. I don't want to leave. There might be a requirement like this. There might be a requirement in some companies across some countries that the company, even though they are preparing special purpose financials for some purpose, even though the contract is not materialized, you prepared for some contract purpose. Whether contract proceeded further or not doesn't matter. You prepared it, submit. There may be a requirement in some countries, some law. In India, there is no such requirement. Special purpose financial statements need not be submitted to lawmaker or regulatory, anywhere, not required. Without modifying, you see, the auditor started with the starting. I am not having objection. Look, without modifying, we draw attention to note number in the financial statement which describes the basis of accounting. The financial statements are prepared to assist the company to comply with the provisions of the contract referred above. As a result, the financials may not be suitable for another purpose. Our report is also purely for ABC company and DF company, should not be distributed or used by other parties. So if at all somebody accidentally got this audit report, after reading this, they will understand this is not meant for me. You're getting the point. So look at this. Now look at this. Alerting the readers of the financials. What? The special purpose financial statements may be used for the purpose other than those which they were intended. There is a possibility like this. For example, a regulator may require certain entities to place special purpose statements as a public record. So in such a case, especially, audit report must contain the clear side heading that basis of accounting and intended use and distribution. In addition to the alert required as discussed above, the auditor shall consider it appropriate to indicate audit report. It is purely for specific users. Depending on law, this may be achieved by restricting the distribution or use of the audit report. In these circumstances, paragraph alerting the readers may be expanded to include these matters also. Alerting the users that the basis of accounting is this. Alerting the users that this is useful only for them. So and so, not for others. These financial statements are not freely distributable. Are you clear? This is one of the reporting requirement. What introduction they are saying? Whether financial statements adequately refer the described, adequately describing the framework. Whether the financials are adequately describing the framework. This is a requirement in 700 also. In the case of financials prepared in accordance with the contract, suppose if I prepare as per a special purpose framework, the auditors check whether financials adequately describe the interpretation of the contract in the financials. We will check whether in the financial statements in so and so note point they clearly mentioned on what basis the financials prepared. If so, draw attention in the audit report. Basis for accounting. Understood? Because special purpose financial statements are not meant for everyone. The audit report on special purpose financial statements is not meant for everyone. So as an auditor, I should check whether financial statements which are prepared on special purpose inside that notes are they describing on what basis they are preparing. Even general purpose also, you see, basis of accounting they will mention. Even in every general purpose financials which is published by Tata Motors, all that they mention, we prepare financial statements as per Ind AS. We prepare financial statements considering these principles. They mention all that. Same requirement is there for special purpose. And auditor should also mention about the same in the audit report. Are you clear? Especially this requirement of alerting the readers and the requirement of mentioning that it is restricted for use and distribution is even more important if at all the company is liable to place special purpose financials on a public domain. If at all privately given, even if I don't use that para in audit report, I'm not bothered because it won't go to anybody else. But if at all I have to place in a public domain, if at all that report is going to be used by multiple people, those specific users only, but a group of people are going to use, in these cases, considering that I'll put. But whether there's a requirement like that, I always put. In case of special purpose financials, I always put this. You clear? 800 is over. Easy. All of you. Technically, 800 standard only little difficult in 800 series. But that 800 standard looks little vague, especially that second question, need of the user, organizational standards, contractual provisions. I gave you that NGO example. Understood? That's it. Otherwise, you feel like reading the same points 3 times. But both those 3 points are slightly different. Just 2 minutes. 805. Audit of single financial statement, audit of specific element, audit of account or item of a financial statement. Audit of single financial statement, specific element, account or item of the financial statements. Depending upon the context, specific element, account, item, they will be using the word. Depending upon the context, they will interchange. Audit of single financials. Now here you need to use this word, complete. There is another word which is frequently used, is complete set of financial statement, single financial statement, single financial statement element, specific element. Many a times in the standard, they use this word single financial statement or element. They use this word called single financial statement or element very frequently in the standard. Nothing but element means what? Specific element they are addressing. So both put together, single financial statement and element. Single financial statement and element. Contrarily, we have another thing, what? Complete set of financial statements. Nothing but generally this complete set of financial statements are audited using general purpose framework. These are prepared using general purpose framework. So a company which is generally preparing complete set every year, in addition to that, they are preparing some specific, they are preparing some single financial statement or a specific element they are preparing, and they are asking you to address this. They are asking you to verify and give an opinion. They are appointing you to do audit single financial statement or a specific element. Best example in banks is stock audit. If a bank has given a loan to a borrower where the amount of borrower exceeds 5 crore, the bank will appoint stock auditor for that borrower. This particular auditor will go to the borrower premises and audit whether the borrower has maintained correct records for stock, whether the statements that he is submitting are true and fair, whether valuation of security and all is proper, whether drawing power is proper or not, he will verify. Mainly he will verify whether valuation is correct, whether that much stock is really there or not. He is doing an audit of specific element. When you are appointed as an auditor for a specific element, or when you are appointed as an auditor for a single financial statement, which is generally not a general purpose framework. Generally, under a general purpose framework, complete set of financials are audited by you. This is not a routine engagement, right? So this is a different engagement, right? So what special considerations you should consider in this? That is what the standard says. I will start with this, like, can I accept a single financial statement element audit? Can I accept audit of single financial statement or element? Can I accept that audit? It depends upon how significant that single financial statement in the overall financial statements, how significant it is. For example, suppose a company called me, sir, please come and do only balance sheet audit. No P&L, no cash flow, don't even touch that. Just come and do balance sheet audit and give an opinion on the balance sheet alone. State of affairs alone, you give opinion whether the position is true and fair or not. Reasonable assurance. By the way, it's a reasonable assurance engagement only. Give an assurance. I saw the company balance sheet. Before I accept, I just asked, give me the balance sheet, rules, all that, or else you give me the rules at least for that. I saw the balance sheet, it contains depreciation calculations. Gross value minus depreciation, net value is there. And I saw inventory valuation is there. And I saw provision for bad and doubtful debts is created. And I saw some liabilities related something is created. And reserves and surplus, especially, huge item is reserves and surplus. In the balance sheet, the huge item in the liability side is reserves and surplus. In that reserves and surplus, the major item is current year profit. The major item is current year profit. I politely said, since the major element in this is current year profit in this balance sheet, doing this balance sheet audit alone is not possible. I cannot give opinion. You are asking me, don't look at P&L account. You want me only opinion on balance sheet. Whereas the balance sheet liability said 50% figure is profit only. How can I give opinion without verifying profit? Then they said, verify profit and loss account also, sir. Then, if that is the case, it's a complete set audit. No. It's not single set audit, single financial statement audit, right? So look at whether auditing single financial statement, is it okay? If at all, that requires audit of various other elements also. Where client is not allowing you to do audit other elements, you should only restrict to balance sheet, sir. Why are you going into P&L? Because P&L is a major portion in the balance sheet. The profit of the current year is more than 50% of the total liabilities, which means most of the assets, more than 50% coming from the current year operations. How can I audit? Without auditing P&L, how can I give opinion on balance sheet? Suppose current year company did not do any business much. Last year only they did business. This year negligible operations. Now they are calling you. Then I will accept. Because current year business operations are not affected in the balance sheet. Only balance sheet audit I will be ready to accept. So whether auditing single financial statement requires audit of other elements or also, you check. If so, don't accept that single financial statement audit or don't accept that single element audit. For example, the company is asking, sir, please you have to give a report on reserves and surplus alone. Single element only, specific element only, they're asking me to audit. Please audit reserves and surplus. These are the reserves. They just give one-page document. Reserves and surplus consist of P&L account, which consists of current year operations result, and moreover in the total reserve, 70% of the reserve is belonging to current year P&L. How come I ignore that P&L account and do only reserves and surplus audit? Not possible. This is the most important thing that you should consider when you're auditing a single financial statement or specific element or item or account of the financial statement. Understood? Now, this standard does not apply when you are reporting, to report. This standard does not apply to the report of a component auditor issued as a result of work performed for the component at the request of a group engagement team for the purpose of audit of financials. Suppose the main auditor has asked the component auditor, dear component auditor, in this company, in this entire group, what I feel is revenue recognition is complex. Can you please do a separate evaluation of revenue recognition and give me a separate report? I asked the component auditor. Principal auditor is asking a component auditor. Does it come under 805 engagement? No. Component auditors, one of the duty is to consider whatever specially the principal auditor recommended. Yes or no? Special considerations to be considered by the component auditors, principal audit procedures. I can direct him what additionally he has to do. Are you getting it? I can direct him what additionally he has to do. If I direct to the component auditor what are the additional elements he should focus on, and he is giving a report on that, this standard will not apply. Then when this standard is applicable, altogether this is a separate engagement. You are exclusively appointed for this single financial statement audit. You are exclusively appointed for specific element audit. For that reason we appointed it. Then only this standard is applicable. Just like 800, this standard is also talking about when you can accept, how to plan and perform, how to form an opinion, and this standard does not deal with internal controls. Just like 800, this standard also have the same applicability and scope. But in 800, it is dealing with complete set of the financials prepared in accordance with special purpose framework. Here it is dealing with single financial statement which may be prepared using general purpose framework or special purpose framework. We don't know. We are auditing single financial statement or specific element. This specific element or single financial statement could have been prepared either using general purpose framework or using special purpose framework. Whatever it is, I am auditing a single financial statement. I am not auditing complete set of the financial statement. Clear? So what is a single financial statement? It is different from complete set, but includes notes ordinarily comprising summary of significant accounting policies and other explanatory information. Suppose when I say, sir, you are appointed only for revenue from operations audit. When I say revenue from operation audit, means in the P&L revenue from operations plus notes to accounts, whatever accounting policies, whatever principles, whatever that are dealing with revenue recognition, all that is covered. Correct? Naturally, impliedly, when I say revenue from operations, does it include only P&L account face of the face value, that face number? No. It also includes related disclosures in notes. It also includes related accounting policies mentioned. It also includes breakup of the revenue from operations. Yes or no? What is an element? Element is nothing but single financial statement and element. Element of the financials, or element means an element or account or item of the financials and includes related notes. That's what I'm telling right now. Revenue from operations means it includes related notes, all that. What are the considerations when you're accepting single financial statement or element audit? What you need to consider? First, you need to consider, is it practicable? Balance sheet example. Company asked me to do only balance sheet audit. But when I see the balance sheet, major liabilities or reserves and surplus, it is not practicable for me to do only balance sheet audit. Unless you give me P&L audit also, it is not possible for me to do only balance sheet audit. And of course, consideration, one more important consideration, you have to comply with all the standards on auditing. Wherever, remember, at the end of the day, this is an assurance engagement. By default, an assurance engagement requires independence. By default, an assurance engagement requires independence of mind, most importantly. The maker and checker should be different. Whether you are an unrelated person to the organization or not, that is dictated by the law and regulation. In case of general purpose audit under Companies Act, law says the auditor must be unrelated. In a special purpose financial statements audit, no, it's a private assignment, right? That's their choice. Suppose the user might agree, sir, my brother is a CSR, so can I prepare the financial statements and audited them by my brother itself? If the user agrees, what's problem for you? So independence in appearance may not be required in special purpose framework audits. You are getting it? Independence in appearance may not be required in single financial statement element audit. Understood? Compliance with requirements of SCAs relevant to the audit of single may not be practicable when the auditor is not engaged to audit the complete. Like the standard says, very simple. See, the point says, if at all you are not the auditor of complete set financials, doing audit of single financial statement becomes difficult. If at all I am the only one who did audit of complete financial statements, I understood the entity, I understood how the entity operations, I know where and all risk is arising, I know entire business environment. Even if you give me a separate engagement, single financial, I can do, because that understanding helps me there. But only single financial statement audit sometimes may not be practicable, because this element is affected by various other elements. Whether revenue from operations is correctly recognized or not, it is affected by first control environment. Whether company established a proper control environment, it is affected by dispatching of goods, inventory, maintenance. Revenue from operations is affected by purchases. Revenue from operations are affected by even sales related controls. Revenue from operation is affected by credit department of the company. So many elements are there. Sometimes check, is it practicable or not. Generally, auditor does not have same understanding of the entity and its environment when we are doing audit of single financial statement. If at all I am the only one who did complete financial statements audit, and the company is also asking me, sir, can you give us a report on revenue from operations alone? I can definitely give, because I already understood entirely about the company. So I can give definitely. But if a some other auditor is appointed, whether he will have that understanding or not, you need to check out. In case of an audit of specific element, certain standards require audit work may be disproportionate to the element being audited. Some elements, for example, reserves and surplus have to audit. Suppose a company called me, do audit of reserves and surplus. I'm happily accepted, because high amount of fee I'm getting just for limited work. 3 days work I felt. When I go, I understood it's 30 days work. Reserves and surplus inside, P&L account is there. That's a major item. I cannot do reserves and surplus audit without doing P&L audit. If I have to do P&L audit, all the elements of P&L have to audit. Are you getting it? Disproportionate work might be there. So these are all points you need to consider. What are the considerations when accepting? Especially when an auditor has not audited complete set of the financial statement. They'll give you this itself for 4 marks question. You are appointed as an auditor for audit of single financial statements, and you have not audited entities complete set of the financial statements. What considerations you will keep in mind before giving acceptance? You need to write these points. 4 marks question. Understood? Next. The first I will check practically possible or not. Second, I will check on what basis they prepare this single financial statement. The second point, what I will check, on what basis they prepare this single financial statement. What is the framework they followed? Generally, the financial reporting framework which we see under Companies Act, Ind AS, these are all frameworks which are designed keeping in mind complete set of the financial statements, correct? Is Ind AS designed to address single financial statement, to address a specific element? No. Ind AS is established, Ind AS is there to recognize various items, measure various items, present and disclose various items which are to be made in complete set of the financial statements. Schedule 3 is there. Is it addressing only a single financial statement or specific element? No. Schedule 3 is addressing about complete set of the financial statements. Whatever frameworks that we see in a day-to-day basis, right, for financial reporting, they are generally dealing with complete set of the financial statements. Now, how this entity prepared single financial statement, by using which framework? Because the general framework is complete set. Which framework they followed, on what basis they prepared the single financial statement, on what basis they prepared the specific element, is it acceptable in light of the user? Ultimately, remember, from user point of view, you should think. Ultimately, whether it is general purpose financial statements audit, special purpose financial statement audit, single financial statement audit, whatever it is, you should always think from user perspective. From the user point of view, is it acceptable? Suppose a bank want to know before they give you a loan. Because this entity has so much of credit sales. Profit is good. Cash flow is moderate. And the bank want to know, you're having super sales, inventory is there, credits you are receiving from suppliers, everything appears fantastic. But I want to know, how is your collection mechanism? How is your inventory turnover ratio? Bank want to know specifically how frequently your inventory turnover, and most importantly, what is the cash flow? So the bank appointed you, dear Mr. Auditor, go and check receivability of trade receivables. No, we will ask banker, dear banker, tell me against what benchmark you will say receivable is not proper. If at all receivable is outstanding for more than 60 days, then I will say it is not proper. I will not give loans for that. Company would have told receivables are less than 60 days, less than 30 days, like that. You go and verify whether receivables are collected within 60 days from the date of sale or not. Check out and give me a report. Give me a report on cash flow statement of the company, how the cash flow is. And cash flow statement, general purpose framework says 3 activities: operating, financing, all that. I'm not bothered about finance at all. I am bothered only about operating activities. Do an in-depth evaluation of operating cash flows and then give me a report. Company prepared cash flow statement exclusively keeping in mind operating activities. They gave a detailed breakup than required under accounting standard. They gave a detailed cash flow breakup for operating. They prepared as per the bank rule. And they prepared trade receivables report with the detailed aging analysis as per the bank requirement. Now here the requirement is decided by banker. Now banker appointed you. You know the user. You know his requirement. Company followed that requirement or not, you can check it out, right? Whether the framework followed by the company is acceptable or not. That is the second important element you should check. If it is acceptable, accept the audit. You take up the audit. First see, is it practicable? Second, you see, is it acceptable, in the sense the framework followed for single financial statement, specific element is acceptable. A single financial statements may be prepared in accordance with applicable framework that is based on framework established by authorized and recognized standing set in, which is generally helpful for complete set. Sometimes a single financial statement or specific element, it is prepared using the same framework that is applicable for complete set of the financials. Banker is asking me, sir, can you give me a detailed report on trade receivable? What company did you know? Trade receivables, whatever is there in the complete set financials. No, where and all trade receivable discussion is there, all that copied into one page and then gave it. Which means the trade receivable element is compiled. The trade receivables single element is compiled by the company following a general purpose framework. Sometimes that can also be there. See, is that acceptable for the banker? For the user, is it acceptable? For the user, if the framework is acceptable, only do audit. Whether that is properly done or not, then give a report. If at all the framework itself is not acceptable, what is the point of verifying? Tell me, you have to verify the financial statements against a subject matter. Against a criteria. You must understand whether the criteria is correct or not. In a special purpose framework, criteria is established by banker. Correct? Now, that's why I told the single financial statement or a specific element, it can be prepared using a general purpose framework. It can be prepared using special purpose framework. Whatever it is. Framework means what? Rule and regulation. Who will give this framework? Users will decide. In case of general purpose, users are so many, right? That's why the lawmaker will decide. In case of special purpose, only one user, right? He himself will decide. That's the logic. Next, framework. Whenever you are unable to understand the context by seeing these words, framework means substitute rules and regulations. Framework means substitute with that, with this word, rules and regulations. Then you will get an idea. Requirement of the framework means what is the requirement as per the rule. Requirement of the framework. How should I prepare this balance sheet? How should I prepare this debtors? How should I prepare this revenue from operations? What the rule says. That rule is given by special user, or that rule may be a general purpose framework, which may be whatever it is. So they'll give you an exam this question. Write about acceptability of financial reporting framework when auditor is appointed for auditing single financial statement or specific element. They'll give you a question on this, 4 marks question straight away. Next, what are the considerations in planning and performing the audit? Ultimately, now what are the considerations? So, okay, you accepted. Practicable, acceptable framework, you accepted. Now what you need to consider? Simple. One of the major requirement is comply with standards on auditing. This is there even in 800 also. This will be there even in 810 also. Usage of evidence obtained earlier. Especially you have audited complete set. Luckily you were only given a special single financial statement audit also. Can I use evidence obtained by me for that specific element in the earlier audit of complete set? Absolutely, you can use. Whatever is relevant you can use. Obtain sufficient and appropriate evidence regarding the single financial statement and specific element, whether that single financial statement and specific element is presented as per the requirement of the user. Verify interrelated items. Technically correct, I told, right? Interrelated items also you should verify. When the interrelated items you should verify, especially when the interrelated item is significant. Suppose banker is asking me to give an opinion on trade receivables. Sales also you should verify. Because trade receivable is a result of sale. Correct? And consider materiality and evaluate as a whole the single financial statement. How material the single financial statement as a whole to complete set. How material? If it is very significant, generally we will not accept that audit. If it is not that significant, it's material but not pervasive, generally we will accept that. If it is pervasive element, we will not accept. Suppose generally only balance sheet audit we generally not accept. If at all during that year major operations were carried out, many items of balance sheet, for example opening balances and right now closing balance are more or less same, I can accept balance sheet audit because this year no business happened. So balance sheet impacted by P&L is very minimal. Are you getting it? Tell me, every item in the balance sheet is affected by P&L, right? Technically speaking, depreciation, current assets, trade receivable, cash and bank balances, everything is affected. Entire current asset is affected by P&L. Like, what is the form of opinion? This is where like many confusion will have. Remember, by the way, form of opinion is different. There is a next question. Forming an opinion is different. Form of opinion deals with wordings of the opinion section. Form of opinion deals with wordings of the opinion section. Forming of an opinion means how to form this opinion. You're getting the point, all of you? Form of opinion is not that important. Forming of an opinion is very important. Just 1 minute, okay? I'll continue. Just 1 minute. அப்படியா? புரிஞ்சுதா மேடம்? புரியுதா இப்போ? Yeah, we'll proceed. Forming of an opinion, nothing but it is dealing with the report. How auditor should report on single financial statement and element. How auditor should report. In order to know this, first you should understand for whose purpose the single financial statement is prepared or the specific element is prepared. Is it published along with complete set also? That you need to check. Is this single financial statement and specific element is published along with complete set? Now here remember, published means what? It's not public domain. To that user, is the company giving complete set and single financial statements together in a single document, in a single report, or not? You need to check. Suppose if they are giving in a single report, auditor has to check whether complete set of the financial statements and single financial statement and element are clearly differentiated. Are they clearly differentiated? How do you know? That report will be there, no? Bunch of documents, booklet. On that booklet, no, PDF or booklet, whatever, index will be there. Inside that index, only one item is there. Financial information is there. Below that, complete set of complete set of the financial statements alone is there. Separate index is not there for single financial statement, but is there in the book. It is there as a continuation. Okay, when I open even that respective page number, I saw, as if it is like a continuation to the complete set they presented. They are not differentiating it. You should specifically ask management to differentiate. Why? Single financial statements are a different financial statements from complete set of the financials. They both cannot be interpreted together. The user must know, okay, this is single financial statement, this is a complete set, there is a separate audit report on this, there is a separate audit report on that. Correct? Even I am the only one who audited complete set financials, but still I should give a separate audit report on single financial statement because it's a separate engagement. Correct? So, an audited single financial statement, an audited specific element may be published together with audited complete set. If the auditor concludes that presentation does not differentiate, auditor asks the management to rectify. Auditor shall also differentiate the opinion on para. You shall also differentiate the opinion. Nothing but you should give a separate opinion. The auditor shall not issue audit report containing the opinion on single financial statement until he is satisfied with the differentiation in the presentation of single financial statement with the complete set of the financials. This itself can be asked as a 4 marks question. Yes or no? If audited complete set of financial statements are published along with single financial statement and element, what are the duties of the auditor in this regard? 4 marks question. You should check. Common sense, right? If they both are published together, common sense. Like, what is the concern here? People might think both are same. So that's why what I should do? They both are different. Company should exhibit that. Yes or no? If the company is not exhibiting that when they are publishing, we should ask them to exhibit like that. If at all company is not exhibiting that, I will not give a report on that. Simple logic. Are you clear? Now you might get it out. Sir, what if we concluded this and then gave a report, later they modified and then published? SA 560 action. Appropriate action. Yes or no? You may directly inform the user that I didn't publish like this. I didn't give report in this context. So they both are different documents. Don't believe, don't read, interpret. This framework is different, that framework is different. This report is different, that report is different. And you know what? Sometimes, okay, let's say summary financial statements audit. There I will discuss. Anyhow, why to confuse again? Suppose like complete set of financial statements were audited either by me or by somebody. Forget about it. Like somebody or somebody, but they were audited. There is an audit report also on that. Now I am giving an audit report on single financial statement or specific element of the financial. I am giving an audit report on single financial statement. Now the complete set. By the way, tell me, even though I am doing a single financial statement audit alone, complete set was done by somebody. Should I read complete set for an understanding of the entity and environment? Obviously, you are supposed to. Just because you are only auditor for single financial statement doesn't mean you don't have any right to read complete set. If at all company is not permitting you, see is it practicable for you to continue the engagement. If not, don't accept that engagement. Simple. If at all after accepting they are limiting this, resign, withdraw. Are you clear? So now complete set of the financial statements and audit report also I read. Shockingly, that audit report contains some qualified opinion or adverse opinion, emphasis of matter, other matter paragraph. So much is there that are dealing with complete set of the financials. Now, whether should I refer about them? Should I refer about them in the single financial statement, or should I refer about them in my audit report on single financial statement or relevant? This is a question. Yes, the standard says yes. When you are giving an audit report on single financial statement or specific element, kindly include the modifications to the report in the complete set, the modifications to the audit report on the complete set of the financials, which contains a modified opinion, which contains an emphasis of matter, which contains another matter paragraph. Mention, give that indication also. Generally, the user for whom single financial statement specific element is given, no, 99.99% of the cases, complete set financial statements access will also be there. Moreover, complete set financial statements are a public document generally. Every company has to publish in their website. We are downloading annual reports from where? Company websites only. So complete set of the financial statements are generally published in the website. So the SA 805 says, in the audit report on single financial statement or specific element, mention, include what are all the qualifications made by the auditor in the audit report on complete set of the financial statements. What are all he highlighted under emphasis of matter paragraph, spoke under other matter paragraph, highlight. That is what. If the opinion of the auditor's report on complete set is modified and which includes emphasis of other matter paragraph, determine the effect it will have on the single financial statement. What is its effect on? Okay. When deemed appropriate, the auditor shall modify the opinion on single financial statement. For example, when I will modify, if at all audit report on complete set contains modified opinion, and when should I modify in the single financial statement? Generally, when I will modify, suppose in audit report on complete set of the financial statements, there is a modified opinion on trade receivable. The qualification is dealing with trade receivable. Whereas I am also doing audit of single financial single element only, that is specific element only, that is trade receivable. If complete set of the financial statements contains a qualified opinion on trade receivable, if I feel that is appropriate even now also, I will also qualify. You are getting the point. Suppose on complete set of the financial statements, the auditor has expressed adverse or disclaimer of opinion. Same I must do for single financial statement, because in 705 we have seen, if on the financial statements the auditor has expressed an adverse opinion or disclaimer of opinion, in the same audit report on a single financial statement or specific element of the financial statements, unmodified opinion is not permitted. When? If it is same audit report. That too, the adverse opinion or disclaimer of opinion was dealing with a major item, and that major item only I am doing audit under single financial statement. It's a major item in the financials. On that auditor, because of that item, auditor gave a disclaimer of opinion. Because of that, auditor gave an adverse opinion. And that major item alone, company appointed me to do audit separately. Even then, I will give adverse opinion only. Even I will give disclaimer of opinion only. Correct? Suppose that this is a separate engagement. No, this is a separate audit engagement. That's a separate engagement. There, the company presented completely not true and fair. But here, the information is modified. Here the information is modified. The single financial statement, whatever cash flow they presented, no, that is not the same cash flow that is there in the complete set, which is actually not true and fair. Here company revised and presented. Now what should I do? This is a question. This provision is not addressed by the standard. This point is not addressed by the standard. But considering the logic, if at all the single financial statement is presented true and fair, whereas complete set, that element, that single financial statement which is part of complete set, at that time it is not true and fair. Depending on that context, you give adverse opinion, the auditor. Here it is since true and fair. Can I give an unqualified opinion? You can give, and draw the attention of the user. Draw the attention of the user that on the same financial statement in the complete set, the auditor gave an adverse opinion. Clear? By the way, under 700 or under general audit, can we give separate opinion on each and every financial statement, or we'll give opinion as a whole financial statements? We give opinion as a whole financial statements. We don't give separate opinion on balance sheet. We don't give separate opinion on P&L. We give single opinion on both. Cash flow. You see, in our opinion, to the best of our information and according to the explanation given to us, the aforesaid financial statements present fairly, in all material respects in accordance with the applicable financial reporting framework of the profit as per P&L account, of the position, state of affairs of the entity, and cash flow regarding the cash flow statement, and notes which contains disclosure of significant account policies followed. We give a single opinion on all four put together. Correct? We are not giving a separate opinion. So, if auditor concludes it is necessary to express adverse opinion or disclaim the opinion on the complete set as a whole, revised 705, nothing but 705 standard does not permit the auditor to include in the same auditor's report. This is a key word. In the same auditor's report, where you give an adverse opinion, can I give in the same audit report unmodified opinion on a single financial statement or on a specific element? No. Because of this sentence only, I said emphasis of matter paragraph is not permitted in an audit report that contains adverse opinion or disclaimer of opinion on the financial statement. Because when you say entire financials are wrong, below you're highlighting emphasis again in the same audit report, you are contradicting with your very first opinion. Correct? Suppose if the single financial statement element is the major item of the complete set of the financial statement, the auditor shall not unmodified opinion. Even if they are not published together. Right now I told you this case, right? The standard is not addressing this scenario. Like, see, the standard is drafted keeping in mind this. Whatever is complete set they presented or not true and fair, the same would have been repeated in single financial statement also, even though it's a separate audit report, even though it's a separate engagement, separate report is given. Like actually 705 says what? In the same report I should not give. Okay, I'll give a separate report. Can I give unmodified opinion on the single financial statement? Can I give unmodified opinion on the specific element, even though on that aspect auditor gave adverse opinion in a different audit report? Can I give like this, even though they are not published together? You are not supposed to give. That's the standard says. What I asked you, how I asked you this question, the single financial statement is actually not true and fair. The element is actually not true and fair. That's a major item. That's why auditor gave adverse opinion. But the company revised it now. The company presented it now true and fairly. Now, can I give an unqualified opinion on this? Standard is silent on this. Standard only says, if at all the single financial statement that you're auditing or a specific element that you're auditing is a major item in the financial statements complete set, on that complete set, the auditor gave a adverse opinion, the auditor gave a disclaimer of opinion, even though this single financial statement is published separately, even though you are giving a separate report, do not give unqualified opinion. Correct? That is what, right? So indirectly, what the standard says, suppose if the single financial statement is not a major item, if at all single financial statement is not a major item, and the single financial statements are published separately, audit report is published separately, now can I give an unqualified opinion? Yes, provided three conditions are there. One, it is not prohibited by law. Such a prohibition is not there. You should not give unqualified opinion on single financial statement if it is derived from complete set of financials which contains an adverse opinion. You should not give like that. There is no law. First condition. Second, the opinion expressed in audit report is not published together with the report containing adverse. Second most important, the single financial statement which is not a major item, the specific element which is not a major item, on which you are giving an unqualified opinion or planning to give an unqualified opinion, that shall not be published with a complete set to the user. Where the complete set is given, adverse opinion. It should not be published together. Third most important, the specific element is not a major portion. It's a minor portion. Adverse opinion was given by the auditor because of non-consolidation something. Here the company is asking about investment value. They are asking me to give a report on whether investment is stated correctly in the balance sheet. I can give. Are you getting it? All of you. That's it. Now, so this itself can be asked as a 4 marks question. This itself can be asked as a 4 marks question. They'll give you this itself as a 5 marks question, main question. Write about forming of an opinion on single financial statement or element when the audit report on complete set of the financial statements contains a modified opinion or emphasis of matter paragraph or other matter paragraph. So what auditor has to do? Finally, we will have to check adequacy of presentation and disclosure in single financial statement and element. What about reference in other matter paragraph in audit report on single financials? Modification in complete set not related to single set. Even if the modified opinion on complete set does not related to audited financial statement. Audited, here you see, here they use this word. This is where many confuse. Emphasis, like even when the modified opinion on complete set or emphasis of matter paragraph, other matter paragraph in the audit report on complete set does not relate to audited financial statement, singular, means a single financial statement or the audited element. Like you audited single financial statement, you audited specific element, right? So the modified opinion, emphasis of matter paragraph, other matter paragraph on complete set, no, they are drawing attention on something that is not related to the single element that you audited, single financial statement that you audited, even though you are giving audit report on single financial statement, right? You are giving audit report on specific element, right? In that audit report, under other matter paragraph, draw this fact. What fact? Hey, there is a separate financial, it's called complete set. In that complete set, the auditor gave a qualified opinion, the auditor gave an emphasis of matter paragraph, auditor gave another matter paragraph that is dealing with so and so. Just I am giving you for your reference. By the way, my opinion on single financial statement is unmodified. My opinion on single financial statement or element is unqualified, clean, clear. This is not required. That's it. 805 is over. Easy or not? All of you? So what 805 says, first, can I accept the audit of single financial statement or specific element? That's the first question. If it is practicable, especially this point we should check when you are not the one who audited complete set. When the auditor for single financial statement is not the one who audited complete set of the financial statement, you need to specifically check, is it practicable for you to audit? Sometimes the single financial statement constitute a major portion and you have not audited the complete set. That's why you see here. You see, like in this question also, they indirectly hint that. Here they indirectly hint that. If same person audited the complete set, then only this entire discussion comes. Major item, not a major item, all that. Suppose different person is audited and I am exclusively called for auditing single financial, and that's a major item. I will not do audit. You're getting my point. I will not do that audit because it is not practicable for me. If same person audited complete set and the same person is appointed for single financial statement, can the same person accept it? Yes, it is practicable, you can accept. Now, before accepting, what framework is used for single financial statement? What framework is used for specific element? Is it acceptable framework or not? Look at the requirement of the user, check out and then accept. Then plan and perform the audit, comply with standards, get sufficient appropriate evidence. You can even use the evidence which is obtained in previous audit of complete set, all that you can use, and perform the audit. When coming to opinion, you both were audited by you and they both are being published together. Check whether differentiation is made. If differentiation is not made, do not give the report. Simple. Ask them and make sure it is made. Otherwise, don't give the report. Sir, can I give an unmodified opinion on single financial statement and element? In the same audit report, you are not supposed to give. That's what already 705 says. But this is a separate engagement, right? The single financial statement and element is a separate engagement, right? Audit, and the complete set audit is a separate engagement, right? Can I give an unqualified opinion on the single financial statement or specific element where we actually expressed adverse opinion on the complete set? Can I give like this? Yes, you can give if it is a minor item, no explicit prohibition in the law, and this not a major item, and not published together. One more important question, not published together. You can give. Suppose if it is a major item, Whether now the single financial statement rectified or not doesn't and all, don't even think about it. Don't give. You also give adverse opinion. You also give adverse opinion. You also give disclaimer on the single element if it is a major item. That's it. Easy. And what about emphasis of matter paragraph, other matter paragraph that is there in the audit report on the complete set of financial statements, but that emphasis of matter paragraph, other matter paragraph or qualified opinion, whatever it is, are not related to single financial statement or other element. What auditor in the audit report on single financial statement, what he has to do in the other matter paragraph, you draw attention to all of them. That's it. Over. Clear? 805. So we now will discuss 810. Yeah. We'll now discuss 810. Engagements to report on summary financial statements. Engagements to report on summary financial statements. We are not doing audit of summary financial statements separately. And you can only report. You have to just give a report. That's it. You're not supposed to do audit again. Actually, in 805 also we can discuss reports, actual practical reports, all that, but that time is not possible. So let's discuss on this. The standard prefix introduction itself says summary financial statements on that report can be given only by the auditor who audited the financial statements. Actually, here they use the word audited financial statements. Here they use the word audited financial statements. Summary financial statements, both are different. Audited financial statements, summary financial statements, both are different. Generally, audited financial statements are nothing but complete set of financial statements in 805. In 805, the same is regarded as what? Complete set of the financials. Summary financials means what? From the complete set, a condensed version. Summary financials also will have these elements: balance sheet, P&L, cash flow, notes, statement of changes in equity, everything will be there. But all are in a condensed version. Whereas complete set of the financial statement means full set, full version. Now here, you just have to give a report on summary financials. You just have to give a report on summary financial statements. When you can give this report on summary financial statements as given under 810, only when you audited the complete set. Now the standard, instead of referring it as CSFS, they are referring it as AFS. They are referring it as audited financial statements. The auditor can report on summary financial statements only when the same person audited the audited financial statements. Audited financials means nothing but the complete set of the financial statements. Understood? Now here the main discussion is actually learning the objective. Now what is the objective here? Tell me. Here what is the objective in a summary financial statements? I need not talk about whether they're true and fair. No, I am not giving opinion on that. I just tell whether this is a fair summary of the complete set. Whether the summary financial statement, you are saying that summary, right? Is it a proper summary? Is it a proper summary, or anything important missed in this? Or anything important which is missed in this? Holding companies generally take summary financial statements from subsidiary companies. Generally, I think even holding company has to give in consolidated financials or standalone financials, I'm not sure. About material subsidiaries, their financial statements have to be presented, right? The holding company has to present material subsidiaries and associates related financial statements in the notes. Which financials? Detailed financials, huh? No. Summary financials they will present. Maybe in that context summary financials are required. Maybe in that context summary financials are required, or maybe summary financials are required by the acquirer, purchasing company, in a scheme of amalgamation. Give me a brief financial statement so that I can give it to my main chairman, who cannot sit and read 200 pages financials. He wants it in 20-25 pages. That's it, enough. He can understand. He has that experience. He can understand. So you are preparing summary financial statements keeping in mind a requirement of some user. Some user requirement is there. You are preparing summary financial statement based on some user requirement. Now what auditor has to report on summary? This is a question. I just have to report whether the so-called summary financials you are saying, are they reflecting the summary from the complete set or not? Are they presenting a fair summary of the audited financials? That is only my duty. Are they called a summary? Can I call them a summary? When I can call the financials as a summary? When it is a fair summary of audited financials. Means the quality of information and summary financial statements should be clear. The quality should be high. Even if the summary financials are read, most of the decisions can be taken. In such a way, summary shall be drafted. Correct? Now, how the summary is prepared? Some criteria would have been there. Some criteria would have been there by some standard setting organization would have given some criteria. Some NDIS would have been talking about the criteria. SEBI would have been talking about the criteria. Somewhere some criteria would have been there on summary financials. You are getting the point. Suppose in prospectus, every company shall give a summary of previous year financial statements. Summary only. You need not include full set. Summary you should give. That can be taken as a framework. Suppose if there is no such framework, summary financial statements are prepared following which criteria? Management decided that. See whether that criteria is enabling, whether that criteria is resulting in presenting summary financial statements that represents a fair summary of audited financials. We just have to check this. Suppose company said, sir, this is summary balance sheet, summary P&L. I saw this and I compared with audited. No, this is not a fair summary. It is not like a summary of that. See, when you are preparing a summary notes, short notes, and we are preparing main material, short notes must be derived from the main material. Both should be connected so strongly that main material, if you read, you'll get a detailed clarity. Short notes you read, you will get a summary of that main concept. Correct? If the summary notes is not at all matching with the main notes, can I call it as first of all a summary from that point of view? No. Exactly 810 is also asking. Company said they prepared summary financials. You check whether are they fair summary or not. If so, give a report that they are fair summary. Positive opinion. Suppose you felt that is not a fair summary. That is not a fair summary. Like summary financials are discussing some details that is not identifiable in the main financials. When I will say fair summary, I saw the summary. When I see open complete set financials, I can easily identify. This item there it is there. This item it is there here. Same way, when I see complete set, this item where it is given in summary, here it is given. I can easily correlate. Then it is a fair summary. If I am unable to correlate, then that is not a fair summary. If at all, summary financial statements are not easily correlatable to the audited financial statements, then we treat it as it is not a fair summary. That's a modified opinion. That's a modified opinion. There I will give adverse opinion. I will give adverse opinion on the report, in the report that is dealing with summary financials. I will say it is not a fair summary. I will say straight away it is not a fair summary. Or other way, what I can say, if at all it's a fair summary, I will say that it is a fair summary. For this, there is in fact so much is there. I have made a diagram on it, simple diagram on it. For your information, I am showing you a summary financial statements just for your idea. Audited financial results, but here it is only a summary. The above is an extract of the detailed financial results that is filed with the stock exchange. And the detailed financials, you see, the full format of audited financial statements are available on the website. Whomever, the standard has a requirement. To whomever you are giving summary financial statements, they must have access to complete set. If such an access is not there, I will not report on the summary financials. When I can report on summary financial statements, one of the most important condition, whether the user who is going to use the summary has access to complete set or not, I will see. Is it easily accessible or not? I will see. If it is not easily accessible, complete set is not available to the users, then I will not report on summary, because based on summary alone, he may not take a best decision. Summary financials are complementary to complete set of the financials, complementary to the main financials. Then only it is permitted to use, otherwise it is not. So, Just a minute, I'll just download that particular thing. Yes. This summary, this analysis is very important, because in this standard, this is where generally many confuse. What is our objective in summary financial statements? Very simple. Our objective is whether the summary financial statements represent a fair summary of audited financials. If so, give an unqualified opinion. Is the summary financial statements consistent with audited financials? Suppose the answer is, you verified, summary financial statements are consistent with audited financials. What opinion I should give? Suppose no, unmodified opinion is given on audited financials. Suppose unmodified opinion is given on audited financials. From that financials only summary is derived. What opinion I should give on this summary? That is a question. Since summary financial statements are consistent with audited financial statements, since they are consistent, what audited financial says, summary also says the same. I will give unmodified opinion. I will give what? Unmodified opinion. Suppose modified opinion is given on audited financials, like complete set of financials, auditor gave modified opinion. And the same financial statement summary is what? Summary is prepared. Same summary. You will give which opinion, you know? Unqualified only. On the summary, you will say that they are consistent only. You will not say otherwise. They are consistent. You have to say only two things. Are they consistent? Are they not consistent? Are they consistent as per audited financials? Are they not consistent? Sir, audited financials contain a modified opinion, sir. That's okay. Qualified opinion is it? That's okay. Is it consistent or not? You tell. Yeah, I said they are consistent with main financial statements, I told. But I should also tell the people, on audited financials, auditors gave, myself, on audited financials, I gave a qualified opinion, or I have included emphasis of matter paragraph, or I have included other matter paragraph. Kindly refer to that also. I should tell this point also, right? So don't just blindly based on summary financials, don't think that everything is true and fair. What I am saying in summary financials, I am saying it is consistent with audited. That doesn't mean summary is true and fair. Understood? In summary financials, my opinion is dealing with either these two. Is it consistent or not consistent? That's it. If it is consistent, say that it is consistent. Sir, audited financial statements contain some qualified opinion, emphasis of opinion, or some emphasis of matter or other matter paragraph. What auditor has to do? Draw attention to that in the report on summary financials. Say that it is consistent. Plus draw attention to that qualified opinion or emphasis of matter paragraph in the audit report on audited financials. Describe the same in the opinion section in audit report on summary financials. But primarily what you will tell, you know, primarily you will say that SFS is consistent. Primarily you will tell SFS is consistent. 1 minute. I will show you the direct that report, then only you will understand. See, illustration 1, sorry, not 805, I'm sorry, 810. Illustration 1 you see. An unmodified opinion is expressed on the audited financials. The auditor's report on summary is later than the date of that I will discuss later. What auditor is giving in the opinion section? In our opinion, just a minute. See, I'll erase like that. The summary financial statements derived from audited financial statements of ABC Limited for the year ended 31st March or fair summary of those financials in accordance with so and so. Simple. We are straight away saying there a fair summary. Suppose a qualified opinion is expressed on audited, and by the way, summary financials are matching with the audited financials. What auditor is giving opinion here? You see, in our opinion, the summary financial statements derived from financials of ABC company are a fair summary. Same positively only we are saying no, they are a fair summary, don't worry. However, below we are saying what are the misstatements identified, like this qualification and also are there where these qualifications are there in audited financials. For a comparison purpose, we give those qualifications in the opinion section in the summary financial statements. Clear? Now look at the magic. Suppose in the audited financials, auditor gave adverse opinion. Suppose on the audited financials, auditors gave adverse opinion. On the summary financial statement, and summary is also matching. Financial statement summary is there, na? Adverse means what? They are not true and fair. Wrong financial statements. The financial statements are containing completely wrong picture. Summary is also exactly describing the same wrong picture without any deviation. Summary is a fair summary. Now, should I say the summary financial statements derived from the audited financial statements of the ABC Company Limited are a fair summary? Can I say like this or not? Technically, you can say no problem. But standard is asking you not to give opinion in this case. Not to give opinion in this case. When the main financials are straight away not true and fair. On summary, when the main financial statements, auditor has given adverse opinion or even disclaimer of opinion, don't give any opinion on the summary. Do not give any opinion on the summary financials. They may be consistent. Don't give opinion. Denial of opinion. Look at this. Suppose if the audited financial statements audit report, it contains adverse opinion or disclaimer of opinion, denial of the opinion on summary financial statements, it is denied. Opinion is denied. Why? What's the logic? See, if the main financial statements are true and fair with some qualification, and summary is also prepared from the same financial statements, I will verify whether their summary and there is a meaning to it if I give opinion. That is not true and fair. You are asking me something which is not true and fair. Is it not true and fair? Exactly like the other two which is not true and fair. You are asking me, that is actually worst. You are asking me, this is also worst. Both are matching or not, you are asking me. Tell me, is it justifiable for us to give opinion when both are worst actually? Yes or no? See, when both are good, I can say, yes, this is matching with that. When that is completely not true and fair, and from that only you derived a summary which is also not true and fair. Now you are asking they both are matching or not. How awkward it will be to give opinion here. Exactly this said. Exactly. Better don't give opinion because both are not true and fair. I know it's a fair summary. Both are not true and fair. So don't give any opinion on that. Clear? All of you. Suppose summary financials are not consistent, means audited financials are containing some picture, summary is giving it altogether different picture. Then I will give adverse opinion on summary financials. I will say that summary financials are not a fair summary of audited financials. Understood? So, first thing, after you verified the summary financials, what you concluded first? Do you concluded are they consistent or they not consistent? Suppose I concluded they are not consistent. Straight away say summary financial statements are not consistent. Adverse opinion. Suppose they are consistent. What should I do? Now you check. What the main financial statements audit report containing, you only did audited. You only audited that also. What opinion you gave? Unqualified opinion I gave there. On summary financials or a fair summary, consistent, give unqualified opinion only here also. I gave a qualified opinion. Then mention that point in the summary financial. You say that they are consistent. In addition to that, you mention what qualifications, what emphasis, what other matter paragraphs you have used. Mention that. I gave an adverse opinion. When I said that itself is not true and fair, why will I talk about summary? The main financials itself is not true and fair. I will not talk about summary itself. Suppose main financials are true and fair. I gave an unqualified opinion. You prepared a summary, but that is not matching there. Then I will say summary is not matching. Are you clear? Logically drafted this. Now I have given here point references, point number references in the opinion. Like in our book we have like reporting. This one. In the question number 18, 1, 2, 3, 4, 5 points are there, right? That only I have given here. So that only I have given here. 1 and 2, all this. You're clear here? Just a minute. Yeah, that only, correct only. So that is the main, this is the main point where many confuse. This is the main point where many confuse. Another 5-10 minutes I'll conclude. Yes. So what are they saying? When auditors report on audited financials contain a qualified opinion or emphasis of matter, other matter paragraph, but auditor is satisfied that summary financials are consistent and is a fair summary of complete set. The auditor's report on summary shall also contain what? State that audit report on audited financials contain qualified opinion, emphasis, describe about the basis for qualified, describe about the emphasis of matter, describe about the other matter paragraph. Just now I showed you illustration. Suppose when the auditor's report on audited financials contains adverse or disclaimer, state that auditor report contains adverse or disclaimer, describe the basis. As a result of adverse opinion, it is not proper for me to express opinion on summary financials. It is not proper for me. That is wrong. Whether it is a fair summary or not, you are asking me. When that itself is wrong, how come you use this? That itself I am telling you not to use. Why you want to use summary again? I will not give opinion. Understood the logic? All of you. Modified opinion. When I will give modified opinion on summary, which means, remember, on summary financials, either I will give unqualified opinion if they are consistent. Even though they are consistent, I will not give opinion if at all the main financials contain adverse opinion, disclaimer of opinion. Sir, is there anywhere on summary I will give an adverse opinion? Yes, only one situation. Summary is not a summary, technically speaking. You are calling it a summary, but it is not a summary of the audited financials. Then I will say it is not a fair summary. So, if the summary are not consistent in accordance with the criteria and management does not agree to make necessary changes, the auditor shall express an adverse opinion. It is not a fair summary. That is when we express adverse. No. The situation of qualified, what qualified? Summary is a fair summary except 1 or 2 places. No. See, I'm telling you, that's why. Either short notes can be reliable or not reliable, that's it. It cannot be partly reliable from the main material, correct? Either only these two. Logically, observe. So, on a summary financials, first of all, remember, we don't audit summary. We just verify whether audited financials and summary financials both are matching or not. Just that this is a condensed version, that's a detailed version. Is it matching or not briefly? If it is matching, I will say it is matching. If it is not matching, I will say it is not matching. If at all any 1 or 2 significant elements, 1 or 2 elements are not matching, if I feel that is significant, I will say it is not matching straight away. I will not say everything is matching except this. Standard does not give that particular inclusion. That is not covered in the standard. You're getting the point. Because the reason why summary is prepared is in order to avoid reading the full financial statement. In such a case, summary should be either right or it should be wrong. That's it. You cannot have again exceptions within that. With that logic, that qualified opinion on the summary financial statements point is eliminated. Either unqualified opinion or adverse opinion or no opinion. That's it. If you want to give opinion, only two opinions. Say whether they are consistent or not, or say whether they are inconsistent. That's it. Or don't give opinion. Clear? No, it's not over. Standard is not over. Now, by the way, tell me, summary financial statement shall also be approved, right? This approval date will be for sure later than approval date of the financial statements. Now, should I consider subsequent events up to the date of approval of the summary financial statements? No. Here summary is approved just for the fact that board of directors saying that summary is a fair summary of audited. Just because approval date is something later, that doesn't mean subsequent up to that date is considered. Same way, the audit report on summary financial statements shall be when? It should be on or after the date of approval of summary financial statements, and it should be on or after the date of audit report on audited financials. Can you give an audit report on summary financials before audit report on audited financials? No. The standard specifically says you can only audit summary financials only if you have audited main financials. So can I accept this engagement if auditor has not audited the financial statements from which summary is derived? The auditor shall not have necessary knowledge to audit a summary, therefore he will not accept the audit. Now summary means what? They reflect historical information that is derived from financial statements but contains less detail than financial statements while still providing structured representation consistent with that provided by financial statement of the entity's resources and obligations at a point in time, or I mean on a particular date or period of time, over changes then over a period of time. Though it is less detailed, it is still giving valuable information just like financial statements about economic resources and obligations at a time or changes there over a period of time. So summary financials means that. You should not accept if you have not audited the main financial statements. So before accepting, on what basis summary is prepared, you need to check out. Summary also, it must have some format, right? It must have some rules, right? What information to be ignored, what information not to be ignored. There must be some guidelines, right? That is called criteria. On what criteria summary financials are prepared? Generally, summary financials are prepared by management. Management will ensure that. Management will decide the criteria. There is no separate framework for this. You see, in SEBI there is a framework on condensed financials. In Companies Act also there are some sections which says that a company has to present in notes to account brief details of their subsidiaries, assets how much, equity how much, income how much, like that. Some requirement is there in Accounting Standard or Companies Act. For subsidiary related information you must show key information of subsidiaries. Hey, you should remember this. Huh? That's what material subsidiaries. For material subsidiaries, company has to show key information about the subsidiaries. Because summary financial statements by nature contain aggregated information. What do you mean by aggregated information? General in complete set of financials. No trade receivables I will show with a detailed subclassification of 10 items. That much disaggregation will not be there in summary. In summary we will show in two elements. Aggregation will be there. Aggregated information we will show. Whereas in normal audited financials, we show information disaggregated from related party how much, from others how much, more than 6 months how much, less than 6 months how much, considered good how much, considered doubtful how much, secured how much, unsecured how much. This much detailed I will show in audited financials. In summary, why will I show that much detail? I will simply show secured or not, from related party how much, from unrelated how much. That's it. More than 6 months how much, less than 6 months. That's it. I will not talk more than 1 year, more than 2 years, more than 3 years. I will not give that much breakup. If I give that much breakup, why it is summary? It's a detailed financials, no? Clear? So what criteria they followed, that auditor has to verify. Now, whether the criteria followed is acceptable, whether the criteria followed is acceptable, it depends upon nature of the entity, purpose of the summary, for whom the summary is prepared, for what purpose. Accordingly, what criteria they followed, is it correct or not, I will check. Information needs of the users. The summary financials are going to be given to chairman, and the chairman is given certain rules. Chairman want to take a decision on so and so thing based on the summary. Whether the decision can be taken by the summary, needs of the user take into account. Whether criteria is not misleading in nature, You need to check out that criteria whether it is not misleading. Sometimes criteria for presentation of summary may be established by a recognized standard. Maybe NFRA would have given summary financial statements format. In such a case, no, auditor may presume that that criteria is acceptable. If a lawmaker has given the criteria, you blindly say that it is acceptable. Suppose if auditor concludes that the criteria based upon which summary financials are prepared is not acceptable, don't accept that engagement. Don't accept that engagement to report on summary financial statements. Suppose, unless mandatory by law, unless it is mandatory. Suppose even though criteria is not valid, but you have to give a report on summary. You can give. See, why? Because there's a requirement in law. You have to compulsorily accept that. Because you are the auditor of main financials, you should only give summary financials. Sir, summary financials, the framework is not acceptable. The criteria is not acceptable. It's okay. No, you have to give. Okay, I'll give. In such a case, I will not use the standard wordings given under 810. I will not say I complied with standards on auditing, because standards on auditing permit me to use fair summary, all that, but only if it is matching, only when SC 810 requirements are matching. So that is what these 2 points. The auditor shall, accordingly, the audit report shall not indicate that engagement was conducted in accordance with this standard. Why? Framework itself is not acceptable. Still you are doing because there is a compulsion in the law. At that time, standard and audit item will not interfere there. Because you are doing as per the law. Whatever lawmaker says, follow that. Don't follow the standard. Don't say about standard. Clear? Next. Obviously, summary financial statements must contain a proper heading. Summary financial statements, clearly identifiable heading. Now, how to do audit, how to report? First, obtain understanding of management's responsibility. Management is responsible for preparing the summary financial statements that represent a fair summary of the audited financials. Management is responsible to provide all the information to the auditor, all that. This is an easy point, not a big deal. So, what auditor will perform? Write about procedures to be performed. This itself can be asked as a 4 marks question. This itself can be asked as a 4 marks question. By the way, in the previously also, write about acceptability of criteria or unacceptability of the criteria. They may be asking about 3 or 4 marks question, this point. This one, 2A, this can be asked as a 4 marks question. Write about acceptability of the applied criteria for summary financial statements. What points auditor has to keep in mind? They may ask you this as a question directly. What are the procedures? Means you decided acceptable criteria. Now you are starting the verification of summary. What you will verify? You will verify disclosures about audited financials, whether they are disclosing the summarized nature. And if at all summary financials are not accompanied with audited financials, generally summary financials to whomever we are giving, audited financials also should be given access. See presentation and disclosure criteria, whether they are applied correctly. Compare with AFS. Get necessary information if at all available, and see that AFS is available to users. See that audited financials are available easily to users. Correct? Now, what is the form of opinion? This is not required. Anyhow, we have seen in the standard that is not required. Elements. Elements also not required. Introductory para. Identify the summary financials on which auditor is reporting, including title. When auditor is aware that summary will be included in document that contain other information, the auditor may consider identify the page numbers of the summary financials. Suppose if the summary financials are given as a part of some consolidated report, in that report some other information is also there, then auditor specifically tells in the audit report, only this portion I am auditing, only this portion I am dealing with, only this portion is dealing by this report. Auditor's report on audited. Refer compulsorily to your report on audited financials, date of that report, and the fact that unmodified opinion is given. Suppose if you gave a modified opinion, mention that what opinion you gave, what reasons you gave, why qualified opinion, why emphasis given, the reasons also you mention. Date. The date of audit report on summary is generally later than the date of audit report on the audited. You must state that summary financial statements do not reflect effect of events occurred subsequent to the date of auditor's report till the date of audit report on summary. People may think, are audited dated summary financial so and so date. No, up to that date subsequent events were there. They might think, no. Look, my audit report date original that only up to that date I consider. After that date to the date of audit report on summary financials, no events are considered. Because this is a summary of audited financials. This is not a separate financials which I am preparing. This is a summary of that financials. Clear? And we should clearly tell the users in the audit report that reading summary financial statement is not a substitute for audited. It is always advisable to read a complete set of the financial statements before taking any qualitative decision. And various other. This is regarding the date of audit report I already covered. And this point I already covered just now. What about other information? Suppose summary financial statements are published along with other information, just like we have seen 720, same reporting here also. See whether other information is conflicting with summary financials. If they are conflicting, where the misstatement is there, same 720 procedure, exactly copy pasted, not that in depth. How auditor has to respond if entity has not included audit report on summary financials in a document containing such a summary financials, or auditor has not audited summary? What is this? Very simple. Suppose company prepared summary financials, but they didn't ask you to report on that. But the summary financial statements are presented along with audited financial statements and report on that, where it appears to the public that you gave a report even on audited financials when in fact not so. Auditor has to request management, please clearly differentiate. Don't give an impression that I have audited summary financials. Suppose that is one analysis. Another analysis, I have verified the summary financials and I gave a report on that under 810. But my report is not attached. Only the summary financials are being presented along with other financial statements, complete set. Whereas that audit report which contains true and fair opinion, all that is clearly given. But summary financials only that is presented, my audit report is not included. I must request and I must convince the entity to include my audit report also. If at all they are not including, take action as per 560. If at all company is not cooperating you, where your audit report is not included in the summary, you have to take an appropriate action. What appropriate action you have to take? Maybe you have to contact the advisory board, audit advisory board regarding this. That's it. The standard is over. The entire standard 810 is over. Yeah. With this understanding, you read now 810, 805, 800, you will see a remarkable difference in your understanding. Always holistic view of the standard if you don't have. Remembering inside contents is impossible, next to impossible. It is not at all possible to remember. That is the reason why there are so many years the subject is ruined like this. Getting it? So you can understand. Remembrance is a byproduct. Understand the whole context, read each and individually. Yesterday I told already, previous class I told, like read, analyze, summarize, revise, then remembrance will automatically come. Getting it? First read to identify what is there, then analyze, then summarize what you read simply, then revise once detailedly. Naturally you remember. By second time you do this process, you remember. Getting it? So we'll take a break and get back. Okay. So let's begin now the 4000 series, 4400, 4410. 4400 is regarding engagements to perform agreed upon procedures regarding financial information. Suppose if you recollect 3402 standard, I told this point. If at all you are exclusively appointed to review controls and give a report to them, where user entity, all that discussion and all is not there. I told that's an agreed upon procedure. But does it apply? That agreed upon procedure, is it covered under 4400 means? No. Because 4400 is dealing only with agreed upon procedures relating to financial information. What about agreed upon procedure I am performing not related to financial information? There is no standard that is addressing. No standard which is addressing that. Why? One of the reason could be because there is no third party which is involved. There is generally no third parties involved, or probably they would have not felt necessity to include a standard on that. So that could be the reason. Even if at all we are called for to review only controls, we are called to review only controls, it is also treated as agreed upon procedure only, because we both agree upon certain procedure that I need to perform. Agreed upon procedure means the auditor, nothing but the practitioner. In the standard we have to use the word practitioner. because we are not auditing anything. We have to use the word practitioner. So in an agreed upon procedure, the practitioner and the management agrees upon something to be done. So that's an agreed upon procedure. There is, and this is a related service where we don't give any assurance. We don't provide any assurance, and it is a related service. And there is another one where we don't provide any assurance. We just assist the management. We just assist the management in accounting and financial reporting process. We assist the management in accounting and financial reporting process in some other engagement, and that engagement is called as compilation. Compilation means preparing. You see, you have a compilers, question marks, compilers. Compiler means what? A compilation means combining everything at one place. Preparation of some information is called as compilation. So that engagement is called as what? Compilation. For example, there are many public limited entities or big private limited entities. They know how to do business. They don't know how to prepare financial statements as per applicable financial reporting framework. They are not aware of all that. They generally reach to experts like you who are chartered accountants who know how to prepare the financial statements. You have to assist the management in compiling the financial statements. And now, when you're assisting the management in compiling the financial statements, can you audit the same financial statements? No. Self-review threat. What is it? Self-review threat. So you are not supposed to do audit of the same financials which you compiled. Getting it? Fine. So let's begin that. And by the way, whether it is an agreed upon procedure or a compilation engagement, both are non-assurance engagements. Both are non-assurance engagements. So what is an agreed upon procedure objective? The objective is to carry out the procedure. Something like audit. Like you verify there also. But you don't have to give any conclusion. You don't have to give any opinion. You don't have to give any report that is used by third party. Your report is only used by the management. Where you just report factual findings. Where you just report factual findings. Suppose a company asked you, sir, please come. Do get external confirmations from debtors. Wherever external confirmations are not conforming with our books balances, prepare a list of that exceptions report and give a report. You just have to find the fact and then report it. The fact finding job, agreed upon procedure, is a fact finding job. Even investigation word, you know, audit is not an investigation. Audit covers whole financial statements. Investigation only covers only few elements. If at all a client called me to discover a fraud related to some investigation, fraud investigation, he called me to discover some trade receivables fraud, and I have to investigate and give a report, that might come under 4400. Because here also your objective is what? Fact finding. In investigation also your objective is what? Fact finding. Remember, investigation is a general term, not a standard term. It's a general term. You call it as investigation. Standard calls it as agreed upon procedure, where you are performing a procedure as agreed with the management and reporting a fact. Whatever findings are there, you are just reporting. So investigation works, forensic accounting works, they all come, there is a possibility that all of them come within the definition of agreed upon procedures. This is highly debatable. So don't go in depth. This is enough. Now, so what is the difference between audit and agreed upon procedure? In audit, no, we express opinion. Whereas in agreed upon procedure, we just report factual findings. Here we don't give any assurance. And in an agreed upon procedure, we evaluate validity of accounts payable. For example, an agreed upon procedure for accounts payable consists of what? Comparing names of the suppliers and amounts outstanding. Getting suppliers statements and confirmations and comparing with our books of accounts. Comparison of these statements to trial balance. If there is a variation in balances, the findings will be reported without providing an assurance. We just report the findings. We don't give any assurance on that. Yeah. So what are the general principles of agreed upon procedure? Are there any ethical principles applicable? Yes. Most important thing is competence is there. You must be competent to perform any procedure. Competence. But by nature, since they are non-assurance, independence may not be a paramount requirement. Independence may not be a huge requirement. In case of agreed upon procedure, because you're not giving any assurance, you're not giving any conclusion, you're not giving any opinion. You're just doing a fact-finding job. Independence may not be required, but remaining elements, confidentiality and competence, due care, professional behavior, skepticism, all this should apply. Yes or no? So these are the principles that are governing agreed upon procedure. This itself can be asked as a 4 marks question, or they may ask you how agreed upon procedure is different from audit. Give an example of agreed upon procedure. This itself can be asked as a 4 marks question. Are you getting it? Next, what are the general principles of agreed upon procedures? You have to comply with ethical requirements like integrity, objectivity, professional competence, all that. However, independence is not a requirement. Auditor may have to comply with independence if at all the client is asking. If there is a requirement in that scenario, then you have to be independent. By default, independence is not a main requirement in agreed upon procedure, because assurance is not involved, because you are not providing assurance. Then you need to establish terms of the engagement. The auditor should ensure with the entity that there is a clear understanding regarding what procedures you need to perform. And it is at the interest of both. An engagement letter must be documented containing key terms and conditions. An engagement letter confirms auditor's acceptance of engagement, avoids misunderstanding. So engagement letter shall include listing of the procedures to be performed. A statement that distribution of the report would be restricted to specific people. It is not a public document. They may ask you, write about agreeing to terms of an engagement in an agreed upon procedure. What are the specific points auditor shall include or a practitioner shall include in that engagement letter? In the engagement letter specifically you must include what are the procedures that you have to perform. 2, you have to specifically mention that this report that you are going to give is not available for public. It is only restricted for specific users. Such a kind of condition should be emphasized in the engagement letter. What matters you have to agree? In an agreed upon procedures, what are the matters you have to agree? What is the nature of engagement? Verification of trade payables, or trade receivables, or stock, what exactly? What is the purpose? Why? For whom this report is going to be useful? Identification of financial information. So what is that information exactly you are verifying? Nature, timing and extent of procedures to be applied. How many days they were given to you? What nature of procedures? Like company might tell you, sir, you cannot talk to the people. We have records. Inspection you can do. Inquiry you can only do with this. With these people only you can inquire. Remaining, just like auditor, you can't have access to all the information, no. You have only limited access. You need to ask them what nature of procedures you have to perform, to what extent you have to perform, how many days you have to perform, and limitations on distribution of factual finding. When such a limitation is conflicting the legal requirements, auditor would not accept the engagement. If there is a legal requirement conflict, don't accept that. Not just in this, in any way, if there is a legal requirement and if there is a conflict with the legal requirement about the proposed assignment, we generally don't accept. They may ask you, what are the matters to be agreed in an engagement to perform agreed upon procedures in relation to financial information? They'll ask you this question. What are the matters to be agreed? You need to write this answer. 4 marks question. Are you clear? Then how to plan and perform this? Auditor has to plan how to perform this agreed upon procedure. Then perform it. Why are you performing? You need to get evidence. You need to maintain documentation. And you need to report the factual finding. Now, for the factual finding, you need to have evidence, right? So what are all procedures you will perform? I'll talk to people, I'll analyze data, I'll recompute, I'll observe what they're doing, I'll inspect documentation, I will get confirmation depending upon the necessity. Whether I will do all of this or any one of this or a combination of this, that depends upon the work you are giving me. You are asking me to check trade receivable, external confirmation I'll do. You are asking me to check inventory. I will see GRN bills, e-way bills, all that I will see. It depends on the matter that we are addressing. And finally, documentation and reporting. So the report on agreed upon procedures need to describe the purpose and in sufficient detail so that user can understand what exact work you perform, how much you perform. The report should clearly mention that. no audit and review is carried out. It is only about a factual finding. Like we have a report. You open SA 4400 original standard. At the end of that particular thing, you will find an illustration on the report. Agreed upon process report will be there. You just go through that. It will have some elements. There are some statements which auditor must tell. In case of agreed upon procedure, there are some facts which auditor must tell. What? A statement that the procedures were agreed upon with the recipient. A statement that engagement was performed as per related services. A statement that had auditor performed more procedures, some other matters might have came to the knowledge of the auditor, but since we didn't perform more procedures, as it is agreed upon procedure, whatever with management we agreed, that only will perform, not more than that. And a statement that report is restricted to so and so people only, and a statement that this is not audit or review, and hence no assurance is expressed. They'll give you this question. You are appointed to perform certain agreed upon procedures. You have completed the procedures. You are now at the stage of reporting the factual findings. So and so person is asking you to assist him to compile or to prepare the report on factual findings, the report on agreed upon procedures. What are the mandatory statements? What are the mandatory statements that are to be included in a report on agreed upon procedures? You need to include a statement that these are the procedures agreed with the recipient of the service client. You need to mention that these procedures are performed as per standards on related service. You should mention a statement that this is not an audit, this is not a review, no assurance is involved. You should give a statement that if at all we perform more procedures, we would have identified more findings. And you should mention a statement that report is only for these parties, not available for distribution. This is something like 800 also we have seen. Restriction on distribution and usage, that point also will be there in the auditor's report. And finally, date, place, signature, clear, and documentation. Whatever procedures you perform, whatever evidences you gathered, whatever findings you made, whatever communications you made, document everything. Enough over the standard 4400. Easy. All of you. Next. Then 4410. 4410 compilation engagement. What is a compilation engagement? Where a practitioner applies his financial reporting expertise. A practitioner applies his financial reporting expertise to assist management in preparation and presentation of financial information of the entity in accordance with applicable financial reporting framework. It may be special purpose framework or general purpose framework, doesn't matter. The company, they have to prepare financials for some requirement. There's a requirement. Financial reporting framework is there. They have to prepare the financial statements as per the requirement. And they approached you, sir, we don't know anything about this financial reporting process, all that we don't understand anything. You please help us how to do. Remember, just because you are compiling the financial statement doesn't mean you become the responsible party. Maybe in reality, from the scratch, you only prepared everything, but still the responsible party remains the same. It is only considered as assistance. That's it. The standard uses the word assistance. The practitioner assist. Be careful when you're choosing words. When it comes to related services, you don't use the word auditor. Use only the word practitioner. Getting it? The practitioner will assist the management and those charged with the governance to prepare financial statements, to do a financial reporting by using his financial reporting expertise. So we are experts in financial reporting. Please know, at least acknowledge. Yeah. So compilation engagement is an engagement in which practitioner applies accounting and financial reporting expertise to help the management in preparation as per applicable framework and issues a report. You issue a compilation report. What in that report you will mention? You will mention that you assisted the management to prepare financial statements as per so and so framework, and the financials are prepared as per so and so framework. You will not give any opinion. You just give a report, compilation report, a simple report you will give. That's it. So management may request an accountant in public practice to assist in preparation of the financials. It is not an assurance engagement. The practitioner need not verify accuracy and completeness of the information. Suppose you know that it is apparently wrong. The information is apparently wrong. The information using which they are compiling the financial statements, that information is completely fraudulent and wrong. Don't accept that. You have to verify whether the information used is accurate or not, relevant or not. That doesn't mean you have to give opinion on that. Are you getting the point? That doesn't mean you are liable to give opinion. So the practitioner, it is not an assurance. A compilation does not require practitioner to verify accuracy of the information for the compilation, or otherwise to gather evidence to give an opinion. For the context of opinion or conclusion purpose, you need not. But generally, there is somewhere else also it is there. Like, like if the information is apparently wrong, that you know that information is apparently wrong, like you know that information is not right, they are preparing compilation. Never, you should not give a report on that. You should not involve in that. Like, financial information that is subject to compilation may be for various purposes. Why first of all, okay, I'll go to that element later. Why first of all management will approach you for compilation? Maybe for annual financial statements purpose, or maybe for quarterly purposes, or maybe reporting to holding company. Various reasons for complying with mandatory periodical reporting, annual reporting, or quarterly reporting, or for some other purpose like management or top management to form some decisions, internal usage, for periodic reporting undertaken by external parties under some contract, for transactional purpose, maybe at the time of mergers and acquisition they prepare some financial information by using some rules and regulations. For that reason it could be. What are the objectives? The objective is very simple. Apply the expertise you have, assist the management in financial statements, and give a report. Scope. What is the scope of an engagement? Management retains complete responsibility for the financial information and the basis on which it is prepared. The responsibility include application by the management and of the judgment required for preparation, like accounting estimates, choosing, everything management only takes care. You only have to assist them in preparing. Different financial reporting frameworks can be used to prepare, ranging from simple entity to established standards. And the financial reporting framework adopted by management to prepare will depend upon the nature of entity and intended use. I mean, they're trying to tell you very simple. The management, on what basis they prepare financial statement, depends upon the purpose. Accordingly, different frameworks they may follow. These frameworks may be a simple financial reporting framework, or it may be a complex framework like Indes. It can be anything. Your duty is to assist them in preparing the financials, and complete decision making related to accounting estimate, accounting policy, they only have to take. If at all they don't know, you assist them how to take. Yeah, you see, the practitioner shall not accept the engagement. This is important question in this. Write about engagement acceptance and continuation in the context of compilation. The practitioner shall not accept the engagement unless practitioner has agreed terms of engagement with the management and the engaging party, if at all it is different. Sometimes no, there will be a third party who is specifically engaging you to compile financial information required for his purpose. But even here also, you are assisting management only. User may be third party. Third party appointed you because he don't want to believe the management. The management person, audit, they will support management only in preparation. Better I'll appoint some auditor, better I'll appoint some separate CA. Who will assist the management in preparing the financial information? So, when you shall not accept, when intended use and distribution, when the intended use and distribution of any information, any restriction on either its use or where it is, like, see, you should not accept if at all the intended distribution and usage is for other than desired purpose. Simple, other than desired purpose. Identification of framework. Identification of framework. Objectives and scope of the compilation engagement. Like, see, these are all various things you should completely agree. You must first agree this. Without agreeing this, you can't proceed. You can't accept the compilation engagement. That's what, simply speaking, without agreeing all this, like what is the framework applicable, what is the objective and scope of this compilation engagement, who are the parties using it ultimately, all this you must. Responsibilities of practitioner, responsibilities of management, correct? Practitioner responsibilities. See, this is like a just terms of audit engagement. In terms of audit engagement also, what we see, what is the nature and scope of the audit, what are the responsibilities of management, what are the responsibilities of auditor. In every engagement, whether auditor, non-auditor, assurance, or related service, or reviewer, doesn't matter. In every engagement, we must establish terms of engagement. Without establishing terms of engagement, can we accept the engagement? Simple. That only they're telling. The practitioner shall not accept the engagement unless the practitioner agreed the terms with management. What terms? For what purpose the compiled information is going to be used, to whom it is going to be distributed, what is the framework applicable, what is the objective and scope, what are the responsibilities of practitioner, what are the responsibilities of management, and what is the expected form and content of the practitioner's report on the compilation. So whatever all the above terms they said, right, all the terms and conditions must be placed on engagement letter, which must be given by practitioner to management. What are responsibilities of management? They'll give you this itself as a 4 marks question or 3 marks question. In the context of compilation engagement, what are the responsibilities of management? Management is responsible for preparation and presentation in accordance with applicable framework that is acceptable in view of intended user of the information. Design and implementation of controls, accuracy and completeness of records, documents, and explanations. Judgments needed for presentation so that practitioner can provide proper assistance. Management is responsible for maintaining accuracy of the data. If I know that data is not accurate, indirectly tell me, can I proceed with that engagement? No. Knowingly never assist in compiling wrong information. As simple as such. Why? You know, if at all later on, if any the compiled information is given to some third parties, they suffered a loss, they went on investigation, immediately they'll tell you, you may say, I am not responsible for accuracy, but you know that it is inaccurate, right? You know that, you are not responsible to ensure its accuracy, I agreed. But that means what? What does it mean? If at all without your knowledge, without your understanding, concealment of so much of facts were there, management, they concealed so much from you, and you relied upon management and gave an opinion, gave a report, then you are exempted. Knowingly that it is inaccurate information, purpose, user, in spite of it knowingly you did, means what? Are you getting it? That's what I tell. Auditor is not responsible for ensuring accuracy of the compilation. But if at all auditor knows that the information used is inaccurate, he should not accept that. Yeah, this is where the point is. You see here, if the practitioner becomes aware that records, documents, explanation, information provided by the management are incomplete, inaccurate, unsatisfactory, the practitioner shall bring it to the attention of the management and request the corrected information. If at all you got to know that information that is used by the management for compiling financial information is not accurate, not complete, ask them to provide a complete information, correct information. If at all practitioner is unable to complete because management failed to provide accurate records, practitioner shall withdraw. You should not accept that prima facie. If at all after accepting you discovered, you should withdraw. Now tell me, the original first place what they said, you are not responsible to verify accuracy of the data. Is it absolutely true? No. So what does it mean? You see here also, they are not asking you to discover the accuracy. No, they are not asking you to discover the accuracy of the data. In the course of the work, you got to know that they are not accurate. You got to know that they are incomplete. Then you should ask management to correct it. Then you should, if at all they are not correcting, withdraw. If you know that the information is inaccurate that is used to compile the information, don't give a report on that. If you don't know any such, you don't have any you don't know anything about it, you can give compilation report, not an issue. That doesn't mean you are responsible for accuracy of the information. Understood the crux here? Obviously, like the question is, suppose if at all we believed the management and then gave, and later some investigation was taken upon that company, and it was found that the information used for compilation is completely wrong, and your name is also associated in the compilation process. You have to prove that you are not aware of it. You have to prove that you are not aware of it. Like somewhere in the mail correspondence, somewhere and all, like some other party, like if they give an evidence that, sir, I informed this auditor, sir, on so and so date, this is the evidence, he did not consider that, then you are liable for guilty. Then you are liable for guilty. Are you clear? It might come under other misconduct. It might come under other misconduct. Not other misconduct, technically, professional misconduct only. Professional misconduct only. But in auditor failed to report a fact, clause number 5. Auditor failed to report a material fact known to him. Though there the context is auditor used, that can be even implemented on other services also, and institute will take a punishment. That's why always when you're interpreting the law, always look at the spirit of the law rather than the letter of the law. There are various interpretations, right? Various interpretations. You should always take reasonable interpretation, intention behind it. If at all, professional ethics schedule number 2, part number 1, clause number 5, 6 and all, if at all we have to apply, they are specifically used about audit only. But their intention is not just audit. The intention is not just audit. If the practitioner becomes aware that during the course compiled information does not adequately refer to framework, amendments are required, amendments are required so that the information is not materially misstated or the information is otherwise misleading. The practitioner shall propose amendments. This will be given as a 3 marks question. I'll repeat, don't worry. Under what circumstances the practitioner will propose amendments in compiled financial information? Under what circumstances? 1, if the compiled financial information is not adequately referring to framework. 2, amendments to complaint financials are required. Why? So that they are not materially misstated or compiled information is misleading. In all these 3 cases, practitioner will propose amendments. Suppose if management declines or does not permit the practitioner to make proposed amendments, what he will do? Withdraw from the engagement. And finally, get an acknowledgement, get a declaration from the management that they have taken full responsibility for the final version of the compiled information. Just because my name is included, I am not responsible. And communication with those charged with the governance, all significant matters that are arising in the compilation process. Then finally, we will give a report where we mention title, where we mention addressee, a statement that practitioner has compiled the information based on the information provided by the management, responsibilities of management, identification of framework, identification of information including title, description that practitioner responsibility was performing audit as per related service. A description is what is a compilation engagement. We have to tell what exactly is a compilation engagement. Explanation that this is not an assurance engagement. Accordingly, we are not supposed to verify accuracy and completeness. This is not an opinion. This is not a review conclusion. Simply speaking, this is not an assurance. And finally, if at all financial information is prepared using special purpose framework, additionally you should also describe for what purpose it is prepared. Draw the attention of the reader in the compilation report to that note point in the financials which talks about basis of accounting and date of the report, practices in a place of signature. For this, I advise you to watch 4410 illustrations. Same format is there, neatly it was given. If you watch that format first and then read the standard, you will get much more clarity. Generally, for many standards, I first read the report and then read that. First I read the report and then we discuss the standard. You will get more meaningful understanding of the standard. And of course, for performing this engagement, compilation engagement, the engagement partner only shall be responsible for ensuring that the engagement was performed in compliance with firm quality control policies and procedure. Remember, quality control standards applicable for all types of works you perform. Getting it? And documentation. What you need to document? Significant matters arisen in compilation and how they were addressed. A record of how the compiled financial information reconciles with underlying. A copy of final version. The practitioner may also include engagement document, a copy of trial balance, significant accounting policies, all that. If the entity permits, you can take a record of trial balance, all this into your, documentation. If at all client permits. Some clients know you should not maintain any documentation, they may say. They may say you don't even have to give a report. You just have to come, help us preparing the information, you just leave, enough. You're not giving report. If you're not giving a report itself, the standard is not applicable. Very simple. Technically, if I'm not giving any report, obviously there is no possibility that they'll sue me later. If there is no possibility of suing me, what is the purpose of documentation? We maintain documentation to protect us. Correct? Huh? That's it. 4410 is over. Yes. Claps alone is not sufficient. You should read it. That is when you really learn. So understood all of you, compilation. So whatever the explanation I told, with that backdrop you read. But before this, read one report. Illustrations will be there in 4410. One or two will be there. One illustration, as a first illustration preferably you read. So you just understand how a compilation report is being drafted. In that itself you will understand so many concepts. You will understand purpose of that engagement. You will understand responsibilities of auditor. You understand responsibilities of management. Then after, if you read the standard, no, you get much more beautiful picture. Because the report is a summary of entire standard, correct? Report is a summary of entire that standard. You read that summary first and then read the actual standard. You will get more connection to it. Confident. That's it. Yeah. Let's continue with 3000 series. So 3400, examination of prospective financial information. Prospective financial information means financial information about the future. And if you recollect, Schedule 2, Part 1, Clause 3. Correct? Schedule 2, Part 1, Clause 3. It prohibits a chartered accountant in practice to associate with any financial information that contains projections. You are not permitted to associate yourself with projection. Like, you should not give any opinion on the projection unless the assumptions are clearly stated, unless you mention that you have not verified the accuracy of the information but only verified the assumptions reasonableness. Yes or no? Unless you mention these assumptions in the report that you are giving on prospective financial information, you are treated as guilty of professional misconduct. You are treated as guilty of professional misconduct. We must give clearly the assumptions used. We must clearly mention that financial information we didn't verify accuracy. See, prospective means what? Like, suppose a company prepared next 5 years P&L, next 5 years balance sheet. Comparatively, they prepared 5 years projections, 5 years forecast they prepared. Actually, here prospective information is two kinds. It can be either a forecast or it can be either a projection. Forecast means what? Generally, for short period we can forecast. For longer period we can only project. Forecast is generally based on best estimate assumption. Forecast is based upon best estimate assumption, based on the recent analytics, based on the recent past data available. You can forecast next 6 months or next 12 months, but you can't forecast beyond 12 months. Beyond 12 months, if you are forecasting, that's called as a projection, where the assumption is only hypothetical. It is not a best estimate assumption, it's a hypothetical assumption. So, and most of the times, prospective financial information is a combination of forecast and projection. Like, we will give next 5 years financial position, financial performance, where next 1 year is a forecast, remaining 4 years is just a projection. Next 1 year is based upon best accounting, best estimates, best estimate assumptions. Remaining 4 years we projected based upon hypothetical assumptions. Whatever it is, whether it is forecast, whether it is projection, you are not supposed to give an assurance report on that. If at all you give, you are guilty. However, you are not guilty. You clearly mentioned in the report, you didn't verify the information about its accuracy. You mentioned in the report that these information is based upon assumptions. And you mentioned the fact that if assumptions are changed, information will change. If you mention these three conditions in the report that you are issuing, then you are not treated as guilty. Correct? Many of us would have signed this projected financial statements for getting bank loans. Projections, yes or no? So these reports, these points must be mentioned on the assurance report on the projected information. Projected financial information, you should mention this particular information, this particular assumptions. You know what we technically audit here? In this entire 3400, we don't audit the numbers, we audit the assumptions. What we audit? We audit the assumptions as to whether the assumptions are reasonable or not. Whether the assumptions are reasonable or not. Specifically, for hypothetical assumptions, we will have to look at sensitivity analysis performed by the management. For hypothetical assumptions regarding projections, we should ask management whether they considered alternative possibilities also. And in the prospective financial information, especially projections, company must show if the assumption is changed like this, how the picture is going to be. In such a way, the prospective financial information should clearly explain. Then only I will give a report on that. That to what kind of assurance I provide, moderate assurance. What is the level of assurance on prospective financial information? Moderate assurance. When I say I am providing assurance on the information, am I actually giving assurance on the information, or am I giving assurance on the assumptions used to generate this information? Assumptions used to generate this information. On the assumptions, I am giving an assurance. And since these are assumptions, I cannot give reasonable or high level of assurance. I can only give you a moderate level of assurance. So 3400, the assurance given by the auditor is a moderate assurance. Whereas 3402, assurance on controls at service organization, where the report is used by user auditor of the user entity, the assurance is reasonable assurance. Assurance on pro forma financial information included in prospectus. Assurance on pro forma financial information included in prospectus. There the assurance is again reasonable. There the assurance is again reasonable. There is only one standard where moderate assurance is given, is assurance on prospective financial information. There we give moderate assurance. I told you this point also. What is moderate assurance? What is limited assurance? Both are same. Both are same. If at all you are giving assurance on the actual numbers, but limitedly, that's a limited assurance. If you are giving assurance on assumptions, they are using the word moderate assurance. Technically, what is the difference between limited assurance and moderate assurance? Can we quantify? We cannot. They both are interchangeable words, but since it is standard terminology, let us not interchange. Technically, for me, both are same. In moderate, even in PF, how do we give report? Nothing has come to my attention. Nothing has come to our attention to say that assumptions are not reasonable. We give opinion like this. Nothing has came to our attention to cause us to believe that the assumptions used are not reasonable. In limited assurance review, what we give, nothing has come to our attention to believe that the financial statements are not true and fair. Whereas here, nothing has come to our attention that causes us to believe that the assumptions are not reasonable. Both are same level of assurance. Just that there the word limited is used. Here the word moderate is used. What exactly the difference? If you ask me, they both are one and same. They both are giving only a lower level of assurance. They both are giving lower level of assurance. What lower level? Lesser than reasonable assurance. Any assurance lesser than reasonable assurance is either limited assurance or moderate assurance. That's it. Are you clear? Now, understood this, right? Look at this. Or else, I'll do one thing. Assurance engagement 3400. Illustrative format of unmodified report on a projection. We have examined the projection of so and so for the period so and so. We performed this engagement in accordance with SAE 3400, which is issued by ICI. The preparation and presentation of projection, including the underlying assumptions set out in so and so. Our responsibility is to examine evidence supporting the assumptions. Our responsibility is to not verify the accuracy of the financial information that is about future. No, our responsibility is to verify reasonableness of the assumption. Our responsibility does not include verification of projections. Means whatever numbers they actually shown, right? That is not our responsibility. Our responsibility is assumptions used reasonable or not. Based on these assumptions, numbers generated correctly or not. Whether these numbers are correct or not, I cannot give opinion. Therefore, we do not vouch accuracy of the same. Accuracy of what? Projected number. The projections has been prepared for so and so purpose. Maybe company is going for bank loan, company is going for some merger, some purpose. The projection has been prepared using set of assumptions that includes hypothetical assumptions. Consequently, users are please cautioned. The projection may not be appropriate for any purpose other than the stated purpose as above. Other users don't use this. In our opinion, the projection is properly prepared on the basis of assumptions as set out in so and so. Get it correct? Now you see here, based on our examination, nothing has come to our attention which causes us to believe that the assumptions do not provide a reasonable basis for the projection. This is the actual opinion section. This is the actual opinion. In fact, let me call this as conclusion. Let me call this as conclusion. But you know, the standard uses the word opinion here, so anything you can use. That's not an issue. They are not particular about it. That's it. So, and you know, at the end, we are even mentioning that even if the events anticipated under possession described over occur, whatever events we anticipated, they might occur, but actual results will likely to be different from projection, since other anticipated events may not occur, and the variation is going to be material. You should clearly mention these statements. You should clearly mention the statement that whatever anticipations we told, right, based on assumptions, they will definitely occur, but they will not be real. They will not exactly like whatever we mentioned. They may not exactly occur. Variation will be there, and the variation is going to be material for sure. Indirectly, what are we telling to the other party? Look, this is a projection. This is based upon so and so assumptions, which include best accounting assumption, hypothetical assumptions, whatever. If at all assumption is changed a little bit, the information will change. The actual outcome might be different from the projection, whatever we are saying, and for sure there will be a substantial difference between these two. So whether you will believe this or not is your choice. We are giving complete cautions to the users. Precautions and all we are telling him at the beginning itself. Clear? Same reporting requirement even for forecast. Same reporting requirement for forecast. Just that here we mentioned that the forecast has been prepared using set of assumptions as set out in so and so, which is a best estimate assumption. Best estimate assumption. Now, so what is a prospective information? Prospective information is information based on assumptions and possible actions by the entity or events that may occur in future. It is highly subjective, requires considerable judgment. It may be a forecast, it may be a projection or a combination. SAE 3400 provides guidance. Their examination of PFI need not necessarily performed by stat auditor, or maybe stat auditor himself can perform, no restriction. This is an assurance engagement, remember. This is not some internal assignment. This is an assurance. Stat auditor also can perform, or others also can perform, anybody can perform. What is a forecast? Assumptions as to future event which management expect to take place, the actions management expect to take place as and when the information is prepared. This is generally based upon best estimate assumption. Best estimate assumption is an assumption that reflects anticipated experience with no provision of risk of adverse deviation. Next 1 year I can expect how the business is going to be, but it will not be completely adverse. A different picture altogether it won't be. Whereas projection, hypothetical assumption will be used. A mixture of best estimate and hypothetical assumption may also be used when we are projecting for more than 1 year. Scope. This standard will not apply. This standard will not apply for narrative terms like that is there in management discussion and analysis in entities annual report, though many of the procedures outlined may be suitable for such an examination. For example, a company called you, they prepared annual report. Annual report will have so much of other information, right? In the other information, so much of reports are there. Corporate governance report is there, CSR report is there, management discussion and analysis. Inside that, they are talking about future of the company, what, like how the company sales will increase, how the company profit will increase. Like they're talking about future outlook of the company. On that, you just have to give an opinion whether that is reasonable or not. This standard will not apply. This standard is specifically applicable when a company is preparing separately projected financial statements or projected financial information, prospective financial information with a view to submit to a third party, specific third party, the two. Getting it? Then only the standard will be applicable. And remember, write about nature of assurance regarding prospective. The nature of, first of all, the nature of prospective financial information is what? Speculative. Why? Because the evidence available at the time of historical financial information, the evidence available for historical is very concrete, clear. But for prospective, you will not have any evidence. It is purely based upon assumptions. So which is highly speculative. Means it may happen, may not happen. Therefore, an opinion as to whether results can be achieved or not, you can't express. If the client is asking you, sir, you please give opinion on whether can we achieve the results or not based on your understanding, you should not give. If you give, it's a violation. You should only talk about assumptions reasonable or not. And tell that assumptions might change. Tell that the results might change. And change can be substantial. You should always alert the user clearly. You cannot give assurance on the projected financial information. Correct? Whose responsibility? Obviously, management is responsible for identification and disclosure of information. Basis for forecast. What is the basis? Assumptions and underlying assumptions, of course. Why CS are needed? Generally, if some other profession is performing this PFI analysis and giving a report, people may not believe. Since people have a very good understanding of CS or general dealing with accounts, financial statements, all that, if you come and give a report, they will believe. That's the reason why CS are required in evaluating prospective financial information. Varied stakeholders will have a greater reliance on reports, that are signed by chartered accountants. Code of ethics point. You should clearly mention the source of information. You should clearly mention the basis of forecast and assumptions, and a statement that you did not vouch the accuracy of the forecast or accuracy of the projection. If these 3 points, if you clearly mention in the report that you are giving, then you are not held guilty. If at all it appears that you are guaranteeing about the future to the user, you are treated as guilty. The same even applies to projection. In examiner, they'll give you what are the points that a CA in practice must state in his report on the projected prospective financial information, which may be a forecast or projection. What points he must state so that he will not be guilty. Or they may give you write about code of ethics. Write about ethical requirements relating to reporting on prospective financial information and requirements of the code of ethics regarding the same. You just have to give this entire answer. 4 marks question they'll give you. They will put a case study and then they will tell something happened in that case study. You need to mention this provision and say that whatever happened is correct or incorrect. Clear? 3400, remember again and again, you are only doing verification of assumptions. How if the assumptions changes, the position changes? Based on the assumptions, the information prepared is correct or not? Based on the assumptions, are they correct or not? You have to verify. And mention these assumptions in the report, mention the information source, and say that you did not verify accuracy of this information. And what are the duties? What are the duties of a member who is examining PFI? The duty is very simple. the auditor shall obtain evidence regarding what? What are the management best estimate assumptions? And are they not unreasonable? Nothing but are they reasonable or not? You have to verify. And see that prospective information is based on these assumptions only. If at all one of the assumptions is inflation rate, whether the inflation rate is rightly applied for increasing the sale value, selling price, check out. The prospective information is presented in all prospective information is properly presented and all assumptions are disclosed, including clear indication whether they are best estimate or hypothetical. The PFI shall also indicate, the management should explain that what assumptions they use. Are the best assumptions or best estimate or hypothetical? Generally for next 1 year we have best estimate assumptions. For beyond 1 year, the assumptions are by default hypothetical. We can't have a best accounting estimate. And the prospective information is prepared on consistent basis with historical financial information. This is one point which many don't understand again. Like, what is the format of prospective financial information? Same Schedule 3 format. It should be consistent with historical financial information so that in relation to historical, prospective can be compared. Why prospective is prepared? First of all, tell me. To compare it with historical data. To compare with historical data, how the company is going to perform in the future. That is the reason, right? Prospective financial information is prepared to compare it with historical data and decide how the company is going to perform in the future in comparison to its past. So that can I give extra funding to the company or not? As simple as such. So what is the nature of assurance? Prospective information relates to events and actions that have not yet occurred or that might not occur. So evidence available to support assumptions itself is future oriented. The assumption itself is future oriented and highly speculative in nature. Therefore, an opinion as to whether result shown, can it be achieved or not, we cannot express. If at all you still ask me what is the nature of assurance, it is only moderate assurance. Its assurance is not about again information. Assurance, moderate assurance is only about the assumptions used. You're getting it? Actually, this question is repeated. Above, no, what is the nature of prospective financial information? Is there, right? What is the nature of prospective financial information? The same thing is repeated. It is repeated twice. There it is given as a paragraph. Here it is split into 3 points. Matter will be exactly same if you cross verify. You are getting it? So before you accept this engagement, the auditor will consider the following. What is the purpose of this prospective financial information? Whether information is generally, whether this PFI is available for distribution, nature of assumptions used, elements and period covered by. The auditor should not accept or should withdraw if assumptions are clearly unrealistic and when the auditor believes that PFI will be inappropriate for their intended use. For what purpose management said, for that purpose this is not correct document. If auditor feels this is not a correct assignment, you will withdraw, you will not accept. Or if the assumptions are clearly unreasonable, you will not accept the audit. If at all you accepted, you withdraw from the audit. So how do you examine? When determining nature timing, the following matters: the knowledge obtained in the previous year, previous engagements, management competence, likelihood of material misstatement, the extent to which management judgment is involved, what information they are using, how far it is reliable, industry statistics, stability of the business of the entity, engagement team experience in that industry. All these points we consider in our mind and design our procedures to verify assumptions, procedures to verify prospective financial information. This is actually, this entire 3000 series is self-preparatory. It's not so complicated. This is not so complicated. Even 2000 series also like this only. Because no complication in that to discuss. Much complication is not there. Suppose you see 805, 810. Even 3402, slight amount of discussion can be done. Here, whatever is read here, I should explain the same. I can't even take up any other case. That is also not required basically. So self-explanatory this entire 3000 series is. Even 2000 series is also self-explanatory. 2000 series also. 2000 series is lengthy. but it is self-explanatory highly. If at all you are very confident in auditing standards, 2000 series becomes very easy for you. And remember, prospective financial information shall also be prepared on a consistent basis with historical. Means in the historical financials, you will disclose all accounting policies. You will mention detailedly the notes, everything. Same way you have to mention here also. How detailed the historical financial information you are presenting, same level of detail PFI also you will present. Just that in PFI, the data is assumption oriented, whereas in historical, the data is actual. That's the only difference. So when assessing presentation and disclosure of PFI and the assumptions, it needs to be considered whether PFI is informative and not misleading. All the accounting policies are clearly disclosed. Any changes in accounting policies and reasons for change are adequately disclosed. The assumptions, it needs to be clear whether assumptions represent best estimate or hypothetical. When assumptions are made in areas that are material and are subject to high degree, this uncertainty and resulting sensitivity results also should be presented. If at all assumption is high degree of uncertainty is there, if estimation uncertainty for that assumption is very high, sensitivity analysis report also company should present. What does it mean? Suppose they have taken some 4 or 5 assumptions, inflation assumption, customer demand, number of customers that are purchasing, that assumption, market related some assumptions like recession related some discussion going on, that related assumptions. What if some of the factor change, how the PFI can modify, how the PFI will be modified. So sensitivity analysis should also be presented, especially when if there is a high degree of uncertainty. And the date as of which PFI was prepared is disclosed. Management needs to confirm that assumptions are appropriate as of the date. Correct? No? Generally, whenever we are taking any assumptions today about the future, the assumptions have taken today is based upon the information available today. If at all I know next year some other data, some updates might come, so my assumption altogether will be changed in the next year. And finally, report. This itself can be asked as a 4 marks question. You are giving a report on prospective financial information assurance report. What are the disclosures to be made specifically in that report? What are the disclaimers you have to make? Disclaimer means what? Again, disclaimer of opinion, not that. Disclaimer means giving some statements. State that whether assumptions do not provide reasonable basis. Have you got anything has come to your attention that cause you to believe that assumptions are not reasonable? Give an opinion as to whether PFI is properly prepared on the basis of assumption. State that actual results will be different from PFI since anticipated events generally does not occur and variation could be material. The same thing they showed or not in the PFI. Just now we have seen assurance report. In case of a projection, PFI has been prepared using set of assumptions and that include hypothetical assumptions that are not expected to occur. Consequently, readers are cautioned that PFI should not be used for any purpose other than the above. This PFI is prepared to address so and so user. For him only this is useful, not for others. This is prepared based on hypothetical assumptions which may not occur. So that statements and all should be presented in the actual report. That's why you say 3400 report illustration 1, illustration 2, these statements will appear. Suppose, no, finally reporting. If presentation and disclosure is not adequate, presentation and disclosure of what? Assumptions, whatever it is not adequate. You will either give a qualified opinion or adverse opinion. If at all you have to give an adverse opinion, situation comes, you have to withdraw. Suppose assumptions are not reasonable. Assumptions are not reasonable. You give adverse opinion, mention the reasons. You are unable to apply procedures given under this standard. Like you have to verify assumptions, you have to get the data, you have to get the sensitivity analysis report, all that. You need to get that entire data and then only you can talk. That data you are unable to obtain, you cannot give the opinion. Disclaim the opinion, first you withdraw. If withdrawal is not possible, give the disclaimer and documentation. That's it. 3400 is over. See, in 3400, 3420, and even 2000 series, I cannot go in depth because the point is you feel like a repetitive from the standards on auditing. Especially 2000 series, you see, except the word audit versus review, except limited assurance, reasonable assurance, everything else is same. I'll tell you, introduction I'll give you for 2000 series, there you will understand. So 2000 series, 3000 series is more of you have to read. It is not that I can explain, because complication is not there in this. No complexity at all. Clear? Yes. So let's begin. SCA, Standard on Assurance Engagement 3420. Assurance engagements to report on compilation of pro forma financial information that is included in prospectus. So if pro forma financial information is included in prospectus, on that we are providing assurance report, assurance opinion we are giving. That too, the kind of assurance that we give in this is reasonable assurance. The standard itself clarifies that. Why in 3420 it is a reasonable assurance, and why on 3400 it's moderate assurance? 3400 is completely assumption based. It's purely assumption based, and there we do audit assumptions. We verify assumptions. Whereas in pro forma financial information, what is the first of all pro forma financial information? Very simple. Suppose I want to go for funding. If you give me like 10 crores amount of funding, how my financial information is going to be presented, altered? How my financial information, or not that example, best example I'll tell you this, mergers. Suppose my company and another company, if at all we merged into a single entity, how our proposed balance sheet and proposed P&L looks like? It's nothing but proposed post-merged balance sheet, post-merged P&L, nothing but post-merger financial statements, how it looks like once a merger is got approved. Getting it? So if we prepare, like before merger, how is our position? After merger, how is our position? If at all we are able to show like this, the post-merger, whatever we are showing, that post the transaction, that's called a pro forma financial information. So for pro forma financial information, we take first some information from here there is a word they use called unadjusted information. What is it? Unadjusted financial information. Unadjusted financial information. To that, whatever adjustments we want to make, like now we want to merge with another entity. So with merger, on account of merger, whatever adjustments that are required, if all those adjustments were made to unadjusted financial information, unadjusted financial information plus adjustments, proposed adjustments is equal to pro forma financial information. So on these adjustments we do audit. Whether these adjustments are made as per applicable framework, on that context we do audit. Getting the point? Here we are not talking about assumptions. Here we are talking mostly about actual data. Two actual data if we merge. Unadjusted informations, two unadjusted informations if we merge. So that we call it as what? Pro forma. So first, no, let's look at how this audit report looks like on this. Illustrative practitioner's report with an unmodified opinion. And you see here, independent practitioners. 1 minute. So let's look at this independent practitioners assurance report on compilation of pro forma financial information included in a prospectus. We have completed our assurance engagement to report on pro forma financial information of ABC, which they compiled. Here we are not compiling, ABC only compiled. Whether they compiled on their own or they used another auditor, another chartered accountant help while compiling, that and all irrelevant for us. Getting it? The pro forma financial information consists of what? Pro forma balance sheet, pro forma P&L, pro forma cash flow, and related notes as given in so and so prospectus. The applicable criteria on the basis of which this pro forma information is combined are so specified in so and so securities regulations. SEBI in India, SEC in US, getting it? All that. The pro forma financial information has been compiled by the management, nothing but responsible party, to illustrate the impact of an event or condition on the company position at a particular date and the company's financial performance for the period ended, as if, you see the wordings, as if the event had taken place at so and so date. If at all merger is taken on so and so place on the past date, how the company balance sheet and P&L would have been, that we will show. As a part of this process, information about the company has been extracted by the responsible party from the company financial statements for the period ended on which an audit report or review report has already been published, or no audit or no review has been happened. So pro forma financial information may be related to a partnership firm. In such a case, there might not be an audit. Are you getting the point? Now, what is the responsibility of the responsible party for pro forma financials? The responsible party is responsible for compiling pro forma financial statements on the basis of criteria described in the pro forma financial statement. This responsibility includes implementing, maintaining controls for compiling the pro forma on the basis of that is free from material misstatement, whether due to fraud or error. So by this time you could have understood pro forma financial information is prepared at a past date by taking information as on so and so date from the financial statements of the entity. Those financial statements are normal financial statements, standalone or consolidated, whatever. From this standard point of view, we call it as unadjusted financial information. What do we call it as? Unadjusted financial. Now, in pro forma, what are we doing to that financial information? We are adjusting. We are just doing adjustments. Now, look at the auditor responsibility. Our responsibility is to express opinion about whether the pro forma financial has been complied in all respects by the party on the basis of the criteria. Just have to check whatever criteria they disclosed in the pro forma financial statements for making pro forma adjustments, whether the criteria they followed, whether the criteria whatever they showed, have they followed the same? Getting it? So they made a pro forma financial statements and they showed a criteria in the pro forma financial statement inside that, whether that criteria is really implemented. Because people will understand, suppose if I say my financial statements are prepared on accrual basis, if I make a statement, you interpret entire results from accrual point of view. If I say cash basis of accounting, you interpret entire information from cash basis point of view. But what if I say accrual, but I prepared on cash basis, but your interpretation goes wrong right then? Exactly. We said some pro forma adjustments we made. This is how we prepared pro forma financial information like that. We declared already. Who will assure that? Is it in the same way the company did? Are you getting it? Auditor like you and me have to give an assurance report on that. And by the way, here we conducted our engagement in accordance with standards on assurance engagement. Assurance engagement, all the general content only. And remember, by the way, here we are expressing opinion on pro forma financial information, which includes unadjusted financial information derived from some financial statements which are historical. Does it mean, are we giving opinion on historical financial statements? That's a separate engagement altogether, and this engagement is different. We are not responsible for updating or reissuing. If at all we are already the auditor, we are not responsible. Maybe I am the auditor, or if I am not the auditor, somebody else is auditor. I am not responsible for issuing any opinion. I am not responsible for reissuing any opinion on any historical financial information that is used in compiling pro forma, nor have we in the course of this engagement performed an audit or review of historical information. Either we didn't verify whether historical information is right or not. That is not our responsibility. The purpose of pro forma included is purely to illustrate the impact of significant event or transaction on unadjusted information of the entity, as if the event or transaction has been undertaken at an earlier date selected for the purpose of illustration. So in order to convince somebody, in order to convince the shareholders that we want to acquire so and so company, okay, if we acquire so and so company, this is how our position could have been. But to acquire this company, we have very minimum funds. We want you to give us extra funding. So by taking your funding and having existing funding, if at all on an earlier date, if at all we have all these funds in our hands, if at all we do a merger like this is how our company position could have been. So we show like this. That too on a past date only. We don't talk about future. Getting it? Since it is past date only, it is reasonable assurance. Are you getting it? If anything about future, we cannot give. reasonable assurance. Maybe I can say that example best. Since pro forma deals with past financial information plus adjustments in the past date. Getting it? What if only? Just that. What if it happened on so and so date? How the position could have been, how the performance could have been. That's why we give a reasonable assurance. And we clearly mention a reasonable adjustment. You know, all that to obtain sufficient appropriate evidence about whether related pro forma adjustments give appropriate effect to those criteria. As per those criteria, correctly adjustments were done or not. The pro forma information reflects the proper application of those adjustments to the unadjusted financial information. Getting the point? The procedure selected is decided by practitioner's judgment. What procedures he will do, all that. The engagement also involves evaluating overall presentation of pro forma financial information. In our opinion, the pro forma financial information in all material respects compiled on the basis of so and so criteria. It's a positive assurance opinion. Negative assurance we are not using. We are not using. Nothing has come to our attention that causes us to believe that the pro forma financial information is not true and fair. So no. We are saying pro forma financial information based on our examination, in our opinion, it is prepared in accordance with so and so criteria. And if at all any other reporting requirements are there under the law or under the regulatory requirements, that also we have to report. Understood? Now look at the standard, how it looks. So pro forma financial information means what? It refers to financial information shown together with adjustments to illustrate the impact of an event or transaction on unadjusted financial information as if the event had occurred. The transaction had been undertaken at an earlier date selected for the purpose of illustration. The same wordings are used in the report also. This is achieved by applying pro forma adjustments to unadjusted financial information. So it is used in offer documents to demonstrate the effect of a transaction on the financial statements. It may take the form of a financial statement of P&L balance sheet to illustrate how transaction might have affected the assets, liabilities, earnings, all this. So if at all you have given funding on so and so date, if at all the funding we used and acquired this company on so and so date, our total profit could have been this, our total net worth could have been this, our fixed assets could have been this, current assets, liabilities, all this could have been like this. So we mention like that. They also include notes of, obviously, in relation to aspects of the transactions and assumptions. Of course, pro forma financial information also, just like any financial statement, it will have notes. Now, in what form pro forma information will be there? They will take a format of balance sheet P&L. They will be in which format? Balance sheet P&L format only it may take. It may be in the form of a balance sheet P&L, just like how we financial statements. Pro forma financial statements will be consistent with the historical financial statement. They will be consistent with historical financial statements. It's consistent in manner of preparing them. So just like Schedule 3, all that we use. Pro forma financial does not represent entity's actual financial position. Obviously, this is not actual position. This is an estimated position. More importantly, rather than the word estimated position, adjusted position. That is most important. Here we are not using estimates, understand? Okay. Now objective. The objective is obtain reasonable assurance whether pro forma financial information has been complied on the basis of applicable criteria and report as per the standard. That's it. You see, if you read that report, the illustration, the way you understand the subject is different. Without reading that report, if you're straight away starting from the beginning, if you read, you'll not understand. You feel like sentence transitions. That's it. Compilation of pro forma financial information. Next one, compilation. Whose responsibility? Obviously, responsible party. Identifying the source of the financial unadjusted information and extracting the unadjusted information, making pro forma adjustment, presenting the resulting along with the disclosures in the offer documents. Over. These are the responsibilities of responsible party for pro forma financial information. This itself can be asked as a 4 marks question. Compilation of pro forma financial information is responsibility of the auditor or assurance provider. False. It's not his responsibility. It's the responsibility of management. What are their responsibilities? Getting it? Or they may ask you, give a brief introduction to pro forma financial information. Give a brief introduction to pro forma financial. This itself can be asked for 4 marks. Next. Now, what is a practitioner responsibility? He has no responsibility to compile. Understand? He has to just report whether the pro forma information is complied on the basis of criteria. And he will be performing procedures to check whether criteria whatever they showed is exactly used while compiling the pro forma information. And is it a reasonable basis for presenting significant effects directly attributable to the events or transactions? Whether the events or transactions all that properly presented. Applicable criteria is nothing but is a criteria. It's nothing but set of rules and regulations. It's nothing but framework. Applicable criteria in the context of financial statement general purpose, we call it a general purpose framework. In the context of special purpose, we call it a special purpose framework. In case of fair presentation, we call it as fair presentation framework. Compliance framework. Criteria is nothing but on what basis you are preparing. So applicable criteria used by responsible party when compiling the pro forma. So criteria may be established by authorized or standard setting organization or by law or regulation. Some law or regulation would have given this. Or some standard setting organization would have given this. Getting it? Where established criteria do not exist. Suppose if there is no criteria as such in SEBI or anywhere else, then management will be developing the criteria. This is something we have seen even in 300402 also. A special purpose framework also. 800 also we have seen. Sorry, 800 we have seen. Generally for preparing special purpose financial statements, if at all any standard setting authority or any regulatory is there, they will give. If that is not there, management will set up the criteria. Now, what are the steps involved in pro forma? First, you accept the audit. Nothing but accept the engagement. Better not to use the word audit here because it is not an audit engagement, it's an assurance engagement. Okay. And planning and performing the engagement. Get written representations regarding all the unadjusted financial information correctly extracted or not. Whether pro forma adjustments are made correctly or not. Whether criteria is disclosed appropriately in the pro forma financial information or not, like that. Forming the opinion and preparing the assurance report. Now, engagement acceptance. So now, before you accept, practitioner shall consider, do you have the capability to do this engagement? Check out. Whether applicable criteria is suitable and that is unlikely that the pro forma information will be misleading. On what basis they prepared pro forma. Whether that basis is usable in the context. On the basis of the criteria which they use, is it relevant in the context? Like, is it for the SEBI? Suppose SEBI is asking them pro forma for so and so purpose. The pro forma, is it not misleading? Check out. Wordings of the opinion prescribed by law or regulation to determine that practitioner will be likely to accept. Suppose if it all SEBI itself give, okay fine, after you verify, you give opinion like this. The wording should be like this. Is it okay for me to use these kinds of wordings given by law so that it will be in line with the standard on assurance engagement? If at all it is not in line with standard on assurance engagement, I have to use a different set of wordings. I will not refer in my assurance report standard on assurance engagement because I am doing absolutely the law as per the law. Sorry, I am doing absolutely the procedures as per the law. That's a compliance framework. Getting it? Where the source from which unadjusted information and any acquiry or divestee, getting it? Financial information have been extracted. Are they audited or reviewed and a modified opinion or review conclusion if at all expressed? Or it has an emphasis of matter paragraph, whether the relevant law permits the use of a reference in the practitioner report to the modified opinion or review report or emphasis of matter paragraph with respect to the sources. Nothing but the entity which appointed us, they prepared pro forma financial information. Now, to prepare this pro forma information, source data is nothing but historical financial statements. On that historical financial statements, auditor or reviewer has given a modified opinion, or they have given an emphasis of matter paragraph. Now you are doing assurance on pro forma financial statements, right? If at all you are providing an assurance report as per law, if the law says source, on the source, if there is a modified opinion, you must talk about that in your practitioner's report on SA 3420. If so, you need to mention about this. Are you getting the point? So in the assurance report, you have to refer. You are not qualified. You have to refer that. You may have to use a separate slide, probably maybe in the standard in-depth explanation they would have given how to present this. Okay, modified opinion on unadjusted financial information extracted for the purpose of pro forma financial information cited below. On the unadjusted financial information of the acquiry, buying company or divestee. Getting it? So we have found these modified opinions, these emphasis of matter paragraph. These pro forma financials are prepared using the same financial information on which the auditors of respective company has given modified opinion, we should mention that fact. When we should do this? If there is a requirement in the law. Getting the point? So whether there is a requirement in the law or not, we need to check under what context or by because of which reason pro forma is prepared. If management voluntarily prepared, not required. Suppose if the historical financials were not audited, if they were not at all audited, practitioner can obtain a sufficient understanding of the entity and accounting practices to perform the engagement. Suppose if at all historical were not audited, I think that's a reported. Sorry, this is entities historical. Means our company for whom we are doing audit of pro forma. Suppose if acquiree or divestee, if their financial information is also not audited, you just have to obtain sufficient appropriate information that acquiree's accounting and accounting practices are qualitative. Finally, get a representation, get an agreement that it acknowledges and understands their responsibility for disclosing applicable criteria, compiling pro forma information, providing practitioner with access to information, additional information, unrestricted access to the people within the entity, and when needed, access to individuals in the acquiree, means buying company, selling company. Acquirer means ours is purchasing company. Acquiree means that's a selling company. Amalgamated company, amalgamating company. Transferor company, transferee company. Getting it? Nothing but. Planning and performing the engagement. First, you should evaluate criteria. The most important thing in this entire pro forma financial statements assurance is criteria evaluation. Then set materiality. Then set materiality. Consider materiality with respect to evaluating whether pro forma information has been completed in all material on the basis of applicable criteria. Probably when you are deciding materiality, you will not decide based on historical financial information. You will decide based on pro forma financial information. Materiality is decided based on pro forma financial information. Individually, two companies are going to merge. Individually, they have different levels of materialities. But once these two companies are merged, the figures will be bigger. In that case, materiality will be different. Now, pro forma financial information is materially misstated. It depends upon materiality levels that is applicable for pro forma level, not for the unadjusted financial information for which materialities are decided by their auditors for audit purpose. Understand how responsibility has complied, like how management compiled the pro forma information and from where they are getting sources. What are the sources of pro forma? So get an evidence about appropriateness of source data. If there is no auditor review on the source data, you have to satisfy that source is appropriate. Suppose if the source data is not audited, not reviewed, how do you assure that source is accurate? So you need to get an assurance that source is accurate and shall obtain evidence about adjustments. Finally, source data you saw. Is it appropriate or not you saw? And what are the adjustments? These are the things that you have to do, mainly two. In relation to unadjusted financial information. Now with respect to unadjusted financial information, pro forma adjustments includes what? Adjustments to unadjusted financial information that illustrate the impact of an event, if at all that event has happened at an earlier date. Adjustment to financials that are necessary to, adjustments to unadjusted financial information that are necessary to pro forma to be compiled on the basis of consistent with applicable financial reporting framework. Consistent with applicable framework means general purpose framework. Generally, pro forma financial statements are also prepared using general purpose framework only. This is like, see, planning and performing the engagement, right? In this, this one is right. What practitioner has to perform? They'll ask you a question on this. For example, what procedures practitioners has to perform while, in relation to unadjusted financial information and pro forma adjustments. So only with respect to unadjusted information sources, this point. This is talking about purely sources. Whereas this is talking about adjustments to unadjusted financial information. Which adjustments? Pro forma adjustments we call it as. Finally, presentation. See whether the presentation is proper or not. And other information. Obviously, this pro forma financial information is kept in a prospectus. Prospectus contains so much of other information. So whether any material inconsistencies is there in the prospectus. Generally, other information definition is annual report in SA 720. Here, other information means what? Prospectus. Get a written representation that representation from responsible party that their responsible party has identified all pro forma adjustments necessary to illustrate the impact. whose responsibility to adjust all adjustments that are required so that pro forma financial information demonstrates true picture management. And they are responsible, they need to give a representation that pro forma financial information is prepared on the basis of criteria. Finally, you give an unmodified opinion when the practitioner concluded that the pro forma financial information has been compiled in accordance with applicable criteria. Suppose where practitioner concludes that a modified opinion is appropriate, the practitioner shall discuss the matter with responsible party. If responsible party does not agree to make necessary changes so that the pro forma financial information properly prepared as per applicable criteria, you withdraw from the engagement or take legal advice. When the law is not permitting modified opinion, generally SEBI and all will not permit a modified opinion on pro forma. Why on pro forma? How modified? Pro forma financial should be prepared as per criteria. That's it. Law has given the criteria. For example, Securities Exchange Commission or SEBI, like that, they have given a criteria. No violation or no deviation is excused. And obviously, when the violation is not excused, auditor just have to check whether it is correctly met or not and give an unmodified opinion. If at all a situation comes where auditor has to give a modified opinion because pro forma financial information adjustments to unadjusted financial information is not proper, applicable criteria is not satisfied, where auditor end up giving modified opinion, but law do not permit, withdraw from the engagement or take a legal opinion. Suppose if law permits modified opinion, in that case, if law permits a modified opinion, so where the relevant law regulation may not preclude, may not prohibit publication of prospectus that contains modified opinion, the practitioner determined that the modified opinion is appropriate. Please apply requirements of the framework for assurance engagements regarding modified opinion. Nothing but you use 700 formats, 705 formats, wordings. Take the wordings, their help, framework, assurance, and framework for assurance engagements. This includes auditing standards, obviously. Framework for assurance engagements includes auditing, review, assurance standards, all put together. Emphasis. In some cases, practitioner may consider it necessary to draw attention to a matter presented where the matter is of such importance that is fundamental to user's understanding. In such a circumstance, practitioner shall include an emphasis of matter paragraph and mention that it does not affect the pro forma financial information has been compiled in all material respects. You need to ensure that here, when we can emphasize any matter, we can emphasize only when it is not materially misstated. Here we are not talking about material misstatements mainly. Here we are talking about adjustments were proper or not. Only when you can highlight, provided the adjustment regarding which you are highlighting. Getting it? On that there is no violation. On that it is not as per applicable criteria or like that. It is in accordance with applicable criteria. Preparing the assurance report. Title will be there. Address will be there. Introduction para. So introduction para, you mention sources from which unadjusted information is extracted, for what period it is covering, reference to applicable criteria. We saw in the report the pro forma financial information is prepared as per so and so note number given in so and so criteria. That criteria. A statement that responsible party is responsible for compiling pro forma. A description that practitioner responsibility is to express opinion. And mention that practitioner is not responsible for updating or reissuing any report or opinion on historical, nor the practitioner performed audit of historical financials. The purpose of pro forma is included in prospectus is only to illustrate the impact of significant impact of unadjusted financial information plus adjustments put together. You see, they'll give you this question, 4 marks. Write about what are the statements the practitioner has to make. What are the statements the practitioner has to make with respect to practitioner's responsibilities in an assurance report provided on pro forma financial information. So in an assurance report that you are providing on pro forma financial, you have to describe your responsibilities, practitioner responsibilities. What responsibilities you shall communicate? 4 marks question. Any 4 points you have to write. And a statement that engagement was performed as per 3420. And we also have to comply with ethical requirements, all that. A statement that we are giving a reasonable assurance. Getting it? Whether pro forma financial information is prepared on the basis of applicable criteria, and it involves performing procedures to check whether applicable criteria is used by responsible party. And auditor has to obtain evidence about related pro forma adjustments and effect to those criteria, whether they are proper application of those adjustments to the unadjusted financial information. what are all adjustments they made, they'll give a list in the pro forma financial information. That is what criteria. So to unadjusted financial information of X Limited and Y Limited, what adjustments we made? On these adjustments, nothing but on this criteria, we prepare the pro forma financial information. That for that you need to get evidence. And that's enough opinion. The auditor can use following phrases: whether the pro forma financial information has been complied on the basis of criteria, or the pro forma information has been properly complied on the basis stated. In all material respects, that phrase you can use, or this phrase you can use. Getting it? This pro forma, everywhere they never use the word true and fair. Mostly pro forma financial reporting frameworks are compliance frameworks. And signature, date of report, place of signature, and documentation. Easy or not? All of you. First, next time also when you are reading, just download 3420, read the illustration. Try to understand. Slowly you read and understand. Then read in this book. Over. Okay. So the specialized areas, related services, review, and prospective all together, we are having 10 standards. Within these 10 standards, first let me discuss on review of financial information. Review. Because review is closely similar to standards on auditing. Because in audit, we perform the audit of we generally discussed until now in the context of general purpose financial statements audit, where we give reasonable assurance. Whereas in review also, we do verify historical financial information only, but we provide limited assurance. That's the only difference between audit and review. The procedures are almost similar. In review, we just do two activities. One is inquiry and analytical procedure. Whereas in audit, we do inspection, observation, recalculation, reperformance, physical verification. So many things we do along with inquiry and analytical procedure. Getting it? So in audit, the level at which we go verify the transactions is in depth than in review. Getting it? So review, you see, 2400, there is a standard: engagements to review historical financial information by an external auditor, who is not the auditor of the entity. Who is not the auditor of the entity. There I'll discuss on that little more in depth. 2410 is dealing with review of interim financial information performed by same auditor of the entity, independent auditor of the entity. If at all financial information, historical financial information is performed by an outside auditor who is not the auditor of general purpose financials, who is not our regular auditor, if he is performing a review, 2400 is applicable. If at all our independent auditor himself is performing review, tell me, when audit is happening, why for the same period again review is required? Obviously not. This is for interim period. For interim period, we will not have an audit report. So for interim period, we will at least have a review report. So anyhow, audit is conducted for the full year as a whole by auditor, where he is giving reasonable assurance, all that. For the same full year, review is not there. If at all for the same year, review is also conducted because of some other reason, then 2400 is applicable. So in 2400, review is generally, this entire standard is generally discussed in the context of full year. It is discussed in the context of full year. Whereas in 2410, that standard itself is discussed in the context of interim period. For example, quarterly financial statements. Now, 2400 first we will understand. So the standard specifically says, by the way, standard is engagement to review historical financial statements. Getting it? The practitioner responsibilities. What are the practitioner's responsibilities when he is engaged to perform a review of historical financial statements, when he is not the auditor of the entity's financial statements? Once he completed the review, what is the form in which the review report shall be given? What should be the content of the review report? It's also called as practitioner's report. Able to understand? Now, by the way, here the practitioner can be a chartered accountant or can be others also. But if at all chartered accountant is providing, he must comply with 2400 ICI things. Getting it? So 2400 deals with the practitioner's responsibilities performing a review when he is not the auditor. Where here practitioner expresses conclusion, like in audit we express what? Opinion, and we get reasonable assurance, and we have unqualified opinion, qualified opinion, adverse opinion, disclaimer of opinion, whereas here it is called as conclusion, and which is a limited assurance, unqualified conclusion, qualified conclusion, adverse conclusion, disclaimer of conclusion. This is the parallel wordings that are there in auditing and review standards. Getting it? Now, the financial statements that we are reviewing in this standard, they may be general purpose or they may be special purpose. Generally, review of general purpose financial is not that popular for full year, because for full year generally most of the entities will have a audit. Okay, so that is what. So the financial statements may be prepared using general purpose or special purpose. Here, practitioner is giving a conclusion based on limited assurance. Getting it? And so in the report, he will specifically mention the nature of review engagement. So for that, I will open this document. So review, so 2400. So we'll go to review illustrations. So this is one review report. This is one review report. In this, you see conclusion is at the last. Of course, these review reports are not yet modified. They will issue revised, I think so mostly. They will issue revised very soon. You see, this is issued somewhere in 2009 or 10, some at that time, probably at that time they might have issued. Okay, 2016 it was issued. So now you see, let us look at the review report first. Heading is like, you see, independent practitioners review report. You are not auditor, you are a reviewer. So instead of calling as a reviewer, we are calling him as practitioner. We have reviewed the accompanying financial statements of the company comprising balance sheet, cash flow, statement of changes in equity, whatever. Management is responsible for preparation of financials that give true and fair view in accordance with accounting standard and GAAP in India, and such internal control whatever it decides necessary so that financials are free from fraud and error. Our responsibility is to express a conclusion on accompanying financial statements. We conducted our review in accordance with SRE 2400, and SRE 2400 requires us to conclude whether anything has come to our attention that causes us to believe that financial statements taken as a whole are not prepared in all material aspects in accordance with applicable financial reporting framework. This is called negative method of assurance. So what I will like here, what kind of opinion we give here is, as I already told, in a simplest way, in audit, we need to tell whether financial statements are good or bad. Whereas in review, you just have to tell, are they not bad, or you cannot tell. Are you getting the point? Not bad versus bad. It's like, but all you felt the financial statements are not as per framework, you say that you will give adverse conclusion. If at all financial statements are prepared as per the framework, you will say that they are not bad. The sense, nothing has come to my attention that causes me to believe that the financial statements are not true and fair. Financial statements are not true and fair, such that I did not get any information to my knowledge. Indirectly, what am I saying? I'm not saying financial statements are true and fair. I am saying, to say that the financial statements are not true and fair, I don't have any information. Are you getting it? It is like not bad. Are you getting the point? A review of financial statements is a limited assurance engagement. This is what the standard says. Auditor must state that, the practitioner must state that, reviewer in the practitioner report, he must state that it's a limited assurance, and you must expressly disclaim the opinion on these financials. We have to disclaim the opinion. Why we are disclaiming the opinion? Because we are giving conclusion, not opinion. So in a review report, we should express disclaimer of opinion. Understand the context. We are not liable to give opinion, right? In the review, are we liable to give opinion? No. We should disclaim the opinion. We should clearly mention the people that the procedures performed in a review are substantially less in comparison to audit. Accordingly, we do not express our opinion on the financials. So we disclaim opinion on the review financial statements where we did review. Why we are disclaiming? Because we are giving a conclusion. Because we are giving a conclusion. Conclusion is a limited assurance. Opinion is a reasonable assurance. We are not giving opinion. We are giving conclusion. That's fact you are saying. So based on our review, nothing has come to our attention that causes us to believe that financial statements do not give true and fair view. Getting it? The financial position of so and so, indirectly they gave unqualified conclusion. What they gave? Unqualified conclusion. Suppose, now you see, for unqualified conclusion, basis for conclusion is not there. Suppose if you are giving qualified conclusion, before conclusion para, basis for qualified conclusion para will come. Able to understand? Generally, our audit report format is what? First opinion, then basis for opinion. Qualified opinion, basis for qualified opinion. But old format of audit report, you know, first introduction, management responsibility, auditor responsibility, opinion. If the opinion is qualified or adverse or disclaimer, then above opinion para, basis for opinion para will come. Now the format is different. Now this review, whatever illustration they have given is as per the old format. You see, this is applicable from 2016 onwards. Auditing standards 700 and all were revised in 1890. That's why there is no corresponding revision in this. Technically speaking, if at all we have to give a review report now, you can deviate from this format and give as per the latest format of audit report, same review report. Able to understand? That is much more better, right? Because here the person who is using this report will get to know about what is auditor's conclusion here only. At the first itself, he is getting to know. It is better, right? Now report on other legal and regulatory requirements and all this. So we will just mention. Able to understand? Place of signature and date. Same way, suppose you see here, based on the review, there is a misstatement which is material but not pervasive. For which opinion he has to give? Qualified conclusion. You see here, basis for qualified conclusion. Why are you qualifying? You explain the reason. Then you explain the qualified conclusion. How they expressed, you see, how they expressed the qualified conclusion. Based on our review, nothing has come to our attention that causes us to believe that financials are not prepared in accordance with the framework. Getting it? This is actually a compliance framework related conclusion. This is in regard to compliance. You see here, true and fair word is not used. In the conclusion para, if at all the review is review of the financial statements, if the financials are prepared under fair presentation framework, in the review conclusion paragraph also, true and fair wordings will come. Otherwise, true and fair will not come. So, you see, in the illustration beginning also they have given. In the illustration beginning also they have given. The financial statements are prepared for a general purpose by management in accordance with the DEF law. This is a financial reporting framework covering law and regulation. So this is not a fair presentation framework. What is this? This is a compliance framework. When you are appointed as an auditor or a reviewer in a compliance framework, your duty is to just inform people whether financials are as per the framework or not. Since it's a limited assurance engagement, you say that nothing has come to my attention that causes me to believe that the financial statements are not true and fair in case of fair presentation. In case of compliance, the financial statements do not comply with the applicable framework. So like that, I did not get anything except the same, except for the effect of matter described in basis for qualified conclusion para. So in basis for qualified conclusion para, same inventory example they took, where they quantified. The reporting requirement is same like audit. You have to quantify, you have to qualify and quantify wherever practicable. If you are unable to quantify, you should say that it is you are unable to quantify. Suppose in the financial statements, misstatement is by way of non-disclosure, you should disclose it in basis for qualified opinion, basis for adverse opinion, if disclosure is practicable. If not, say that it is not practicable. Same. What are the requirements of basis for modified opinion paragraph? In case of modified opinion, whatever requirements are there, same will be there here also. Clear? Now you see, next in a review, same adverse conclusion, basis for adverse. This is regarding fair presentation. This is probably fair presentation. Yeah, do not present fairly. So they gave qualified opinion, qualified conclusion related illustration, one for compliance framework, one for fair presentation. In our book, all this matter is there. I'll show you. Then here the effect on the financial statements is not determined. Non-consolidation of subsidiary. Non-consolidation of subsidiary means what? It's material and pervasive. Effect is not determined. Same illustration which is there in 705. So here what he gave, adverse conclusion and basis for adverse. Now you see here the wordings are same. Based on our review, here it is not except and all. Due to significance of matter described in basis for adverse conclusion section of our report, paragraph. The consolidated financials do not give true and fair view of the affairs of the entity. Here you need not say nothing has to come to my attention or nothing. You will straight away say they are not true and fair. If at all you are giving a unqualified conclusion or qualified conclusion, you will give negative assurance wording. Nothing has come to my attention that they are bad or they are wrong. They are not true and fair. Getting it? I'm not saying that they are not true and fair. I'm saying to say that they are not true and fair, I did not get any information. Getting it? So that's a kind of assurance. Are you getting it? It is like suppose movie reviews. Movie, if it is very good, you'll say, you'll reply, reviewers, movie is fantastic, go and watch. Yes or no? The movie is okay, kind of. They say not bad. So okay, fine. So they're not giving any positive assurance then. When you see this kind of assurance, will you feel like watching the movie? Obviously not. Reviews like that. Getting it? The review is conducted on a review is conducted on the principle that something is better than nothing. Review is like something is better than nothing. In review, what auditor primarily focuses on? Whether financial reporting framework in financial statements is compliant or not. Whether the format of balance sheet, P&L disclosed requirements properly or not. Inquiries he will perform. He'll inquire all the management, how they followed, what is the methods they used, what estimates they followed. All the things he'll inquire. Whatever we inquire in audit, all the things we inquire. And we do analytical procedure. We logically see their answers. We logically see the data. If nothing is suspicious, we will straight away give up a report. Something is suspicious, only we investigate further for discovering material misstatement. If nothing is suspicious, we will proceed further. We will not check underlying transactions. We will not do test of details. We will not do vouching. Whether everything is correct or not, we will not do vouching under logical. If it appears fine, okay. Sales increase, purchase increase this year, fine. Logically, everything is fine. Companies also, based on my understanding, everything is good. Fairly it appears everything is fine. I'll give review report. At least I'm doing some verification and then giving a report. Without verification, directly blindly believing the financials is much more dangerous, right? At least some sort of verification is there, right? That's the objective of review. And here it is disclaimer of conclusion, basis for disclaimer of conclusion and disclaimer of conclusion. Directly you see, due to significance of matter described in so and so, we do not express conclusion. And basis for disclaimer, they mentioned clearly the reason. Practitioner's responsibility. Our responsibility is to express a conclusion on accompanying financial statements. Because of the matter described in so and so, we are not able to obtain sufficient evidence as a basis for expressing conclusion. Just a minute. Yes. So now let's go to the actual review standard. 2400, if you understood thoroughly, 2410 is dead easy. Because 2410 content is almost copy pasted from 2400. Getting it? Now. So what is the objective of the practitioner in case of a review engagement? Obtain limited assurance. Primarily by making inquiries and performing analytical procedures, whether financial statements are free from material misstatements, as so that it will enable the practitioner to express a conclusion whether anything has come to his attention that causes him to believe that the financials are not prepared in accordance with the applicable framework. Report on financials as a whole and communicate. Suppose if at all you are unable to get limited assurance, you did not get that assurance. If a limited assurance cannot be obtained and a modified conclusion para is insufficient, nothing but a qualified conclusion is not proper, you cannot give. In such a case, disclaim a conclusion, or if it is possible, withdraw from the engagement. This is the objective. This objective itself can be tested as a 4 marks question. Actually, this syllabus is there before 2018 in CA final. up to 2017 November attempt, getting it up. This syllabus is there. That time it is old of the old scheme. Now you are calling the latest whatever November 23 is old scheme, right? Before this scheme there is another scheme. Okay, at that time we have all these standards in the syllabus. Probably 2017 or 18 attempt, up to 2018 attempt, you may find question papers. In that you will find questions on this. But again, don't run behind it. Just I'm dictating that, I'm teaching right in the class how it can be asked. That itself is enough. Next. So what are the objective we understood? Next. You know, there are some circumstances where you cannot accept a review engagement. One, there is no rationale or review engagement is not appropriate. So where a client approached you for conducting review, there is no logic behind that review. The client told me, sir, banker asked me financial statements, audit and all. So you just come and do basic work and then give me report. No sir, banker requirement is audit there. I will only do audit. If you want, I will do audit. I will not give review report here. Requirement of the user. On what is the requirement of the user, end user? What is he expecting? If at all he is expecting an audit kind of assurance, their review is not suitable. I will not do that. So the practitioner, if it is not satisfied that there is a rational purpose for the engagement, assurance engagement may be accepted only when the engagement exhibits certain characteristics that are conducive to achieving some objectives. Only when there is a necessity, you will do a review or audit, whatever. Getting it? If there is no necessity at all, why will you do? If you don't know who are the users, why will you do? And no sir, you just come and do sign and go. I will not do. Standard says that you should not do without there is a rationale. So suppose when an engagement is intended to meet compliance requirements of a law, getting it? And such law requires financial statements to be audited, there is no rational purpose for such a review. So if at all, when anybody approaches you, sir, can you do a review of financials? Just a basic review of financials. See what is their necessity. Is there any requirement under any law, or is there any requirement from a third party? What? Just like that you cannot review. You have to understand. Certain cases, review engagement is not appropriate. Suppose the company approached you, sir, we are preparing financial statements, sir. You just come and check whether we are preparing in the right manner or not. That is a compilation engagement, not a review engagement. So they may not aware of. They are asking me to do a review where my nature of work is something like a compilation. You see, compilation engagement definition: application of financial reporting expertise by the practitioner in assisting the management in preparation and presentation of financial statements. That's called compilation engagement, where we use our financial reporting expertise, getting it, to help them in preparing financial statements. That's it. Or suppose review is, remember review is something like audit. Independence is by default an expectation. An expectation of independence is required. If you think you are not complying with ethical requirements, don't accept. If you think in a review they are not providing information properly, you felt at the beginning discussion itself, somehow information I'm not getting. They directly brought me balance sheet P&L, sir, give me a review report on that. How can I give? Show me some background data. I want to inquire certain things. No sir, we don't have time, 2 days time only there, give me review report. Obviously, non-availability of information. If you have doubts about integrity of the management, if there is a limitation on scope by management, so if there is a limitation on the scope of the practitioner work, where practitioner believes that limitation will result in disclaiming a conclusion, in all these circumstances, practitioner shall not accept a review engagement. Direct 4 marks question. Under what circumstances practitioner shall not accept a review engagement? Any 4 points. First one, no rationale. Only this point itself, this itself is 1 point. Or review engagement is not appropriate. This itself is another point. This is 3rd point, 4th point, 5th point, and 6th point. So any 4 points you write. You can write limitation on scope, doubts about integrity, non-availability, non-compliance with ethical. Remember, out of this 3 points are similar to SQC. Integrity of the management, ethical requirements, and limitation on the scope. availability of information, all that. So what are the preconditions? That means in order to accept a review engagement, what are the preconditions? What should be there? If what conditions exist, you will accept a review. 1. Financial reporting framework that is applied in preparation of financial statement is acceptable. What framework they used? That should be an acceptable framework. It may be a special purpose financials or general purpose financials. I'm not bothered. Whatever framework they prepared. See, if it's a special purpose framework, we will see what is the requirement of the user. Maybe because of a contractual obligation, they are preparing some special purpose financials for which the user is asking a review report. So whether as per the user requirement, company prepare the financials or not, I will see. If they prepare the financials as per the requirement of the user, financial reporting framework is acceptable in the light of the circumstances, I will accept. 2. Agreement of management in acknowledging and understanding this responsibility. Management should agree to their responsibilities. Management should provide access to all information, whatever practitioner needs necessary. So they'll give a straight question. What are the preconditions for review engagement? 4 marks. Remember, preconditions to an audit, preconditions to a review, both are different. And the points are almost the same. In preconditions to audit, we discussed the preconditions little more in depth. First point in preconditions to audit in SA 210 is also same, exactly. Acceptability of financial reporting framework by the management for preparation and presentation of financials. 2. For design and implementation of internal control systems so that the financials are free from material misstatement. 3. Provide access to information, access to persons, access to additional information, all that. These are all preconditions to audit. Same only covered here, but here briefly they covered. Have you all seen this, by the way? No, have not seen, but able to understand? Yes or no? This is similar to audit. The standard is almost similar to audit. So indirectly, what points we have to consider prior to accepting a review engagement? You know, here they did a mistake. Preconditions to audit. This is there in the main content of the standard, original standard. Further detailed explanation is given in the explanatory material. So no, detailed explanation. They gave both of them as 2 different topics. Actually, what are the points to be considered before accepting a review engagement? What are the preconditions? When auditor shall not accept, all the 3 are same, right? Yes or no? So the person who drafted the CA final material copy pasted main material and explanatory material without thinking that explanatory material is an explanation of main material. Getting it? Very simple. In the same material, I give you fast track material at first. Then immediately after fast track concept is over, main material I have given. When I say 2 or 2 different concepts, will you agree? This is a summary and that's an in-depth explanation. That's what they did here. Fine. So in exam, no, what are the points to be considered before accepting a review? 1, I feel like this answer I will feel to write. So maybe anyhow, since I have used the word preconditions, at least some sort of variation is there. Yes or no? Since they use our preconditions, okay, small answer I'll remember. Suppose if the question is like points to be considered or factors to be considered, issues to be considered prior to accepting a review engagement, long answer. Getting it? So what are they? Same, acceptability of financial reporting framework, obtain the agreement of management that acknowledges preparation of financials for internal controls, same preconditions, detailed question they gave here. Getting it? So for preparation of financials in accordance with framework, for internal control as management decides necessary so that financials are free from material misstatement, management is responsible for providing the practitioner with access to all information, additional information, unrestricted access to persons within the entity from whom auditor can obtain information. Suppose if the practitioner is not satisfied regarding above preconditions for accepting a review, he shall discuss the matter with the top management and get an acknowledgement. Suppose if changes cannot be made to satisfy whether the and if at all management is not agreeing for the above preconditions, you shall not accept the proposed engagement unless it is mandatory under law. There is no such law in India. Clear? If at all under law you conducted such an engagement which is not as per SRU, in the review report you should not refer about SRU 2400. If at all you accepted a review engagement because there is a requirement in law, generally as per standard on review engagement you will not accept. Getting it? Because management is not agreeing to the terms. But it is compulsory as per the law that you have to do. You are appointed in a statutory position. Whether management agree or not doesn't matter. You have to do review. That is the case. You did review even though standard requirement is not complied. In that case, you are giving a review report, right? In that review report, do not refer about SRU. Because you conducted the review engagement as per the law, not as per the SRU 2400. If after the engagement has been accepted, if you discover that preconditions are not present, see whether matter can be resolved. Check whether you can continue. See whether you are still having unrestricted access to persons from whom you can get the information. If at all this is not possible, withdraw from the engagement. Clear? So this is an in-depth answer. That's a brief answer. So this is actually given in the standard main content paragraph. These points are given in the explanatory content. That's it. So if they give you for 4 marks question where the wordings used are, what are the points to be considered prior to accepting a review engagement? This answer you have to write. What are the preconditions for accepting a review engagement? These 3 points enough. Clear? Now, okay, preconditions are present. You decided to accept the engagement. Now what you have to do? First you should issue a engagement letter, right? So first you have to issue engagement letter. You see, in auditing, for all these elements we have separate standards. For review we have everything in one standard. Everything is discussed briefly. So prior to performing the engagement, you must agree to the terms of engagement with management prior to performing the engagement. Agree to the terms of engagement. Obviously, even in audit also we have seen SA 210. We must establish terms of engagement before starting the audit. And by the way, this terms of engagement must be in writing. That's called letter of engagement or engagement letter. So it's the agreed terms shall be recorded in an engagement letter or some other suitable form of written agreement. What about recurring audits? What about recurring reviews? Suppose I am being reviewed, as like last year I have reviewed the financial statements. This year also company is asking. It's a recurring review. Now should you once again issue an engagement letter? It depends upon, see whether any terms have been revised or whether there is any need to remind the management. Suppose last year the management who appointed me for review are different. This year the management is different. So it is better for me to issue once again engagement letter to remind them what are their responsibilities, what are my responsibilities. As a customary practice, every year we issue engagement letter. Whether it's a recurring audit or initial audit doesn't matter. Whether it is an initial engagement or recurring engagement doesn't matter. I'm getting audit words in between. Sorry. Whether it's an initial engagement or recurring engagement, we have to issue engagement letter every year in reality. Whereas as per the standard, recurring engagements, you need not issue engagement letter again and again. If at all there is no necessity or if there is no changes in the terms or management also not changed, getting it? In these cases, you need not. This is something you studied in SA 210. Yes or no? Suppose you issued engagement letter. Management is asking for changes in the terms. Sir, you said unrestricted access to persons and all, but this is a review, sir. How come you go and talk? Please kindly remove that term. Okay, we will give you access to information, additional information. We will not provide access to unrestricted access to persons. External lawyers and all you can't communicate. Internal lawyers and all you can't communicate. Without that only you have to do review. Management is asking me to change the terms. Look at the reason. If there is a reasonable justification, you will accept the revised terms and agree the new terms and conditions on a new engagement letter. Suppose if there is a reasonable justification, you will write new terms in writing. Suppose if there is no reasonable justification, you will not accept changes. They may give you this 4 marks question. Changes in terms of engagement in case of review engagement. Reasonable justification. And once if it is reasonably justified, you will accept and record that the terms of engagement are changed during the course. So auditor shall agree on record new terms in a new engagement letter. That's it. This is again similar to 210. So what will I perform in a review engagement? we decide materiality. We check whether financial reporting framework is proper or not. So obtaining the understanding of the entity, what is the financial reporting framework they used. We will do risk assessment to identify possibilities of misstatement. We will perform inquiry and analytical procedures, and we will address any specific issues that are getting and perform any other procedures if necessary. Now you see materiality. So one of the important element in review is first you should decide materiality. For audit, what is the materiality percentages that you apply? For review also it is same. Just that assurance level is different. But whatever we do in audit, whatever judgments and assumptions we use in audit, same judgments and assumptions we do here also. Just that here we don't go in depth in verification of financial statements, whereas in audit we do verify in depth. Just 2 minutes gap. So, you know, like a student is showing me MTP paper, where in the MTP only 14 marks came from all these 10 standards. This was an MTP conducted day before. Yeah. And you recollected first day I told you, not more than 20 marks. And you will ignore all the standards on auditing and only study this. I told you how stupid students are. They don't understand how the exam pattern is going to be. Getting it? Everyone, what I noticed, some students know what I noticed, I'll tell you. They directly started watching my review videos. I can see encrypted key and open, right? So I just saw just randomly how the students are watching the class. Getting it? I'll just go and see in my backend whether they're watching which class, which chapter they're watching it first. When I open and see, he didn't watch anything. He directly opened the specialized areas and review standards, thinking that major marks will come. So that's why I'm clarifying in revision in the first day itself. You will not get more than 20. I bet, mark my word. Getting it? In the entire 60 marks. That is a minimum marks for the entire engagement and quality control standards. 20% to 30% is the weightage for these 10 standards. See, simple as such, proportionate. We have 46 standards. From 10 standards, how many marks it will come? Proportionate. If at all 46 standards for 70 marks, 10 standards proportionate is how much? Exactly it will be. Just because it is newly added, for you it is newly added. From the paper setter, for him it is not newly added. For him, he will see 46 standards this, he will test from this. First 11 chapters he will test. From each chapter he want to test. Simple. For him it is not like 3 chapters newly added and all. So be clear. So the maximum weightage as per MTP is 14 marks. On a worst note, I am telling 20 marks. Not more than that. Okay, just allow me 2 minutes. Yes. So the overall procedure under the review is, first auditor has to perform. First auditor has to decide materiality, which is same like in audit. And he shall obtain the understanding of the entity and its environment, which is even more important, especially when you are not the one who is doing audit of general purpose financials. You are not the regular auditor of the company. So you have to do a thorough understanding of the entity and its environment. Nothing but risk assessment procedure as per 315 you do. And you will design and perform procedures through inquiry and analytical procedures. So especially you have to address all material items and focus on addressing areas where material misstatements are likely to arise. You do risk assessment, right? You will understand what are the important items, and you will also understand what are the areas where misstatements likely to arise. Nothing but risk factors you will identify. It may be fraud risk factors or error risk factors, nothing but misstatements related areas. Then the auditor, that is not required. Only this designing and performing procedures to inquiry analytical. So auditor, the reviewer has to review accounting records with a view to identify unusual transactions. Identifying unusual is nothing but analytical procedures. Through analytical procedures, you just scrutinize the data. By looking at the data, you will find something unusual. Just you need to try to identify unusual and investigate further. So mainly inquiry. This itself can be asked as a direct question. Inquiry is one of the important review procedure while performing a review of historical financial statements. What are the matters that auditor will inquire or the practitioner will inquire? This B point will ask 4 marks question. So where you have to write the first point, meaning of the inquiry. Inquiry means what? Seeking information from management and others within the entity, whatever practitioner considers appropriate, whatever information you feel important, you will ask information. What you will ask? You will ask about related parties, you will ask about accounting estimates, you will inquire about complex unusual transaction, you will inquire about frauds, you will inquire about subsequent events, you will inquire about whether management is performing a going concern assessment, you will inquire about contingencies, you will inquire sometimes about non-financial information. This itself can be asked as a 3 marks question. The practitioner, while performing a review, may do inquiries of various financial and non-financial information. Yeah. So the practitioner can also inquire non-financial information. What are they? So they specifically ask you a question on this 3 marks question. Okay. So like what they can ask. The practitioner may also extend inquiries to obtain non-financial data. What is the non-financial data? Nothing but board meetings when happened, AGM, general meetings, what are all happened, discussions happened with vendors, discussions happened with customer, nothing but, you remember audit evidence means accounting records and other information. You can inquire other information. Other information is nothing but non-financial. So what are the decisions taken at meetings of the owners, proceedings at other meetings, communications the entity received or expect to receive from regulatory agencies, matters arising in the course of applying other procedures. When you are performing some other procedures like analytical, you can inquire that also. And now, when you are inquiring, what will you get? You will get response. Evaluate the response. And when performing further inquiries in relation to inconsistencies, practitioner considers reasonableness and consistency of management response in result of evidence obtained in other procedures. Nothing but, generally, when you are inquiring, you will get some information. When you are analytically when you are applying analytical procedure, you will get some conclusion. If some inconsistency is there, what will you do? Generally, we do further inquiry. Generally, we call it as further investigation to resolve the inconsistency. Analytical procedure. Whether data from the entity accounting system, accounting records, are they adequate for the purpose of performing analytical? First check whether they are adequate and then do. Now, why we do inquiry? See, what we do in inquiry, we discussed. That can be asked as a question. Why inquiry can be asked as a question? This is there in test your knowledge question. In ICA book itself, test your knowledge question. Why inquiry? That question is also there. Evidence obtained through inquiry is often principal source of evidence, especially management intentions. Management might choose various intentions. Suppose when they purchased the land and building, they might have chosen as investment property and they classified as investment property. When you went physically there and checked, for example, you found the land was empty as of now. How do you know whether they will use it for investment purpose or whether they will start constructing factory after a year? Right now, okay, they classified as an investment, but how do you know that? Getting the point? They may intentionally classify it as an investment in order to show a better fixed asset turnover ratio. So how do you get evidence for management intention? Look at their past history of intentions. In the past also, they have said many times various intentions and accordingly they have chosen a particular course of accounting treatment. Whether that intention is turned into reality or not, check out. Whether they violated their intention. So understand management's past history of carrying out its stated intention. Management's reasons for choosing a particular, why you have chosen as an investment, why not a fixed asset? Specifically look at the reason, whether for that reason any evidence is there. Management's ability to pursue a specific course of action may provide relevant information to corroborate the evidence obtained through inquiry. How far company will retain that land as it is without using it for business? How far management can pursue their decision, intention? Check all this. This itself can be asked as a 4 marks question. Generally, information available to support management intention is limited. So the information to prove the intention of the management, the information, evidence is very limited. Okay. In that case, what auditor has to do? Understand, in the past also they have said so many intentions, whether they turn into reality. And 2, what is the reason for particular course of action? Why they have taken that decision? And how far they can pursue that action which they thought? How far the intention turn into reality? Based on these two, you will understand whether intention turns into reality or not. This itself can be asked as a 4 marks question. Getting it? So the information available for management intention is generally limited. What auditor has to do? 4 marks question they make. So auditor has to inquire about all this. And remember, whatever response you are getting, be skeptical, be alert for finding inconsistencies. And performing inquiry will help the auditor in understanding and updating understanding of the entity and its environment. So only by inquiry, only by doing inquiry, you will understand about the business, what is happening. Without inquiry, how will you? Can auditor be quiet and do the audit or review? No. Same way, why analytical procedures? They'll give you an exam, why inquiry, why analytical procedure. You have to write this answer, this entire answer full. Getting it? Why inquiry? If they ask you, this full answer. Getting it? This full answer you have to write. In the test your knowledge question, it is there. Next, why analytical procedure? Obtaining or updating practitioner understanding of entity, including to be able to identify areas where material misstatement likely to arise. Through analytical procedure, you will get to know where mistakes can happen. Suppose look at Tata Motors, very simple. They have given equity, balance sheet last year value, the current year value they have given. There is an increase in 8 lakhs. There is an increase in 8 lakhs. One possibility. Now, when I see that there is a change in share capital, I understand that there is an allotment of share capital happened during the year for which company has received any cash. Getting the point? Now, when I analyze the data only, I will get so many conclusions. So, suppose one conclusion is either they have allotted shares or by mistakes they printed instead of 0 they typed 8 by mistake. That could also be the reason. Able to understand? Now, by analytical procedure, you will identify inconsistencies. You will identify variations from expected trends. Company has, as per budget in the last year, this year turnover is 8 lakh crore, but in the real turnover is 6 lakh crore. Why? Generally, most of the times budgets will match by 95% because company has a real data. They do forecast. Getting it? It is not just a projection. They do a forecast, which is a best accounting estimate, best estimate. Getting it? So why there is a huge difference between what the company has budgeted and how much company has really spent or really achieved? So by analytical procedure, they provide corroborative evidence in relation to inquiries and other analytical processes already performed. Suppose you inquired sales and all, company saying, sir, we are growing, sir, our business has increased, all that they showed in the understanding. When you are understanding the entity and environment, you got to know that company business has increased. What is when business increase? Sales increased. But when you see the balance sheet P&L, sales have decreased. Able to understand? So analytical procedure serves as an additional procedure where you may identify material misstatements. Like you may use various methods. Various methods you may use as to simple comparisons of last year figures and current year figures to performing complex analysis. So apply analytical procedure to evaluate financial information, underline the statements and assessments of the results. Expectation may be developed by practitioner on the information obtained from relevant sources. For example, expectation means nothing but in a bank, I have to verify interest expenditure cost. Last year deposits were 10 lakh crore and at that time interest expenditure is 80,000 crore. This year deposit are 20 lakh crore. So interest expenditure should be approximately 1.62, 2 lakh crore. Something around this would be there, right? But real interest expenditure is 3 lakh crore. Actual interest expenditure is different from my expectation. That will give me a suspiciousness. I will investigate further. That's why we do analytical procedure. Why we do analytical procedure? This is actually there in 520 also. But content is slightly different compared to this. Here they see, look, in SEA 2400, I will tell you almost 20 standards on auditing related content they'll discuss. But they will only discuss in one pair. Why analytical procedure? You see, SEA 520 entire standard is of 10 pages. Here they discuss only in 2 to 3 paragraphs. Getting it? Now, further, we need to address specific issues in a review. Specific issues means what? One is related parties. Another one is regarding fraud and non-compliances with laws and regulations. Going concern. Use of work performed by component reviewers. Others. It may be internal auditors or whatever. And review of group financial information. Suppose you may be doing review of consolidated financials. Getting it? So actually, if I read, no, you will feel like, hey, I'm repeating the same auditing standard. You feel like repetition of standard on audit. So in related parties, practitioners shall remain alert, be skeptical for existence of related party relationships that are not previously identified or disclosed. Have you seen this or not in SF 550? If the practitioner identified significant transactions outside the normal course, what is the business rationale you should evaluate? This is what there in 550 also. Now fraud. When there is an indication that fraud or non-compliance with laws and regulations has occurred, the practitioner shall communicate to senior management or top management and request them assessment of the effects on the financials. I'm suspecting so and so fraud. I detected so and so non-compliance. What is the effect on financials? Please decide. The practitioner has to consider the effect on his conclusion on the financial statements and on his report and determine whether there is a responsibility to report the occurrence to any party outside the entity. See whether in the engagement, do you have a responsibility to report the fraud or non-compliance to any outsiders? You check out. Under no clarity is there, but it is applicable only for audit of listed entities, not review. Understand? Auditor has to review going concern. Suppose if auditor becomes aware of events or conditions that may cast a significant doubt about the entity's ability to continue as a going concern, inquire management plans for future actions, whether management believes that these plans situation will improve, evaluate results of those inquiries, continue whether the companies continue to presenting the financials on going concern basis if applicable, see whether they are materially misstated or misleading. Consider, look at the management's response in light of all the information that you have. Use of work performed by others. By the way, here they may give you a question like this. You are appointed to conduct review of historical financial information prepared in accordance with so-and-so framework by so-and-so entity. As a part of the review procedures, you have to review or you have to address specific circumstances in case of a review. Give examples. So you have to write this first point. This one, the auditor has to address related parties. The auditor has to address when there is an remember these side headings and all were added by me. It is not there in the institute book. In the institute book you will find like raw data. The side headings I have added. Getting it? So you need to check regarding going concern. So technically when they ask the entire question, they are expecting you to write the initial point at least. The first point. Getting the point. In related parties also first point. Getting it? They are expecting you to write at least that first point. Then sometimes it may be necessary for a practitioner to use work performed by other practitioners or an expert who is expert in any field other than accounting or assurance. If the practitioner uses work performed by another practitioner or expert, practitioner shall take appropriate steps that work performed is adequate. Now you see, they have used the word other practitioners. What is other practitioners? Maybe a component auditor, maybe internal auditor, whatever it is. You can use internal auditors reports also, for which 610 guidelines and all you can follow. Next. Then finally, review of group. So when a practitioner is engaged to review financial information of a group of entities, nothing but consolidated, the nature, timing, extent of procedures for review are directed at achieving the practitioner objective for review in accordance with the standard, but in the context of group. Same standard will apply. But you like what? You tune all these responsibilities in the context of group financial statements. They are still connected, all of you. You feel like a revision of the revision. Now from here it is important. Of course, previous thing also, by the way. The moment I said this is more important, people start, okay, I can ignore previous one. This is even more important. Within this, most important from here. From here, it is a reporting part. Because in exam, no, to best of my knowledge, from these standards, they test reporting questions only, to best of my knowledge. For example, you saw, somebody showed me that MTP, right? Show me once. Review question, what they asked just now, we'll see. What is the question here? I told right. There is a 5 marks question. In a review engagement performed under 2400, practitioner relies mainly on certain procedures. Naming such procedures. Discuss importance of these procedures in a review. What procedures? Inquiry and analytical. Why inquiry? Why analytical? Three points you have to write. To best of my knowledge, that answer only will be given. 5 marks question. And another one. Practitioner's report containing outcome of review engagement in the form of a conclusion also contains a description of review of financial statements and limitation. Which statements in this respect are to be included in practitioner's report? Reporting question. So that I will discuss now. I showed you review report, right? Once I need to just sync with that. Summary financial statements. They have given one question. Yeah, very dynamic papers. So, what are the additional procedures? If practitioner becomes that aware that financial statements may be materially misstated, if you think financial statements are maybe, you have not decided materially misstated. If at all you expect some misstatements, you have to conclude two things. Either they are not materially misstated or yes, they are materially misstated. If at all you are unable to conclude, you have to do further inquiries, further procedures to come until you come into any of these two conclusions. If at all you are unable to conclude even further procedures, all that, there is an indication that limitation of scope. When there is a limitation of scope, you are unable to form conclusion, qualified conclusion or disclaimer of conclusion. That's what will be given in the next. So here, practitioner will undertake additional procedure where he has cause to believe financial statements may be materially misstated depending upon the circumstances. And how much procedures he will perform, it's a matter of professional judgment. What are additional procedures? Additional procedures focus on obtaining evidence to enable the practitioner to form a conclusion on a matter, like additional inquiry, additional analytical procedure, or some other types of procedure. When you find the symptoms of misstatements, you will do substantive test or external confirmation. Generally, by default, you will not do. But if you find any symptoms of material misstatements, risk of material misstatement, you will do further work. They'll give you this question itself straight away. So when practitioner performs additional procedures, getting it? Under what circumstances practitioner performs additional procedures? See, practitioner has to conclude whether the financial statements are either materially misstated or not materially misstated. If at all he is unable to conclude any of this, he has to perform additional inquiry and analytical procedures and other procedures until he gets that conclusion. Yes, they are misstated or not they are misstated. Now, you must also do review of subsequent events after the date of financial statements, but on or before the review report. If any events occurred for which conditions present on the date of financial statements, whether they are adjusting or non-adjusting, requiring disclosure, check. See whether the financial statements are reflecting that or not, you have to check. I'm not reading this. This is exactly like 560 which I covered. Okay. Same, you see, management amending the financials, not amending the financials, take appropriate action, exact copy paste. Getting it? Then you should also get written representation, and we know written representation is not a substitute for audit evidence. Okay, and you must get representation regarding responsibilities of management, that they fulfilled the responsibility, that they provided with all the information, and all transactions are recorded and reflected in financials. They'll give you what are the responsibilities of management that are to be included in a review related written representation. You are conducting a review. As a part of review, you have duty to obtain written representation. What are the points that are considered, or what are the points to be included in the written representation regarding management responsibilities? Here there are 3 points they have covered. So 3 points. These are all depth not required now. Representation related to disclosures. Some written representations are also required where practitioner may consider it necessary to request other representation about financial statements. For example, to complete the practitioner's evidence with respect to certain items or disclosure reflected in financials, where practitioner considers such representation is important in forming a conclusion. You may get a representation on disclosures made in the financial statements. And you may get a representation on additional matters. Additional matters means what? This itself can be asked as a 4 marks question. The auditor has to get, the practitioner has to get a written representation on various additional matters. What are they? One is related party. One is relating to fraud. Another is relating to non-compliances, going concern, subsequent events, material contracts, non-monetary transactions. Any 4 points. So here the keyword is additional matters. Representation on additional matters. One representation is regarding management responsibilities. Another representation is regarding additional matters. Another representation is regarding disclosure in the financial statements. Summarize like this. Suppose if management is not providing it, discuss why are they not providing. Check whether they are honest or not. Take appropriate action. Either you disclaim or withdraw. If the representation is not reliable, you will either withdraw from the engagement or give a disclaimer of conclusion. Even if the representation is not provided, same action. Fine. So you got all the evidences. You performed a review. You inquired. You did analytical procedure. You obtained representation, all that. Now you have to evaluate the evidence. What you have to evaluate the evidence? The auditor shall evaluate whether sufficient and appropriate evidence is obtained. If not, practitioner shall perform other procedures so that you will be able to form a conclusion. In some circumstances, practitioner may not have obtained the evidence that had expected to obtain through preliminary inquiry and analytical. Now, in these circumstances, practitioner considers that evidence obtained is not sufficient to form a conclusion. Now, if the evidence is not sufficient so that you are not able to form conclusion, extend the work. Perform other procedures as you may decide. Suppose neither of these is practicable. Suppose you are unable to perform additional procedures, all that. Determine the effect on the practitioner's report. Suppose if the practitioner is ultimately unable to obtain evidence, discuss with management what is the effect on the scope of the review. Now that you need to decide all that, and if there is a limitation on the scope imposed by management, all that, you will give a disclaimer of conclusion. Now here they have given one clarification. Just because you are unable to perform a specific procedure does not constitute limitation. If you are unable to do that, doesn't mean it's a limitation. Limitation means what? They are not cooperating you. That's it. Now, forming practitioner's conclusion on financial statements in case of review engagement. Forming the conclusion. Now, when you are forming the conclusion, you have to consider uncorrected misstatements which you have identified, qualitative aspects of entities accounting practices. Suppose if at all the financials are prepared using financial reporting, fair presentation, you will check overall presentation, structure and content. See whether the financial statements including notes, are they describing underlying transactions in a fair manner? The practitioner's conclusion on the financials, it may be unmodified or modified, shall be expressed in appropriate form. How you should express? Now we are coming to reporting. So unmodified conclusion in the practitioner's report in case of a review report. The practitioner shall express an unmodified conclusion. When the practitioner has obtained limited assurance to be able to conclude nothing has come to the attention that causes him to believe that the financials are not prepared in accordance with the applicable framework. Suppose if it is fair presentation framework, do not give true and fair view or not, you need to write. So based on our review, nothing has come to our attention that the financial statements do not give true and fair. In case of compliance framework, based on our review, nothing has come to our attention that causes us to believe that financials are not prepared in accordance with the framework. Their true and fair will not come. Suppose the practitioner shall express modified conclusion if the practitioner decides based on the procedures performed and evidence obtained, financial statements are materially misstated. Getting it? Then you will give which conclusion? Modified conclusion. One situation. Another situation is what? You are unable to obtain sufficient appropriate evidence regarding one or more items of the financials. One or more items of financials, you are unable to get evidence. One, you got evidence, you concluded that they are misstated. That time you give modified conclusion. When you are not able to get the information also, you will decide to give modified conclusion. Suppose you will give a qualified conclusion when the misstatements are material but not pervasive, and if they both are material and pervasive, you give a adverse conclusion. Accordingly, when you are giving, the conclusion para headings have to be modified. Qualified conclusion, adverse conclusion, and description of matter. Why you are giving qualified conclusion, you should tell. That you should tell in basis for qualified conclusion, basis for adverse conclusion, basis for disclaimer in a separate paragraph immediately before the conclusion para. I showed you in the report, yes or no? Are you getting it? But maybe later on 2400 they will modify. At that time, immediately after the conclusion para they will add. But now it is before. Clear? Wordings. What are the wordings of conclusion para? We have seen this already. Yes or no? I showed directly in the illustrations itself. Based on our review. If it is a qualified conclusion para, except for the effect of matter described in basis for qualified conclusion para, nothing has come to our attention that causes us to believe that financials do not give true and fair. Here it is, nothing has come to our attention that causes us to believe that financials are not as per the framework, except for the effect of the matter described in so and so. Adverse. In case of adverse, what we will tell? Based on our review, due to, yes or no, significance of matter, the aforesaid financial statements do not present fairly. Whereas compliance framework, based on our review, due to the significance of matter described in basis for adverse conclusion para, the aforesaid financials are not as per applicable framework. Now, in the basis for conclusion para, you should describe the qualification, you should quantify. And if the misstatement is regarding a disclosure, how disclosures are misstated, you should qualify. If at all misstatement is like a omitted information, you shall include the omitted information wherever practicable. Suppose if the misstatement in financial is like they omitted some data, they didn't disclose some information, you disclose it in the basis for qualified conclusion or basis for adverse conclusion wherever possible. This is also something like same in audit report we have seen. Same, yes or no? How basis for modified opinion paragraph will change. Various types of misstatements. Same exactly it is. What is the meaning of, remember in the standard itself they didn't discuss in depth. The only reason is because it is already covered in standards on auditing. So the ICI, when they are drafting 2400, they drafted in such a way that those who read standards on auditing properly only can understand review standard. Directly if you start review, you can't understand. Getting it? Now, if the disclosure is in the form of narrative, we include it. What is the disclosure they made? What disclosures they omitted? What is the narrative disclosure? Narrative disclosures are integral part of financial reporting package. They are deemed to provide a view of the company through eyes of the management. The narrative represents management's constitutional or corporate events and are largely discretionary. Simple. They disclose it in the form of paragraphs and all, right? What accounting policies they followed, all that. They are all narrative disclosures. We call them as. Next. Suppose, what is the practitioner's conclusion in case of inability to obtain sufficient appropriate evidence? Express a qualified conclusion if the item is not pervasive. If it is pervasive, disclaim a conclusion. You are unable to obtain evidence. Not able to obtain evidence means either qualified or disclaimer. Suppose if at all a situation comes where you have to give a disclaimer. First withdraw from the engagement if possible. If a withdrawal is not possible, disclaim the conclusion. Now when you are disclaiming or qualifying conclusion because of inability to obtain evidence, how the qualified conclusion para looks like, how disclaimer of conclusion para looks like, they have given. If at all you are qualifying or giving an adverse conclusion because of a material misstatement, how the wordings will be, they have given in the previous paragraphs, previous topics. Getting it? And in basis for conclusion para, you shall describe all this. Finally, elements of practitioner report. There must be title, addressee, introduction para. In introduction, we will identify the financials are reviewed. We will state that they have been reviewed. Getting it? And we will mention management responsibilities and we will mention practitioner responsibilities. In this paragraph, no, we will mention that what are our obligations under this standard. So that we will mention the date of report and we mention these statements. A description of review and its limitations. They'll give you a question on this. The practitioner has to report in the review report what is the nature of the review and its limitations. What is the limitation? It's a limited assurance engagement. It primarily consists of inquiries and others. And the procedures performed in review are substantially less than those performed in audit. Accordingly, practitioner will not express an opinion on the financial statements. So they'll give you an MCQ. In case of a review report, the practitioner expressly disclaims an opinion. Because we are disclaiming the opinion. Why are we disclaiming the opinion? Because we are not giving the opinion. We are giving a conclusion. So specifically he has to mention that he disclaims the opinion. So I think this and all I showed. And the date of practitioner's report. In TYK there is a question on this. Test your knowledge. What is the significance of date of practitioner's report? You need to write what date you must use, and you should also mention regarding subsequent events a point. You should also mention regarding subsequent events. Up to the date of practitioner's report, whatever events happened after the date of financials were considered. Getting it? That is the date of practitioner's report significance. And the date of practitioner report shall not be earlier than the date on which you obtain sufficient appropriate evidence, shall not be earlier than the approval of the financials. You see, the practitioner shall date the report not earlier than sufficient appropriate evidence and whether applicable framework is followed, and those who have authority have approved it. And signature, place of signature, now you didn't, all that will come. That's it. And in review report, if you want, you can include emphasis of matter, other matter paragraph, same. Only when there is no material misstatement, you can highlight that point, yes or no. Where you will place the emphasis of matter paragraph? Immediately after the paragraph that contains conclusion. After conclusion para, you should write emphasis of matter para. Other matter paragraph. That is also same. After emphasis of matter, other matter paragraph will come. The definitions are exactly same. Other than those presented or disclosed in financials, exactly same. Now, other matter paragraph is what? Other than those presented or disclosed in financials, that in practitioner's judgment, relevant for users' understanding of, instead of audit, review. Auditor responsible instead of that, practitioner responsibility. Auditor report instead of that, practitioner's report. So independent practitioner's report on review of financial statements is a heading of the review report. And any other reporting responsibilities. For example, if any legal and regulatory requirement is there, suppose if you are doing review as per any SEBI guidelines, if at all SEBI has given any reporting requirements, that reporting requirements you must include in review report. As of now, there are no guidelines in this regard. Clear? Finally, the practitioner has to document. What he has to document? Nature, timing and extent of procedures performed. Nothing but a review plan will be there, right? You document who performed the work, what is the date, who reviewed the work, what are the evidences you obtained, what are the significant matters arisen, what discussions you have made with the top management, and if any information is inconsistent, inconsistencies you identified, how inconsistency is addressed, document that. Over. Appa, 1 hour 15 minutes almost. That too a quick revision. Correct. But I think at least now you must understand that you have to be extreme strong in auditing standards so that review standards appears dead easy. Damn sure 5 marks question on 2400 and 2410. But you know what? In reality 2410 is popular, not 2400. But major content is discussed in 2400. So in exam there is a high possibility that 2400 questions will be asked. Whatever it is, the answer looks same. Just that instead of historical financial statements, use the word historical financial information. Sorry, interim financial information. Got it? Okay, fine. Just give me 2 minutes. Let's continue with the 2410. Review of interim financial information performed by independent auditor of the entity. So if the review is performed by independent auditor of the entity, then we apply 2410, that too for interim financial information. What is interim financial information? It is a condensed set of financial statements or a complete set of the financials, whatever it is, but for a period that is shorter than entity's financial year. Getting it? But remember, This interim financial information is also prepared and presented in accordance with the applicable framework. Means Schedule 3, Part 1, Part 2, that only followed. But it is presented either in a complete format or a condensed format. But it is prepared for which period? Shorter than financial year. So that is called as interim financial information. The objective is very simple here. It is to enable the auditor to express a conclusion. You see here they are using the word auditor again. In 2400 they have not used the word auditor. They use the word practitioner. Why? Because he is not auditor of the entity. He is only a reviewer. Whereas here the review is performed by audits of the entity. So it is to enable the auditor to express a conclusion whether anything has come to his attention that causes the auditor to believe that interim financial is not prepared in accordance with the applicable framework. Suppose if it is fair presentation framework, so nothing has come to my attention that causes me to believe that the financial statements are not showing true and fair view in accordance with the applicable financial reporting framework. The true and fair view will remove if it is compliance framework. Now here also the auditor makes inquiries and perform to reduce to a moderate level of risk of expressing inappropriate conclusion. So reduce the risk of expressing inappropriate conclusion, review risk. Remember, the objective of review significantly differs from audit. A review does not provide basis for expressing an opinion. Getting it? A review is not designed to obtain reasonable assurance. They'll give you what is the objective of engagement. 4 marks question they'll give you. You need to write all these points. A review primarily consists of inquiries like from the persons responsible for financial and accounting matters. A review will bring significant matters affecting the interim, but it does not provide all the information that would be required in audit. Just like in 2400, here also when we are performing 2410, we should consider it as a separate engagement from audit. For this 2410 engagement also, we should agree the terms of engagement. What is the nature? What is the objective and scope? What are their responsibilities? What are your responsibilities? What is the nature and form of review report that you are going to give? Now, just like in 2400, here also we have to understand the entity and its environment. But here there is a slight variation. There you are not doing audit, you are doing only review. But here you are doing audit also. While doing audit, you might have already got understanding of the entity and environment. Suppose last year you did audit. You already understood the entity and its environment. Now, evidence obtained in earlier audits, can you use it? Yes, absolutely. Whatever evidence you obtained in earlier audits regarding the client, entity and environment, that you can use it. Suppose if any updates are there, just update it. Remember, the control system the control systems for annual financial statements audit and the control systems that are implemented for interim financial might be different. So observe that difference. If you recollect 143 subsection 3 clause 8, sorry, clause I, the auditor has to talk about operating effectiveness of internal financial controls. There they specifically tell you it is in the context of annual financials. That reporting will not apply for other financial reportings. Getting it? And the controls which company generally implements for preparation of annual financial statements may be different from the controls that they are implementing for interim financial information. So you recognize that fact. So what procedures you will do to obtain an understanding, to update an understanding of the entity and environment? Remember, this itself they'll ask as a 4 marks question. What are the procedures the auditor will perform to update the understanding of the entity and environment? What points he will? He will read the latest documentation regarding previous year audit, review of prior interim periods, review reports, audit reports. He will consider any significant risk, any risk of management overriding controls that were identified in the audit of prior periods, reading the most recent annual reports, comparable prior period reports, considering materiality with reference to applicable framework. But remember, normally when you are doing a review of historical financial statements for full year, materiality concept is same. But when you are doing review for interim financial information, materiality level will be lower. So consider materiality with reference to applicable framework as related to interim financial information in assisting and evaluating potential misstatements. Considering the nature of any corrected material misstatements, any identified uncorrected misstatements in prior period. So previous year, when you're doing audits, you found so many mistakes which are corrected by the management, some are not corrected. So whether similar kind of mistakes happen in the current year or not also, you have to check. Consider significant financial accounting and reporting matters that may be continuing significance, such as material weaknesses in internal control. What are the reporting requirements in last year? Simple. Here you see, you are not obtaining understanding, you are updating the understanding. Updating means what? You are already an existing auditor. You are the auditor who did audit of last year also. So this year, when you are performing review of interim financial information, what are the changes happened? You just have to update. So what are the changes that you have to update is what this point is. Considering results of any audit processes performed with respect to current period. Suppose I am doing quarter 3 review. Before I started this quarter 3, quarter 4 review, I am already doing audit also. So while doing audit, I got some evidence. That also I will use. Getting it? Considering result of any internal audit performed. So I will take the help of internal auditors. I will see the results of management's risk assessment process relating to fraud. And I will inquire management effect about changes in business activities, any significant changes in internal control, and what is the impact of those changes on the interim financial information. What is the process by which interim financial is prepared and the reliability of underlying records? So what systems they implemented for preparing interim financial information? Generally, SAP, all the softwares have the feature to generate balance sheet P&L as per Schedule 3 format. Same way for interim financial information preparation also, do they have any software? Whether the software which they are using, does it have an ability to generate interim financial information and see whether it is as per applicable framework or not? Suppose if at all a newly appointed auditor, if at all you are a recently appointed auditor who has not yet performed the audit, you have to understand the entity and its environment as it relates to preparation of both annual and interim. Since you are newly appointed as an auditor, if you don't have this understanding, do a fresh understanding. If at all you are already an existing auditor, you have to update the understanding. So this question is there in the test your knowledge questions. In test your knowledge question, it is there. What are the procedures the auditor will perform to update the understanding of the entity and its environment? They'll give a story like this. You are auditor for this entity from so and so year. This year you are doing review. So what points you consider, what procedures you perform to update that knowledge? Getting the point? So 4 marks question they'll ask you. You just have to read any 4 points. Any 4 points. Now, obviously, you will do what procedures? You will perform inquiry, you will perform analytical, and if any other procedure is necessary, you will perform other procedures also. So what ordinarily you perform? You will perform like reading the minutes. You will see what are the unadjusted items in the previous year. Suppose if at all you are the auditor of the previous year, if you find any unadjusted, uncorrected items or material misstatements, see whether they are there. You will communicate with other auditors and you will inquire with management. What matters you will inquire? Especially whether the interim financial has been prepared as per framework. Any changes in accounting principles happened. Whether any new transactions, new accounting principles followed. Whether any interim financials contains known uncorrected misstatements. Whether management ever have any mistakes in interim financials, you will ask. You will ask them what are the unusual complex transactions that all happened. Example, business combinations and all. You will ask a company what are the significant assumptions regarding fair value measurement. You will ask related party transaction. You will inquire significant changes in contingencies, commitments. You will ask them whether management is complying with the debt terms and conditions, covenant terms and conditions. And significant transactions happened during the last several days of interim period. That is called cutoff procedure. You will inquire whether management has knowledge of any fraud or suspected fraud. You will inquire whether management has allegations of fraud. You will ask non-compliances. You will apply analytical procedure. You will read the interim information. You will see whether anything is not true and fair. You will just see whether anything else is not true and fair. So this itself will ask you what matters the auditor has to inquire. I think same common answer you can write for SRE 2400 and 2410. In SRE 2400 also what points you inquire, same points were there. Yes or no? Especially related parties, going concern, all these points are exactly same. Subsequent events, written representations, yes or no? Now, You can conduct a review along with the preparation of financial information. When the interim financial information is being prepared, when the entity is preparing interim financials, simultaneously itself you can start review, or before also you can start review. Early days of interim, if at all you do reviews at the early days of preparation of interim itself, you may discover some mistakes, so that mistakes will not appear in the final interim financial information. And you may do review along with your audit itself, so that you can minimize the total work burden. Whatever audit procedures, evidences that you are gathering, you may use it for review. And this is what popular. Most of the auditors, no, they don't separately do for review. They just do audit and give a review report. For quarterly, they're giving review report, right? They don't do anything specifically for review. They just give audit report. They just give review report. Review report is just a formality in 2410. In reality, listed companies, listed companies have to prepare quarterly results. They need to file with SEBI, and those quarter results must be reviewed by independent auditor. So do you think auditor will separately conduct a review? No. He will just do the audit and give a review reports each quarter. Whenever time comes, he'll just give a review report. For every quarter, within 45 days, review report has to be submitted from the end of the quarter to the SEBI. And litigations and claims, you will check litigations and claims. If at all you are not having clarity, you communicate directly with the entity's lawyers, where auditor believes that entity lawyers will have some pertinent information. You will do reconciliation with accounting records. See, these are all the activities that you do in review. What you will do in review, you read the minutes, you see unadjusted items the previous year, you communicate with other auditors, you inquire management, you check litigations and claims. you do review along with audit. You will reconcile with accounting records, supporting data and all you will check. And you will inquire about subsequent events. You will inquire about going concern. Same point is there here also. We discussed in depth in going concern in SA 570. Okay. And additional inquiries. If any other, like when any other matter came to auditor's attention, that leads the auditor to question whether a material adjustment is made. Like if you think any adjustment is required in interim financial information, if you get to know any such symptom, the auditor should make additional inquiries to enable the auditor to express a conclusion. Example not required. Suppose when you are performing review, you identified misstatements. How should you evaluate? Suppose if the auditor should evaluate whether uncorrected misstatements have came to auditor's attention or material. If it is material, see whether an adjustment is required to be made in the interim financial information. Now, when you are deciding the materiality, you need to exercise professional judgment. And when you are performing 2410 review, you have to obtain management representation letter that management is responsible for design and implementation of internal control to prevent and detect fraud. Management is responsible for preparing interim financial information as per applicable framework. Management, no, they should give a representation. Sir, if any uncorrected misstatements are there, they are immaterial. Don't worry. But all any uncorrected misstatements are there, they are immaterial. Getting it? And the auditor has to get a representation that all facts relating to fraud were disclosed to the auditor. And risk assessment by management and the results they got has been disclosed to auditor. Non-compliances are disclosed to auditor. Disclosed to the auditor all significant events occurred after the date of, not balance sheet actually taken, maybe yeah, balance sheet, because interim financial information also will have a balance sheet. That's it. So these are the representations. Now, what is auditor's responsibility for accompanying information? Suppose along with interim financial information, other information is also presented. Same, read the other information, see if inconsistency there. Material misstatement, if at all in interim financials, give a modified conclusion, ask them to rectify. If they don't rectify, modified conclusion. Suppose if material misstatement in other information, by an additional paragraph in the review report, you clearly mention what is the inconsistency that is there in other information. First, no, before you mentioning it, discuss with the management and ask them to correct the other information. Suppose no, other information is something else, is there not related to financial, but it is something about facts. Company, they are saying they are going for expansion. They are going to start a factory, or they have started so and so factory at so and so location, but in fact it is not started. In that case also, you must mention in other information section within the review report that so and so fact is not correct. That is called misstatement of fact, apparent material misstatement of fact. If there is any apparent material misstatement of fact in other information, I'll show you like how interim financial information company presents. This is Reliance Industries Limited interim financial information for the quarter ended. You see, they show for 3 quarters comparative information. So the one highlighted is the latest quarter, and they even show 9 months cumulative picture. Since it is a Q3, they show 9 months cumulative, and last year figures also they will show, just for a comparison. This is unaudited standalone financial results for the quarter or 9 months period ended 31st December. This is the latest thing which is available. You see, so much of other information is also companies presenting. So much of other information companies presenting. I discuss so in depth in all regular class, okay? Revision, and that's why I use the same documents. Why should I download again for revision? Same documents I'll show. You see, they show so much. This is the quarterly result filed with the SEBI. This I downloaded from BSE website. Got it? So this is something filed with SEBI. And here the company also comments that the above information is reviewed. They will not give, they didn't publish review report, but they just mentioned that they are reviewed. You see here, the statutory auditors of the company have carried out a limited review of the aforesaid results. They didn't give the review report to look into, so to show it to you. Like Tata Motors audit report we have, Reliance audit report we have, but we don't have review report. They just mentioned that the statutory auditors of the company carried a review. Probably in MCA you can download. In MCA website, you can open and download the historical results of the company. So in that review report will be there. Signed original review report will be there. Scanned copy will be there. Next. Suppose if you identify any matters that are necessary to make adjustments to interim financials, please communicate it to appropriate level. Suppose if management is not responding, communicate to top management. How you have to communicate? Look at the nature of the matter. Is it, if it's so severe, you have to communicate in writing. Sensitivity of the matter, timing of communication. If the information is communicated orally, please document that communication. Suppose if top management also not responded, where interim financial information requires an adjustment, material adjustment, modify the report, or if possible, withdraw, or resigning, if possible, withdraw. Getting it? Withdraw or resignation. And see if there is any fraud. Whether you have to communicate the fraud to any outside authority also check out. And any governance issues, communicate it with the top management. Now what are the elements of interim financial information related report? It is same like 2400 format, same like 2400. Same, we will mention that it is substantially less in scope than an audit. Accordingly, we do not express opinion on the interim financial information. Conclusion para, date, place, signature, FRN. UDIN is also to be added. Clear? Suppose if the interim financial information is presented by deviating from applicable framework, you should give a modified conclusion. The auditor should express a qualified or adverse conclusion when matter has come to knowledge of the auditor that causes him to believe that a material adjustment should be made. You see here they are not using the word material misstatement. Everywhere in entire SA 2410 they are using the word whether it requires material adjustment. Nothing but indirectly what? Financials require modification, but they are not modifying. If matter have come to auditor's knowledge, auditor's attention that the interim financial information is materially affected by a departure from framework and management is not correcting the framework, then also auditor will modify the opinion. Sorry, conclusion. Two situations the auditor will modify the conclusion. One, when material adjustment is required in the interim financial information prepared by the management. Two, if the interim financial information is not prepared as per applicable framework. In both the cases, we communicate them to modify, to change. If they are not responding, we give modified conclusion. Manner of modification is exactly same. Adverse conclusion is exactly same like 2400. Suppose if there is a limitation on the scope, please do not accept. Suppose you accept it, then the limitation is created. Ask them to remove. If management is refusing to do so, communicate to top management. Even then, if there is ultimately no response, withdraw from the engagement or provide a review report with a disclaimer of conclusion. If any other limitation are there, not limitation by the management, but limitation because of circumstances and all, try to get evidence through alternative procedures. If you are not getting through alternative procedures, the evidences, give modified opinion. Sorry, give modified conclusion. And you have to consider going concern, significant uncertainties, all that. Emphasis of matter paragraph, uncertainty in prior period. Suppose the auditor may have modified a prior period review report by adding an emphasis of matter paragraph or highlighted a material uncertainty related to going concern. See whether that situation continue to exist in the current year review. If so, if the material uncertainty still exists and adequate disclosure is made, the auditor modifies the review report. Remember, here he is modifying the report, not modifying the conclusion. To include emphasis of to include a material uncertainty related to going concern para in the review report. He still give unmodified conclusion only. However, if at all it is not adequately disclosed, the auditor should express qualified or adverse conclusion. And other considerations. When we are doing a review, other considerations, what we need to check. See whether review report is published along with the interim financial information. You need to ensure that both are published together. Actually, you see the quarter results which they showed, they just said that the above are reviewed. But in the same document, review report is not there, which is actually not correct. Probably when they filed, they might have filed it as a separate document, which is not uploaded in public domain, probably. Getting the point? Here there is a requirement. The terms of engagement shall include management agreement that whenever any document containing interim financials indicates that such information is reviewed, review report will also be included in the document. Wherever you said review, the above information is reviewed, review report should also be there in the document. In that document which we downloaded from BSc, it is not there. Getting it? If management has not included the review report, the auditor must take legal advice. Suppose, especially you have given a modified review report where you include an emphasis of matter or uncertainty related to going concern or a modified conclusion, and there management, no, like if the auditor has issued a modified review report and management issues interim without this review report which contains modifications, the auditor takes legal advice, if possible resign from the appointment. And interim read in conjunction with latest audited financials. We should alert people that whatever latest financials are there, no audited financials of last year, along with that, please read this interim information. Only interim information you should not read. That's why in interim financial information we give comparatives. Interim financials information is consisting of condensed financials. So they do not include all the information that is required in a complete set. Detailed accounting policies, accounting methods, accounting estimates, so much of disclosure and all were not there. If you want to see if at all any changes are there, we will mention the changes. But if any changes were not there, we will briefly mention what the company followed. So if the users want to know detailed information, please read the latest audited financials. The same principles are followed. Interim financial information is prepared in consistent with the same framework which is used for latest audited financials. Any changes to the methods of accounting principles policies will be disclosed. Remaining we might have not disclosed because in interim financial are presented in condensed format. And documentation finally. That's it, over. And see, brief revision. You might have felt that so fast I discussed. Fast itself means 1 hour 15 minutes for that standard, half an hour for this standard. Are you getting it? So it takes time. So since this review is similar to auditing standards which we already discussed, I went little quicker. Getting it? Normal I discuss 6-7 hours. These two standards put together maybe 5 to 6 hours I'll be discussing. Where we discuss in depth. In spite we have covered in depth in standards. Getting it? Suppose SQC1 SA 220, I still remember I spent 5.5 hours. 5 to 5.5 hours I discussed those standards. See, that's a different regular. Remember, whenever you think I'm going fast, you are in a fast track class. I'm not going fast. Okay. Your mindset is not yet prepared that it is a fast track. Revision class is a fast track class, right? So I'm genuine to my duty. In fact, more than genuine. Yes. So that's it. 2410 is also completed. In the entire 800 series, 3000 series, 4000 series, 2000 series only lengthy. Getting it? The lengthiest discussion is over. Technically speaking, 2400 and 2410. These two occupy 50% of the entire 10 standards. Content size. Getting it? Remaining standards content is very less. Compared to this, it is less. And discussion is more. Okay, review, no discussion. I thought of telling my regular students, say, discuss on your own. Then they will again complain me saying, you're not covering full syllabus. So I discussed. What can I do? Yes or no? Fine. Okay. So next one, 510. Initial audit engagement, opening balances. Initial audit engagement, opening balances. What auditor has to check in this particular standard? Whenever you are performing an initial audit engagement, when auditor is performing an initial audit engagement, it is compulsory for the auditor. Whenever he is performing initial audit engagement, it is compulsory for the auditor to verify opening balances. This standard and 710 standard is slightly connected, especially with respect to reporting element. They both are very much connected. In 710 corresponding figures element and here opening balances verification, reporting requirement is connected. In 710 also, what auditor has to do? Audit procedure for corresponding information, corresponding like comparative information, what procedure we should perform? Whether the comparative information that is given in the prior period financials were they correctly brought forward and kept in the comparative information. Whether accounting policies that are reflected in corresponding information or comparative information are they brought forwarded correctly and consistently applied. Whether changes to accounting policies that were there in the comparative information, whether the changes are properly accounted and disclosed. Whether, these points I will check, these points basically I will check. And if at all prior period financials were audited by predecessor auditor, what opinion he gave, what is the date of audit report, all that you have to give another matter paragraph. This is what F710 actually says with respect to the corresponding figures. What the standard also says, this standard says this standard talks about 3 elements. 1, opening balances. 2, accounting policies. 3, predecessor auditor's report. First, let us look at what is the standard talking about predecessor auditor's report. Suppose if there is a modified opinion in the predecessor audit report, if there is a modified opinion in the predecessor audit report, what opinion he gave? Qualified, adverse, checkout. Predecessor would have given reason, right, for basis for qualified opinion, basis for adverse opinion, he would have given reason, right? Look at that reason. Is that reason still prevailing in the current year? Check it out. Whether the reason is still prevailing in current year, check it out. Is it relevant and material in current year? Check out. If so, modify current year opinion also. You should also modify the current period audit report. Suppose you felt the same reason is continued this year, but it's not significant in this year. You can ignore that and you can give still which opinion? Unmodified opinion. Now for a comparison purpose, 710 says what? In the other matter paragraph, what opinion predecessor auditor gave? What is the date of report? Who is the predecessor auditor? Give that information just for comparison purpose. Just so that people will get to know that auditor has been changed. This requirement is there where 710. Understood? 2. Accounting policies. What auditor has to check? Whether the accounting policies that were reflected in opening balances. Whether the accounting policies that were reflected in opening balances, whether they were correctly brought forwarded to current period or not. If there are any changes to accounting policies, if there are any changes to accounting policies were made, whether those changes were accounted and recognized and disclosed in the financial statements as per applicable financial reporting framework or not, you have to check. Suppose if accounting policies are not consistently followed or changes if at all there, they were not correctly accounted, presented and disclosed, the auditor shall give either a qualified opinion or adverse opinion because you have not followed properly the policy. Understood? Then opening balances. Opening balances, what auditor has to check? Whether opening balances are correctly brought forwarded from prior period. Any adjustments to it. Any adjustments to the opening balances if at all made. Whether they were reflected separately as a prior period item or not, you need to check out. See, very simple. At the end of the day, what 510 says, the auditor shall obtain sufficient appropriate evidence that opening balances are free from material misstatements. If at all opening balances are containing material mistakes, how in the current year the entity will rectify them? Through a prior period item. They will rectify these mistakes as what? Prior period item they will rectify. And we know, as per requirement of the framework, prior period items must be disclosed separately. So whether that is done or not, you have to, whether that is completed or not, you have to check out. How do you check out all this? What procedures you will specifically perform to check opening balances? I will specifically perform, for opening balances, I will specifically perform the following. Like specific procedures I will perform. For example, I will take opening trial balance and compare with the previous year audited balance sheet. Like in the standard they say perusing. Getting it? So nothing but what? Comparing the current year opening trial balance with the previous year balance sheet. Determine whether closing balance have been correctly brought forwarded. Any adjustments have been disclosed as prior period. Whether accounting policies are appropriately applied. Perform one or the more of the following. Whether procedures performed in current period provide evidence to opening balance. Current year verifying receipts and payments. In that you might have identified some payments and receipts belonging to last year outstanding, right? So indirectly that receipt and payment belonging to last year is an evidence that last year outstanding is there. Correct? Means that's an evidence that opening balance is correct. Clear? And performing specific procedure like comparing the current year opening trial balance with the last year audited balance sheet or last year audited financials. Correct? Suppose if auditor obtains evidence that opening balances contains misstatements, if auditor concludes that the misstatement is there in the current period, continuously it is there in the current period also, you have to communicate to those charged with governance as required under 450. You need to evaluate that misstatement impact under 450. What is 450 standard? Evaluation of misstatements identified in the audit. Evaluation of misstatements, you need to consider this. First, communicate to the management and consider what is its impact on the current year closing balances. Clear? And you know, this entire opening balances audit we perform if opening balances are material to the current period financials. If opening balances are not that material, for example, companies recently incorporated last year only, just March month they incorporated, or just December month they incorporated. As on last year March, no business happened, nothing. They just brought capital, purchased machinery, took a building on rent, that's it, nothing else. You're getting it? Financial statements are prepared. Now for next year, this year business has happened drastically. So much is there. There are so many closing balances which are there. Now in this case, is opening balances significant for the auditor? No. In such a case, he may be exempted from this procedure. Clear? Now the standard says this procedure must be compulsorily applied for initial audit engagement. What is an initial audit engagement? Initial audit engagement is an engagement in which prior period financials were audited by predecessor auditor, or prior period financials were not audited. You are appointed as an auditor for the first time for the company. In our question bank, we gave a question on this. There is an RTP question. What should be the audit procedure for opening balances if prior period financial statements were audited by predecessor auditor? What is the audit procedure for financial statements where prior period financials were not audited? Separate procedures they are asking. In exam, they may ask you like this. Whereas in the main standard, it is not clearly discussed. Understood? But in question bank, it is there. Clear? Confident all of you? That's it. The standard is over. Hey, what happened? Understood, right? All of you? Understood, right? You're all clear? Entire reporting part also I told. Compulsorily in the ICA book illustrations were there. Please follow that. Don't neglect it. So we'll begin 550 related parties. We'll begin 550 related parties. See, first of all, who is a related party? The standard says, first of all, what the standard mainly dealing with. We have an accounting standard to verify whether disclosure of related party transactions are proper or not. You have Ind AS 24, accounting standard 18, which deals with related party disclosures, where you anyhow verify accounting standard whether related party transactions are disclosed or not. Then why the standard specifically there? The standard is addressing about What if company failed to identify related party that you identified now, or you identified a new transaction that is made with related party, but company did not identify that? Two, another one. What are the fraud risk factors? What are the fraud risk factors that you need to consider when you are verifying related party transactions? We all know related party transaction is one of the major scope of opportunity where frauds can be committed. It may be fraudulent financial reporting, or it may be misappropriation of assets by the directors, whatever. Related party is the one route where fraud can be committed. That is what the standard highlights. Objective of the standard to obtain an understanding of related party transactions, to recognize fraud risk factors. The primary objective of the standard is what? Recognizing fraud risk factors through related parties. That is why SA 550 has been brought. Second, conclude whether financial statements are affected by these transactions, and whether financials are achieving fair presentation, not misleading. Evidence whether related party transactions are identified, accounted, and disclosed in the financials as per applicable financial reporting framework. This is the objective of this standard. So whether related party relationships and transactions are identified, presented, and disclosed as per applicable framework is the secondary objective of this standard. The primary objective of this standard is identifying fraud risk factors. Whether related party transactions are properly done. Is there any fraud risk factor? Like, so for that what I will do? There are the requirements under the standard. First we will do risk assessment procedure and related activities. Like, what is the risk assessment procedure and related activities? First of all, did the entity establish any process, controls to identify related party relationships, to identify related party transactions? We will understand who are the entities related party. This we will do understanding. First we will see whether entity has that process. In our risk assessment we will see whether they have a process. Two, we will try to understand whether entity has a related parties. How we will understand entity has a related parties? We have given practical questions in question bank on this. On every standard we have given good questions in question bank. Not just all past 11 attempts, 20 attempts, 15 attempts, not required. Correct questions, if you study 5 to 6 in each standard, it covers whole standard. Such a kind of questions we picked and gave it in the question bank. Getting it? Like, if at all any of you want to take that question bank, PDF is free in the website. You can download and take a print. We are not selling that question bank as a separately. We can sell it, not an issue. The printing cost is 150 rupees, courier cost is 200 rupees. And by the way, we need to pack it. That is 30 rupees for us. Packing cost. You're getting the point? So we are not, that's why we are not selling many resources separately. We always tell the students directly take a print. You'll get it 150, 200 rupees. You can take a print of the same entire question bank. It's free. PDF is free. So you can take it. So understand the related party transactions. On this there is a question in the question bank. Maintain a net list when you're reviewing the records. When you're verifying the records, in the financial statements, you have to be skeptical. You have to be alert. Are there any indication of related party transactions? Then sharing the related party information with the team if at all you identify anything. And identification assessment of risk associated with transactions. So now interpret, is there any risk involved in this transaction? Why this transaction is performed? What is the business rationale? Suppose some transactions with related parties are happened outside ordinary course of business. What are they? Give you examples. We have a question in the question bank. We have a question in the question bank. IC book is not answering all that. In your IC book, don't this diagram they gave. But they are giving an RTP, MTP, all that, so much. At least now better. They are giving this diagram. In the old scheme, this diagram also not there. In old scheme, whether 550 is there or not, also student don't know. You're getting it? And suppose what is the procedure? This is important. This is important. What if auditor identified? Here what? Auditor identified previously unidentified related party transaction. Some related party transaction is there, but company did not identify previously. They gave a list of related parties to the auditor. They gave list of transactions made with them. They gave outstanding balances with them. Everything they gave. In that list, there is one related party transaction or relationship which company failed to identify, which we identified. What auditor has to check? Auditor shall determine whether underlying circumstances confirm existence. First of all, is the transaction existing? Communicate with the team. Once again, request management to identify all the transactions with the newly identified related parties. Perform substantive procedure. Consider risk with respect to related parties. If non-disclosure by management appears intentional, evaluate the implications. You will ask management, why management failed to identify related party transaction? Why they failed to identify? Is there any deficiency in internal control? If so, it's a significant deficiency in internal control. You will have to communicate it to those charged with governance. In 540, we have seen this requirement, same requirement. If management failed to identify accounting estimate, is that the failure is because of a deficiency in control? Same, if management failed to identify related party transaction, why they failed? Which process failed so that this transaction is omitted? Are you clear? Then, suppose if you identify significant related party transactions outside normal course of business, what auditor has to do? Suppose you identify related party transactions, you are verifying, you found some related party transactions where terms and conditions are altered after transaction is completed, or where the related party was given a significant discount. You're getting it? Where the related party was given a significant discount, or a related party was given a loan where company is not charging any interest. As per articles of association, company shall charge interest. But as per that, he in this case, subsidiary company is not charging any interest. These are all examples of transactions which are outside normal course of business. If so, what is a necessity? Necessity is what they express it as what? Business rationale. What is the business rationale? Like, inspect the underlying contracts to evaluate business rationale. Look at the business. What is the need for the transaction? Why you gave that much discount? What is the necessity? Whether the terms of transactions are consistent with management's explanation, whether transactions are properly accounted. Okay, it's an outside ordinary course of business. Generally, that is what happens between related party. So whether they're accounted properly, check it out. Obtain evidence that whether they are properly authorized and approved. Every related party transaction shall be authorized and approved. In addition to it, for transactions which are outside ordinary course of business, some special approval mechanisms would have been there. See whether those approvals and all were there or not. You're clear? 188 section deals with related party transactions approval in Companies Act. 177, audit committee, if at all there in an entity, audit committee is the right party to approve the related party transactions. Then finally, the auditor shall obtain written representation. The auditor shall obtain written representation that all related party transactions are disclosed to the auditor. All the transactions are properly accounted. You should get a representation that all relationships and transactions are disclosed to the auditor. All the relationships and transactions are accounted and disclosed in financial statements. You should get two declaration. One regarding the information shown to you, two regarding the presentation in financials. Finally, the auditor shall communicate with those charged with governance any significant matters relating to related parties. Suppose you identified some transactions which are outside normal course of business. These are all the transactions happened outside normal course of business. You can communicate a list to top management. These are the transactions. You identified some previously unidentified transaction. You can communicate to the management that these related party relations are not identified by your internal controls. There is a deficiency in internal control. Please rectify. And documentation. That's it. On related party, we have some 3 to 4 questions, which are beautiful questions in question bank. You solve that in 550, any kind of question you can answer. Clear? All of you? We have given question bank. You see the index itself, you will find standard wise index. You can directly go there and then watch. Confident. Next. So with this, essay 550 is over. So 560 subsequent events. 560 subsequent events. We have an accounting standard, right? We have an accounting standard on subsequent event. Ind AS 37 we have. AS 4 we have. Events occurring balance sheet date or events occurring after reporting period. Whatever it is. See, what is this events occurring balance sheet date? Like, what is the standard says? If at all any conditions that are existing on balance sheet date, before the date of approval of the financial statements, if at all that condition turned into reality. If actual event arises, for which condition already existing on balance sheet date, that's an adjusting event which requires financial statements to be adjusted based on the prudence concept. That's the main logic. But there are some events which arise after balance sheet date altogether. Means there won't be any condition on the balance sheet date. But if they are material, they require disclosure in the financial statements. If they are material, they require disclosure in the financial statements. They are non-adjusting events. So typically adjusting and non-adjusting, if it's a non-adjusting event, if it's a material, then you need to disclose in the financials. And as a part of audit, we anyhow verify accounting standard, whether subsequent events are accounted, rectified properly or not, like whether they are accounted, adjusted, non-adjusting items adjusted, non-adjusting items which requires a disclosure disclosed. So we verify anyhow. Then why we separately have an auditing standard? If at all, anyhow we address all this. But after we sign the audit report, we got to know about few more subsequent events. After the date of audit report. But you know when these events happened? Between the same period. For example, between balance sheet date and between the date of financial statements approval. Between this period, let us assume some 20 events happened. Some 20 issues happened. Out of this, some 5 require disclosure, 15 require adjustments. 15 events, no, they require adjustment. But management identified only 10. Management identified how many? Actually 10. Number of events happened are 15. But management identified only 10. They failed to identify remaining 5. And when I am looking also, at that time also, I also got to know about these 10 items only. Whatever management identified, that only I also identified the time. And I got a representation that all the subsequent events are adjusted properly. Everything I got representation, concluded my audit. Now after the date of audit report, I got to know about these 5 more events that happened between balance sheet date and audit report date or approval date. Generally in accounting standard, they say approval date of the financials. In audit report, it is audit. In auditing standard, it is audit report. You recollect SA 700. What is the date of audit report? Date of audit report shall be on or after date of approval. 99.99% of the cases you will see audit report date is equal to approval date. 99% they keep approval. So which means you will not have a conceptual difference of subsequent event meaning between auditing standard and accounting standard. The meaning, consequence will be same, because auditors generally keep the same date of approval. So there won't be any difference. But there are some 5 events which we identified after the date of auditor report. With regard to these 5 events, what is auditor responsibility? That is why 560 is established. It is not about the remaining 10 which is already adjusted. It is not about remaining 5 which is already adjusted. What about the events if you identify after the date of audit report? What exactly auditor has to do? That is what the standard deals with. Now, this particular situation can be 2 types. Suppose 31st March is the date of financial statements. 15th June 2024 will be date of auditor's report, which itself is date of approval of the financial statements. And company is preparing to send AGM notice. The company is sending AGM notice. What is AGM notice? Notice sending means what? We send notice for what purpose? So that it's an annual, you have to come for the AGM. Along with notice, we send what else? We send financial statements, we send auditor's report, we in fact send annual report. We in fact send what? Annual report. We give time, no, 21 days time. Why generally we give 21 days time? To read entire this notice, audit report, financial statements, and so that they can attend the general meeting and take a productive decision. So to take an effective decision, we need to give them the time to read. So they read, and the AGM planned is, let us assume, 20th August 2024. This is the date of AGM. Now, you got to know about subsequent event. By the way, subsequent event happened here. Yes or no? 5 events. We don't know. Out of 15, 10 events were adjusted. But 5 events knowledge we got to know when? After the date of audit report. Yes or no? After the date of audit report, we got to know. Suppose, what if you got to know in case number 1? What if you got to know in case number 1? What is case number 1? You got to know about that event after the date of audit report, but before the date financial statements notice are issued to the public. Before the financial statements, date of AGM notice is nothing but date of issue of the financial statements. Date of issue of financial statements. So what if you got to know about subsequent event before this date but after audit report date, what to do? And standard also gives one more case. Case number 2. What auditor has to do if at all financials are already issued to the public? What if financials are already issued to the public? Now you got to know about subsequent event, what to do? Now, before AGM point, they did not highlight, but the intention of the standard is what? Before AGM date. Before AGM date. Or it may be even after AGM date also. You may have identified subsequent event even after AGM. Tell me, if you bring any subsequent event knowledge to the management after AGM date, what management generally reply? It's okay, sir, we will adjust it as a prior period item, which results in a material misstatement in opening balance. 510 procedure will apply. What will apply? 510 procedure will apply. Getting it? So exactly what is the consequence if at all auditor got to know subsequent event knowledge after date of AGM? There is nowhere given clearly. But if at all it is given, if we identify before AGM date, standard did not tell before AGM date. By the way, remember, I am just telling you for your better understanding. After financials are issued, what to do? The standard said. I am adding, what if it is before AGM date? What auditor has to do? That is, one is case 1, another one is case 2. Case 1, what they are saying is, if auditor identified any subsequent event information after the date of audit report, but before financial statements are issued, 1, discuss with the management. See whether financial statement requires amendment. If so, whether management is ready to amend. Verify whether amendment was properly made or not. If at all audit report is already given, take back and throw that. Prepare a new audit report with a new date. Are you getting it? And then give it. Now the question is, should I use an emphasis of matter paragraph for the revised financial statement? Because financials are amended, right? Financials are amended. Should I highlight that amendment? Not required. It depends upon materiality. That is your choice. It's not compulsory. It's not compulsory. Suppose if management is not ready to amend, sir, already approval and all happened, sir, we can't amend it right now, which is what generally management tells. If so, you have to take an appropriate action. That is what the standard says. What action you will take? You have a right to attend AGM, right? You have a right to talk at AGM, right? Maybe you can explain the situation to the people who are attending at AGM. That's it. Clear? This is the process. Second one. What if balance sheet, P&L, cash flow, notes, audit report, everything is issued to the public, issued to the shareholders. They're all planning to attend AGM. And now you found a subsequent event. What you have to do? Same process. Generally, after audit report is issued, we don't have any responsibility. However, if at all we came to know a fact after the date of audit report, that if at all I know this information earlier, I would have not given that report. If I know such a kind of information, first I will go and discuss with the management and those charged with the governance what we have to do it. Now I will ask them what action you are going to take so that people who already received AGM notice, financial statements, audit report were informed of the situation. The situation, how are you going to inform all of them? Are you ready to amend the financial statements? Management said, no problem, sir. Let us be fair. Let's amend once again. Management amended the financial statements. You carry out audit procedure to that amendment less. In case 1 and case 2, you are amending the financial statements, right? Let us assume you are amending somewhere the financial statements on, 10th July. Whether it is case 1 or case 2, in both the cases, management is amending. Management is amending financials. When they are amending 10th July. And again, when they are approving 10th July only, they are approving it. Now tell me, again, accounting standard shall be reapplied. Why? Because date of approval has been changed. Now date of approval means date of approval of the amended financials, correct? Earlier we only considered subsequent events up to 15th June. That was the original approval date. Now financials were changed and amended, and again approval date is given, which is 10th June, which means I must consider subsequent events that are arising up to 10th July, which is the revised amended financials, yes or no? Now there is a question in the standard, whether auditor will only apply audit procedures to the amendment alone, or will the audit procedures be extended up to the revised approval date? Amendment, of course, you will see, plus subsequent event procedures we will apply up to revised approval date. So because approval date is changed, subsequent events up to the revised approval date we need to verify. Understood? Suppose management amended the financials, everything they did, they once again forwarded to all the members, these are the amended financial statements. They clearly mention amended financial statements, amended audit report. Okay, amended financials amended, right? Now I will give a new audit report, right? What I will do, I cannot take back, audit report already went. So I should prepare a new audit report. In this I will put emphasis of matter paragraph. Why? Because people already received old financials and old audit report. Now they are receiving new financials. What change happened between old and new? Of course, company will give a statement of difference, but I will also highlight the same in the emphasis of matter paragraph. What are all the changes that were happened in the previous financials to this financials? Understood? So in the case 2, emphasis of matter paragraph will come. In case 2, emphasis of matter paragraph will arise. Understood? Suppose management said, sir, what sir, nonsense, already we gave all the documents and our people are ready to come AGM, another 5-6 days only left. For example, they said like this, if at all you feel it must be carried out, management is not listening to it, you can take appropriate action. That's what the standard says. What appropriate action? You have a right to attend AGM. See, legally, regulatorily, is it permitted for you to explain the situation? If so, do it. Else, if you don't know what to do, take a legal opinion in this case. Legal opinion means consult regional ROC, consult regional NCLT office. They will tell you. What they will tell you? Leave it, sir. Next day they'll take care. That's all they'll tell. What they will tell? Are you getting it? That's it. This is the standard. Over. You see, the same matter is there. Instead of reading it from the book, I explained each and every point. That's the only thing I did. Getting it? Every point in that standard I covered. Now, one more important topic inside this is how to identify subsequent events. Generally, how to identify subsequent events. What is the audit procedure for identification of subsequent events? This can be asked as a 4 marks question. What is the audit procedure? Audit procedure is what? First, obtain an understanding of management procedures. What management is doing to identify subsequent events? First, understand that. Inquire management whether they entered into new commitments and guarantees, whether sales and acquisitions are any planned newly, whether any assets are appropriated, compulsorily acquired by government, whether any development regarding contingencies that were existing on balance sheet date, whether any unusual accounting adjustments were made after balance sheet date. For example, company sold so many goods, after balance sheet date sales returns were there, so many unusual accounting adjustments. Whether any events occurred that bring into question appropriateness of accounting policies. Is there any other event or any indications about actual current period evidence regarding estimates? Suppose estimates company chosen, this year you have a date of claims. Getting it? So all this, one best example I'll tell you. Insurance companies, generally, suppose insurance company selling car accident insurance policies. Suppose any dent happened to car, you can lodge a claim with the insurance company. They will repair it neatly. They'll replace the part or they'll repair it. Anything they'll do to make sure that it comes into its original condition. They have to do whatever it is, whatever the amount involved. Now, 31st March itself, suppose generally, in reporting, insurance companies, they'll put a condition to the customers. You have to report the accident within 90 days. 30 days to 60 days to 90 days. Depends on the company to company. Most of the companies accept even if it is up to 90 days. Because I have to report them. When accident happened exactly, suppose I'm going, auto wala hit the car, for example. Front bumper, back bumper, lights and all damaged, for example. Will the company has any assessment technique when exactly it happened? No, they don't know. So I will go and give the car and say, recently only it happened. They have to honor it. They have to honor entire whatever repair cost is that they have to bear it. So they have to bear it. Now, as on 31st March, what are all accident happens to their customers where they sold insurance policies? Will the insurance company have a data? Will the insurance company have a data? But no, they will not have. Unless customer complained me, I will not have. Customer will report me in April month or May month. With respect to the accident he met with March. Small tile lamp damaged, I am in somewhere, I will cancel my trip and come back and report insurance company. No, I will use the car, it is usable condition only, no problem. Getting it? After I coming back, I will report insurance company. As a customer, do I know subsequent event knowledge? I don't know. I will come and report to insurance company in April or May month. But insurance companies have to create provision based upon historical data available by taking actuaries' help on claims incurred but not reported. What is it? Claims incurred but not reported. As on 31st, for sure, insurance company has to bear some damage. Claim is incurred, but customer not yet reported. Now for this, should a company create a provision or not? So they created a provision. In the month of April and May, so many damages were reported. And the amount of settlement is so high. To that extent, proportionate provision should be reversed. Actual provision should be recognized. Correct? That is what the meaning of, any events occurred or likely to be occurred, all that. Here accounting policy is what? They will create provision for claims incurred based on actual policy. That's the policy which the company is following. Now, actual event will affect this policy, right? Yes or no? Whatever the policy was affected by the actual event knowledge. So based on that, the company has to revise. This is one example of how a subsequent event works. And you know very well many other examples. Debtor became insolvent. Yes or no? Conditions exist. Legal court. Some cases pending on 31st March. Later it was settled at a different higher amount. For example, yes or no? That's it. Read the minutes of the company. Read the latest interim financial report if at all available. By reading all this, you will have a knowledge of subsequent events. That's it. 560 standard is completely over. Okay. Yeah. So let's begin the next standard, that is 580. Written representations. Written representations. See, if you observe, the standard says, actual original, if you see the entire standard is there only in CA Inter. And recently May 24 exam, there is a question which is asked, which is not there in the CA final book, it is there only in the CA Inter book. But that question was previously listed in some RTP or MTP. Getting it? And in this illustration, below 580, they have given an illustration. Inside that one para is there. That provision is being addressed. Based on that, they gave a question in the recent May 24 exam. Like, first of all, what the standard says regarding written representation. The standard classifies representations into totally 3 categories. The standard classifies into 3 categories. One, you must get representation. You must get written representation regarding fulfillment of responsibilities of management. Fulfillment of responsibilities of management regarding financial statements as per applicable financial reporting framework. 1. Regarding financial statements prepared in accordance with applicable financial reporting framework. Another representation from management regarding fulfillment of responsibilities, regarding completeness of information disclosed to the auditor. Disclosed to the auditor. The auditor shall obtain a written representation from the management regarding 2 responsibilities fulfillment. 1. Completeness of information disclosed to the auditor. Completeness of information disclosed to the auditor. 2. Whether financial statements are prepared as per applicable framework. Yes, we fulfilled management responsibilities relating to preparation and presentation of financials as per applicable framework. We fulfilled. We fulfilled the responsibility of providing complete information to the auditor which is relevant for the auditor. We fulfilled that responsibility. Like this, management should give one important representation. This is what we generally call it as MRL. This is what we call it as what? Management representation letter on fulfillment of responsibilities of management. This MRL shall be obtained as near as practicable to audit report date. This MRL shall be obtained as near as practicable to audit report date, but not later than the audit report date. But not later than audit report. This is one representation you must obtain. Another representation you must obtain what? When there is a requirement under other standards on auditing. The auditor shall ask written representation when there is a requirement under other standards on auditing. For example, 240, you need to ask a representation that management is responsible for internal control. You need to get a representation that all identified frauds and suspected frauds are disclosed to the auditor. All allegations are disclosed to the auditor. Like that, under 240 we should get representation. Under 560 we should get representation that knowledge of all subsequent events are adjusted and disclosed to the auditor. We should get another representation under 550 whether all the related party transactions are accounted and disclosed. That the company has to give a representation. You should get a representation on litigations and claims, whether the impact of all pending litigations are disclosed to the auditor or not. Company has to give a declaration, yes or no. There are various standards on auditing that requires the auditor to obtain representation on various matters. In those cases also auditor should obtain, correct? Any other case, third scenario, any other case where auditor feels necessary. Where auditor feels necessary. Any other scenario where auditor feels necessary, their auditor can obtain representation. These are the three cases. Now the main confusion is, first of all, what is a representation? What is a written representation? Suppose I verified legal expenses. I spoke to internal lawyers. I spoke to external lawyers. I verified fines and penalties payments. I tried to identify indicators of non-compliances with laws that results in litigations and claims. I did all the procedure and I identified what are all laws and regulations, what are all non-compliances, what are all litigations and claims and all is there in the entity. Whether they disclose it in the financials also I verified. They are all verified. I documented and gave the audit report. Later it was discovered that some material litigations were not available to the auditor's knowledge. When they investigated, the management told, why you didn't disclose? Management said some reply. Why you didn't disclose to auditor then? You have a duty to disclose the auditor complete information, right? Management, while saying, they blamed the auditor saying, he never interacted with us. He will come do audit on his own. He will not talk to anybody. He will verify some records. He will go through this and he finally gave a report and left. He never interacted with us. This is a complaint which management gave, for example. Why? Because, see, that's why, if at all, you do entire audit process. No matter you do in-depth audit, unless management gives you the full data. Tell me, is it easy for you to find all the information, or will management have all the information? Which is easy for them? Which is easy? Like among these two, it's easy for the management. In fact, you try your best to identify litigations, to identify pending cases against the company, which company did not disclose. You try your best. Finally, before you decide, take a declaration from the management that except these which you identified, except which company already disclosed to you, is there any other litigation? You once again ask them. You did your best. You ask once again the company whether do they have any other knowledge of pending cases against the company. They said no. Give me declaration. Give me declaration. Tomorrow, I can prove to the lawmaker that, I can prove to the regulatory that I did my duty and I also interacted with you and I unconfirmed in every dimension possible I verified. Written representation, you see here, it is only supporting in nature. Directly on day one itself, I can ask a representation, right? Dear management, I am the auditor for the company. Whether financials are true and fair. They said true and fair. Since you said true and fair, I will give unqualified opinion. Can I? Written representation is not sufficient appropriate evidence. Written representation is only corroborative in nature. It is only supporting in nature. Written representation provides necessary information for the auditor, which may be supportive or corroborative or confirmative in nature. They are not main source of evidence. They are not main source of audit evidence, but they are also audit evidence. They are also audit evidence, but they are not main source. Understood? Look at written representation is nothing but a statement provided by management to auditor for to confirm matters, to support other audit evidence. You see, written representations are confirming in nature, supporting in nature, which means auditor already has some information, which means auditor has obtained that information through audit procedure. Written representation is never a substitute for the audit procedures which auditor is performing. Written representation, can we use it as evidence, by the way? Yes, you can use it, but they alone do not provide sufficient appropriate evidence on their own. Just like a response to inquiry, if you are asking inquiry, you are getting information. Just like how you get information, through representation also you get information. That's an evidence, but that cannot be sufficient and appropriate audit evidence. That is only supportive in nature. Clear? Next. So the objective of the standard, in this objective of the standard is also important for 4 marks question. The objective of the standard is what? Auditor has to obtain representation from management that they believe that they have fulfilled their responsibilities for preparation of financials and for the completeness of information provided to auditor. And another one, written representations are obtained by auditor when there is a requirement by other standards in auditing, or written representations are obtained by auditor to support other audit evidence if auditor determined necessary. So 3 circumstances: fulfillment of responsibilities for financials and completeness of information provided to the auditor, requirement under other standards on auditing if auditor determines necessary to get information from the management that supports other audit evidence. So then auditor will get representation. So get representation in all these cases and respond appropriately for the representation they provided. Now they gave the representation. How do we respond? We see we read the representation, whether it is sufficient or not. If at all the representation is not sufficient, we will ask them to give sufficient representation. Are you clear? Next, what should be the date and period covered? The date of representation shall be as near as practicable to date of audit report, but not later the audit report date. Written representation must be for all the periods covered in the audit report. Whatever period for which you are doing audit, for that period only you should ask representation. Correct? All of you? Now, written representation from whom? From generally the management person, whoever is dealing with that area. Sometimes if that representation may not be sufficient, you may ask a higher authority to confirm the same. Written representation from whom? This is one. This itself can be asked as a separate question. Written representation should be obtained only from the knowledgeable party. In your knowledge, in your point of view, who has that knowledge, only he should give you the representation. Correct? Then, suppose if there is a doubt. Suppose if there is a doubt about representation, doubt about reliability of the representation. Auditor has to try to obtain evidence through alternative procedure. If at all written representation is unreliable or written representation is not provided by the management, it's a limitation on information, limitation on evidence, limitation on scope. The auditor can give a modified opinion. The auditor can give a modified opinion for not able to obtain representation. Now, if representation is not provided, discuss with the next level higher management. Reevaluate integrity. What is their integrity once again? Because I thought all these days they are giving me cooperating with all that. Now suddenly they said no. So are they honest people? So reevaluate the integrity. Take action as per 705. General we express if it is so sensitive, disclaimer of opinion. But remember, whenever a situation comes for you to give a disclaimer of opinion, you cannot straight away give disclaimer. You have to withdraw from audit if possible. If withdrawal is not permitted, you have to give disclaimer of opinion, then you will give that opinion. Correct? Now in exam, they asked this question. No, I think it is not here. It is there in the question bank. In our question bank, we have that. Like for example, I'll show you where you can download this question bank. So you can just open my website, rest of a CA website. So inside that PDF resources, CA final is there. So CA final is there. Inside that you will easily find. Below itself, like edition 2025 materials were there. So below that question bank that you download, It's absolutely relevant for November attempt, no problem at all. Getting it? Audit syllabus is same for the next 2 years. It won't be have any change at all, unless in professional ethics CA Act modified. Except that there is no other possible changes in the audit subject, except maybe some new standards like 800 series and 2000 series. Some revision has happened. If at all they say that is applicable for May exam through a supplementary material, then only it is applicable. Otherwise, don't. If some of you, if another friend or any friend of you brings some revised standard, revised modified report, something they came and showed you, is this applicable for exam? Don't be with the blind, like blind, dumb, kind of dumb. Don't behave. Very simple. Is it covered in the supplementary material? Ask him. Answer over. If it is covered in supplementary material, it is applicable. If it is not, it is not applicable. As simple as such. Clear? Last time, February month only 800 series came. Exact 5 student is applicable for May. I told no, for you only applicable, I said. Too much. Can't even apply common sense sometimes. Now, in the recent exam, what they asked is, I will give you that, I will show you that question for your better understanding. Yes, in this you see this representation. This is the question which is asked. 580 question, 5 marks question. N is carrying out an audit of restated financial statements of BQR for past 3 years. 23, 24, 22, 23, 21, 22 for submission to SEBI because of the upcoming IPO. Under SEBI, they are giving restated financial statements. They are submitting some restated financial statements. CAN is planning to issue an audit report on 5th August 2024 covering these restated financial statements. Before issuing the report, N requested MRL from the management of the company for this assignment. The management of the company provided representation letter dated 1st April covering 23-24 only, but not covering 22-23, 21-22. Now, as they were not in a position to provide for these years because they were not in place during that period, how would N deal with the above situation as per this standard? This is a straight CA inter question, which is asked in CA final May 24 exam, which is there for you in the previous MTPs, RTPs, somewhere it is there. But if you blindly read without understanding the link, there is no point. You will never remember that. Some students I notice, they only read question bank. They won't study any subject, nothing. You read question bank without any structure. You are reading question bank without any structure. As if you are taking a bike without reading any signboards, name boards. You are figuring out to find area. Like, if you take a bike and go to each and every street, each and every area, you will never understand. You will have to see, you will have to analyze what is this area, what is that area, what are the routes available. So you need to study like this. Like if you study from the concept book only, you will get that clarity. Concept book, from the concept book, you should link question bank. That's how you should revise question bank. Only question bank if you study, you will not. You may immediately say, sir, my friend qualified at this method. Lottery method that is. Getting the point? Lottery will work. Out of 100, for 5 it will work. For many 95 it will not work. So follow the right process, not the lottery method. I'm not saying if you follow wrong method you will fail. I'm saying probability for failure is high. This route probability of success is high. Which probability factor you will use, that is your choice. Which route of probability you will go, that is your choice. Next. So you see in this the answer. So they gave written representations. First they described the issue. Now you see like how to present these answers. This is one common question. How to present the answer? Generally the accepted presentation is first you write the relevant discussion under the standard. First you write relevant discussion under standard. Relevant discussion under standard means what exactly the standard is dealing with. Now in the given case, the auditor, the auditor's opinion cannot be expressed and audit report cannot be dated before the date of representation. And the auditor is concerned with events occurring up to date of audit report that may require adjustments or whatever it is. This is a relevant matter. In some circumstances, it is appropriate for the auditor to obtain written representation about specific assertion in the financials So they will request representation. They will request representation. Situation may arise. This is what the question exactly they tested. Where current management were not present for all the period referred in audit report, such persons may say that they are not in a position to provide representation for all the period because they were not in place during that period. This fact does not diminish that person responsibility. What does it mean? If you are not there, that doesn't mean you are not exempted. You are now signing restated balance sheet, restated P&L for submission to SEBI, right? Which includes all the 3 years, right? You are accepting authority, right? That one I'm asking you. Are you getting it? If you are accepting a responsibility for the financial statements, why can't you give representation for the financial statement? So the person's argument that they were not present in the previous periods for which the information, for which representation I'm asking, that's not a valid basis. The standard specifically says, for example, no, we all know financial statements approval, authentication of financials must be by 2 directors. One among should be managing director. It must be by CEO and it must be by CFO. Company secretary also should sign if at all they're available. Correct? These are the people who should sign the financial statements. Suppose they are coming and arguing, I was recently appointed as a CEO. Old CEO gone already. Our CFO is not there. Director is not there. So how do I know all this? Can the director say I cannot sign? As per the law, you are the director right now. You should sign it. If you don't know the information in this, get to know about it and then sign it. That's your responsibility. Are you getting it? So this is what accordingly the requirement of the auditor to request representation that cover whole of the period still applies. Therefore, CAN should take representation from the management for these years also. In case if management does not provide representation, reevaluate the integrity and take appropriate action as per 705. You see, like how cleverly the argument is presented. If you write this matter, if you write in this question this matter and this particular matter, this particular issue, that is more than enough. That is more than enough. For 5 marks, that is enough. In this, no, some points may not have. For suppose 560 discussion is there, it will not have any weightage. It may not have any weightage. Even if it is a half mark weightage would have been given for that. The main weightage will be given for this one. Why written representation must be near to the date of audit report? Logic. So that all the subsequent events up to the date of audit report also they considered or not, they need to give, right? For that reason, we always will take representation up to date of audit report, up to the date of audit report, nearest date we will take, so that management, whether they fulfilled all the responsibilities for financial statements, which includes subsequent event related responsibility fulfilled or not, we will know. If at all representation is taken on 10th April, we are giving audit report on July. What about this period? Did they consider subsequent events? Up to 15th April, whatever is it, they said they considered. What about this period? That's why written representation must be obtained as near as practicable to audit report date. That discussion only they gave here. You are clear, all of you? So this is there in the past RTP MTP. In our question bank, the answer is there for this. This question is there in our question bank. Just I will show you this. This is P3. In this, no, you can see question bank is there, right? You can see in this standard wise we gave, wherever standards are applicable, we give standard wise questions. Some 267 page, I guess. So we have given standard wise important questions. Sometimes some of them might get repeated, so you can ignore, that's not an issue. Yeah, this is 580. Yes, you see here. Here we have discussed the provision. A situation may arise where current management were not present during all the period. Such person may assert that they are not in a position. Accordingly, requirement of the auditor to request from them written representation for whole the relevant period still applies. This was there in RTP 2019 May CA final. But if you directly open a question bank and read all this, no, you may not, it may not strike in exam suddenly. You read along with standard this provision, it will strike. So that's why when you're reading a standard, immediately the standard related question bank you should practice. And if any additional concept is there in that question bank, any additional question tested from pronouncement somewhere they took, that you should immediately note down below the standard. When you're revising, you should revise that also. Whenever you're revising standards, you should revise additional concepts you identified in question bank that are dealing with this standard. Never ignore the standard altogether and read only question bank. You will never get that command. You will never get that command on the subject. Read always the standard, then how questions can come in the exam, read those questions. Clear? All of you? That's it, 5/8 is over. Confident? Yes. Yeah, shall we? You know, in 530, there are 3 standards which are highly interlinked. 530, 450, 320. 530, 450, 320. Just to make you understand the terminology of 530, I'll give you certain terms. Misstatement word, you know. Yes. Misstatement, risk of misstatement, tolerable misstatement, expected misstatement, projected misstatement, undetected misstatement, uncorrected misstatement. There are seven or 8 where for a word misstatement the prefix is different. Unless you understand the meaning of all these words and their context, you cannot understand 530. What is the misstatement? What is a projected misstatement? What is a tolerable misstatement? What is an expected misstatement? What is risk of misstatement, undetected misstatement, uncorrected misstatement, corrected misstatement. 8 words totally. These are the words generally used in across all the standards. Any of these words. If you recollect 450 standard, evaluation of misstatements identified by the auditor means misstatements are identified by you. But there will be so many mistakes which you have not identified, which you projected. The projection is called as projected misstatement. How will I project a mistake? Based on sampling result. In the sample, if I find, 2 more, anomalous misstatement, non-anomalous misstatement. Total 10 words. Yeah, exactly 10 words. Anomalous misstatement, non-anomalous misstatement. Totally 10 words. Misstatement, with that if you start, total 10 words will be there. Up to anomalous and non-anomalous misstatement. So, within the sampling standard itself, all these words are used. 10 varieties of misstatements. Like it's not varieties of misstatements, sorry. 10 context of misstatements. 10 different context of misstatements. So, what is audit sampling? Okay, let's discuss from bottom to top. What is audit sampling? Applying audit procedure to less than 100% of the items in the population. Correct? What is audit sampling? Is applying audit procedures to less than 100% of the items in the population. Like what is the objective of sampling? Audit sampling provides the auditor with a reasonable assurance that the conclusions drawn from the sample are appropriate to draw conclusions on the population. Based on conclusions drawn in the sample, you can derive conclusions on the population. For that, you should select a right amount of right sample. You should select a right sampling where sampling risk is low. Again, in the risk word, no, we have so many types of risk: engagement risk, audit risk, sampling risk, non-sampling risk, detection risk, inherent risk, control risk. Various risk context. So you have to reduce sampling risk. What is reducing sampling risk? Nothing but ensuring your sample selection process is representative of population. Like in population, so many characteristics were there: high value items, medium value items, low value items. So many items were there, so many expenses were there in the population. Your sample should cover all characteristics of the population. Your sample should cover all characteristics of the population. In such a way your sample should be. The sample should cover all the characteristics of the population. Then only conclusions drawn based on the sample will match with the population. What is sampling risk? You know, the possibility that conclusions drawn by the auditor based on sample differs from the conclusions drawn on the populations, if at all population is audited, which generally we don't. That is sampling risk. Again, sampling risk has various reasons, because we verify controls on a random basis, we verify transactions on a random basis, we don't verify 100%. Based on verifying transactions on a random basis, either we may conclude over reliance on the control, under reliance on the control, anything can happen, or we may incorrectly accept the population as correct, or we incorrectly reject the population as wrong. Based on the sample, suppose I found in sample only mistakes, I found so many mistakes, but the point is mistakes are there only in the sample, not in the population. In the rest of the population, mistakes are not there. Bad luck, you selected all the vouchers which contains only mistakes. Technically in population there are no mistakes, but I don't know that fact. Since the sample I selected contain mistakes, I assume population is also misstated. So I give which opinion on the population. I conclude what? Population is materially misstated. Purchases are materially misstated, I conclude. Correct? Now, when you're doing sampling, whenever you find any misstatement in a sample, before, like the standard says, first you should project it. Within 100 items a sample, you found this much value of the mistake. How much is the value of the mistake in the population? That is called extrapolation. That is called as projection. That is called as what? Projection or extrapolation. How much is the mistake in the population? If I have to extrapolate, if I have to project, what is the characteristics of this mistake I need to analyze? Suppose if the mistake which I identified, I classified as anomaly. Anomaly means what? This is a mistake which is non-repetitive in nature. This is a mistake which is non-repetitive, means this mistake is there only in that item. That will not be there in some population. Generally this is not repetitive. This is some human mistake, clerical mistake. Clerical mistakes are generally anomalies. Suppose if the mistake is happened because of a loophole in the software. Now tell me, every transaction processed through that software will contain mistake. These mistakes are repetitive in nature. These mistakes are called as non-anomaly. Can I project them? Suppose out of 100 sample, one I found. Out of 10,000, how many? Yes, we can project it. So, when you find any misstatement, when you identify any misstatement in a sample, that mistake which you identified, not yet corrected by the management, is called as uncorrected misstatement. That mistake nature is anomaly or non-anomaly, you should decide. If the mistake is non-anomaly, project it to the population to get a projected misstatement value. Now when I am projecting anomalous misstatement, should I exclude it? When I am projecting it, any mistake which I identified as anomaly, that mistake I should keep it aside. That is not eligible for projection. Now I projected mistakes. Now projected mistake is there, right? Is that mistake I detected or not detected? Not detected. The projected misstatement is not detected. That is called undetected misstatement. That is called as what? Undetected misstatement. Now, what is the total misstatement in the population? Projected misstatement plus anomalous misstatement is equal to total misstatement. That is how auditor can take a best estimate of misstatement. What is the best estimate of misstatement? Projected misstatement plus anomalous misstatement, both together will be the total mistake. Now immediately you might get it out. Sir, we never projected like this in articles and all. Because 99.99% of the cases, the mistakes you identify are anomaly in nature. They are anomaly in nature. Anomaly means what? They won't repeat. They're all clerical, human errors. They won't repeat. Just because sample mistake is there, population also this much proportionate mistake is there, I can't analyze like that. Most of the mistakes are anomaly in nature. That's why projection concept is not that popular. But theoretically it is important. So this is what exactly happens in sampling process. This is what exactly happens in sampling. Now, like in samples, total sample, what are the stages involved? 1, deciding the population. 2, determining the sample selection process. 3, selecting the sample in an unbiased way, so that every item in the population will have a chance of selection. Now, when you are selecting sample, are there any methods available? Okay, are there any methods available? Are there any methods available for selecting the sample? Yes, there are so many methods. Each method is useful. Each method has its own, characteristics. It has its own characteristics. So, method we will select depending upon the type of population that we are evaluating. The method we will select depending upon type of population we are evaluating. So, that is sample selection method. Then determining sample size. How many samples should we select? It depends upon the risk involved. It depends upon the expected misstatement that you are expecting. It depends upon tolerable misstatement. There are so many factors. Whether a sample size, when you are performing test of details, what should be the sample size? First of all, common sense, it must be sufficient to reduce sampling risk. Just by taking 5 vouchers, can I say population is true and fair? No, you should verify that many number of samples until you get a confidence. How many? It depends upon various factors. Risk you assessed, tolerable misstatement, risk of, expected misstatement, all these factors were there. So once you selected the determined sample size, draw sample, verify sample, you will find some misstatements, you will find something from that conclusion, form a conclusion on the sample, forming conclusion on the population. Now, if at all you found any mistake, you will project it. If it is non-anomaly in nature, you will project it. This is how entire sampling process happens. For all of this entire process, sub-processes were there. For all of that, you have questions in SA 530. So like you see here also they say a similar thing. Sample design, sample size and sample selection. They may ask you this question, write about sample design, sample size and sample selection. When designing the sample, the auditor shall consider purpose of the audit and characteristics of the population. If the population is heterogeneous, multiple varieties are there, I will follow stratified random sampling. If the population is homogeneous, all are similar items, similar amounts, I can follow simple random sampling. Simple random sampling or stratified random sampling, simply speaking, statistical methods, these are all. Where we use random tables. Nowadays, random numbers are generated using Excel itself. RAND between, you can just type in Excel, you will find the random numbers. You can easily, unbiased selection. Numbers will be unbiased. Voucher numbers you can select like this. And the auditor decides sample size sufficient to reduce sampling risk to an acceptable level. The auditor shall select the items so that each item will have a chance of selection. The selection process should be ensured that every item will have a chance of selection. Means random sampling methods you must apply. Then finally, whatever the sample you selected, you perform audit procedures. Each item, whatever is selected, you verify, you perform audit procedures. The audit procedure is not applicable on selected item, perform it on a replacement item. There is some discussion like this which you will understand only when you go with the CA interbook. That's an in-depth discussion. If auditor is unable to apply procedure to a selected item, treat that item as a deviation. In case of test of controls, misstatement. Suppose I am unable to verify my procedure on a particular sample, it's because either information is not available or because the item is wrong. Any of this reason only, I cannot perform the audit. I cannot verify the same as per my policy. Then I will treat it either as a misstatement or a deviation in case of control. Then The auditor shall investigate the deviation, shall investigate the misstatements identified and evaluate its possible. What is the mistake? Investigate. Is it anomaly or non-anomaly? If so, when a deviation misstatement is considered as anomaly, the auditor shall perform procedures for getting high degree of, like evidence. For test of details, auditor shall project misstatements found in sample to population. We will apply projection only for what? Non-anomalies. Yes or no? The auditor shall evaluate the result of sample, whether the sampling has provided reasonable basis. Finally, whatever the result of sample you concluded, is it reasonable for the auditor to form an opinion or not? This entirely is given as a small diagram, but which is close to 12-13 pages chapter. This itself is a 12-13 pages topic. If at all you want to have a brief, deep in-depth idea, I just gave a brief idea to make you understand how much concept is there in sampling. As I already told, see enter this videos you can watch for 5:30. Clear all of you? That's it. 5:30 is also over. With this, all the standards on auditing we covered. And if you recollect, we did not cover these one. Like what are they? 200, 210, 230 and 450, 330 we are not covering. And 520. That's it. Even 600 I explained, no? Yes or no? And coming to 300 and 315, I am covering in the upcoming chapters, risk assessment and audit strategy. Technically, we completed 50 marks portion, 50. Okay, that's it. Yeah, we'll meet tomorrow. Yeah, wind up.